Alright guys, my name is Chevron. In this video, I'm going to be ranking every single stock in the S&P 500. Now, the S&P 500, for those of you who don't know, is an index fund that covers all the companies in the Fortune 500, which are the top 500 companies that are publicly traded in the US. And of course, all the usual suspects are there, your Apples, your Amazons, your Googles, etc. All the biggest stocks that everyone knows and loves, and a lot smaller stocks that you've probably never heard of before because there's 500 companies here. I'm sure there are some that you are not familiar with. We're going to go through all of them. We're going to go through them one by one, and we're going to discuss what each company does. We're going to take a look at some of the data, some of the charts, some of the graphs, some of the numbers. We're going to discuss, are there any news that we need to be aware of, and any other thoughts or opinions I have about each of these stocks. I'm going to share them with you. But before we get into all of that, I do need to put this disclaimer out there, and that is that this is not financial advice. In fact, I'm simply sharing my own personal opinions about these stocks with you, and I'm going to be ranking them based on how likely I am personally to invest into these stocks. Now, that doesn't necessarily have to be the same for you. I mean, depending on your financial situation, your age, your risk tolerance, and a lot of other factors, some other stocks might be a better investment opportunity for you than others, or some different types of investments might be better opportunities for you. I would highly recommend you use this video as a learning opportunity so you can learn more about each stock, maybe get a different perspective or different opinion about things. But before you invest, I highly recommend you either do your own research or you sit down with a financial professional who can help you discover what is exactly the best strategy for you specifically. Also, on top of that, by the time you watch this video, some of the numbers might be slightly outdated. Some of the stocks might have gone up or down since I recorded this video. So also keep that in mind. Some of these numbers might change just because they are a certain way as I'm recording this. Doesn't necessarily mean it's going to be by the time you watch it. So definitely make sure to do your own research as well so you have all the up-to-date information. But now with all that said, let's get right into it because there is 500 companies. There's going to be a hell of a lot of things that we need to go over. It's going to be a hell of a long video. But don't worry, I'm going to be leaving timestamps down below for each of the stocks individually. I don't know if I can do it for all 500 because I don't know how many timestamps YouTube even allows. But I'll do as many as possible. If I can't do all 500, maybe I'll bunch a couple together. You should be able to see if you scroll down below. But let's get right into it with NVIDIA. Now, NVIDIA obviously has grown a lot in the recent years, and we're going to go over here and we're going to take a look at some of the numbers. Of course, everyone knows NVIDIA is the greatest GPU manufacturer in the face of the world. It's grown tremendously because of the AI boom, and that's part of the reason I'm a little bit hesitant to perhaps invest a lot into NVIDIA right now. There's the worries of the AI bubble and all those things, but also on top of that, it's just grown so much in the recent years. It is down a little bit since the previous highest point, so it went up to 210 almost. It's a little bit down from there, but besides that, NVIDIA is just so uniquely positioned to be able to spearhead AI development for the next couple of years. They are just so uniquely positioned to be able to sell to so many different companies for the foreseeable future. They almost have a monopoly on this thing. The only worry is in the short term because, they've grown so much. And if there's any sort of an AI bubble and if there's any sort of a correction, NVIDIA would be taking one of the biggest hits out of all of them, right? So for the short term, I'm not so sure about NVIDIA. That's probably some of the reason why I'm a little hesitant to invest into NVIDIA. But let's also take a look at the numbers. And these are the two things that we're going to be taking a look at a lot going forward with all these stocks. We have PE trailing and PE forward. Now, PE trailing, this is price per earnings per share. And trailing means for the past 12 months, whereas forward means what the market expects for the next 12 months. Now, you do want this number to be on the lower side because that means that the earnings are higher, right? Remember, we have price over earnings, right? So the smaller this number is, the higher the earning is according to the price that you're paying for that individual stock. Now, for the past 12 months, it was perceived to be around 46, whereas for the next 12 months, it's perceived to be around 24. Now, usually when this goes lower from the past 12 months to the next 12 months, that means that the market expects the earnings to be higher, at least for the same price. So what do I think of NVIDIA overall? I do like it. Obviously, it's a growth stock. It's a very high risk, high reward type of growth stock. Over the long term, I think it's a good investment. Over the short term, I'm not too sure. So I'm going to be putting it somewhere around maybe a low A because, again, I really do believe in it over the long term. I think it's just so uniquely well positioned. It's so key to AI development. that I really do think if you invest for like, let's say 10 plus years, I think you're going to be doing just okay. My personal opinion on it. But for the short term, I'm a little bit hesitant. I'm not sure how it's going to be performing in the next year or two. If there is any sort of correction, it's going to definitely be hitting NVIDIA for sure. So I'm going to be putting it not an S, not even a high A. I'll put it a low A, if that makes sense. Next up, we have Apple. So let's take a look at Apple's numbers. Now, right now, Apple is going for just over $278 per share. The P trailing and P forward, it does seem to indicate that the earnings are going to be going up in the next year, at least as perceived by the market. Now, again, looking over here at Apple, it's pretty close to its all-time high. Again, is this a sign of things to come? Is this an AI bubble type of thing? I don't really think so. I mean, Apple has been not really even jumping on the AI hype train as much as the other ones. So perhaps if there is an AI correction, maybe Apple will be the least affected by it because, I mean, they've been trailing quite a bit in AI, and still despite that, I mean, they're doing so well. So Apple, I do like Apple. I don't think it's as big of an issue as NVIDIA, at least in the short term. Long term, I'm a bit more skeptical with Apple because for the longest time, I mean, they had such a monopoly with the iPhones and all those sorts of things. It doesn't seem like they're innovating as much as they were before. So putting aside the numbers, just looking at the big picture, where do you see Apple in 10 years? Do you think they're still going to be one of the biggest players as they have been over the past 10 years? It's tough to see. I mean, they're not really getting involved with AI as much. The Apple Intelligence thing has been pretty much a failure so far. I don't know if they're going to be innovating as much with their products. Apple Vision hasn't really blown the lid out of anything. So I don't really know. I don't really see it. They're still a very good company, so it's tough for me to put them too far down. I just don't think they're an S type of company, even though they still are the second largest company. I'm going to be putting it somewhere around NVIDIA, but for different reasons. For NVIDIA, I think for the long term, they're very promising. Short term, a bit dicey. Apple, I think short term will actually be okay. Long term, not so sure. Next up, we have Microsoft. And Microsoft has come down a little bit recently, but let's put that aside for now. Let's take a look at the fundamentals. The price per earnings per share for the past 12 months, 35. Going forward, it's about 26. So again, market expects the earnings to be higher, which is always a good sign. But again, just looking at the numbers over here. Right here, you can see that it hit an all-time high right at the end of July at 554. And again, at the end of October, it hit 551. But again, it's so far down to 478 as of this moment. So it does seem to be going up and down a little bit. It does seem to be volatile a little bit more than some of the other companies we've looked at. But again, Microsoft, I really like Microsoft for several reasons. I mean, the fundamental numbers are good. What I really like about Microsoft as an investment for the long term is that unlike Apple, they do have a lot of room to grow and improve. They can solidify themselves in the marketplace. They have the deal with OpenAI. They definitely have a very good opportunity to catch up. I mean, they've been able to catch up with the other tech giants in the recent years, in some part because of their involvements with AI, but also because of Azure. I mean, Azure has been so profitable for them because, again, similar to AWS, they're able to rent out servers to all sorts of websites and all sorts of clientele. I do like Microsoft a lot. And again, as far as, Windows and all those sorts of things, I think they do have the opportunity to gain even more of a foothold in those markets. They have the opportunity to catch up maybe a little bit on the likes of Apple. So I really like Microsoft as an option. I do think it's slightly better of an investment than Apple and NVIDIA. But again, in the short term, I'm a little bit hesitant, again, for the same AI bubble reasons. So again, even though the numbers look good, even though we anticipate there to be a better rate of earnings per share, according to the price for the next 12 months, again, it's not as big a difference as we saw with NVIDIA or with Apple. So I'll rank them around the same area. Maybe I'll put Microsoft a little bit higher than NVIDIA and then maybe Apple right there. Now, before we get into the next one, if you're enjoying this video, do me a favor and smash the like button down below for the YouTube algorithm. And also, if you're not subscribed to the channel, make sure you smash the subscribe button down below so you can see all my new videos right as they come out. I'm going to be doing a lot more videos like this where I'm going to be ranking a bunch of different index funds or stocks and etc. So you don't want to miss out on any of those. Make sure you're subscribed to the channel. Next up, we have Amazon. So let's go over here and take a look at Amazon's numbers. Now, Amazon hit an all-time high just in the beginning of November, so just a little over a month ago at 253, but right now it's offered at 231. So it's a little bit further down from its all-time high, just a little over a month ago. So is that, again, the AI bubble sort of thing? Perhaps. I'm sure all the tech companies that we take a look at, there's some volatility going on right there. But again, let's take a look at the numbers. The numbers look good. Again, the earnings per share, according to the price of the stock, is expected to be a little bit better going forward. And again, you can just see the actual earnings per share over here. It's expected to be maybe about 10% higher going forward in the next year. So again, it looks fine to me. Again, the only worry with Amazon, similar to the other companies, is if there's some sort of a tech correction. But I don't think it's going to be affecting Amazon as much, because Amazon, again, is not as reliant on AI for development and all sorts of things. And of course, AWS is a huge part of Amazon's business. The Amazon website is a huge part of the business. So they have a lot of different avenues where they're doing okay. So I actually like Amazon perhaps slightly better than all those other tech companies. Now, the earnings per share going up for the next year isn't as big as the market expects for Apple, NVIDIA, Microsoft, all those companies. But I do think Amazon is a little bit more shielded against any sort of correction because of an AI bubble. So for that reason, I'll probably put Amazon as our first S. Now, I reserve the right to change this list as we go through. If S is super crowded, maybe I'll drop Amazon down, because I'm not like over the moon about Amazon either. But I do think it's quite a bit better than all these other companies, at least right now. So for now, we're gonna put it in S, but we'll see how it goes with the next ones. Next up, we have Alphabet, which is the parent company of Google. Now, there are two separate stocks that you can buy. And, as you can see, they're ranked 5th and 7th by market cap. This is Class A and Class C. So the difference between these two is one of them is a voting share and one of them is a non-voting share. So really, they're just the same. It really doesn't make that big a difference. So we don't have to worry about that for the purposes of this video. Now, Google is a little less volatile than some of the other 10 companies that we've taken a look at. There are small ups and downs, but for the most part, it's been a smooth ride up for almost the entirety of 2025. I mean, there was a little down from the beginning of 2025 until like mid-March, and then around April, it just shot up just like that, right? So again, you want to be a little bit more pessimistic when it's so far high and it's been going up smooth sailings, and particularly for Google, which is so reliant on AI, maybe perhaps we need to be a little bit more cautious. Of course, Google has been doing a great job catching up to OpenAI and making sure that Gemini is basically absolutely destroying all the competition. And that's part of the reason why they're doing so well. Can they keep it up though? Let's take a look at the rest of the numbers. So again, the earnings per share are expected to be higher over the next year than it was over the past year. The PE trailing, again, is larger than PE forward. Good sign. So the market does expect there to be a higher amount of earnings over the next year, and it's a little over 10% that is expected to increase. So not bad, very good. Again, the one thing that we got to keep in mind is that Google, very reliant on AI. A lot of the growth recently has been because Gemini has been able to do so well and catch up so quickly. If there is any correction because of AI, if there's an AI bubble similar to the dot-com bubble in the early 2000s, Google will be one of the companies most likely that is affected. But I really do like Google. I think, at least for the long term, they're an amazing investment opportunity. I do expect them to do very well. And unlike some of the other tech companies, as we saw, they're not as volatile. There's a lot more trust with the investors into the Google stock. So I do like it quite a bit. Do I like it enough to put it in S? Probably not. It doesn't feel right, by the way. Putting all these companies in A, but putting Amazon in S just feels wrong. But again, the reason for that is because over the short term, there could be a little bit of a correction. So that's the only reason. And if there is correction, that doesn't mean they're not good investments for the long term. It's just that there might be a better entry point if you don't invest right now into these companies and invest into some other companies instead of that. So that's the only reason I'm not putting these companies in S, but realistically, a lot of these companies are very good investments, and I'm not trying to dissuade anyone from investing into them. But right now, I just don't feel comfortable enough because of the looming threat of an AI bubble to put him in S quite yet. But who knows? Maybe I'll change my mind in just a couple of months. Next up, we have Broadcom, and Broadcom is a semiconductor company that produces chips related to networking. And, if you need to interact with the server or build a server, you're going to be buying a lot of stuff from them. So they've seen their stock price go up massively because of the AI boom, because, so many AI models need to constantly connect to servers, and a lot of companies need to build new servers for their AI models and a lot of other things. So they're doing really well right now, but here's the thing. The PE trailing for this company is over 100. And that's where you get into a territory where you're like, okay, now the price is probably quite a bit higher than what the actual value or actually earnings are. To be fair, the earnings do look like they're going to be going up a lot. At least the market expects that. So over the past 12 months, the earnings per share was just under 4, but they expect it to be about 13 in the next 12 months. So as such, the PE trailing, which was 103, the PE forward is expected to be about 31, which is quite a big difference. Now, those are all well and good, but at the end of the day, no one really knows if these are going to pan out the way we think they are, right? That's the real issue. And you can have all these projections. Companies can have all kinds of projections, but they don't always hit those projections. And once you go above 100x, 100x is that point where even like when you get close to 100x, that's still quite a bit. But even at, a price per share of 100 times or close to 100 times of your earnings per share, it could maybe make sense for some massive growth stocks that are really like taking full advantage of the boom in a specific industry. But once you go above 100, that's where it gets really dicey, and you need to start showing earnings real fast, or there's going to be a massive correction because a lot of the investors are going to be like, okay, where are the earnings? And all it takes is just one bad news to come out or one projection to be missed, and all of a sudden it's panic station, right? So I'll be a little careful with this particular stock. It has come down recently a little bit as well. There's definitely promise there. There's definitely a possibility of the stock doing really well. I'm not saying if you invest into the stock, it's not going to work out or you can't make money. There's definitely a chance that this stock could do even better than some of the other stocks we've looked at so far. But because that inherent risk is there, even though it looks like they're going to be bumping up their earnings quite a bit, at least that's what the market expects, right now, because the price per earnings per share is just so high, that I'm going to be a little bit more conservative with this one and just put it in B. Even though, again, I do think there's a possibility it could do very well. If the earnings do come through the way the market expects, it definitely could compete with all these companies. But just right now, just to be a little safe, I'm going to put it in B. Next up, we have Meta. And of course, Meta, the parent company of Facebook and Instagram and all those things. It's looking quite good. It's a company that I really like because not only are they going very much so into the AI boom with their own AI models, with Llama and all those things, but they're also being innovative. They're also producing new products that are pushing the boundaries. The new Meta glasses, particularly the new one they just came out with that has a display and everything. I mean, it just looks like they're taking steps that companies like Apple used to take beforehand, and they're trying to come up with new designs, new products, and of course they already have almost a monopoly on social media and all those sorts of things. So I really like Meta as a company. And also, even their numbers look good. I mean, their earnings per share over the past year was 22.63. Market expects it to be even higher over the next 12 months, 29.76. And even when you look at the ratios that the market expects, over the past 12 months, it was 28.5 for the PE trailing. But over the next 12 months, the price per earnings per share is anticipated to be 21.65. And again, remember, if this goes down, that's a good sign. And of course, we have the expected earnings per share to go up as well. So all of that to say, I really like Meta as a company. I really think it's a great investment. I personally am a huge believer in their mission and the way they're moving forward, the way they are reinvesting into new product lines, making sure they keep up with the pace of the technology and all the AI aspects of things. So to me, Meta is so far the best investment we've looked at. Not to say these other companies don't have their own merits, but out of the ones we've looked at so far, Meta is the one that I like the best and definitely one I really like investing into myself. Next up, we have Tesla. And speaking of companies that have an incredibly huge PE trailing ratio, I mean, look at this, 306. that is insane. I mean, that's how you know the price of the stock is a lot higher than the earnings would suggest it should be, right? So the earnings per share are expected to go up from the past 12 months to the next 12 months. It was 1.5 over the past 12 months, a little over 2 over the next 12 months. So as such, it is expected that the ratio will get better. But even then, even for the next 12 months, it's expected to be 211. So these are crazy. Obviously, I think a lot of Tesla investors, I mean, some of them are just Elon Musk fanboys, let's be honest about it. But I do think some of them are investing with the promise of future, with the promise of, groundbreaking technology like the Optimus robot, like the RoboCab, and all those sorts of things. Are we really confident that they're going to be coming out with those products anytime soon? I don't know. That's the thing. Tesla, it's one of those companies that it really could just shoot up because of all those groundbreaking technology. Somewhat similar maybe to the way NVIDIA just absolutely blew the lid out of the door over the past, couple of years because of how involved they were with where the technology was going and all the AI boom and all sorts of things. So it's possible that with the next boom, Tesla could really, really do well. Their earnings could go up massively and it could justify the price of the stock. Maybe the stock will still keep going up as well. But when you're at 306x your earnings, how much more room do you have to grow? That's the real question. Even if you go up, how much can you even go up? So that's why I'm not a huge fan of Tesla, at least not right now. I do think there could be potentially points in the future where, if the price of the stock comes down massively, there might be some entry points where you could be like, maybe I want to get in on that a little bit just in case it does blow up. But right now, I would just avoid it, to be honest. It just seems way too overblown, way out of proportion. Nothing against you if you have Tesla stocks. I hope you do well. But I'm not quite interested right now. Maybe I will take a look at it if there's a massive drop in price. If there's a huge correction, it comes down, let's say 20-30%. Then at that point, I might take another look at it. But right now, I'm just not really interested. I'm going to put it in C. Next up, we have Berkshire Hathaway, of course, Warren Buffett's company, famously. And we, of course, have to address the elephant in the room. Warren Buffett just recently retired, just a couple months ago. And, after a long and illustrious career, he might just be the best and biggest investor of all time. I think we all have nothing but respect for him. But now that he's gone, how do we feel about the company? I just don't know if they can. It's one of those things where a huge personality, a huge influence on the company is gone, and I just don't know how you replace that kind of a person. You could maybe point out someone like a Steve Jobs, where they never really replaced them, but their stock still did very well afterwards. They almost 10x their stock price since Steve Jobs famously passed away. But I just don't know if they can do that. And even if you look at the market expectations, so I'm not just gonna tell you how I feel about it. I'm gonna back it up with data. I mean, look at this. Earnings per share over the past 12 months were 31. It's expected for the next 12 months to be 21, quite a bit lower. And same with the PE trailing and PE forward ratios. It's expected to go higher. And again, we talked about this. We want this ratio to go down in the next 12 months. So for that reason, it's unfortunate, but I just don't really know if this is a particularly great investment. And again, it is quite high up. It has grown quite a bit over the past year or two. How much more room does it have to grow even if it does do well? So I'm going to put it right next to Tesla. It's really unfortunate. Again, no disrespect to Warren Buffett, but with him gone, I just don't know how well the company is going to do going forward. At 11th place, we have Walmart. And Walmart is one of those stocks that I would just say it's a little bit on the safer side of things. It's not super risky, but you don't expect Walmart to go out of business. You do realize their efficacy and how important they are to at least the North American way of living. And of course, they have the ability to undercut prices because they're able to make so many things more efficient. And I just really like them as a company. That said, right now might not be the best time to invest. When we look at the numbers over here, the earnings per share over the past 12 months was 2.85. It's expected to be slightly higher for the next 12 months, 2.97, but that's like barely anything. And in fact, their PE forward is expected to, again, be slightly lower going forward. But again, it's not a super massive difference. I do see the stock maybe stagnating a little bit, at least according to this data. But it could be, let me give you the devil's advocate on this, it could be a good hedge against the AI correction or AI bubble burst or anything like that, because, you know, obviously Walmart is as further away as you can get from tech companies and AI companies and all sorts of things. So, and the good thing about these kinds of, why I say companies like Walmart are a little bit safer, is because no matter what happens, people always need their groceries. People always need to go and buy bread, milk, etc., whatever. And that's the difference, right? People don't always need iPhones. People don't always necessarily need Instagram, but they always necessarily need groceries. So unless there's better competitors that absolutely outcompete Walmart, they're gonna keep, you know, chugging along. They're gonna keep moving along. They're not gonna be hindered too much. But when we talk about yield and the potential for growth, I just don't really see it there. So Walmart, it's an okay stock. It's definitely a safe stock. I don't expect it to be taking on huge losses anytime soon. Famous last words, but that's just how I feel about it. But I just don't really see the upside as much. So I won't put it down to C, because I don't see it like going down like some companies like Tesla or Berkshire Hathaway could go down in the next couple of years. But I don't necessarily see them going up too much either. So I'm going to put it in B. Next up, we have Eli Lilly and Company, and this is a pharmaceutical company that has products specifically for things like diabetes and weight loss and autoimmune situations. It's an interesting company, a little bit different. It's growing quite a bit recently. The numbers look pretty good. So the earnings per share over the past 12 months was just over 20. It's expected to be over 32. That's a huge gain. That's almost 60%. And as such, the PE trailing and PE forward, again, it's expected to go down quite a bit. So the numbers look good. Looking over here at the chart as well, I just want to bring it back a little bit. You see that the company does have quite a bit of volatility. So over here, just look at those peaks and valleys, right? So we have from April 24 to July 24, quite high, and then it drops all the way down for over a couple weeks, and then goes all the way back up over another couple of weeks, then comes all the way back down here, goes back up. So there's a lot of volatility going up and down constantly. So if you are someone who's investing into these kinds of companies, or this company in specific, you should expect a roller coaster ride. This is not going to be a smooth ride. It's not like something like an AI related company that is going to be getting in investment from all sorts of directions because they really believe in the mission. It's a little bit more complicated than that. And there's always this saying that, they have this drug ready to waiting for FDA approval, and as soon as it gets that, it's going to shoot up if I had a nickel for every time I've heard that. Not that this particular company has that right now, by the way. I'm just pointing out that pharmaceutical companies in general are a little bit more volatile, a little bit more difficult to predict than maybe some other companies. So in general, I'm just a little bit more hesitant of pharmaceutical companies. Not even this company specific, just in general, all the pharmaceutical companies, I kind of get the ick. That's just me though. I know a lot of people are very interested in them because there is potential for huge growth as well. And again, to be fair to the company, their earnings are expected to be quite a bit higher going forward. So if you are to invest into a pharmaceutical company, you want it to be a company that has numbers like this, not a company that's like highly speculative, really high PE trailing ratio, maybe not dropping down quite a bit. Maybe the earnings are not expected to go up as much. So to be fair to this company, it's looking pretty good. I'm going to put it at a low A just because of the numbers. But to be honest, personally, I'm not a huge fan of pharmaceutical companies, so I don't see myself necessarily investing into this company in specific. But again, the numbers look good, so I can't really put it too far down. So a low A it is. Next up, we have our first financial company, JP Morgan Chase & Company. And the numbers, they don't look that great. I mean, they look okay. The earnings per share over the past 12 months was 20. It's expected to be slightly higher at 21. And as such, the P trailing and P forward, again, it's expected to go slightly lower. So there could be a little bit of growth with this company, not expecting anything specific. It is also a dividend company. It is giving you 1.74% in dividends. Dividends, if you don't know, it's basically when companies share a portion of their profits with you, the investors, in order to entice you to invest into the stock, because maybe the stock isn't growing super fast, or it's not a growth stock where it's expected to shoot up anytime soon. So they give you that as more incentive for you to invest into the company. Now, this company in particular, 1.74% is not that high when it comes to dividends. When you look for dividend companies, you want maybe like 2, 3, sometimes even 4%. Those are the sweet spots. If it gets higher than that in dividends, it probably means that the company is expected to go down in value, and it's really like trying to get any investor, so they're giving a higher amount. But 3%, even 4%, that's not that crazy. That's not a red flag necessarily. So I don't know, 1.74%. I would have liked it to at least be above 2, to be honest with you, or at least the earnings going forward to look a little bit better than this. So overall, I don't know. Like I'm fine with dividend companies, but I would like a little bit more yield if that's the case. And maybe, look, it's fine if it's stable and it's not expected to go up quite a bit, but I would like some return coming from somewhere. So not particularly a big fan of this one. I don't hate it either. I'm going to put it right beside Walmart, somewhere around there. Next up, we have Visa, and this is a company that I like quite a bit, and I'll explain why that is, but let's first take a look at the numbers. The earnings per share over the past 12 months were about 10. It's expected to be about 14.5 going forward. So again, that's almost like a 45% increase. It's pretty good. P trailing was 34. Going forward, it's expected to be 24. So again, going down quite a bit. That's what we like to see. But in general, one of the reasons why I like transaction processing companies like Visa or Mastercard is that these are one of those companies that no matter what happens anywhere, they're gonna be getting their earnings. You know what I mean? Because like they get a percentage on every purchase that you make. So if you have a Visa card, no matter what you do, anytime you use that for buying anything, they're getting a percentage. Now, yes, if it's a recession and people are not spending as much, they will be getting less, but they're still getting quite a bit, and not for a lot of work in particular either. So just in general, Visa, Mastercard, they both have a huge user base. I don't think either company is going anywhere anytime soon. One thing I will point out though is that there has been quite a bit of volatility with the stock price recently, but once you zoom out a little bit and get a little bit more perspective on the price of the stock over the years, it doesn't look as bad, right? Because like once you zoom out for a couple of years, you see that it's actually not as volatile as it might seem. It's a lot more smooth. And again, it's for the reason that I said, like no matter what happens, no matter what's going on, Visa, Mastercard, they're always getting their earnings, almost always no problem. So once you zoom out a little bit, you see that, you know what, the company's actually doing pretty well over time. So I do expect them to keep that up. I was thinking A, but you know what, I'm just going to do it. I'm just going to put in an S because, again, the beauty of Visa and Mastercard both is that no matter what happens, they're always getting their cut. You know, it's almost borderline criminal how they get paid for everything. They rip everybody off. That's a joke, by the way. Don't take that too seriously. But yeah, that's the benefit of investing into Visa, Mastercard, is that you know that your company is always going to be getting their earnings no matter what. So I like that quite a bit. And the numbers look pretty good too. So win-win. Next up, we have Oracle, which is Larry Ellison's company, the person who just bought TikTok in the United States. And they mostly focus on, you know, database software, cloud solutions, cloud engineering, all those sorts of things. And looking at the numbers do look good. That said, the company has grown quite a bit. We'll take a look at the chart in a second, but the earnings over the past 12 months were about 5.3. It's expected to be closer to 8 going forward. And as such, again, the P trailing 35, P forward 24. It's going in the right direction. There's a little bit of a dividend yield, about 1%, but that's very small. It's not exactly something you look for with a dividend stock. You look for maybe 2, 3, 4%. So we need to see quite a bit of potential for growth for this stock to be worth it. And here, look at this. So this is how the company has been performing over the past couple of months. So there was a massive boom right over here up until about September of this year. And then after that, I mean, it's been it's been a fall from grace a little bit, but that could be a good thing if this is just some volatility. It could be that if you invest right now, you could be on the way up, or it might just be that, you know, it went up way too high and it found a correction. Now, it's anybody's guess which one that really is. The one thing I want to focus on, going back to the numbers, is that the earnings are expected to be higher going forward. And again, even if the growth isn't at the rate that you expect it to be or you want it to be, you at least have a little bit of dividend yield there to help you out as well. So I do like the investment. I am a bit hesitant though. I mean, again, it is a company driven also by the AI boom to some extent as well. So overall, I don't hate it, but I don't love it either. I'm just gonna put it in B, somewhere around here. It could be an investment that pays off quite a bit, especially if it goes back to its all-time high that it was at just a couple months ago. But will it do that? I don't think it's guaranteed that it will do that. So I'm just not too sure about it. It's just something I'm not probably going anywhere near right now, but I will keep a close eye on it. Next up, we have Mastercard. And again, similar to Visa, I really like companies like this because no matter what happens anywhere in the world or with the economy or whatever, these companies are going to keep making their money, no problem. So I do like them quite a bit. The earnings per share is expected to be higher over the next year. It's going from 15 to 19. And again, the P trailing to P forward, it's going down the way we like it too. So overall, I do like it quite a bit. I probably like it slightly less than Visa. Again, Visa had better numbers, and also Visa has a slightly bigger user base. So I will put it not in S, I'll put it in a high A just to demonstrate that I like Visa a little bit more. But MasterCard honestly could have even made it to S as well. I really like both of these companies. I do think they're both really good investments if you want to have something that's not super risky, but could also have a good amount of return going forward as well. Next up, we have Johnson & Johnson, one of the biggest pharmaceutical companies out there. I think a lot of us are familiar with their vaccines and all those sorts of things. They also produce a lot of other medical equipment like Band-Aids and stuff like that. So huge company, a very good company. The earnings are expected to be slightly higher going forward. Going from 10.3 to 11.5. Again, P trailing to P forward, it is going down, but just slightly. But the good thing about Johnson & Johnson is that it's a dividend company. You have a dividend yield of 2.4%, which is pretty decent. You basically get $5 for each share. That is valued at $211. So this is the type of company where if it doesn't go up quite a bit, or it doesn't produce a lot of new products, doesn't expand or raise its stock price massively, it's fine because you're getting paid a dividend on a regular basis, and that's what you can rely on to make the investment worth your while. But even looking at the chart, I mean, the chart looks pretty good. It is at an all-time high, so what goes up must come down. So there's a little bit of risk of that happening. But even if you look at some of the volatility of the stock, it's never been to the point where it's gone down massively for a long time. I mean, maybe this is the biggest period we can look at over here, which for about 2 years it took for it to reach those levels. But again, to be fair, this was probably their all-time high at the time because of all the stuff that was happening with the 2020 lockdowns and the vaccines and all those things. So it did go up pretty high. It had some corrections, but again, that's in part due to that phenomena. I do think they're a little bit safer right now, and again, they're a good hedge against an AI bubble bursting. That said, it is quite a bit high though. Just looking at this chart, it does look a little scary. If there's to be a correction against this company, it wouldn't be a shock. But then again, if there's a correction against AI companies, a lot of investor money might go to places like this instead. So overall, I do like it. Even if there's a slight downturn, again, you at least have that dividend coming in on a regular basis. So I do like it quite a bit. It's definitely not going in S. It's looking a little dicey, just a tiny bit. But I do still like it quite a bit. So I'll put it somewhere around here. I'll just, what? At some point, we're going to get to a point where there's so many companies up here, I won't be able to just actually rank every single one. So don't get too fussed about that. But it is in a higher level of A, I would say. Now, whether it's right before or after Google, let's just not worry about that. There's got to be 500 companies here. Okay, so give me a break. Next up, we have Exxon Mobil, an energy company that specializes in oil and gas. Looking at the numbers, the earnings per share are expected to go up a little bit from 6.89 to 7.24. That's a good sign. It's not a huge amount of difference though. P trailing to P forward, it's coming down a little bit. Again, not a huge amount, but the dividend yield is pretty decent. Dividend yield is 3.37%, which is nice. And also looking at how the stock has been doing recently, there was a little bit of a correction, but it has recovered for the most part, not quite to its all-time high levels. But you see there's a lot of this volatility with this stock again. And again, you expect this with a lot of dividend stocks that, they go up and down, but they stay around the same area. They don't change too much. And I mean, that's why you get the dividends, right? So we had a huge boost to the company value from 2021 to 2023. But since then, I mean, it's been a bit stable. It's been a bit stagnant around this, like 110, 120, down to 100, around that range of price. Do I expect it to keep going up? Not particularly, but again, this is a good hedge against an AI bubble, right? So, and it is slightly higher dividends than Johnson & Johnson. Johnson & Johnson was about 2.5%. This is about 3.3%, so that's a little bit higher. Even if it doesn't go quite up, honestly, a dividend stock that gives you good dividends, I'm fine with it even if it's stagnant, because, you know, that dividend is regularly coming in. It's safe. It's not as risky as a lot of other companies. And again, this is a huge multinational gas and oil company, right? We're not getting rid of gas and oil anytime soon. I know a lot of people want to have renewable energy sources and all of that. That's still ways away. So for the time being, it's not a bad investment. It's decent. I'd put it somewhere around the same as Johnson & Johnson probably. Again, keep in mind that these two, at least in particular, are a little bit on the safer side of things. And, you know, just because all these companies are in A doesn't necessarily mean they all accomplish the same thing, right? A lot of these companies have a lot more room to grow, but at the same time, they bear a little bit more risk in the short term as well, whereas these companies are a little bit safer in the short term. And again, going in with that idea and that framework that, you know, there is a very real possibility of an AI correction, these other companies just become a little bit more valuable in terms of at least short-term investments to hedge against that, right? So just keep that in mind. Just because these companies are high, I know some people are going to be in the comments saying, how could you rank them higher than some of these other companies? That's the reason why. It's not, some of these are really comparing apples to oranges, and I'm just trying to reconcile that by explaining these thinkings that are going through my head. But yeah, that's about it. Let's go to the next one, which is Palantir. This is going to be interesting. Now, Palantir is Peter Thiel's data company, and it has grown incredibly over the past year or two. I mean, just incredible levels. That's part of the issue, though. The price has gone up so much that, I mean, look at the PE trailing, 429. That's insane. Even with the expected higher earnings, I mean, the earnings were about 0.43 over the past 12 months. It's expected to be closer to 1 over the next 12 months. Even with that, and the PE ratio dropping significantly, even then it's still 185. And again, that's like what's expected by the market. Is it even going to hit that? So I just think the time to buy Palantir was like a year or two ago. In fact, going over here, looking at the chart, you can see how much it's grown. It's at about 183.5 right now. Just like a year and a half ago, it was at 22. So yeah, it has just grown significantly. That's like what, 9x growth over just a year and a half? I mean, that's insane, right? Like, do you even have any more room to grow? Probably not. I will say this though, even though Palantir with these current numbers is just not really a good short-term investment, I do think it's a good long-term investment. Not because of the numbers, but in particular because of how it's getting involved in so many different industries and with the government and all those sorts of things, all the new contracts it's getting. And of course, Peter Thiel is a very influential person as well, has a lot of connections, all sorts of places. So I do think that over the long term, it'll actually do very well. Not in the short term, though. I think for this company, at least some sort of a correction, I mean, surely is inevitable, is it not? I don't know. If it never goes down at any point in the next couple of years, I'd be shocked. Let me just put it that way. Doesn't mean it can't happen, but I would honestly be shocked because it's just gone up so much. It's ballooned to insane levels. So I do think there might be good entry points in the future, maybe like a year or two from now, if it comes down a little bit. There could be some good entry points because, again, over the long term, I do believe in the stock. But just over the short term, it's just way too ballooned up, way too high. I don't know if I quite want to put my money there. I'll probably put it in B right next to Oracle. But again, this is one that really could be a lot higher if it was just a little bit lower in price. If, you know, it got some sort of a market correction, came down a little bit at least, it really could find its way in A and S in almost no time. But right now, I'd probably just stay away for now, but monitor very closely. Next up, we have Netflix, who are doing so well. They're now putting in bids to buy Warner Brothers. We'll see what happens with that whole situation. But their numbers looking very good. Their earnings per share over the past 12 months was 2.4. It's expected to be 3.2 over the next 12 months. So that's pretty good. That's a decent amount of growth. That's about like what, 40%, 40%. And their PE trailing going from 39.7 down to 29.3 in the next 12 months. Looking very good. The numbers look good. I do like the company. And they are just turning over money hand over fist. Also, looking at the chart, it has come down quite a bit from their all-time high back in June, where they reached 134. Now it's at 95. So you're also getting a little bit of a discount if you want to invest in the company. So I do like Netflix quite a bit. Do I like it enough to put it in S? I don't really think so, because I don't think the ceiling for the investment is that high. I know I've put some other safer, maybe lower return kind of stocks in higher tiers before, like Johnson & Johnson and Exxon Mobil. I think Netflix probably goes somewhere around the same. I do think they're not super risky. I wouldn't say they're safe, but they're not like super risky like some of these other companies. I don't think they're at a huge risk of a correction. And again, you're kind of getting a discount right now, compared to its last all-time high. So I do like it quite a bit. I'm going to put it somewhere around here. I don't think it quite has a high enough ceiling for me to go with it in S, or like I trust it enough as much as I trust something like Visa, for example, to put it in S. But it's a very good company. It does look like a really good entry point right now. It does look like you're getting in. If you buy, you're getting in at a discounted rate. So I like it quite a bit. I'm going to put it in A. Next up, we have Bank of America, another financial company. And financial companies, I mean, they're a little bit tricky, right? Because they could be doing all sorts of nonsense. It's very difficult to predict. Just looking at the earnings per share, over the past 12 months, it was 3.67. Over the next 12 months, it'll be 4.37. That's a decent amount of earning going up that is expected by the market. PE trailing going from 15 to, P forward being around 12.6 as expected by the market. So numbers look good. It is, of course, also a dividend stock, so you're getting about 2% in dividend yield as well. And just looking at the chart, I mean, again, it doesn't look super high volatile. There was a little bit of volatility here at the beginning of the year. In the recent months, it has been going up quite smoothly, but at the same time, you are buying at an all-time high. So there's a little bit of a risk of a correction there as well. Overall, I like it enough. I'm not like a huge fan of the stock, but it's like one of those companies that give you a decent amount of dividend, like 2%. It's not super high, so you want at least some promise of the price of the stock going up. But if you look at it over time, it has also exhibited that it does have the ability to grow quite a bit as well. And again, with the expected earnings that are quite higher than they were over the past 12 months, I think it's a good investment. So I'm going to put it somewhere in the middle A. It's not like something I'm crazy about, but I think maybe somewhere around here will be just fine. I don't particularly love it, but I can't really find too many faults with it either. So I think it's a fine investment. Next up, we have Abbvie, which is a pharmaceutical company that is very much so focused on research and finding new treatments and cures and stuff like that. These numbers are kind of crazy, so hold on to your hats. PE trailing 168, PE forward 15. What? Insane. Look at this. Earnings per share over the past 12 months, 1.33. Earnings per share expected for the next 12 months, 14.3. So over 10x. And it's also giving you a lot of dividends, by the way. Like, what? Am I reading these numbers right? What are these numbers? These are crazy. I will say this one more time. Pharmaceutical companies, very risky. They could go in any sort of direction. If I had a nickel for every time something was awaiting FDA approval, and it's going to blow up after that. But, I mean, with these numbers, can I do anything other than put it in S? I don't know if I can, really. And it is a stock that has shown the tendency to go up over time, even though there is volatility. Over time, it has been quite reliable. Look at that. Ever since 2020 to 2020, almost 2026, it's just been almost a smooth ride up. So, can you really hate on this stock? I don't really think you can. So again, I will reiterate this. take caution. Don't overextend yourself on this stock. Don't put all your eggs in this one particular basket. It definitely is risky, but the numbers look so good that I can't not put it in S. So Abbvie, very well done. I don't know how the market expects you to do so well over the next 12 months, but whatever it is, I hope it pans out for you guys, because I might just be investing a little bit. I'm not gonna lie. Next up, we have Costco. Again, another one of those safer, quote unquote, safer investments, because again, people always need their groceries. Costco, I mean, is so well respected and well liked by almost everyone in North America, that I really like their model. If you look at their chart over the years, not just the past couple of years, if you look at it over the decades, it's always been a smooth sailing upwards. I'll show you that in a second, but first let's take a look at the numbers. The earnings per share over the past 12 months were about 18.7, is expected by the market to be higher at 22.2. And as such, again, the P trailing for 47, P forward, quite a bit lower at around 40. But look at this though. I mean, look at the growth of the stock over the years. And maybe I can just go a little bit further back as well. I mean, look at this. Look at how smooth that line goes up over the decades, right? So that's the type of company that you know is well run, that is always maintaining its standard of delivering what the customers expect at a high level of efficiency, always being a good, profitable company that just does what they're supposed to do very well. And right now, you might be getting in at a little bit of a discount as well. I mean, the all-time high, like in early 2025, was around 1,075. Right now it's down to 884. So you'll be getting in at a discount as well. And again, it's a good hedge against, the AI companies, the tech companies, all those things. If there's a correction to them, Costco's most likely not going to be affected all that much. So I do like Costco quite a bit. Numbers look good. The expected earnings look pretty good. So I think it does go somewhere in A. Again, a little bit of a safer pick, but what's good is good. Next up, we have Home Depot, another dividend stock. It gives you 2.5% dividend yield. The earnings per share are expected to go up slightly from 14.67 to 15. Again, very slight. PE trailing 24.5, P forward 23.8. Again, very slight difference. I don't particularly like Home Depot in general. I know that maybe it's just my own personal opinion seeping in through. But I gotta be honest, I just don't particularly like that company all that much. I don't think it's one of those companies that like a lot of people use. Maybe I'm quite off with that. I just think it's a bit more technical. I don't see a lot of room for them to grow. I mean, how many new products can they come up with? And I understand that, you have situations with Costco and Walmart where I had a little bit of a different tune, but I just think those companies are a little bit safer, because no matter what's happening, everyone needs groceries. Are everybody like remodeling their home or building new homes, no matter what the regulations are, no matter what the economic situation is like? I don't think so. So I just don't like it as much. Again, maybe it might be a little bit of a personal opinion coming through, but I just don't particularly like Home Depot. I'm going to put it in B. It's not like that bad. Numbers look okay, but I'm just not a big fan, so I'm just going to put it in B. Next up, we have AMD, which stands for Advanced Micro Devices. And this is another chip company that is producing CPUs, GPUs, all the lot, and is a big competitor to Intel. It's surpassed Intel's market cap recently. And over the past 10 years, they've actually grown their stock price by over 100x, which is just absolutely crazy. But let's look at the numbers right now. Their earnings per share is expected to go up quite a bit. It was about 2 for the past 12 months. It's expected to be 6.5 for the next 12 months. But look at this. The PE trailing is slightly over 100. Again, little slightly risky territory. The PE forward is expected to be a lot smaller at around 32. Okay, that's not bad. But again, the PE trailing being so high, I mean, makes sense, right? Because they've just gone up so much over the past couple of years. And that you can kind of see why the price is so much higher than their earnings currently. But the earnings are expected to go up. So there is again, some merit to investing into AMD. Again, I don't think it's particularly the best entry point right now. They're not at their all-time high, but they're not too far away from that. So really the only thing that is making me consider this a little bit more than some other stocks that have been so high is that the earnings per share expected for the next 12 months is just so high. It's over 3 times what it was for the past 12 months, which is definitely a step in the right direction. If they can stabilize it somewhere around there, it's looking a lot better. So I do like it. I will probably put it at a low A, but just barely. It could have probably went down to B even, but I do think it's a good company. I do think they have the capacity to grow a lot over the next couple of years, particularly if you invest for the long term. But of course, a little bit of a risk is there, and any sort of an AI bubble definitely will, or at least most likely will, impact AMD as well. Next up, we have Procter & Gamble, which is a company that owns a lot of the brands that we use on a day-to-day basis. This is stuff like Tide, Gillette, Head & Shoulders, and a bunch of other ones. Basically, a lot of consumer goods that are in some way or another related to personal hygiene or cleanliness or stuff along those lines. Obviously, it's not a company that you look for, it's not a stock that you look for like a lot of growth. It's not a growth stock. It's not gonna like 10x in a couple of years or something like that. It's mostly a dividend stock, and as you see it, the dividend yield is almost 3%, which is not bad at all. And the earnings are expected to be slightly higher over the next 12 months. Not crazy high, but again, given that the dividend is a decent amount, it's actually a decent investment opportunity. But this is perhaps what I'd like to see, is that you're getting quite a bit of a discount since their last all-time high, which was at around 180 just about a year ago. So now you can get it at 140. It has gone down quite a bit, but it's a dividend stock, right? So you get it not for the crazy returns it's going to give you. You get it for the regular dividends that are coming in. But given that you're buying it for like a decent amount of discount since the last all-time high, there is some potential to get in on a little bit of that recovery as well. Now, of course, that's not guaranteed. It could just linger around 140, and that's completely fine because you're getting the 3% dividends on a regular basis. Just as long as it doesn't go down too far, it should be a fine investment. And again, given that the earnings are going up, or they're expected to go up for the next 12 months, I don't think there's a too high of a risk of that happening necessarily. So I like the company as a potential investment. I will probably put it somewhere in A. Again, not too high, but maybe somewhere around here. Low A would make sense to me. Next up, we have GE Aerospace, which is a company that produces aircraft engines and stuff around those lines. The earnings per share were about 7.5 for the past 12 months. They look to be going slightly down over the next 12 months, so that's already not a great sign. And also just this sector in general. And when you think about aircraft engineering and stuff like that, I mean, how much room do they have to grow? If you're looking at it as a growth stock, are there going to be revolutionary new products that are going to change anything? So I just wouldn't be that interested in a company like this in general. Doesn't mean it can't do well, it might, but it's just not something I look at immediately. I don't have a lot of expertise necessarily in this area either. And also, you're not getting a high dividend at all. You're getting like 0.45%, less than 0.5%. The earnings are expected to be slightly lower going forward. So there's nothing I see here that I like. If somebody else likes this stock, no problem. I'm just, from my perspective, this is an easy C right there. Next up, we have United Health Group. We finally get into some healthcare companies. And this one right off the bat, the numbers are looking a little troubling. I mean, the earnings are expected to be lower for the next 12 months. It was about 19.2 for the past 12 months. It's expected to be 17.75. So that's a little bit of a decrease. The PE trailing to PE forward, again, it's going in the wrong direction. There is a decent amount of dividends, but it's never a good sign where the earnings are expected to be lower. And particularly with healthcare. With healthcare, this is not, again, a kind of company where you're thinking of, a huge amount of growth. It's okay if there's not a lot of revenue coming in. It's okay if there's not a lot of earnings because, we're investing into this, that, the other thing. It's healthcare. You want to see the earnings be there. You want to see a decent amount of earnings. You want to see the earnings going up. So just because of these numbers alone, I'm not too interested. The only debate is, do I put it in C or B? I probably have to put it in C just because numbers are going down like a decent amount. Maybe I'll put it like at the beginning of C. That looks about right. Next up, we have Cisco, which is another tech giant that are involved with a lot of areas like connectivity and stuff like that. They've also gone recently into AI security to some extent from what I've read. So it looks like they're trying to expand. They're trying to get in on the AI boom at least a little bit. Let's take a look at their numbers. Their earnings for the past 12 months, about 2.65. For the next 12 months, expected to be quite a bit higher, so that's a good sign. They do have an okay amount of dividends. It's about 2.1%. It's a little bit on the lower end, though. You would like to at least have some prospect of the stock growing at least a little bit to complement the dividends here. And looking at the chart over here, I mean, you can see it's grown massively over the past year. The real question is, could it keep up that growth? Because when you zoom out and you take a look at the company, since about late 2022, it's been on an upward trajectory overall. But before that, there was some volatility here and there. It seems like, I mean, as soon as they started getting into the AI boom, they started going up. So it would follow that they would also be one of the companies that could get really affected if there's any sort of AI correction. So I would be a little cautious with this company as well. I would put it slightly lower than a lot of these other companies because I feel that a company like Apple, Microsoft, they have a lot of other sectors where they can really rely on if there is a correction in AI to prop them up at least a little bit. Whereas Cisco, I do feel they could be affected a little bit more. So I still like the numbers. It's just that element of risk and the fact that the company is probably a little bit more susceptible to corrections than some of these other giant companies is the reason why it goes to B. I know the numbers, they kind of look like, oh, it could be a good investment, and it could be. It definitely could be. It could be one of the highest performing ones here. Just because it goes in B, it doesn't mean that I don't think it's gonna do well, right? It means that I'm trying to balance the risk and the reward together, and I just think the risk is a little bit higher than some of the other tech companies because they're not as big and as solidified as some of these other companies are. So that's why I personally, again, I can totally understand if other people put in an A, but I personally am a little bit more hesitant with it, and I just, B feels a little bit more right to me. It's a high B, but B feels a little bit more correct. Next up, we have Coca Cola. Of course, Warren Buffett famously absolutely loves this company for some reason. Has always invested a lot into Coca Cola company. Let's take a look at the numbers. The numbers are expected to be a little bit higher going forward, but not too much. Going from 3 trailing to 3.2 forward. And as such, the P forward is expected to be slightly smaller than P trailing, but again, it's not a big difference in there. There is quite a bit of dividends, almost 3% dividends that you get with the stock. So as long as the stock doesn't falter too much, then it probably should be fine. Let's take a look at those numbers as well. So this is the chart right here. As you can see, there's a lot of volatility with the stock, which again, it does make sense as long as it's within a certain range. For dividend stocks, that's fairly normal, but there are some spikes of growth here and there, and perhaps that's why someone like Warren Buffett is really into the stock, because you have the dividend coming in consistently, even when there is a lot of stagnation and nothing particularly growing all that much. But then all of a sudden you get these spikes, right? Or these runs that the company goes through that, it maybe falters a little bit, but doesn't all the way come back down. And we see this pattern happening over and over again as they gain market share in different markets, as they come out with new products. I know Coke Cherry was a big product that they came out with a couple years ago. That was a big success for them. So overall, I do like Coca Cola. I don't love it or anything like that, but I do think, and again, this is one of those other companies that has that too big to fail syndrome. Of course, famous last words, but I do have that feeling with Coca Cola that no matter where you go in the world, everyone knows what Coca Cola is. Everyone likes Coca Cola. So for that reason, I'm probably going to put it closer to some of these other companies like Johnson & Johnson, which are a little bit on the trying to be safer side of things, getting the regular dividends, and we don't expect the stock to do too poorly, and it is a little bit of a hedge against AI. Again, Coca-Cola is the farthest thing you can get from the AI bubble or anything like that. So if there is anything of those sorts of things going on, Coca-Cola is a very good hedge against it. So that's why I like it. I'm going to put it in A. Next up, we have Chevron, another energy company, another oil and gas company. The earnings are expected to be a little bit higher, like about 7-8% higher than it was over the past 12 months. And as such, again, the PE trailing to PE forward, it is going down. That's good to see. The dividends are tasty. They're very nice. You get 4.5% dividends. That's pretty nice. Can't complain about that. And again, you see somewhat of a similar trend as you see with a lot of dividend stock, is that they kind of go up and down within a specific range. The range here that we can see is somewhere around like 170 and the low around 130. So right now the price is somewhere in the middle of that range. So if we just keep oscillating around this number in this range, honestly, that's not that big of a deal, right? We're getting a big dividend payout, which is really nice, 4.56%. And as long as we can just maintain the value or just oscillate around that value that we bought for initially, that's perfectly fine. Now, the stock has hit an all-time high of 190 back in November 2022. And of course, back here, there was all sorts of nonsense going on with oil, if you remember, in the 2020 and all those sorts of things. So it did go down there as well, but I don't expect it to be visiting that, at least not anytime soon, unless there's a massive global situation that happens again. So I really like the stock. I really do. The massive dividend payment. And this is not like a company that no one knows about and they're like really trying to get investors. No, this is a very well-established, well-known company. There are Chevron gas stations everywhere. So I like the stock quite a bit. I'm going to put it in a high A, somewhere around like Costco, Netflix, probably like right around here. So it looks about right. Next up, we have Wells Fargo, another financial institution, another bank. Their earnings look like they are expected to go higher. They were about 6 for the past 12 months, expected to be around 7 for the next 12 months. You have a little bit of a dividend payment, but it's quite low. It's even less than 2%. Really, anything less than 2%, you're getting into territory where, okay, I need to see something else, some other prospect with the stock price itself. And again, the P trailing to P forward, it's going in the right direction. Looking at the chart, it looks like it's at an all-time high right now. So again, if there's any sort of oscillation, as you expect with a lot of dividend stocks, it could be coming down, and maybe this is just not the best entry point right now. Maybe you'd be better off just looking the other way and then reassessing the situation if the price goes down. I'm trying to zoom back a little bit more. The one thing I do like a lot about this stock in particular is that as you see over the years, the trajectory has been really good. But once you go before 2023, there was some sort of oscillation going on here. In fact, if you look over here, and I know that 2020 there was a lot of situations that happened there, but from 2019 all the way to 2024, the price was pretty stagnant, right? So that's fine if this is a stock that gives you 2.5%, 3%, maybe even 4% dividend payments, but it's not really. It's a stock that gets you less than 2% dividend yield, and you would be buying at an all-time high right now, which, I mean, again, are they going to keep up this trajectory? The numbers, again, they look decent, and one thing I do like is that the PE, the price per earnings per share, is quite low. It's less than 20x, which is what you want to see with financial companies. It doesn't really give me a lot of doubt that, oh, I don't know if they can keep this up. It could keep growing because the ratio isn't so high where you're like, okay, the earnings don't justify this price right now. So overall, I like it. I'm a little hesitant. Again, I would have liked this dividend to be a little bit higher. If it was over 2%, I'd probably be a lot more happy with the stock. But as is, I'll probably sneak it into like a low A, maybe like right there. Not the best option. I think there are better options to invest into, but it's not that bad either. Next up, we have IBM, and IBM is a very good example of a kind of a combo stock where it gets you about a little over 2% dividends, but it does have some prospects for growth as well. If you look at the numbers are very promising. The earnings per share for the past 12 months were about 8.4. For the next 12 months are expected to be 50% higher, about 12.2. And as such, you can see the P trailing about 37, the P forward expected to be around 25, which is, again, very good. And again, if you look at the chart, the stock does kind of behave like a growth stock. I mean, at first glance, you don't look at this and say, oh, it's a dividend stock. You know what I mean? So it's a growth stock, which might not be as aggressive as some of the other growth stocks where we have like Apple, Microsoft, etc. But it does get you 2% dividends on top of that. So if you have the dividends reinvested, the compounding effect could be very nice here as well. And it's a really good combo combo stock. It's one of the better ones. So I do like it quite a bit. Some of this, again, just be cautious. Some of this might be because of the AI boom. If there is a correction, if there is a bubble that bursts, could that affect IBM? Possibly, at least to some extent. But I do like it. I do like it as a little bit of a different option than all these other companies that we have here. It doesn't necessarily mean it's a better investment than all of these, but it's a little different. And again, you have that consistent dividends coming in. So even if there is a correction, even if the values go down, you at least get a decent amount of dividends at the same time as well. So I like it quite a bit. Maybe we can even put it a little bit higher, maybe over here somewhere. Next up, we have Morgan Stanley, another financial company. Their earnings are expected to go up a little bit, about maybe 5, 6, 7%. They do have dividend payments, about 2%. Their PE trailing, again, is smaller than 20x. It's good to see that for financial companies. It was 18.3 for the past 12 months. It's expected to be 16.9 for the next 12 months. Again, similar to IBM, it's one of those companies that do have some potential for growth, but also give you like a decent amount of dividends at the same time, 2% dividends. And again, you look at this this trajectory of the chart and you don't think dividend stock, right? You think, oh, is this a growth stock? What is this? In fact, they've grown like a decent chunk, like about, like, what is that, 60% or so, 50, 60% since May of this year. That said, though, they're pretty much at their all-time high. And what goes up must come down as a thing, definitely. And we've seen them have oscillations before as well. But again, similar to IBM, if this does come down in price, you're still getting the dividend payments regularly until the price recovers. And again, the earnings are expected to be slightly higher. I would have liked this to be a little bit more. If this was 10% or more, then I would be all over the stock. But at 6, 7%, again, it's very easy to miss that, right? And if you miss that, all of a sudden you might be in the negative. So I'm a little conflicted about this one. I do like that it's a combo. I do like that it's a little bit different. And what I really like about it is that it's a hedge against, again, all the AI and tech companies. If there is an AI bubble that bursts, how much is that going to affect Morgan Stanley? Not that much, I don't think. So I somewhat like it. I'll probably put it right next to IBM, to be honest. I like IBM slightly better, but Morgan Stanley is a better hedge against AI bubbles and all of that. Next up, we have Caterpillar, or CAT for short. They produce a lot of manufacturing and mining equipment. I'm sure you've seen those equipments at work sites, at job sites. Their earnings are expected to be a decent amount higher, a little over 10% higher for the next 12 months than it was for the past 12 months. Their PE trailing was about 30.7. It's expected to be 26.9 for the next 12 months. They have a slight amount of dividend, just under 1%. Nothing to write home about necessarily. And the stock is at an all-time high right now. There's no discount. You're not getting any discounts here. And I just, in general, not the biggest fan of this kind of a stock. I would have liked their dividend to be a little bit higher because, again, like, how much room for growth is there with mining equipment or with construction equipment? I don't really see where the value is for the investor. Are you investing because you think the company can grow a lot, or are you investing because you're getting a lot of dividends? Because you're not. You're getting less than 1%. So look, I appreciate that the earnings are going to be higher, or expected to be higher, for the next year. But besides that, there's nothing else that entices me about this stock. So I won't be too harsh on it because, again, the numbers look decent. But I can't claim that I'm particularly interested in this stock. I'm going to put it somewhere around here, probably right around Home Depot. Actually, maybe it's just me. Maybe I just am not super into these kinds of companies, but it's going to go right there. Next up, we have Micron Technology. This is a company that focuses and specializes on creating computer storage. This is stuff like RAMs or hard drives, etc. Their earnings look to be going up significantly. This is very interesting. Earnings for the past 12 months were about 7.6. For the next 12 months, they're expected to be 23.4. That's very interesting. I don't know if it's a lot of the AI companies buying storage or whatever, maybe for servers. I'm not sure what's going on here. But yeah, this is no dividends, purely a growth stock. Their P trailing was about 32, which is not that bad for an AI growth kind of stock. But forward, it's expected to be 10. That's a very good ratio, very healthy ratio. I really like that. Now, looking at the chart, they are at an all-time high. They're pretty high up there. They have grown quite a bit since this trough in April of this year. That's almost, what is that? That's a 4x. That's crazy. But again, the numbers look insanely good. Like if the numbers were just a little bit better over the next 12 months, I would look at this and be a little bit more cautious. But when the earnings are expected to be almost like triple or just slightly over triple of what they were for the past 12 months, and it's grown so much in the past 12 months, that gives me a lot of confidence. So Micron Technology, this might be unexpected, but this one is, I gotta scroll it up. There we go. This one's going right to S. I know, might be unexpected, but can't argue with those numbers. Next up, we have Goldman Sachs, another financial company, a renowned bank. Their numbers are okay. Their earnings per share for the past 12 months was 49.2. It's expected to be 55.3 for the next 12 months. And as such, again, the ratio is going in the right direction. They do have dividend payments, but it's 1.5%. It's not super high. Again, if this is not over 2%, I want to see more with the potential for growth. And there has been a decent amount of growth. The graph does flatter the company and how they've been performing, at least since April. You can see they've gone from, they've basically doubled the price of their stock. But again, the numbers going forward are not significant enough for me to forget about the fact that we're not getting a discount here. We're buying at an all-time high. How much more room does this company have to grow? Unless you're hedging against the AI companies, I just think there's better options, right? So we took a look at stuff like Morgan Stanley, which gave you better dividends, and some other companies that we just took a look at, even Micron Technology, that just had such incredible numbers. I just think there's better options out there. So even though I like Goldman Sachs, I'm probably just going to put it in B, somewhere around here. It's a good investment opportunity. I just don't like it as much as some of the other ones that we've taken a look at so far. Next up, we have American Express, a company that I talk about a lot on this channel. I have a lot of their credit cards, big fan of them. Their earnings for the past 12 months was 14.9. It's expected to be quite a bit higher, 17.44 for the next 12 months. So that's over 10%, but that's like 12-15% higher. They have a very small amount of dividends, almost nothing to write home about, 0.8%. Their PE trailing to PE forward, again, moving in the right direction. It's going from 25.7 to 21.9. And again, as I mentioned earlier with Visa and Mastercard, what I love about credit card processing companies is that no matter what happens, no matter what's going on, everyone is using their credit cards. Everyone are buying all sorts of things. Sure, there could be less people buying, but I mean, just look at that graph. When you look at it over the long term, the arrow points one way. You see that? You see what I mean? And that's the beauty of companies like this, is that over the long term, I mean, look at how they perform. Since let's take a look at over here in 2020. Maybe 2020 is a bit of a weird place to look at because of all the situations that were going on. So let's take a look at here 2016. Okay, so in 2016, almost 10 years ago, let's say 10 years ago, the stock was going for $52, and now all the way over here, 10 years later, it's going for $382. And that's the beauty of companies like this, is that they grow so steadily and so nice over time. Yes, there are like small oscillations here and there, but in the grand scheme of things, I mean, when you just zoom out, they look pretty insignificant. So I like the company a lot. I believe in the company. And again, all the credit card transaction companies, they get their percentage no matter what's going on. They have the revenue coming in no matter what's going on with the economy or the politics or whatever. So I like American Express a lot. I'm going to put it, where should we put it? Do we put it in A or S? Let me take another look at those numbers again. Okay, so expected to be earning quite a bit more, getting a tiny bit discount, not a huge amount. You know what? Screw it. We're going to do it. We're going to put it in S. It is what it is. Next up, we have Merck Co, another pharmaceutical company that works a lot on a lot of treatments and cures, potential cures, stuff like cancer, all sorts of other things, HPV, what have you. The numbers they look okay. Earnings per share for the past 12 months were about 7.56. The next 12 months expected to be 8.5. So that's about 13% higher. The dividend is really good. You're getting 3.23% dividend payment. So even if there isn't a lot of growth with the stock, that's fine because you're getting a handsome payment here on a regular basis. And looking at the chart, it does look like a dividend company, doesn't it? But you are getting quite a bit of a discount since the last all-time high. So there is that. It was at 134, trading at 134 in June of 2024. It has since come down. And when you look at the oscillations are quite violent. I'm not going to lie. They're kind of all over the place. But it seems like one of those companies that is high risk, high reward. You could get lucky and, the price of the stock could go up massively while you get a lot of dividends, or you might be getting dividends, but then this happens to the price of the stock. You invest over here and then you end up over here. So it's a bit of a high risk, high reward one. This might not be for everyone, but I'm sure there will be people who are looking to take that on and go for the highest reward possible, even if it entails a lot of risk. I'm probably going to be a little bit more conservative, just put this down here in B. Again, doesn't mean it can't grow. The company could do very well. And if you get the 3% dividend payment while the company goes up quite a bit, that would be nice. But actually, let me take another look at the numbers. The earnings are expected to go up higher by a decent amount. The PE trailing to PE forward. Both of these numbers are not too big. Again, they're less than 15, 20x, which is good to see for pharmaceutical companies. You know what? I need to perhaps rearrange this a little bit. So maybe we bring down Johnson & Johnson here. And then we substituted with this because the thing with Johnson & Johnson is that I don't think it quite has the same amount of upside as Merck Co. And also Merck Co. just gets you more dividends as well. So we might even rearrange Exxon Mobil a little bit. We'll leave it B for now, but we might, or actually, you know what? Let's bring that down here too. I think both of these, because these are fine. These are a little bit more aggressive. I think this looks a little bit better the way it lands here, but I don't know. Let me know. Maybe you guys think it was good the way it was before, but but then if I'm putting this up here, I have to bring it down a little bit because the risk is there. So maybe I'll put it over here somewhere. Yeah, I won't tinker with it too much, but that looks a little bit better. Next up, we have Salesforce, which is a tech company focused on sales and customer acquisition and all that. And of course, they've been able to benefit from the AI boom by implementing a lot of AI tools and a lot of AI agents that can help with those sorts of things. So this is one of those companies that you got to be a little careful with because if there's an AI bubble that bursts, or if there's any correction, this company could be affected quite a bit. Looking at the numbers look decent though. Earnings per share for the past 12 months, 7.5, expected to be quite a bit higher at 13. So that's like what, 60% higher or something like that. It's barely any dividends, 0.6%. The chart, I mean, it kind of looks like a dividend stock with the oscillations and all those things. And of course, it's quite a bit down from its all-time high. So you're getting a massive discount. So in that sense, it could be a decent option. And with the earnings expected to go up so much higher over the next year, it might be a decent entry point, actually. So, look, I don't love it. I'm not like a big fan of it. I'm not saying I'm going to go out of my way to invest into this company, but to me, it doesn't look like a bad entry point. It looks decent. So, it definitely still has a risk. Definitely not a sure bet by any means. But I'll probably put it somewhere around here. I do like some of these other ones better, but it's a decent option. I do think it's worth it could pay off a decent amount if you get in right now. Next up, we have RTX, which is an aerospace and also a defense conglomerate. They get a lot of defense contracts and all those sorts of things. So, you know, that's where a lot of money is going all the time. The earnings for the past 12 months were about 4.87. It's expected to be a decent amount higher. It's 6.78. It's almost 50% higher, maybe like 40 something percent. It was a decent amount of dividend, about 1.5%. It could be a combo stock if you look at it in that sense. And just looking at the chart, you're not getting any discounts, unfortunately. But the growth has been pretty decent. And again, this is happening, yes, while the AI boom is going on. But there's a lot lot more to companies like this than just that. They're always getting the defense contracts. They're getting, to implement a lot of these things. And you could say that as volatility in the world has gone up, maybe their price has gone up as well. So if you expect more volatility in terms of, I'm not talking about money. I'm talking about, between different countries and all those sorts of things. Then in that sense, maybe companies like this will make more money. If not, maybe it won't be as much. So again, just looking at the numbers look like, the earnings are going up a decent amount. There's a little bit of a dividend yield. There's a little bit of a potential for growth. There's a little bit of a risk because, you're not getting a decent discount, you're going up, but it's shielded against maybe some of the AI blowback. I don't know if a company like this is going to be that much affected by stuff like that, so maybe it's a good hedge against that. So overall, it just seems like a low A to me. So I'll probably put it somewhere around here. In fact, we have a lot of companies in A. We need to maybe start changing some stuff around. But for now, we'll leave it be. We'll see how it goes going forward. To be fair, we're starting from the companies that have the largest market cap. So it's expected to be a little bit more lopsided in terms of how many good companies we have versus how many companies are maybe not the best investment right now. So maybe that's why we have so many in A right now. But we'll see how it goes going forward. Next up, we have Philip Morris, which is a tobacco company. They own a lot of brands like Marlboro and a lot of other ones. I'm not too familiar with them. I don't smoke or anything like that. So I don't know if this is the right investment option for me, but numbers look decent. The earnings were about 5.5 over the past 12 months. For the next 12 months, it's about 8.4. Again, the P trailing to P forward, moving in the right direction. The dividend yield is really nice, 3.6%. That's very, very good, very generous. And the stock price, it has moved a little weird over the past couple of years. It had this massive spike from 2024 to 2025, but it's come down quite a bit since then. So yeah, I'm not really sure what to make of this one, but just the fact that dividend is a decent amount, 3.6%, and as long as, even if this price of the stock stagnates or stays around the same, maybe oscillates around the same number, that's totally fine too. And, we're not buying at an all-time high. There's potential for it to perhaps recover and all those sorts of things. So I don't hate it. I don't particularly love it either. So maybe I'll just put it at a low A because the dividend is a decent amount. But yeah, not too far higher than that. Next up, we have Applovin, which is a tech company that provides end-to-end software solutions for app developers, for all sorts of other software developers. The earnings are expected to go up massively, almost double from last year to this year. And as such, the P trailing to P forward is expected to go down significantly, which is good because at 84.5, again, that's getting close to that 100x, which is like the max you want to see with like the massive stock growth types of things. It just seems very much so overpriced, but perhaps earnings are going to justify it a little bit more, bring it back down to earth a little bit. The stock has grown quite a bit over the past couple of years. Again, you can see that it's definitely gotten in on the AI boom, going from about $40 less than 2 years ago to now $670. That's crazy. But again, how much more room does it have to grow? It's probably the wrong time to get in right now. Like, you would have wanted to get in on this stock much earlier. There's a lot of much better entry points. If it does fall again, or even here, over here in November, just a little over a month ago, or just about a month ago, it would have been a much better entry point. Right now, it just seems way too overpriced. And again, the trailing was 84. If the earnings are there and it can maintain these levels, maybe it'll just justify the price. It doesn't necessarily mean the price will keep going up. So I'm a little bit more skeptical on this one just because of that multiplier being so high. So I'm just going to put it in B. Put it somewhere around these ones. Not the best option. Not terrible. If you go in on an investment like that, there's a lot of risk that comes with it, and I'm just going to be a little bit more risk averse on that one in particular, and I think it just belongs here rather than with some of these other companies. Next up, we have McDonald's. Who doesn't know McDonald's? Everyone knows them. Their earnings for the past year, 11.7, expected to be 13.2 over the next 12 months. That's pretty good. The P trailing to P forward, moving in the right direction. They're a little bit high for a company like McDonald's, though. I would have liked them to be below 20. It seems like it's a little overpriced at those multipliers. The dividend, there is a decent amount of dividend being given, 2.2%, but it's not super high. It is over 2%, so that's fine. And also looking at the chart, I mean, it just looks like a classic dividend stock, right? But it's a dividend stock that only pays you 2.2% or 2.3%. If this stock was giving you 3% or higher, that's fine. That's totally fine. You can oscillate as much as you want. It's totally fine by me. But 2.2, it seems a little low for an oscillating stock like this. And really, how much more room does McDonald's have to grow? McDonald's seems like one of those companies that is like, it's already pretty much as high as it's going to get. How many more markets can it break into? How many more streets can we have like McDonald's open in? Like, it seems like it's already in every street, right? So maybe it's just me, but with this particular company, I'm not a huge fan. I might even put it as low as C. I know it sounds maybe crazy to some of you guys. Maybe you expected this to be quite a bit higher, but not a particular fan. Next up, we have T-Mobil, very famous telecommunications company. Earnings look fine, going from 10.4 to 11.55 over the next 12 months. There's a little bit of dividends. It's less than 2% though. It's 1.88, almost at 2%. It is being offered at a little bit of a discount right now though, because it's fallen hard over the past 7, 8, 9 months, from an all-time high of like 270 or so down to just 195. So it might be a good time to get in on this particular stock, but I mean, again, how confident are we in T-Mobile? You know, it's how much more room do they have to grow? How much more can they innovate? How much more, if you do believe that, I don't know, there's 6G or something like that coming out, it's going to be massive. They're going to be one of the pioneers. In that case, that would make sense. But as is, I just don't see a lot of value. It could just stagnate. It doesn't even have to like fall further down. It could easily just stagnate around this price that it is right now. And the earnings being about 10% higher, that's decent. But the P trailing to P forward, it's not that big a difference either. It's about, again, 10%. It's okay. The dividend, again, if the dividend was quite a bit higher than 2%, if it was 2.5, 3%, then that's probably a different story. But at 1.88%, I just not too confident about this particular stock. I'm going to put it not too far down, maybe like somewhere in B. But there's some potential with it, but nothing too crazy. Next up, we have Abbott Laboratories. They're a company that produce medical equipment and such. And looking at their earnings, expected to go down quite a bit. Expected to go down from 7.97 over the past 12 months to 5.67 over the next 12 months. And even their dividends aren't quite that high. So I think we've seen enough. This is a classic case of just straight to C, even could be D. It's not a huge drop off, so I'll just leave it in C for now. I expect we will see some other companies that might be a little worse, but if D is really empty, we might drop it down even. Next up, we have Thermo Fisher, which produce a lot of lab equipment and analytical equipment. Their earnings are expected to go up a decent amount, 17.3 over the past 12 months, 24.6 over the next 12 months. Not really a lot of dividends though, so we're just looking at growth. The P trailing was quite a bit for this kind of a company, 33. It's a little bit on the high side, coming down to 23 over the next 12 months. That would be good if they can manage that, but doesn't look that great. You're also buying at, I mean, not the all-time high, but the recent time high, and some of these, look at this. Some of these oscillations are crazy. I mean, oscillating from 600 to 400 back to like 600. Yeah, it just seems like way too volatile for my liking. There might be some people that like this type of stock, but for me, it's pretty much an avoid. Do I drop it as low as C? I might actually. It's a little bit higher than some of these other companies, but not for me. Next up, we have Applied Materials, which is a hardware company. They work on semiconductors and solar panels and stuff like that. Their earnings are expected to go up quite a bit, from 8.68 to 11.37. They don't pay a lot of dividends. We're only looking at growth right here. The PE trailing, again, it's a little bit higher than I would like it to be. It's almost at 30. Expected to go down to 22.8 if it can hit those projections. Looking at the chart over here, you are buying at an all-time high, but that's barely an all-time high because it almost hit 256 over here like a year and a half ago, and then fell all the way down here. And again, some of these volatile behaviors, it just kind of puts me off, to be honest. I prefer stocks that, you know, they go up nice and smooth. Maybe they come up and down a little bit, oscillate a little bit, not oscillate this violently, right? It just seems too high a risk. Sure, sometimes you can catch lightning in a bottle, but often it just seems like a headache. So not for me. It could be a good option for some other people, but I'm going to put it right next to Thermo Fisher. Next up, we have PepsiCo, which, yes, they produce Pepsis and also a lot of other beverages. Their earnings look to be going up a decent amount from the past 12 months, 5.26 to 8.56. The PE trailing, again, was quite a bit high for my liking for this type of a company, because it's not a growth stock, you know, so like being 28.66 times the earnings seems a little much. It's expected to go down, but again, we'll see if it does that. The dividend is very good, though. Dividend is 3.73%. That's very nice to see. So I don't hate it. I just don't love it as much as Coca Cola, so I'm not going to put it in A. I will put it over here because it does get you a lot more dividends than some of these other dividend companies that we're looking at that we were kind of like about. And I kind of feel the same way. It's not the worst investment. It's fine, but doesn't particularly excite me either. Next up, we have Lam Research, another semiconductor company. This one, the earnings are expected to go up a little bit, 4.5 to 5.6. For this type of company, I can understand 35x P2E, because again, this is an AI company. It's a huge growth stock, so I can understand that. But I would have liked the earnings to be going up a little bit more for this type of company, for it to be worth the investment. And also, given all the competition with the semiconductors, all the other companies we've looked at, again, it just screams a little too high risk for my liking. And again, if there's any sort of an AI bubble, you know what's going to happen with this. It's not going to be pretty. So overall, it is quite a bit high. I mean, look at that. Over the past 7-8 months, it's gone basically from 60 to 160. That's a decent amount of return, but I mean, it's had its ups and downs before that as well. Not a big fan. It's not that bad. Again, it's fine. It's not as bad as some of the companies we put in C or anything like that, but it's just not something I'm particularly looking into. It doesn't seem like the right time to get in either. Maybe if this company fell down like quite a bit, if there's some sort of correction, then maybe it could be worth a look. But right now, I'm just not too interested. Next up, we have Citigroup, another financial company, Citibank, all those sorts of things. The earnings are expected to be up a decent amount, from 7 to 10. P trailing, P forward. Again, these are more reasonable multipliers. We want to keep these below 20x, so that's good. 15 and then going to 11, that'd be very nice if they can hit that. Seems very stable. You get 2% dividends, which is nice. It's just over 2%. Maybe there's a little potential for growth, and I can be happy with this. You are buying at an all-time high. It would have been nice if there was at least a little bit of a discount. But again, similar to some of the other companies we've looked at, it's really good to see this trend. But then, I mean, look at this. Since 2021, it absolutely crashed violently. I mean, it makes sense. It's a financial company, right? And that's around the time when it wasn't looking too particularly pretty for financial companies. But again, a lot of oscillation over time. So for this amount of oscillation, we would want a little bit more dividends than just 2%. So that's why I'm not a particular fan of this one either. Again, it could be okay, but again, you're buying an all-time high. I'm just not particularly happy with that. I'm not gonna put in. Probably not in C, but very low B. It looks about right. Next up, we have Walt Disney. And Walt Disney is a very volatile company as far as, you know, the stock price goes. The earnings are expected to be a little bit higher than last year, just under 10%, maybe like 7, 8, 9%, something like that, going from 8.85 to 7.38. There's very little dividend, 0.9%. And again, the one good thing that I will give them is that their multipliers are not too high, so that's good. So it's not really super overpriced. But I mean, just look at this chart. It's kind of all over the place. I mean, what kind of company is this? What are you guys doing? And also look at where they were in 2021. Right, and of course, they've had a lot. There was a lot of optimism over there with Disney Plus and stuff like that, expanding into new domains. But now that they've settled and Disney Plus has kind of like found its audience to some extent, and it's not going to be changing all that much, do we really see a lot of potential going forward with Disney? Also, a lot of their big movie franchises. I mean, they used to have Marvel Cinematic Universe, which was so big. Star Wars movies that were so big. They're a little bit on the down low right now. I just don't really see the promise with this stock going forward. I mean, there's nothing really that much that excites me that makes me think this is going to make the Disney stock go up massively because it's going to be huge or whatever. I just think they're not in the best moment right now, and I'd like to see a little bit more from the company before I can change my mind. I'm probably going to put it somewhere in mid to low Bs. Probably somewhere around here. Looks about right. Next up, we have Linde PLC, which is an industrial gas company, another energy company. And as we can see over here, the earnings are expected to go up by about 20% or so. They're expected to go up from 15 for the past 12 months to almost 18 for the next 12 months. And as such, the PE ratio, again, is expected to go down a decent amount. There's a little bit of a dividend with the stock, about 1.44%. But again, that's not high enough to be worth it on its own. We can take a look at the chart as well. And again, we can see that it's a very volatile stock going up and down rapidly on numerous occasions. And again, I'm just not a fan of these types of stocks personally. Again, if the dividend is very high and it's oscillating around a specific number, and especially if you can get in a little bit cheaper, as you can hear, then that's fine. But again, the dividend in this case is not high enough to justify it. So for me, this one's going to be like maybe a low B, high C. I'll probably put a low B because, again, at least you're getting in for a good price right now, but not a huge fan of this one either. Next up, we have Intuitive Surgical, another biotech company. And as we can see over here, the earnings are expected to go up about 20% or so. They're expected to go up from 7.55 to 9.7. The P for the past 12 months, the P ratio is actually quite high. Again, for some tech companies, maybe we can be okay with this kind of a multiplier. With biotech, again, it's a little bit riskier. So I don't like just how risky this stock looks from the outset, and it is expected to do better over the next 12 months. So that's a positive sign, and it's expected to come down quite a bit, but it's still above a 50x multiplier. So just overall, this is the type of stock where it could do really well. It's possible. If it ends up doing really well over the next year or two, I wouldn't be shocked out of my mind. But there's a lot of risk with it. So again, because of that, I'm just not particularly interested. So for me, it's going to go into maybe a high C. Next up, we have Qualcomm, a very famous chip designer. A lot of Android phones and a lot of mobile phones nowadays have Qualcomm chips. So they're very, very well renowned. The PE ratio is expected to fall a decent amount, and that's because their earnings are expected to go up by quite the margin, almost 3x. And on top of that, you get a decent amount of dividend with the stock as well, almost 2%. Again, it's just barely under 2%, so not quite enough on its own. But the fact that earnings are expected to go up so high, that does bode well for the stock as well. And over here, looking at the stock on its own, it does seem a bit of an oscillating stock. I mean, it keeps going up and down around, the same median or same mean. So again, it does seem kind of like a little bit more of a dividend type of stock, but right now might be a particularly good time to get in because the earnings are expected to go up so much, and it's not anywhere near the all-time high. The all-time high was over 220. Right now it's about 178. But that said, it's not particularly amazing either. So if the stock was more stable, if it was a steady growing stock, or if the dividend was a little bit higher, if it was like 2.5 or 3%, then of course that would change a lot of things. But at just barely under 2%, I don't know if that's enough. The earning numbers are really good, so I can't put it too far down on the scale. So I'll probably put it at a high B or maybe a low A, somewhere around there. Maybe just over here at a high B because, again, I'm not a fan of those oscillating stocks unless they give out a lot of dividends. Yes, the earnings look good, but I think, again, it's a type of stock where I think I'm okay. Even though there is some potential there, I'm just probably not too interested. Next up, we have Intuit, which is kind of like a financial tech company. They have a lot of famous products, like Credit Karma is one of the famous ones that I've talked about previously on this channel. So they provide some of those financial services with particular apps and those sorts of things. Their earnings are expected to go up a decent amount from 14.6 to 26.3, just almost doubling, which is pretty good. And again, their PE ratios are expected to fall a decent amount. It is quite a bit high though. I mean, this is more of a tech kind of a company, but it's not a tech company like, an AI company that's really taking off with the boom. It's a little bit more like on the financial side of things. So it would have been nice if the PE ratio was a little bit smaller. It is going to be smaller at least it's expected to be smaller in the next 12 months. So that would be nice. But again, I'm just a little cautious with this one. Doesn't have a lot of dividends. So again, let's take a look at the chart. And again, you see a lot of oscillation with this stock as well, but the trend overall isn't too bad. You can see that over the long term, again, there has been a decent amount of growth. And that's why you get into these kinds of stocks. You're getting a little bit of a discount from the all-time high at around 813 just a couple months ago. So, it might be a sneaky little pick, this one. I'm not too in love with it, but it's one of those stocks where, I wouldn't mind having just a tiny bit of, because I do see some potential and I do like their products. I have used their products myself. I think they're very good and they have a very good user interface. And again, it could be a little bit of a hedge against all the other tech companies because they are not as reliant on the AI boom and all those things. So if you want to balance out your portfolio a little bit against the other tech companies and just have a little bit of a different kind of tech company, like a finance tech company, then it really could be a sneaky little pick. So you know what? I'm going to sneak it in right there, like at the low A. It's not super high. And if A gets crowded, I don't mind really bumping a couple of these guys down to B. It's in and around that area, but I do like it a little bit more than Qualcomm. I just think it's a little bit of it could be like an alright little pick. Definitely has its risk. It's definitely not like an easy recommendation to anyone or anything like that, but I don't mind it too much. Next up, we have GE Verona, which is a renewable energy company. And right off the bat, the PE multiplier for the past 12 months, that's just too high. Particularly for an energy company, over 100x. I mean, that's kind of ridiculous. It is expected to fall by a decent amount. The earnings are expected to go up and almost double. So that's at least a little bit better. But again, I'm still a little concerned. Even at 52x, that's still a lot for an energy company. I understand they're renewable energies. They're investing a lot into that. But you got to get the earnings up a little bit, at least compared to the price. It seems like the company is just a little overvalued at this point. And here you can see that it's basically at its all-time high. So it just looks like the absolute wrong time to get in on this stock. So maybe if you were investing a year ago or something like that, then the numbers would have looked a lot better. And obviously it's performed very well since then. But right now it just looks like the wrong entry point. So for that reason, nothing against the company itself. It could be a good company if it does come down like a decent amount in price. If there is a correction or something, it could be an interesting pick. But right now I'm just not particularly interested. I'm going to put it in C. Next up, we have Intel, and oh my god. Oh my god. Need I even say anything? You know what? I'm just going to do that, and we're just going to move on to the next one. Next up, we have ServiceNow, another tech company, a cloud computing company. And this one, again, the multiplier is up there. Let's take a look at the earnings. The earnings are expected to go up by a decent amount, almost 2.5 times from the past 12 months, which was about 8.27. It's expected to go up to 20.41. There's no dividends or anything like that, so we're just looking at pure growth. The multipliers are a little bit high, but again, maybe for some tech companies, we can kind of understand that. It's a cloud computing company though, so again, I'm struggling a little bit with this. And looking at the chart, I mean, it's kind of all over the place. It's just, again, these kinds of companies, maybe there could be something there, but there's just way too much risk, way too much uncertainty, unless if you really know these companies well and you have some reason to believe that their specific product could really take off or their specific product could really change the industry. I would avoid going near these companies. Not because they can't do well, they obviously can. It's just way too speculative and way too difficult to tell what's going on with any of them. So I'm just going to, maybe it's harsh to put it in C, maybe B is more appropriate, but I'm just not interested in these kinds of companies, so I'm just going to dump it and see. Next up, we have Uber. And I do like companies like Uber because I think there's a lot of area for them to grow when it comes to, in particular, automated cars and those kinds of markets, especially if they are on the ball and trying to innovate, which I know Uber is. The earnings are expected to go down, though. That's the big issue here. They're expected to go down from 7.8 to 3.5. So that kind of kills a lot of the enthusiasm I have for this company. Even though I do believe that in the long term, it really could have a lot of potential. This might just be the wrong time to get in on this stock. And that's really the issue here. And we can see the PE ratio over the past 12 months was 11, which is a great multiplier. It's going to be almost doubling over the next 12 months. That's not good. And the stock price, again, it's been kind of all over the place as well. And it just might be the wrong time to get in on the stock. If it does come down a little bit further, then perhaps we can look at it. And also, if their earnings just are looking a little bit better, the outlook for the next 12 months are looking like they're going to be improving instead of going down, then again, I do like the stock over the long term. And I'm not going to rate it too far down. Even though it does have lowering earnings, I'm not going to put it like in D or C because I really like the company and I believe in their products over the long term. It's just right now is, I think, the wrong time to get in. So I'm going to put it in a low B, maybe like somewhere around here. Around Walt Disney or something. Next up, we have TJX Companies, which is an amalgamation of a bunch of different brands that are very famous, like HomeSense, Winners, etc. A lot of these big department stores. The earnings are expected to go up a tiny bit from 4.5 to 5.16. There's a little bit of dividend yield, 1%. That's nothing too much to write home about. The PE ratio, 34.5. Again, it's a little bit high for this type of a stock. It's going down over the next 12 months, but it's still not too, like, it's not the range that we like to see. I would like it to be below 20 for these kinds of stocks. It's just, I don't see the need for it to be so overpriced, particularly when it doesn't really have that much room to grow. And right now it's basically at its all-time high as well. The stock does look nice over time. It does look like the growth has been steady. So that's probably indicating like very good management and very good expansion. But again, the numbers are fine. They don't look all that amazing. And the growth, I mean, you can see it's grown a decent amount, like over basically 2 years it's gone and got you like what 60-70% return, which is really good. But can it keep that up though? And that's the real issue. And the earnings are just not necessarily there to give you a lot of confidence that that's going to be keeping up going forward. It might still produce some returns. Is it going to be as much as the past 2 years? I mean, again, I do like the shape of the stock, though. I will say this. The shape of the chart does give me some confidence. From basically July 2022, it's very smooth. Look at that. Look at that. There's not a lot of volatility. There's not a lot of crazy movements. So that does give me some reassurance. So I'm not going to put it too low. But again, the numbers are just not there for me to rank this one like super high either. I'm probably going to put it like at a high B, maybe above Qualcomm. Yeah, maybe you're just right there. It looks about right. Next up, we have AT&T, very famous telecommunication company, and the earnings are just not looking great. They're expected to go down from 3.08 to 2.22. That's a pretty big drop from, that's almost like 30% that it's dropping. PE ratio going from 8 to 11. Now, I will say this, the 11 multiplier is actually still not that bad. So perhaps the stock was a little undervalued. Now the earnings, even though they're coming down, perhaps it's not going to affect the value of the stock too much. This is what I really like about the stock, the 4.5% dividend yield. That's really nice. That's really good. So that basically means that even if the stock is like oscillating and it's not like gaining a lot or losing a lot, it's just kind of oscillating around like kind of an average, that could also still be fine because you're regularly getting that 4.5% dividend payments. And just looking at the oscillation over here, again, it seems like you're getting a little bit of discount from the all-time high, but just if you zoom back a little bit, you can see that, you know, it's still pretty decent amount higher than it was just a couple years ago. So it's a tough one, this one. The growth has been really good at points, but then there have been points where, you know, it's been doing all sorts of mad things. So it just might be that it's one of those stocks where it oscillates over long terms. But again, if this is the oscillation we can expect, let's say a low of 13, a high of about 30, and we expect to see that like on numerous occasions over the years, Buying at 24 is a little bit too high if that's the range we're going to expect a lot, unless we see actual growth. And again, we're not seeing higher earnings, we're seeing lower earnings, in fact. So that doesn't give me a lot of confidence that this pattern is going to break and we're actually going to start seeing some nice real gains again. It's just, it seems like maybe it's the wrong point to enter the stock, but the dividends are very nice. I will give that. So I'm not going to rate it too far down. Again, the dividends are really doing a lot of heavy lifting here. 4.5% is really good, but it's just the outlook on the stock does not look good. The lower earnings does not look good. The oscillation, the previous oscillations, a little dicey. So maybe I'll put it like in a mid B or something like that. Maybe not quite as low as some of these ones here, but perhaps somewhere around, maybe around, Palantir, Oracle for maybe slightly different reasons, but similar to these, if the price of the stock does come down like a little bit more, then I might be a little bit more interested in these stocks. So that's some of the similarities there. But other than that, again, I'm just not particularly interested in these stocks right now, but I am keeping an eye on them. Next up, we have Verizon, and this one looks a lot better than AT&T because, I mean, look at this. Dividend yield 6.66%. That's really nice. And the earnings are actually expected to stay rather the same. I mean, yes, it seems like it's stagnating, but if you get me that much dividends, no problem. Stagnate all you want. I'll take those regular payments. Thank you very much. And again, just looking at the stock performance on the chart, it looks like you're getting a little bit of a discount if you just look at the past year, because the all-time high was 47.35, and it's around 41 or so right now. But I mean, if you just zoom out a little bit more, you can see a lot more oscillation, and then you see some the all-time high was actually over here. So again, the stock, it does look like, and I mentioned this earlier, once companies start offering you more than just 4% or 5% dividends, that does kind of signal that, there are some other issues that they have to offer so much in dividends to still entice investors to come in. So the question is Verizon able to keep up these levels and stay and at least maintain this oscillation over here that it's been seeing over the past year or so? Rather than, some of these other crazy oscillations. And of course, that's anybody's guess. I will say this though, from whatever perspective you look at it, you're getting a good price. You're coming in for way cheaper than the stock has been for a very long time. So I don't hate it. But of course, it's very risky. It could easily just plummet just all the way down, or it could perhaps maintain its levels, maybe even go up a little bit, right? So I do think there's quite a bit of risk with this one. But given that you're getting a very high percentage dividend yield, and also the earnings, at least for the next year, seem to be on par with what they've been for the past year, it does seem to indicate it's not super unlikely that the stock maintains its levels. Maybe it stagnates, maybe it doesn't grow a lot, but maybe it doesn't fall all that much either. So, of course, not this is guaranteed. It could do all sorts of things. But just because of how high that dividend yield is, I'm gonna do it. I'm gonna drop this at a very low A, and again, I'm gonna offer a very strict caution that this stock could absolutely implode out of nowhere. There's definitely a lot of risk with it, but that a high dividend yield, at least for now, seems to be mitigating that risk a little bit. And also, given that there are earnings that are looking very good for the next 12 months, I think it might just be worth the risk to have at least a little bit of it and then see how it goes from there. Next up, we have Amgen, another biotech company that works on treating diseases and all sorts of things. The earnings are expected to go up a decent amount from almost 13 to 22, almost doubling the earnings. And we have a decent amount of dividend yield, 3%, not bad at all. The PE ratio going from 24.5 to 14.4. Now, 24 is a little bit higher than we want to see, but 14 is very, very healthy. If it's a 14x multiplier, that's totally fine. We can definitely deal with that. Even if it's like at a high teens, like a 17, 18, even that's fine if it slightly misses the earnings projections. And just looking at the chart over here, again, there's a lot of oscillation, but this is a dividend stock. It's a 3% dividend stock. It's not like a small dividend. It's not like 1.5 or 2 or something. 3%. Now we can maybe be a little bit more accepting of these oscillations and a little bit more of a risk with the price of the stock. And we are getting a little bit of discount from the all-time high, down from 347 to 317. So it's not a bad time to get into this stock either. I'm not like a big fan, but the numbers look good, the earnings look good, and the dividends are pretty nice. And again, with the higher earnings, is it unfeasible that there is at least a little bit of growth so that we can at least capture back some of that lost value since the all-time high? I don't think it's unfeasible at all. I'm not going to put it too high, but I think somewhere around like the low A's or something like that definitely could do. Next up, we have Booking Holdings, and this is again another huge company that has a lot of different bands that it covers. This is stuff like Bookings.com, OpenTable, and a bunch of other ones. The earnings are expected to go up by a decent amount from 153 to 266. That's very good. That's almost like a 60-70% increase. And the PE ratio, maybe a little high at 34, but coming down to a little bit of a healthier margin, just under 20 at 19.9. There's very small dividends with the stock, so we want to see a lot of growth. I mean, the higher earnings are definitely helping with that. And just looking at the growth of the stock over the years, again, it does seem very smooth and very nice for as long as we can see. I mean, if you take it from 2020, and of course we know what happened in 2020, up until today, it's been a very smooth ride, all the way from a low of 1,200 to a high of 5,300. Now, the only thing that I will mention is like how much more room does it have to grow? Well, given that the earnings are going up by 60-70%, it certainly has at least a little bit more room to grow. So perhaps it could be a decent investment. I'm not too big a fan because, again, when it comes to a lot of these brands that this company holds, Booking.com, OpenTable, it just seems that they have matured to a point where they have captured most of the customer base they're going to capture. They have implemented a lot of things they want to implement. So unless they start coming in with a lot of new products, I just don't know if they're going to have all that much more to offer the marketplace other than maybe just higher earnings in the short term. So for the short term, I think it's actually a very good company. I think it could still keep growing at least a little bit more. But like over the next 10-15 years, is this really going to be a company that is going to have amazing and incredible gains for you? Probably not. So I would put it decently high because for the short term, it looks like a good investment, but not over the long term. So probably somewhere in the low A's looks about right. Next up, we have Charles Schwab, another financial company. The earnings are expected to go up from 4.26 to 5.6. The P ratio coming down from 22.7 to below 20 at 17.2. Okay, that's not bad. There's a little bit of dividend with the stock, 1.1, but again, nothing crazy. The growth of the stock has been decent though over the years. There has been some huge turbulence and oscillations, but if you just average it out, right? Let's say we go back over here to, let's say, not even the bottom over here or the bottom over there. Let's say you if you got in somewhere around here in 2018 at 53, you would still be not that bad off, right? So you'd be at about 96 just 7 years later. So double in 6 years. Again, it just seems like at best case scenario, you're performing similar to the market. At worst case scenario, you're ending up in some weird territories, right? So again, it seems like a bit of a high risk stock without too much upside. And yes, the earnings are expected to be higher, but just a little bit. It's not anything that blows the lid out of anything. So again, I'm just not particularly interested in this type of a stock. I'm going to put it somewhere in B, maybe just below AT&T. That looks about right, but I don't hate it. It just seems like too much risk without all that much promise. Next up, we have NextEra Energy. You would never guess this, but this is another energy company. I know, what would give that away? We have earnings that are expected to go up by about 33%. We have PE ratio going from 26 down to 20. So again, it's just at the level for the next 12 months where I can say, okay, that's fine. But 25, 26, it's still a little higher than I like it to be. Dividend, not bad, 2.77, that's decent. And again, looking at the growth of the stock in the past, you see again, a lot of oscillation, a lot of up and downs. You come to expect these with dividend stocks. At 2.77, it's not bad, but again, we've looked at so many other dividend stocks that have either done better or have had more promise or more potential for higher earnings. So it's fine. It's not bad. You're going to hear this a lot, by the way, because that applies to a lot of companies. We have 500 companies we have to go through. Not everyone's going to be gangbusters. It's fine, but it's nothing particularly that makes me excited. So I'll put it here next to the other energy company that we had with Exxon Mobil. Next up, we have BlackRock, another financial company. The earnings are expected to go up by a very decent amount, 38 to 54. The PE ratio at 28, maybe a little higher than we like, coming down to 20. That's okay, a little bit better. Dividend just below 2%. So again, not quite enough. We want to see at least some potential for higher returns. The higher earnings does give me some confidence with that. And now looking at the performance of the stock, it does seem to be a little bit better and a little bit smoother, a little bit direct going up compared to some other dividend stocks. So even though the dividend is super high, it is acting a lot more like a growth stock, and you can see that it is going up consistently and very, very nicely, right? There are some areas where it's kind of stagnating and oscillating a little bit, but it does recover and go up again. And again, the earnings are expected to be a decent amount higher. It's not just that it's stagnating or it's like having lower earnings. The earnings seem nice. So especially given that you also have that almost 2% dividend, that does calm my nerves a little bit, so that if it falters a little bit, at least you have that regular dividends coming in. But there's definitely potential for growth as well. So I like the stock. And of course, BlackRock itself, I mean, they take in money hand over fist for a reason. They have a lot of great products. And you know what? You could always also look at some of the products that they offer. They offer a lot of good index funds, a lot of good ETFs. So who knows? Maybe it's even better to invest into some of their products than their own stock. But I like their stock too. I'm not like a huge fan of it. I'll probably put it like in the middle A somewhere here. Maybe around Merck Co or something like that. But yeah, it's fine. It's nothing crazy. It's nothing amazing, but definitely all right. Next up, we have Accenture, which is a consulting company, and the earnings are expected to go up a little bit, about like 20% or so, from 12.2 to 14.9. There's a dividend yield of about 2.24%. Not bad, but nothing amazing either. The PE trailing for the past 12 months was a little bit higher than we want to see with this kind of a company, with a consulting company. 22.34. Maybe a little too high, down to 18.29 expected for the next 12 months. It's a little bit better. Looking at the chart, though, it is a little concerning. The price has dropped quite a bit, and even before that, there was a lot of weird oscillations going on. So yeah, and there's some other ones. So again, it looks like a classic dividend stock. At 2.27, maybe the dividend yield isn't quite enough, especially given that the prices come down so much. Like when you have dropped so much in value, you would expect the dividend yield to be a little bit higher as a percentage of the price that you're paying for the share. But at this valuation, it's 2.27. So if it was to recover a little bit, it would basically be, unless the dividends are increased, it would be a lower percentage of the price that you're paying for each stock. So unless you really believe that the company can perhaps get some of that gains back. But again, unless if you know very specifically about what this company is implementing, and I haven't heard anything about this, unless if they have specific techniques using AI, like they're trying to like implement specific things, and that really gives them a competitive advantage over other firms like McKinsey or Deloitte or whatever, I just don't really see necessarily why we'd be so confident in the stock bouncing back. And the dividends currently are just not that high to entice me necessarily. So, not particularly interested. I'll probably put it somewhere around here at C. Next up, we have Texas Instruments, another semiconductor company. Earnings are expected to go up a little bit, which is surprising. For a semiconductor company, you'd expect them to be doing better and better because of the AI boom. So that's a little concerning. Even though it's going up, I just feel that for this kind of a company, I'd like to see a bigger jump. But to be fair to them, the price doesn't seem to be too overvalued either. Because again, with a lot of semiconductor companies, you see 40x, 50x, 60x, 70x PE ratios. Whereas here we see 32 for the trailing for the past 12 months, 29.5 for the next 12 months. So that's a bit surprising. Dividend yield is decent at 3%. That's nothing to scoff at. The chart, again, a lot of oscillation, a lot of weird nonsense going on. You expect this from dividend companies. At 3% though, doesn't look too bad. I mean, it's kind of oscillating around like the average of where we're at right now. So if you get in right now, it seems like you'd be getting in on the average of the current oscillation at least. We'll see how it goes from there. There aren't a lot of, again, what really gives me pause is that the increment in the earnings is not particularly high, given that this is a company that is engaged in an industry that is absolutely booming right now. So I would have liked to see at least a little bit more going in there, but it doesn't seem to be happening. So even though the dividends are nice, it just that specific fact that the earnings aren't going up all that much, it does concern me a little bit. I'm not going to put it too far down, but perhaps somewhere around here in a low B. Maybe that looks a little bit better. I just prefer some of those other semiconductor companies that we took a look at over this one. Next up, we have Boeing. Everyone knows what Boeing is. They make planes and all those things, but look at this. Earnings for the past year, negative. Earnings going forward. It's 2, and that means that basically the PE ratio going forward is going to be 97.5. Do I need to say any more? I think we know where this one is going. Yep, we know where that one's going. Next up, we have Danaher Corporation. I'm not sure if I'm pronouncing that right, but basically another healthcare company, and we see that the earnings are expected to go up by a decent amount, 4.86 to 8.41, almost doubling. The PE ratio, it seems quite high for the past 12 months for a healthcare company, almost 47x. It's kind of ridiculous, but it is expected to drop to a little bit more of a reasonable level at 27, but even then it seems a bit high. So right off the bat, I'm not too interested. There isn't a lot of dividend payment either, 0.54, very low. And just looking at the growth, I mean, it just looks a little overvalued, particularly with that those multipliers of the PE ratio. I will say this though, the earnings going up does look really nice, so I'm not going to put it too far down. But again, some of these volatilities are just insane, so maybe I should put it really far down. I'm going to put it, I'll put it over here, somewhere around here in C. Not particularly great. Next up, we have Amphenol Corporation, which produce products like antenna, sensors, those kinds of things. The earnings are expected to go up by almost 30%, 3 to 4 basically. The P ratio, again, quite high. I understand that they manufacture a lot of tech products, but again, it's just it doesn't seem like they're not really all that connected with a lot of the boom going on. So the high multiplier just doesn't necessarily make sense. It does look like a stock that is a little overvalued. 43 for the past 12 months, going down to 32 for the next 12 months, but even then, not particularly great. Not even a lot of dividends. So we just rely on the growth, and it just doesn't particularly look like a great entry point. It seems like it has grown a very high amount over the past like 7-8 months, almost doubling the price, a little over doubling the price actually. But is this going to continue, or is the stock a little overpriced? It seems like it's a little overpriced, especially with those multipliers. So I'm not particularly interested. Again, maybe it'll keep going up, maybe it'll surprise us. It does even show a little sign of stagnation over here with a little oscillation at the top. So again, I'm not particularly interested. It could, maybe it'll start doing really well again out of nowhere, but I just don't see a lot that would make me interested in this kind of a company. So I'll just put it somewhere around here and see. Next up, we have Arista Networks, and you would never guess they create networks. I know, crazy, right? The earnings are expected to go up a little bit from 2.63 to 3.36. That's about, what is that, like 30% going up? Not bad. No dividends or anything like that. The P ratio, quite a bit high. I understand maybe a little bit with this kind of a tech company, but again, even then, it's not like directly involved with AI or anything like that. Well, maybe a little bit, as you need hardware for building new servers and all those sorts of things, but just in general, I'm not particularly interested in a company like this in specific. The growth does look very smooth and really good, but do we have a good entry point? It's a good question. It's a good question to ask. We can see the past performance has been decent, but past performance doesn't necessarily guarantee future returns. And right now, at the stage that it is right now, it's good that the earnings are going up by about 30%. That's a decent amount that it's increasing by. And it's a little bit of a discount that you're getting right now compared to the all-time high. It's actually a decent discount. It's about a 30% discount you're getting. So 30% discount here and 30% expect higher earnings. It could actually be okay. So I'm not going to put it too far down. I'm not particularly interested in this type of a company, like a hardware company with cables. I'll just not particularly, but the numbers look okay. So for that reason, I'm not going to put it too far down. I'll probably put it somewhere around here, around Qualcomm. But it's not something I'm going to be going out of my way to invest into, at least not right now. Next up, we have KLA, another tech company that works on solutions for semiconductors. The earnings are expected to go up a decent amount, about 30% from 31.85 to 42.13. P ratio, not too far high. That's actually nice to see for a tech company. These are actually okay rates, 37.5, and it's expected to go down to 28.3 over the next 12 months. That's pretty nice. There's very tiny bit of dividends at 0.62, nothing to write home about, but the numbers look good. Again, it's a company that's right at the heart of the AI boom for sure. There's a lot of potential for growth. Of course, if there is an AI bubble, it will be affected. So there's definitely inherent risk there. And you can see the growth has been very nice and smooth and steady throughout the whole AI boom. So how much longer would keep going? At least right now, the outlook on the earnings look pretty good. And what I really like is that the multiplier is not too high. So that means that it's not too overpriced, at least for a tech company in the middle of a boom. So I like the stock. And I'm going to put it somewhere in A. Let's drop it maybe somewhere around here, maybe around NVIDIA. That looks about right. I like the stock. There's, again, a little bit of risk because it is very much so propped up, in at least to some extent, by the AI boom, and an AI bubble will definitely, almost certainly affect it, at least in my opinion. So I think somewhere there in mid A looks about right. Next up, we have S&P Global, which of course is the company that put together the product that we're taking a look at right now, which is the S&P 500. Their earnings are expected to go up very nicely from 13.7 to almost 20. That's a very nice amount. It's like about 50% increase. Very small amount of dividends, but it's nice that it's there. The multiplier is a little high for this type of a company, for like a financial type of a company. 36.4 over the past 12 months. It's expected to go down to 25. Maybe a little bit more acceptable, but still, it just seems a tiny bit overpriced to me. Not that I don't like the stock. I think it could be fine. And again, the brand does a lot of heavy lifting for S&P specifically. But again, just look at all the oscillations. It just looks like a dividend stock, at least for the most part, until you go back and you see some of the incredible gains that it had a couple years ago. And again, it really does depend. If there is a huge boom in the market, a lot of people are going to be excited to invest. So they're going to invest into S&P 500 and all those things. Right now, we're in a particular space where, because of a lot of the fear around the AI bubble, I don't expect everyone to be excited out of their minds to invest, kind of like they were like around these periods, like right around after the 2020 thing. You can see that. And then there was a little bit of a small bear market. You can see that even pan out with the S&P stock. If you lay this on top of the actual market, you probably see a lot of similarities. And then again, after that, once the market starts booming again because of AI, among other things, again, people get excited about investing again, so they start investing, and the S&P also does very well. So right now we're at a stage where there could be a lot of stagnation. There could potentially be a little bit of a drop off as well. So as such, I'm probably going to reflect some of that here. There's a little bit more risk right now with investing into something like the S&P. So I'm going to put it, I like the company itself, and I think over the long term, it will do very well. You might be better off getting their product than the actual stock, just getting the S&P 500. But putting that aside, I do like the company. I think over the long term, they'll do well. Just right now, I'm not particularly interested for the reasons I said. I'll put it in B. Next up, we have Capital One, another financial company. Their earnings were pretty deplorable for the past year. The market expects it to be a lot higher. So if that's the case, that would be nice. But the issue is that it seems like for the past 12 months, they were very much so overpriced. So even though they're expected to be a lot better going forward, again, it seems like a big jump for a financial company to make. So am I too confident about this? No. The numbers look like they're going in the right direction, very much so. But just in general, it this stock just kind of gives me the ick, so I'm not gonna be too excited about it. I'll put it like in a low B, just not for me. Next up, we have Gilead Sciences, another pharmaceutical company working on treatments for stuff like HIV, hepatitis B, hepatitis C, etc. The earnings are expected to go up by about 30% from 6.5 to 8.7. They have a decent amount of dividends at 2.6%. Again, trailing to P forward, expect to go from 18.65 to 13.8. Both of these, again, very decent multipliers, not too overpriced, which is very good to see, particularly with pharmaceutical companies, because if these are too high, then it could get very risky very fast. But overall, it looks, among the pharmaceutical companies, it looks like one of the better options. So I'll put this one potentially even at a low A. You're getting a little bit of discount right now as well with the stock. So I'll actually put it a little bit higher than maybe most would have anticipated. I'll put it at a low A, maybe somewhere around here, somewhere around Wells Fargo or something like that, or into it. I just think it looks like it could be a promising investment. Nothing I would go out of my way to invest into, but it looks promising enough. Next up, we have Adobe. I use their products all the time for making my videos and thumbnails and all those sorts of things. Obviously, they're very popular products that they regularly update and add features to, and I like the company a lot. Their earnings are expected to go up a very decent amount, almost like 40%, from 16.7 to 26.5. They don't have any dividends. It's purely growth stock. But again, even the P ratio are not too high. It doesn't look like an overpriced type of company. It's maybe a little bit higher than we wanted to see over the past 12 months, but it looks like it's going to be a lot better over the next 12 months. So I like the company. I like the stock. You're not getting it at a discount right now. Well, actually, if you zoom out all the way over here, you are getting quite a bit of a discount. I mean, look at this. What happened over here with the stock? They did not have a really good year in 2024 or 2025. So honestly, I already like the stock, but seeing some of this, it makes me get a little bit more excited. You know that famous saying by Warren Buffett where he says, you know, be greedy when others are scared and be scared when others are greedy. That's kind of what I'm saying here. I mean, it looks like a lot of people were scared, and you know, we had kind of oscillations similar to a dividend stock, but then everyone got greedy, and then it just kind of like fell off again. So it might be at the right entry point that you're getting in with the stock. So this one definitely a lot more risky than some of the other things we looked at, but numbers look good, the earnings look good, multipliers are very low, which again makes sense looking at how much the prices dropped recently. But it just looks like the right entry point right now. It's a little bit riskier. Of course, I would not be shocked if it just drops down again, but it looks like the right time. And again, I really do like their products, and I believe in their products, and I use their products all the time. I've seen how much more value they've added. I've seen how much they've implemented AI features into stuff like Photoshop or Premiere. So I do like their new offerings, and also a lot of the social media solutions that they've had. So maybe I'm a little bit biased because I use their products all the time, and I just think they have a lot of promise. But personally, I'm gonna put it at a low A. I think that this could be a sneaky pick. This could really well be a sneaky pick that could really pay off, particularly if you're getting in at the right time, as I suspect you might be. But, you know, again, be cautious with this one. I would not put all my eggs in this basket at all by any means. Very high risk, but it looks like the rewards might just be worth it. Next up, we have Pfizer, a company that a lot of us got to know over the 2020 situation. Again, a pharmaceutical company providing a lot of treatments and all those things. They've been making money hand over fist for a very long time for a lot of things that they've put out into the world. Their earnings are expected to go up a decent amount from 1.7 to 3. But look at this over here. Dividend yield of 6.65%. Other than Verizon that we saw that had similar numbers, nothing else we've looked at so far has been offering anywhere near as much. But again, I always say pay caution when it's higher than like 4 or 5% dividends, because I mean, why are they offering so much? So let's take a look at their stock chart. And again, here you can see a lot of volatility, right? But To be fair, I think part of that is because the stock just grew so much because of the whole lockdown situation and everybody's reliance on Pfizer products, and everybody paying, all the governments paying so much to get Pfizer products. I think that was a big part of why it just was so overpriced at some of these stages. It has dropped quite a bit though, like even lower than what it was before 2020. So that's a bit concerning, but again, at the same time, it might just be the right time, and a little bit of a riskier pick. The numbers look good, the earnings look good. The dividend is very high and very good. So even if it just stays stagnant, again, the dividends are very high that it would justify holding on to it if it just does stay stagnant, doesn't fall too much. A little bit of a riskier play, but I do like it a little bit more than Verizon. So for that reason, I think I just have to put it a little bit higher than Verizon. So it does go into A. How far up the A? Not too far up, probably around Adobe, because I think, again, both of these are a little bit higher risk, but they seem to be offering even slightly higher potential for rewards than their high risk. So for that reason, even though they are high risk, and generally I'm not a big fan of risky companies or risky opportunities, it's just these ones, I kind of get a good feeling when I look at the numbers and their products and just how far they've gone and all those sorts of things. I do get a better feeling on this. Maybe it's just me. It's definitely not for everyone, but I don't mind this one either. So these two are a little bit of those picks where it could definitely go wrong very fast, but I think it might just be worth rolling the dice with these two. Next up, we have Union Pacific, a railroad company, and this one, the earnings are expected to go up a little bit. PE ratio, again, a little bit higher than we like it to be. We have some dividends, 2.27, not too high. And again, just in general, railroad companies don't interest me that much. How much room do they have to grow? And also the earnings, they look fairly stagnant to me. Dividend doesn't look that high. If this was like 3% or higher, okay, maybe I might be considering that, but 2.27, not quite high enough to overcome all those things. I'm just going to keep it simple. I'm going to drop this one into C and not worry too much about it. Next up, we have Lowe's, which is a holding company with a lot of different subsidiaries in the energy sector and the hotels and a lot of different areas. I just don't really like these types of companies where it's just so convoluted, so many different hands and so many different pies. The earnings don't even look to be going up all that much. It's even like a less than a 10% gain. Dividends are not that much either, 1.9. So it's in general, and again, it's at 20. Like I said, if it's around 20, it's not maybe like all that crazy. So just overall, again, I'm not gonna waste too much time with this one either. Just not particularly interested. Gonna drop this one somewhere around here. Next up, we have Progressive Corporation, which is another insurance holding company. Their earnings are looking to be going down for the next 12 months. They don't offer a lot of dividends. Their P ratio, even though it was actually decent for the past 12 months, it's looking to be gaining higher. So again, lower earnings, not even any dividends or anything like that. I'm just not particularly interested. It's an insurance holding company also. Really, is that the type of company we're looking at for a lot of growth? Not particularly, at least not me. So we're just going to drop it somewhere in lower C, actually, because I don't even particularly like it as much as those other ones. Maybe somewhere around here, and we're just going to move on. Next up, we have Analog Devices, which is again another semiconductor company. Their earnings are expected to go up a decent amount, again, particularly with the AI boom and everything. We expect that. They have a little bit of dividends, 1.4, nothing to write home about, but it's okay. The P ratio was 61, which again, for semiconductor companies, maybe we can understand a little bit, but it's good that they're bringing that down. So it's a little bit more stable. You would be buying quite a bit, almost at an all-time high right now. The growth has been decent, again, alongside the AI boom and everything. But again, you can see it's very much so correlated with the AI boom, at least for the past couple of years. But even before that, it was doing very well in terms of growth. So overall, the trajectory looks good. The earnings look good. I don't mind this particular stock. I'm not a huge fan of it in particular, but I think it's all right enough to be maybe like at somewhere around Qualcomm or TJX. It's fine. It definitely has some potential for growth. Honestly, maybe it could be a little bit higher, actually. Maybe I'll put it somewhere around here, maybe slightly higher than Adobe and Pfizer. It's a little bit safer than Adobe and Pfizer. The risk really is that if there is an AI bubble, it very much so could be affected as well. And also, there's a lot of competition between the different semiconductor companies. So I'm not too in love with it. Maybe I should put it a little bit further down. Maybe I'll just put it next to Qualcomm, actually. That just looks a little bit better. With the Adobe and Pfizer, those are a little bit more opportunistic. With this one, it doesn't seem like the best entry point either in particular. So I'll put it here in B. I could definitely hear an argument for like maybe a lower A or maybe even a middle A. But right now, it just feels more right in a higher B rather than a lower A. Next up, we have Bioscientific, which is a biomedical engineering company. They're trying to engineer a lot of solutions for medical situations. This could be things like treating very complicated cardiological problem or neurological problem, all those sorts of things. The earnings are expected to go up a decent amount from 1.87 to 3.47, almost doubling. There's no dividends or anything like that. The P ratio was a little bit higher. It was almost like a tech company. It's expected to come down a little bit. So I don't love the multiplier all that much. Again, a lot of these healthcare companies, biotechnical companies, they're just a little too risky for me. I'm not particularly interested in them, and with the higher multipliers, it just puts me off a little bit. Nothing against this one in particular, and again, the fact that the earnings are almost doubling, that definitely does help. But overall, maybe like a high B or something like that I can do, but I'm just not particularly interested much more beyond that. Just me, I can definitely see the value in it though, and there might be some people who go for it and it might do very well over the next couple of years. It's just not for me really. Next up, we have Stryker Corporation, which is a medical technology company. Again, these are very speculative types of companies. The earnings are looking to be improving by a decent amount, almost doubling from 7.62 to 15 for the next 12 months. PE trailing coming down. Again, that was quite a bit of a high multiplier at 46.5, coming down to a little bit of a more decent, acceptable level at 23.65, but again, still a little bit higher than we would like to see. And just in general, again, medical tech companies, these are very speculative. Yes, if they have a breakthrough or something like that, it could be a very potentially high reward type of scenario, but just in general, these types of companies, they're a little more high risk than I like them to be. So not a bad option. Again, the high earnings going up by almost double, definitely a good sign of things to come. So I can't put it too far down, but again, just because I'm not particularly interested in these kind of more speculative companies, I'm gonna have to put it somewhere in like the mid B. Probably put it right next to Broadcom or something like that. Next up, we have Palo Alto Networks, which is a cybersecurity company. They're also implementing AI into a lot of their platforms, so they've been able to get a little bit of a boost with the AI boom, and their earnings are looking to go up by a very nice margin from 1.58 to 4.35. Again, that's almost tripling, so those are really good signs to see. Their PE for the past 12 months was extremely high though, at 121, above 100x multiplier, but it looks like it's going to a little bit more of a reasonable level for this type of a company at 44, but again, the risk is definitely there. And, I don't trust something like a Palo Alto Networks as much as I trust some of the bigger players in terms of like long-term growth. Of course, in the short term, as long as the AI boom is going well and as long as the earnings are looking as good as they are here, it could be very high potential in terms of the returns that you can get from it. But just in general, again, too much risk. I'm going to put it in B somewhere, maybe slightly higher than Stryker and Broadcom, but I'm not particularly interested in it either, just because, again, if there's any correction, any bubble bursting, this is going to be possibly one of the bigger ones that falls. Next up, we have Deere & Company, which is a company that produces a lot of agricultural machinery and a lot of heavy machinery, all those types of things. Their earnings are looking to go up by a decent amount from 18.5 to 22.78. That's about, what is that, like a 20% increase, not bad at all. Their P ratio was a little bit higher than we like to see for this type of a company at 26, but it's coming out down to 21, a little bit better. Again, looks like just another B. There's going to be a lot of mid-range stocks here, which are okay or could maybe have a little bit of a potential, but also carry a lot of risk. This is one of those ones that's a little bit safer, but also just not looking like a particularly exciting option. There's a little bit of a dividend yield at 1.34, but again, are we really looking to heavy machinery and agriculture for the next boom or the next company that could absolutely blow the lid off the door? Not particularly. And also, it is not a particular company where I can say, okay, we have like high dividends coming in, or it's a very safe company that grows like very nicely over time and stuff like that. So just in general, it seems like a very mid-range company to me. It doesn't look bad at all. Again, the earnings look decent, and the P ratio, again, coming back down to an okay level. It was a little bit high for the past 12 months. But just overall, again, another B. We're going to have a lot of Bs, I feel, in and around this area. Next up, we have Eaton Corporation, which is a global electricity and power management company. Their earnings are looking to go up by about like 30% from 10 to 13.75. They have a little bit of a dividend, but nothing, again, to write home about. 1.25%, very low. Again, we need nice growths to supplement that. Otherwise, that's just very, very low. Their PE ratio was, again, a little bit higher than we like to see at 33.2. It's going to be a little bit more reasonable, but even at 24 times for an energy company, again, unless if you expect there to be a lot of investments for the future, a lot of like innovations and stuff like that. In general, I just like to see a little bit of a lower PE ratio so that I can feel confident that this stock is not like super overpriced. It might be okay, but it just doesn't give me a lot of confidence necessarily. So you guessed it, we got another B. But the question is, where do I put it in relation to the other ones? In general, I like the energy companies a little bit better because it just feels a little safer to me, because no matter what happens, we always need our energy, we always need our electricity. So I'll put it a little bit higher than these other companies that we looked at, but again, seems like a middle range B to me. Next up, we have Welltower, which is a real estate investment trust. And in general, I'm actually a fan of real estate investment trusts, but this one in particular, I mean, just right off the bat, that PE ratio for the past 12 months, that's crazy. 140x. I mean, that just screams overpriced to me. Even though it looks like with the projections and the earnings going up by like double or a little bit more than double, it seems even then 67.6 PE ratio. Again, that still seems a little too high for my liking. And the dividend isn't even that high. The dividend is 1.5%. If this was like a high dividend stock, then okay, maybe we can talk about it. But 1.5%, again, it seems a little too risky for me. It just seems, it's screaming overpriced. It might not be, it might do well, they might up the dividends going forward. If that happens, we can definitely take another look at it, or if it comes down in price a little bit so that these ratios are looking a little bit better. But right now, it just screams an avoid to me. I'm going to put it at a low C. And I'm just not particularly interested. Next, we have Medtronic, which is a company that produces a lot of healthcare technology. For example, stuff like pacemakers or insulin pumps, stuff along those lines. Tech that's involved in healthcare. And their earnings are looking to go up by a very decent amount, almost doubling from 3.7 to 6.12 expected for the next 12 months. P ratio was maybe a little bit higher than we'd like to see over the past 12 months, but it's looking a lot better for the next 12 months at 16.3% projected. And their dividends are very nice at 2.8%. That's almost 3%. That's more like it. So I do like this company quite a bit. I'm going to be giving them an A rating, again, for those reasons, that their earnings are looking to go up a high amount, that their dividend is a very nice amount, and also it looks like their P ratio is going to end up being not a crazy high multiplier. It seems very manageable. It's not something that I look at and I'm worried, oh, is this overpriced or what's going on here? So I like the company a lot, and I like their mission. Maybe that's not as important because, we want to invest and make the most money possible, right? But I also like it a little bit better. Not that it affects my judgment too much, but it just feels nice when you're investing into something that's going to be used for a good cause. The money that you're investing is going to be used for research and development of all these things that can help so many lives better. So I like the company already. I like the numbers. I like the potential for returns. But that's like an extra cherry on top that it does also provide that. So I'm going to be rating it an A. I was thinking like a middle A initially, but with that cherry on top, maybe I'll give it a little bit more of a favorable rating. Maybe I'll bring it up a little bit more, maybe right there next to Mastercard. Maybe it's a little too high, but again, I really do appreciate what companies like this do. Not that if the numbers are not right, I'm still not going to go anywhere near them, don't get me wrong. But if the numbers are looking good, then that just makes me like proud to invest in those kinds of companies. So it's going to go a high A for me. Next up, we have CrowdStrike, which is another cybersecurity company. And yeah, these are not great numbers. Again, negative earnings per share for the past 12 months, even as they look to be getting more earnings. Look at this. The P ratio going forward is expected to be over 100x. So this just seems to scream at me, avoid, too much risk. So yep, we're gonna go right over here and we're gonna get another one in D. Next up, we have Honeywell, which is a company that produces a lot of both industrial products specific to aerospace and energy, etc., but also a lot of home-used products such as thermostats, air purifiers, humidifiers, etc. And their earnings are looking to go up a little bit from 9.5 to about 10.3, just under 10% increase, maybe 7-8%. There's a little bit of dividend yield, not bad, 2.26. So it would have been nice if it was a little bit higher, but it's still okay. And the P ratio is not bad at all again, 20.4 going to 18.75. So it seems fine. The only thing about this company that I don't particularly like is that it's just so all over the place. Again, divided into so many different factions. There are parts of it that produce products for this sector, part of it that produce products for that sector. And in one sense, it's good that it's diversified so that, you know, if one sector is being problematic or it's not making as much money, that some of the other sectors can step up and still make sure the company is doing well overall. But on the other hand, it also kind of limits what the company can do, and it's also making it a little bit more difficult to peg exactly, okay, how is this company going to be doing going forward. So in general, I'm just not a big fan of these types of companies that you can't really figure out, okay, what's like the main products that they're going for. It's just kind of all over the place. So for me, it's going to go somewhere in B, but it's not going to go too far down. I'll probably put it somewhere in middle, maybe even slightly higher than middle, because their numbers look good. So I'll just put it over there. Next up, we have KKR, which is an investment firm, and their earnings are looking to go up by a very decent amount, from 2.35 to an expected 6.78 for the next 12 months. And as such, the P ratio is dropping from a kind of a high 58 to a much more reasonable 20. But again, given that the P ratio was 58 for the past 12 months, that tells me that this stock is probably at least a little bit overpriced. And as such, we're saying that it's dropping a little bit in recent times, and there might be a little bit more correction as well. Again, it's just a little risky. I know that it's moving in the right direction. It's going to have a much better P ratio going forward. And of course, the earnings being tripled, that's very impressive as well. But again, it just seems a little risky. So I don't mind it if you are more familiar with their specific portfolio. Maybe, I mean, you should look at some of the other options out there as well. But I don't mind them. I'll probably put them somewhere next to Charles Schwab, because it's kind of in the same boat where it's like, yes, could it do well? Of course it could, but it's just way too risky and way too unpredictable. And there's a chance that it could still be overvalued at this current moment. So there might be better entry points in the future. So this is one that you could definitely monitor. But right now, I'm just not particularly interested. Next up, we have Chubb Limited, which is an insurance company. Their earnings are looking to go up by perhaps a little over 10%, from 24 to 26.3. They have a little bit of dividend yield, very small, at 1.24%. So again, not quite enough for this to be like a solid dividend stock. We need to see potential for growth. Their PE ratio is very healthy though. Their PE ratio for the past 12 months was 12.88. Going forward, it's projected to be 11.73. So I like them. Again, this is particularly what I like, is that the multiplier is so small, and it gives me confidence that, you know, the stock is probably not overpriced, at least not too much. And also the earnings are going in the right direction. I would have liked it to be a little bit more. I feel like if this was just a tiny bit more, if it was maybe 15-20% of an increment, I feel I could have put this in A. As it is right now, it's going to be a very high B for me, almost at like a low A. Later on, if there's too many companies in B, we might even put this up to A. But as of right now, I'm just going to put it at a high B, it's a decent company. If you want to invest into like something a little different, but just at this very moment, it's not enticing me enough to put it up maybe higher than some of these other companies that I really like. Next up, we have Prologis. I hope I'm pronouncing that right. It's another real estate investment trust. This one is looking to actually have lower earnings for the next 12 months, which is, again, not a good sign. Their dividend yield is decent, though, at 3%. So I can't really put them too far down at D. And also, just looking at the P ratio, ratio is a little too high. 38 going to 42 for the next 12 months. I'm struggling. I'm really trying to find a reason not to put this in D. The one thing I'll give it is that real estate for the long term, it's always, well, not always, you shouldn't say always, but it's a lot more tangible as an investment than something like an Intel or something like that, where it could just be like anybody's game. There are so many different companies that are trying to compete for very limited attention, and a very limited number of companies that are interested in buying those semiconductors, and also like whoever has the best one wins out, everyone else is left in the dust. With real estate, it's a little bit different. If you have a huge portfolio and you're able to rent those out and manage them well, you should be able to earn and be able to do fine, at least at the very minimum, on a regular basis. So with a real estate, there's just a little bit more tangibility. So for that reason, not going to quite go down to D with this one, but the numbers are not looking good. So it's going to be a low C, somewhere around here for me. Next up, we have ConocoPhillips, which is another oil and gas company. Their earnings are looking to be going down again for the next 12 months from 7.07 to 618. They do give you a decent amount of dividends at 3.33%, but again, it's just not a great sign to see this, the lowering earnings. Their P ratio is not too high, so I'm not going to go too far down with this one. Possibly like a high C. If, C is getting a little overcrowded, maybe we could push this to a low B, but it just seems like a high C to me at this moment. I'm going to put it like somewhere around here. Perhaps even I'll put it first over here, but not quite enough for it to push into B for me, and B looks to be quite crowded, so I think at a high C makes sense. Next up, we have Blackstone, which is an alternative investment company, and a lot of people call it the best or the leading alternative investment company in the world. They look at, as I just mentioned, alternative investments that are a little bit out of the ordinary, not your just standard stocks and bonds and real estate, etc., just other forms of investment. Their earnings are looking to go up from 3.5 to 6.4 projected for the next 12 months. Their PE ratio was quite a bit high, but I mean, you can maybe understand it because they're a little bit more speculative, but coming down to a little bit more of a reasonable ratio, but still, it's just, it does get me worried a little bit. Is it overpriced or not? So I can't quite put it too far high because of that. Dividend yield is decent though, 2.7%, not bad at all. And I also like the concept. It's a little bit of a different type of a company, and I like those alternative investments, again, just kind of as a hedge against your other investments, and also bringing in a little bit more diversity to your entire portfolio. So I don't mind them, but I do think there might be better entry points in the future, particularly as that P ratio gets a little bit more reasonable. So I'll probably put it somewhere like in the mid B, maybe like a little bit of a lower mid B, somewhere around here, maybe just under these two. Somewhere around there. But again, I will be keeping an eye on this one. If the numbers get a little bit better going forward, I might be a little bit more interested. Next up, we have Vertex Pharmaceuticals, which is another pharma company. Their earnings are looking to be going up from 14.2 to 20.3, which is decent. That's about like a 40-45% increase. Not bad at all. Their P ratio, again, maybe a little high for this type of a company, and pharmaceutical companies. You got to be very careful because a lot of times they're very all over the place and they're extremely volatile, extremely risky. 31.86 over the past 12 months. For the next 12 months, looking to be 22.2 as projected. So not bad, but again, just pharma companies, unless the numbers are amazing, I'm just going to be a little hesitant. There's no dividends either, so we're just looking at pure growth. So, and again, I'm not going to be too interested in listening to claims of, oh, we got this waiting for FDA approval, or it's only a few days, it's only a matter of days before this one comes to the market, it's going to disrupt everything. It's just been there, done that. I've heard that too many times. Not interested. It's not bad. The numbers are decent, so I'm not going to put it too far down. Probably like a slightly higher than mid B, maybe somewhere around here, around Charles Schwab again. But yeah, not particularly interested. Next up, we have Parker Hannifin, which is an engineering company. They focus a lot on motion, so this could be applied to a lot of different sectors like aerospace, etc., or just machinery. Their earnings are looking to go up from 28.08 to 33.1 almost over the next 12 months. Again, not bad. That's about like a 17-18% increase. It's okay. Dividends are very minimal, 0.8%. So those are basically negligible. We need to see a lot of potential for growth. And again, I don't love the multipliers at 31.5. They're not too bad, but again, nothing particularly great. Looking to project to be 26.77. If these are under 20, then I'm getting a little excited. But if it's above 20, I'm just there are better options out there to invest into. So I know we've been doing a lot of companies in B, but it just seems appropriate. Probably somewhere around here. Maybe I do like Blackstone and Uber a little bit better, so I'll put it over there. Next up, we got Lockheed Martin, which is an aerospace and defense company. Their earnings are looking to go up from 17.9 to 29.46. Not a bad increment at all. That's almost like what, 60-70% increase. It's pretty nice. Dividend yield of 2.78%, pretty good. And also, this is what I like, that the P ratio was not like too bad. It was okay over at 26.8, maybe a little higher than we like it to be over the past 12 months, but it's projected to be 16.3 for the next 12 months. So that's very good. It does give me a little bit more confidence that we're not looking at something overpriced. And again, when it comes to these types of companies, especially companies that have a lot of defense contracts and those sorts of things, I just have a feeling that generally speaking, they're going to be well taken care of. So in that sense, I don't mind this one, actually. I might put this like at a low A. I still don't like see a lot of value more than like some of the best companies I've taken a look at so far, but there's definitely a little bit of value there. It could do just okay. And honestly, I feel like I need to push some of these A's down a little bit because I feel we found perhaps some better solutions along the way. So perhaps we put into it over here. And what do we do with these ones? Do we push these down? You know what? I'll keep it the way it is right now. If A starts filling up a lot more, because I know B is also filling up quite a bit, we'll maybe readjust later. But some of these, the lower A's, particularly Lilly, I feel like we can drop Lilly down. We've looked at some better similar companies. Maybe put it down here somewhere. It looks a little bit better. I know we talked about it earlier. It was a little bit earlier on. We're still figuring out where A and B is going to be, so it just looks a little bit more right here. Perhaps even this. Yeah, I think that looks a little bit better. We'll keep it as is right now, and then we'll see if we need to adjust later. Next up, we have Constellation Energy, another energy company focused on renewable energy, whether it's nuclear or other sorts. Their earnings are expected to be going up from 8.73 for the past 12 months to 11.3 for the next 12 months. The decent amount, that's about like a 30% increase. The dividends, again, almost non-existent at 0.44%. That's pretty irrelevant. We want to see potential for growth. This is the part where I go a little bit hesitant on this one. The P ratio is just a little too high. For the past 12 months, 40.3. Projected for the next 12 months, 31.14. Even the projections are a little bit higher than I'd like them to be. So nothing against them, but perhaps we need to wait a little bit more to see a little bit more promise with the earnings, or see some sort of a correction, maybe the price coming down a decent amount, so that these numbers make a little bit more sense for us to get involved with this particular company. But as is, it's going to go to a low B, somewhere around here. Just barely avoiding the C. Could have even gone to a high C, but I'll just put it at a low B for now. Next up, we have HCA Healthcare, one of the biggest healthcare providers in not just the United States, but in a lot of other companies like the UK as well. Their earnings are projected to be going up from 25.9 to 29.85. That's about like a 30% increase, or I should say 15% actually increase in earnings. The dividend yield is almost non-existent. It's 0.58%. Again, very irrelevant. Their P ratio is not too bad though. 18.73 over the past 12 months, 16.24 over the next 12 months. It's going in the right direction, and it's not too far up. It has come down a little bit in recent times. So numbers are looking not too bad. Doesn't seem overvalued, doesn't seem overpriced. The earnings going up about 15% is not too bad either. Like I've said on a couple of other companies that there were about 10% of increments estimated in their earnings for the next 12 months. This one is about 15%, so it's a little bit better. I just wish they maybe had a little bit of a better dividend, but even as is, it's okay. It's not that bad. Is it enough for me to put it in A? Probably not, but it'll go to a high B. I don't mind them at all. I don't have a lot to be upset about with them. It's just not particularly enough there to interest me a great deal, but it's definitely solid. It's not bad. I'll put it at a high B. Again, if B fills up, we could even push it to a low A as well. Next up, we have ADP Automatic Data Processing, which is a company that allows businesses to outsource a lot of things like, their taxes or their HR departments or some of the talent, etc., stuff like that. Their earnings are expected to go up from 10.14 to almost 12 over the next 12 months. That's close to a 20% increment, about 18% increment. Not bad at all. Dividend yield is okay, 2.38%. P ratio would have been nice if there was a little bit lower, but it's not too bad as is. 26.24 over the past 12 months, projected to go to 22.2% over the next 12 months. So not bad at all. Again, not particularly enough there to make me really excited about the stock and put it in A, but could be a high B for me. I'll probably put it maybe slightly below HCA Healthcare, maybe like right there. Or maybe just behind Analog Devices. That looks okay. Next up, we have Robinhood Markets, which is the company that owns the trading platform Robinhood. I'm not a particular fan of their product, so as such, I'm not going to be a particular fan of the stock either. I just think it's one of those products that was able to get a lot of traction by offering something for quote-unquote free, but then doing a lot of other things on the side, shady things like data collection and stuff like that to be able to have a profit. And I don't like the way companies like this operate, and I just don't know if that's sustainable. I don't know how much longer they're going to be able to go without a lot of controversy coming around with them. So this is a company that I just don't like in general, just because of what the company itself represents, not particularly because of numbers. Numbers are not stellar either. Earning going from 2.4 2.5, barely increasing over the next year, but look at this, the PE ratios are very high. 49.6 for the past 12 months, 47.5 over the next 12 months. So numbers are not great. This would probably be somewhere in like maybe a high C, but again, add to that the fact that I just don't like the company itself either. This one might be a little bit of a personal thing, but I'm just gonna dump this right there in D. Enjoy. Next up, we have Newmont, which is a gold mining company. Their earnings are looking to be going up from 6.4 to 8.1 over the next 12 months, which is an okay increment. That's about 20% or so, or actually that's a little closer to 30%. Their dividend yield is very low, again, 1%. Not enough to justify anything. We need to see potential for growth. But look at this. The P ratios are very good. 15.2 over the past 12 months and 12 for the next 12 months. That's very good. So if the earnings are going up by 30% and the P ratios are so healthy, that does give me a little bit of confidence that this company can do well. Is it going to be ranked too high on my list? Probably not, because again, is there really that much room for growth for a gold mining company unless they find like a new source of gold or something like that? But one thing I will say is that it's a good hedge against all the craziness that we're investing into, all the tech giants, all those kinds of companies. Again, this is one of those companies that is as far away from all of that as possible. So if there's a bubble that bursts, any correction, this company is not likely to be affected by much of that at all. So I like it in that sense. Do I like it enough to put it in like a low A? You know what? Just because of how much the earnings are going up and the fact that the P ratios are so healthy and the fact that gold, I mean, it's gold, right? Gold is an inflation hedge for a reason. I might barely put it in like at a low A, but barely. And, if A starts filling up, I'm going to be dumping it down to like a high B or something like that. But for now, I'll just dump it in at the very low A barely squeezing in. Next up, we have Bristol Myers Squibb, which is another pharmaceutical company. Their earnings are looking to go up by they're basically doubling from the past 12 months at 2.96 to 6 for the next 12 months. Their dividends are looking very nice, 4.73%. That's a very good return. Very good amount of dividends that you're getting, and also P ratios are very healthy. So I really like the stock. Their P trailing for the past 12 months was 17.7, and going forward looking to be 8.7. Those are very good. Once you get into single digits, that tells me that, you know, these are projections, right? So that's assuming that the price doesn't change too much, and, you know, the earnings go up as much as projected. But when we get to those kinds of numbers, that actually tells me that it's probably going to end up in reality being a higher PE because the price of the stock probably will go up. So I like this one quite a bit. So you're getting a high amount of dividends, 4.73% dividends, and very healthy PE ratios. It's a pharma company. I know I've said be careful with the pharma companies. When the numbers look this good and you're also getting so much dividends, I have to back it. Again, just because it's a pharma company, I'm not going to quite put it in S, but the numbers are looking really good. Like if it wasn't because of my fear of the pharma companies a little bit, this might have even gone into S. But as stands right now, it's going to be very high up in the rankings, almost at like a very high A. Let's see where we can squeeze this one in. I think I do like it better than Netflix, to be honest. So I'll just put it over here, right ahead of Netflix. Next up, we have McKesson Corporation, another healthcare company. Their earnings are looking to go up from 32 to 43.8. That's almost a 30% increase. And their PE ratios are not too bad. PE trailing of 25.3, looking to be about 18.6 for the next 12 months as projected. There's almost no dividends though. The dividends pretty much non-existent, so it's not bad. But again, it's just the type of company that really excites me all that much. And again, healthcare in general, I'm just not that interested in unless there's a high dividend. Then we can definitely look at it. But unless that's the case, it's just that's not the type of stocks I look for a lot of potential for growth. And these numbers, I mean, the earnings going up is a decent amount. But the P ratios are okay. Like they're not that bad, but they're not like super exciting either. So just in general, it's fine. Probably like a high B looks about right, but it's not going to be blowing the lid off of anything, at least not anytime soon. Next up, we have CVS Health, another healthcare company. This one, look at that PE ratio. That is crazy. 207.5. The earnings projected though are crazy. I mean, this company is so weird. The earnings for the past 12 months were 0.38. The earnings for the next 12 months projected to be 20 times that. Really? Do we really trust these projections? That seems a little weird. Dividends are decent though at 3.35%. P ratio again for the past 12 months, crazy, 207. For the next 12 months, 11. What? Like, what is this? What is this company? What are these numbers? And just looking at the chart, I mean, it's not even like the prices come down all that much or anything like that. Well, if you zoom back enough, I guess it has come down quite a bit. Let's look at this part over here. So the all-time high was 111. It's at 80 right now. That was a while ago. That was like almost, 3.5 years ago, almost 4 years ago. Not particularly. Again, it just seems way too wobbly. Maybe there's some kind of unicorn company going on here. Maybe if you got in and this blew up, then you could come back and say, well, the writing was on the wall. But it looks too weird to me. It's fine. I'm not gonna put it too far down because again, the projections are crazy good. Even though for the past year, the company has been looking really weird. But I'm not going to particularly put it too high. I'll probably put it somewhere around here. Maybe just under these ones. And yeah, we'll see how it does, I guess. Next up, we have Nike. Everyone knows what Nike is. Their earnings for the past 12 months were 1.95, expected to be 2.5 for the next 12 months. So the P ratio was quite high, actually, surprisingly, at 34.58 for the past 12 months. Expected to be a little bit more reasonable at 26.9, but even that is still a little too high. There's a little bit of dividends, but again, it's not super duper high either. It's 2.4%. At least it's above 2%, but again, Just in general, nothing exciting about this stock either. It's screams to me like a classic middle of the way B. Maybe I'll just put it slightly ahead of some of these ones because it does feel a little bit safer to me than some of these other investments. But to be fair, I don't also see a lot of potential for growth either. So it just seems kind of middle of the way, middle of the road type of thing. Next up, we have Comcast, a major media company. Their earnings are looking to be going down by a significant amount from 6 to 4. That's a massive drop. That's 33% drop. That's why the dividends are so high at 4.77% to make up for the fact that you're probably going to be losing a lot of value. To be fair though, I'll give them this. The P ratios are very healthy at 4.5 and again projected to be 6.67 with these poor projections. So perhaps it won't drop as much as feared because of these. But, you know, if the earning is going down that much, how much longer can you afford to pay such a high dividend? That's the other issue. And it's just a weird one. Again, the PE ratios being so good is the only thing that's saving this company from being like at the very bottom of my list. And also dividend being so high, but I'm not particularly confident about the prospects of this stock either. So I'm going to put it at a low B, but you know, it's one that could be okay. I mean, if it just even stagnates and maintains its level, 4.77% dividend yield is very good, but will it? It's definitely not guaranteed, and it looks a little up in the air right now. So I'll just put it there for now. Next up, we have Altria, which is a tobacco company. Their earnings looking to be go up from 5.24 to 5.59. Their dividend yield is 7%. That's crazy, particularly for a company that is, you know, projecting to have a higher earnings, and their P ratios are so solid. Very, very interesting one. So just based on these numbers, I mean, this has to be ranking very high. I don't love the fact that it's a tobacco company. I'm not a particular fan of tobacco companies, but you can't argue with these numbers. These numbers are crazy. 7% dividends, if they can maintain that, and again, the higher earnings, very good PE ratio. None of this suggests they can't maintain that at a reasonable level, and none of it suggests that they can't maintain their stock price at least around the same place. If they even just stagnate, they don't even need to grow because it's 7% dividends you're getting. That's insane. So yeah, honestly, this one has to rank high. It's just the numbers are just way too good. Is it enough to put it in S? Maybe not, because I'm not sure. Maybe. Well, we'll look at it later. If the S category is very empty, we might have to push Mastercard and maybe even Altria, maybe even Medtronic into the S category. But for now, we'll just put it over here. But yeah, those numbers are looking very good, at least for the moment. Next up, we have the CME Group, which provide a derivative marketplace for stuff like agricultural futures and those kinds of alternative investments. Their earnings per share for the past 12 months were at 10.3, projected to be 11.66 for the next 12 months. That's about like a 15% increment, which is decent. The dividend yield is 1.83, just below 2%, so we need to see some more potential for growth. P ratio is a little bit higher, but perhaps not too high, 26.5, 23.4 for the next 12 months. So again, I don't mind them too much. I'll probably rank this one very similar to the other alternative investments option that we took a look at earlier. So yeah, I'll just put it right here and a little lower than middle B. Next up, we have DoorDash, which is a food delivery company. Their PE ratio is looking extremely high though. So right off the bat, I can just say that it screams like a company that could be potentially very overpriced, at least for the moment. Their earnings per share looking to be going up from about 2 to 3.3 over the next 12 months. So that's decent increments. But even with that increment, their expected or projected PE ratio will be 68.9. So that's still quite high for a company like this, a DoorDash company. So and again, this is not the type of company I look at for a lot of innovative growth and getting in on the AI hype or anything like that. So just in general, it just seems like an avoid to me right now. Just a way too high of a multiplier. So this is going to be like somewhere in the middle C. perhaps right next to McDonald's. Looks about right. Next up, we have Starbucks, the famous coffee company. Everyone knows Starbucks. Their earnings are looked to be going up from 1.63 for the past 12 months to 3 for the next 12 months projected. Not bad. They have a decent amount of dividends at 2.87%. Pretty nice, pretty solid. The thing that really gives me pause, though, is the P ratio. For a coffee company, the P ratio 52.38% or 52.38 multiplier, I should say, over the past 12 months. And then 28.44 for the next 12 months. Even at 28.44, that's a little higher than I want it to be, but 52.3, that's just way too high. So it seems a little overpriced. This might be the wrong time to get in on this stock. There will probably be better entry points in the future. Dividend is fine. Earnings looking good. But yeah, that multiplier is just throwing me off a little bit. I'm still not going to rank it too far down because, again, it looks like a solid pick. And, of course, Starbucks is one of those companies that just makes money hand over fist. It has so many different locations, and they have so much profit over every single cup of coffee that they sell, because it costs them like 20 cents to produce each cup of coffee, but they charge $5, $6, $7. So I like the company. It's just that right now it seems like it might be the wrong time and the wrong entry point. So for now, I'm going to be ranking it at a low B, probably like around Disney or something like that. Maybe slightly ahead of Disney. But in general, this is one company that I will keep my eye on. If the numbers look a little bit better in the future, it could definitely rank up a little higher for sure. Next up, we have Southern Company, which is an electricity company. Their earnings looking to go up from 4 to 4.58. That's about 15% increase. They do have a decent amount of dividends at 3.5%. P ratio not too bad either, 20.99 going down to 18.45. So overall looks good. And the good thing about these kinds of energy companies is that, again, no matter what's going on, no matter if there's a recession or if people are making money or if the economy is booming or not so good, whatever's going on, everyone needs electricity, everyone needs their energy. And if the numbers are looking good, so the earnings are going up, there's a high amount of dividends, decent amount of dividends, and also the P ratios are well within reason, then in that case, it's just a solid company. I'm going to put it at a low A for now. Again, if A gets very crowded, we might demote it to like a high B. But for right now, where'd it go? There it is. For right now, we can probably put it somewhere around here at a low A, maybe just ahead of Intuit. Next up, we have Intercontinental Exchanges, which is a multinational financial services company. They give you the ability to access a lot of different financial exchanges, and their earnings are looking to be going up from 5.5 to an estimated 7.5 over the next 12 months, which is a very good increase. That's like a 35-40% increase. Not bad at all. They have very little dividends, 1.16%, but P ratio looking not too bad. There, it seems like it was 29.7 over the past 12 months. Projected to be 21.7 over the next 12 months. Maybe it would have been nice if it was a little bit lower, but still okay as it is right now. I don't mind this one. It's not like enough for me to put it in A. And also just exchanges in general. Yeah, I just don't know how valid they're going to be if there is a recession, if there is a bubble that bursts. There's a little bit of risk there because people are going to panic sell and be withdrawing a lot of their funds and all that. So right now, I just don't know if it's the best time to get into a stock like this. So I'll just put it somewhere in like a middle B. I do like the company, and there might be a better entry point later on, but right now I'm just not particularly interested. Next up, we have General Dynamics, which is an aerospace and defense company. Their earnings looking to be going up from 15.4 to 17.2. That's about like a 15% increase, which is not bad. Their dividend yield is, again, under 2%, 1.75%. Would have been nice if it was a little bit higher. At this point, we probably still need to see some potential for growth. P ratio, not too bad, 21.87. Looking to go down to 19.58. Again, I do like these types of companies that are involved with defense contracts and stuff like that, because there's a reliable source of earnings and also potential for future growth for sure. So I like them, but I just don't see enough here to excite me over some of the other options we're taking a look at, and also like to put it in A or something like that. But this will be on like on a higher end of a B. I'll probably put it, we'll see where we can fit it in. B is getting very crowded, by the way, but I'll probably put it somewhere around here, perhaps maybe right there. maybe a little bit higher than that over here. But yeah, B is looking to get very crowded, but I think it's appropriate because I do think there's a lot of middling companies that are just kind of in the middle where like it could really go either way. So I think it's fine. Next up, we have a Marsh & McLennan company, which is a company that provides insurance brokerages as well as consultancy and stuff along those lines. Their earnings looking to be going up from 8.3 to 10.3 over the next 12 months. That's almost a 20% increase, or maybe slightly higher than 20%, almost 25% increase. Not bad at all. Dividend yield of 1.84. Again, it's below 2%, so we probably need to see some potential for growth. But again, it looks fine. Like the P ratio is not too high, 22.33, not too bad, but looking to get a little bit better over the next 12 months as projected. 18.1, which is again below 20. That's what we'd like to see. So overall, it looks fine. Again, is there enough to push me over the edge and make me go with a low A? Maybe, probably not. I think I'll probably put this like at a very high B for now. And also with consultancy companies, I just don't particularly see like a lot of extreme potential for growth or anything like that. So I'll just put it here for now. But we could, again, if B is way too crowded, we might push a couple into low A as well. Next up, we have Duke Energy, another energy company. This one focused on electricity and also natural gas. Their earnings looking to go up a little bit from 6.36 to 6.7. Very minor, that's about 5% increase. So not bad, but nothing particularly amazing either. Dividend is very good at 3.66%. The P ratios are also decent, like 18.13, looking to go to 17.2 over the next 12 months. So not too bad. I do like the company, but again, is there enough to push me over the edge to go with an A rating? Perhaps not quite, but I do like the company, and I'm going to be putting it again at a high B. And again, if A is very, very much so empty, we can push a couple up into A as well. Next up, we have the 3M company, or MMM, and those M's, by the way, just in case you're curious, stand for the Minnesota Mining and Manufacturing Company, and their earnings looking to be going from 6.26 to 8.65 projected for the next 12 months. It's very good. It's a 30-35% increment, which is very nice. Dividend is okay, again, below 2%, so we need to see some potential for growth. 1.73% dividend. P ratio was perhaps a little too high for the past 12 months at 27, but looking a lot better at 19.5. So again, very similar to the other ones. Maybe I'll put it a little bit lower than some of the other high B companies that we looked at. Maybe I'll put it just below ADP, or maybe even below Qualcomm, somewhere around there. But again, decent company. I'm just don't love it particularly over some of the other companies that we've taken a look at. So I'll just put it right over here. Next up, we have Cadence Design Systems, which is a technology and software company. Their earnings looking to be going from 3.88 to projected 8.05 over the next 12 months. There's no dividends. It's just a pure growth company. Their P ratio is quite a bit high, 83.4 over the past 12 months. Looking to get a little bit better, more manageable at 40. Again, for tech companies, you can understand this, but again, with this particular company, I just don't know if these are justified for this particular type of thing. And also, the same risk applies with this one. If there is a huge correction, huge bubble burst, it's probably going to affect companies like this as well. So we've had a lot of other companies of similar ilk that I liked a lot better, that we've ranked higher. So for this one, I'm going to rank it a little bit lower than those ones, at somewhere like in the middle B. Again, nothing against the company. It's just too many companies of similar ilk. We can't invest in too many things of the same. And also, I just like some of those other ones a little bit better. Next up, we have Trane Technologies, which produce products for indoor use, such as air conditioning and such. Their earnings per share for the past 12 months were about 13. It's projected to be about 14.85 over the next 12 months, which is about like a 13-14% increase. Not bad. Dividend yield very low, below even 1%. So again, not justified to not enough to justify really anything. We need to see potential for growth. P ratio was a little bit higher than expected for this type of a company. This is not, an AI powered company that, we can be like, okay, maybe we can expect a little bit of a higher multiplier. This type of company, 30 just seems a bit too high. Even projected 26 seems a bit high. So I'm looking at like a low B, maybe a high C. Honestly, I'll go a high C because I'm just not particularly interested in this type of a company anyways. So I'll just go somewhere around here for this company as well. Next up, we have Moody's Corporation, which is a risk assessment company. They do a lot of financial analysis and credit rating and stuff like that. Their earnings are expected to go up from 12.44 to 16.31. That's about a 30% increase. Not bad. Their dividend is very low, basically negligible at 0.77%. And the PE ratios are a little bit higher than we would have liked it to be. If these were a little bit lower, I could have even considered 8 because it's a decent company to be looking at. But they're a little bit higher than I would like them to be, but it's still a decent company. I'm probably going to put it probably like a slightly high B, but not too far up either. Probably somewhere. Let's take a look over here. Maybe right there, or right before Qualcomm, perhaps. Next up, we have Waste Management, and as the name suggests, it's a waste management company, and they do environmental services and those kinds of things as well. Their earnings are expected to go up from 6.35 to 8.33, about a 30% increase. They have a small amount of dividend yield, but not too much, 1.5%, not the worst, but it's all right. And a P ratio similar to the last company we looked at, so it's going to be probably ranking somewhere around that one as well. I slightly like Moody's slightly better. Because of just the type of business it is, but the waste management is not that bad either. It's not anything that excites me to invest like right now or anything like that, but probably put it somewhere around there, maybe slightly lower than these ones. I do like 3M a little bit better, so right around there looks about right. Next up, we have Synopsys, which is an electronic design company. Their earnings are expected to go up from 8 to, basically doubling at 16.94. They don't have any dividends or anything like that, but their PE ratio was quite a bit high for the past 12 months. A little bit more understandable as they are, in the electronic development and stuff like that. And again, that's in tech, you can see sometimes these high multipliers because they're investing into producing new generations of products and innovation and producing much better technology than before, but it's looking to be a little bit better in the next year. I do like the fact that the earnings are projected to double and that the P ratio is going to be a lot more reasonable for a tech company especially. Of course, there's still a little bit of risk if there is a AI bubble burst or something like that, probably going to affect companies like this as well. So I think even though this company is slightly better than the last two that we looked at, I'm going to rank it around the same as well because this one has a little bit more risk than those other two. So overall, it probably ends up being around about the same. Maybe I like it slightly better than those two. Maybe I'll put it slightly ahead of Moody's, but I'm going to leave it there for now. Next up, we have Dell, which is a company that produces all sorts of technological products such as laptops, printers, etc., all those sorts of things. Their earnings are projected to go up from 7.5 to 11.5, basically, about a 40-50% increase. Not bad at all. They have a small amount of dividend yield, 1.55%, but again, not enough to make it a dividend company or something like that. We still want to see potential for growth. But what I really like about Dell is that their PE ratios are very good. The PE trailing for the past 12 months was 17.41, which for a tech company is very, very good to see. It's a lot lower than most tech companies are, and it's expected to be even better going forward. In fact, I don't think it will end up being this because that just seems a little too low for this kind of a tech company. But if that goes up, I think that will be because the price of the company will likely go up. So I like Dell actually a decent amount, specifically because of the P ratios, but of course, earnings going up and all that as well. And you have a little bit of dividend yield as well on top of that to help you earn a little bit more as well. So I like Dell. I'm going to be ranking it somewhere in the mid, maybe to low A. Let's see what's going on in A. It's kind of getting crowded here, so I got to figure out. I like it a little bit better than these riskier options over there, so probably put it just ahead of... do I put it ahead of AMD? Probably not. I'll probably put it right here, ahead of Booking Holdings. That looks sort of about right. Next up, we have Apollo Global Management, which is a financial asset management company. Their earnings are expected to go up from 6.75 to 9.26, about a 40-50% increase. Not bad at all. Very small dividend yield, again, 1.36%, not quite enough to be a dividend type of company. P ratios are good, though. It was 21.75 for the past 12 months. Projected to be 15.85 for the next 12 months. For a financial company, very reasonable. I do like this company as well. Nothing screams out at me that this is a very good company that you got to jump on right now. And also, when it comes to asset management companies, I don't really expect these to be coming out with new products or anything like that. Obviously, it's a very different type of company, but I think they're solid. This probably is going to be either a low A or a high B, just because B is a little bit crowded than we usually like it to be. I'm gonna sneak it into. We gotta walk this up the ladder. We have so many companies here, and we're not even halfway through. By the way, this is the. I'm gonna be dead by the end of this list, but I'm just gonna sneak it into like the low end of A for now, and again we can readjust later. Next up, we have United Parcel Services, better known as UPS, which is a shipping company, very similar to FedEx and those kinds of companies. I think a lot of us have dealt with UPS at some point or another. Their earnings are expected to go up from 6.5 to a little bit higher at 7, but it's not a huge jump by any means. That's like maybe about 10%. Their dividend yield is massive, though. 6.56% dividend yield, very nice to see. And their P ratios are very reasonable. So the high dividend yield combined with the fact they have very reasonable P ratios, combined with the fact that the earnings are going up a little bit, that does signal maybe a low A to me. The reason why I'm not really thinking about middle A or high A is because, again, the earnings are not going up all that much. And also, because the earnings are not going up all that much, I don't know if they can keep increasing the amount of dividends as the price of the stock goes up. So the dividend yield might end up being a little bit less than what it is here, but it's a 6.5. So even if it drops down to like 5%, that's still pretty good. So I like UPS quite a bit. And of course, no matter what goes on in the world, we're always going to need our shippings and our products being shipped. Of course, there is a little bit of competition with some other big players like FedEx and all those sorts of things, but UPS is very well established, so I don't worry about that too much. Of course, there's a little bit of risk with it, but it's also very different than a lot of the other companies we're looking at. It's a good hedge against all those tech companies, all the AI companies, all those sorts of things. Obviously, if there is an AI bubble burst, it's probably not going to necessarily affect UPS all that much because they're very far removed from that entire world. So I like UPS as a little bit of a different pick to be included in there. I'll probably put it slightly ahead of Apollo, but again, somewhere around the low A's looks about right to me. Let's bring this up all the way here, and I'll actually put it a little bit higher. Maybe somewhere around here. I'll put it right next to Wells Fargo. Next up, we have American Tower, which is a communication infrastructure developing company. Their earnings are expected to go up a little bit from 6.27 to 6.89, probably less than 10%. The dividend yield is decent at 3.73%. It's not as massive as some of the other options we've seen, but it's decent. And their PE ratio would have been nice if it was a little bit lower. Perhaps it's a little too high for this type of a company. 28.75 for the past 12 months, 26 for the next 12 months. And again, earnings are going up a little bit. Overall, I think there's some other better options. It's not bad. It's not the worst investment by any means, but I think there are some better options out there. So I'll probably put this one like smack down in the middle of B somewhere. I'm just going to drop it in the middle somewhere. I'm not going to spend too much time. There's too many companies in the middle here. So I'm not going to spend too much time figuring out exactly where it's going to place, but somewhere in the middle looks about right. Next up, we have US Bank Corp, which is another financial company, another bank. Their earnings are expected to go up a little bit from 4.37 to 4.9. That's slightly ahead of 10%. Their dividends are decent, 3.76%, I should say. They're not that bad at all. Their PE ratio, very reasonable. PE trailing for the past 12 months, 12.3. For the next 12 months, 10.93. Again, I think there are slightly better options out there and slightly more reputable banks and slightly more promising options in terms of both dividend stocks and growth stocks. So I'm not going to rank it too high, but it's definitely very decent. I'm probably thinking like a high B, low A, just because of the company itself and the fact that we have so many other banks that we've looked at. I'm just going to put it at a high B because, again, I'd rather look at maybe some different types of companies to include an A. And we've already had a couple of banks up there and even here in B as well. So I'll probably just put it up here somewhere. Right around there. Looks about right. Next up, we have PNC Financial Services, another financial company, another bank. Their earnings are expected to go up by a little over 10% from 15.5 to 17.7. Their dividends are decent, 3.12%. P ratio, again, very reasonable, 13.63 over the past 12 months, 11.9 for the next 12 months. So very reasonable overall, but again, similar to the last bank that we just took a look at, the US Bank Corp. Again, very similar in terms of numbers and projections and all those things. So I'm just going to put it right next to that one. Perhaps US Bancorp slightly higher, but they're both very similar. Next up, we have Bank of New York Mellon, another banking company, another financial company. Earnings are expected to go up by about 20% almost, 6.9 to 8.16. Their dividend yield is very low though, especially for like a bank or a financial company. 1.7%. Would have been nicer if it was a little bit higher. And the PE ratios are reasonable, but again, we just took a look at two other banks that had lower P ratios, higher increment in earnings, and they had higher dividend yields as well. So just comparatively, this one has to be lower down. Again, I don't think it's like bad. Like these are still decent numbers, so I'm not gonna like put it in C or anything, but it's going to be lower down on B compared to these other two banks and a bunch of other stuff that we've taken a look at so far. So I'm probably just gonna put it somewhere around here, maybe around Starbucks or Disney or something like that. Looks about right. Next up, we have the Sherwin-Williams company, kind of my namesake company. Of course, mine is with a V, but still very similar. Of course, they're a painting company. I've bought from them before. Their earnings are expected to go up from 10.24 to 12.55, about like a 20-somewhat% increase. Their dividend yield is less than 1%. So again, very negligible, not too big. We need to see potential for growth. What really gives me pause is that their P ratio is a little bit higher than you'd like to see for this kind of a company. Like this, you're not looking at Sherwin-Williams to reinvent the wheel or something like that, right? Or to push the boundaries of some kind of technology. So these are just way too high. 32.07 for the past 12 months, 26.18 for the next 12 months. So overall, again, looks like a low B to me. Not bad enough to be in C, probably not. Well, it's not too far away, but probably not quite there. So I'll probably put it at the low B, somewhere around here. Maybe right after Citibank or something like that. Next up, we have the Northrop Grumman Company, which is an aerospace and defense technology company. Their earnings are expected to go up from 27.86 to 28.92. Very negligible increase. That's like 3-4%. Their dividend yield is 1.56%. Again, not high enough to be like that notable. P ratios are not bad, 20.67 for the past 12 months and 19.9 for the next 12 months. But again, very small change there because the earnings are slightly changing. So it doesn't scream like a great investment opportunity for me. I'm not going to put it too far down because I do like these kinds of defense companies because they have a lot of contracts. It's very stable and all those sorts of things. So I don't hate it as much, but there were some other defense companies that we took a look at, and they had much better outlook. So I'm not going to rank it too high. Again, looks like a low B to me. Maybe I'll put it right next to Sherwin-Williams. Next up, we have Howmet Aerospace, which is a company that produces jet engines and engines of all kind. The earnings are expected to go up from 3.56 to 4.44, almost a 30% increase. Their dividends are almost negligible at 0.22%. Their P ratio is very high though, 55.36 for the past 12 months, 44.39 for the next 12 months. So again, just because of the high P ratio, it just looks like a low B to me. Not something I'm particularly interested in. I'll put it somewhere around here. Maybe right next to the defense company. Next up, we have Marriott International, obviously a hotel company. They have the Marriott hotels and all those sorts of things. Their earnings are expected to go up from 9.5 to 11.33, about a 20% increase in earnings, which is pretty nice. Their dividends are pretty negligible at 0.86, less than 1%. Their P ratio is a little bit higher than we would like it to be. Not too bad. So probably I'm thinking like a middle B or something like that. 32.58 for the past 12 months, 27.23 for the next 12 months. So like about a middle B looks about right for this particular stock. Maybe I'll put it like slightly ahead of Home Depot and stuff like that. Maybe right after Broadcom and Stryker. Yeah, somewhere around there. Next up, we have O'Reilly Automotive, which is an auto parts company. They produce parts for cars. Their earnings are expected to go up from 2.89 to 3.32 over the next 12 months. That's about what is that, 20 something percent increase. Not bad. They have no dividend yield. P ratio a little bit higher than we'd like to see in these kinds of companies. 32.96 over the past 12 months, 28.67 projected for the next 12 months. So overall, again, nothing that enticing. Middle of the road, middle of B looks about right for this kind of company. I'm probably going to put it right next to Home Depot. Next up, we have Elevance Health, which is a health insurance company. Their earnings are expected to go from 24.5 to almost 27, which is about a 10% increase. They have lower dividend yields than we'd like to see. That's about 1.9%, less than the 2% that I talked about earlier. Their PE ratios are pretty good though. They're pretty low, 14.75 for the past 12 months, 13.35 for the next 12 months. So overall, maybe a little bit of a higher B than the middle of the road, but it's not good enough to break into A, at least not for me. So it's going to be somewhere around here probably. Maybe right after AT&T. Next up, we have Regeneron Pharmaceuticals, another pharma company. Earnings expected to go from 41.77 to 44.36 over the next 12 months. Less than a 10% increase, about like 7-8% increase. Dividend yield almost non-existent at 0.47%. Very low, very negligible. P ratio is decent though. It's 18.02 over the past 12 months. 16.97 for the next 12 months. So not bad. Decent P ratio. I'd probably put it like at a high B. Because the numbers look decent, but not good enough to push into A. Not quite, at least. So I'd put it probably, maybe even ahead of Synopsys. Or would it be? No, probably not. Probably ahead of Qualcomm. Looks about right. Next up, we have Airbnb. I think everyone knows Airbnb, short-term rentals and all those sorts of things. Earnings expected to go from 4.23 to 5.2 for the next 12 months. They don't have dividend yields, but P ratio, again, a little bit higher than you'd like to see with this type of a company. I suppose there's a little bit of tech involved, but still, I would have liked that to be a little bit lower. So it just seems a little, perhaps, possibly overpriced, not necessarily, but could be. There's definitely the danger of that. 31.19 over the past 12 months, 25.36 over the next 12 months projected. So again, just kind of looks like a middle of the road B, which is not the worst, but not particularly exciting either. Gonna put it perhaps right after Marriott. Next up, we have Emerson Electric, which is a technology and engineering company. Their earnings are expected to almost double, 4.05 for the past 12 months, 7.11 for the next 12 months. That's about like a 75-80% increase. Pretty nice. Dividend yield of 1.56%. Not quite enough to justify the cost of the stock, but it's still something. The PE ratio is a little bit high for the past 12 months, 33.92 for this kind of a company specifically. And for the next 12 months, it's expected to be a lot better, but we'll see how that pans out. Of course, 19.3 projected for the next 12 months. So overall, maybe there could be some potential. I mean, it's a decent amount of increase in earnings. Would have been nice if it had higher dividends. Would have been nice if the P ratio was a little bit more reasonable. So overall, maybe like a middle to high B, somewhere around there. We'll see where we can squeeze it in. Probably like right after American Tower, something like that. Next up, we have Royal Caribbean, which is a cruise company. I'm sure you've seen the Royal Caribbean cruises all over the place. Their earnings are expected to go up from 14.8 to 17.76 over the next 12 months. That's about a 10%, or should I say 20% increase. Not bad at all. Dividend yield of 1.06, pretty negligible, not enough to justify anything. P ratios are decent though. P ratio over the past 12 months, 19.4. Projected for the next 12 months, 16.17. So I like the stock. Probably like a higher B, maybe a low A, but perhaps not quite. If the earning was increasing a little bit more, or if the dividend was a little bit better, maybe it could have pushed into a low A. But as is, I'm probably just gonna put it at a high B and call it a day. Let's see where we can squeeze it in. I think probably better in Qualcomm, maybe even right here. Looks about right. Next up, we have Aon, which is a British-American company that specializes in stuff like risk management, retirement planning, etc. Their earnings for the past 12 months were about 12.5, and for the next 12 months, projected to be about 19. That's a decent increase. That's about 60-70% increase, not bad at all. Dividend, pretty non-existent, 0.82%, pretty negligible. P ratio, not the worst, but could have been a little bit better for the past 12 months, 28.36. Projected to be a lot better at 18.61. So looks about like a high B, perhaps not quite enough to push into a low A for me. So I'm just going to put it at a high B for now. Let's see where we can squeeze it in. Maybe right after Boston Scientific. That looks about right. Next up, we have Corning Incorporated, which is a company that specializes in material science, specifically with stuff like glass and ceramic and other stuff along those lines. Earnings expected to go from 1.58 to 3.04, almost doubling, which is really nice to see. Dividend yield, not that high, 1.27%, pretty negligible. P/E ratio is very high though, 55.88 over the past 12 months. That's quite high. Projected to be a lot better, but even then it's still a little bit higher than we like it to be, 28.94. So overall, probably like a middle of the road B, just because the P/E ratio just kind of kills it right dead in its track. Maybe even slightly lower than that because, you know, you don't even have like a high amount of dividends or anything like that. So probably like right after T-Mobil. Next up, we have General Motors, which is a car company that owns a lot of famous car brands, some of which are Chevrolet, Buick, Cadillac, etc. Their earnings expected to go from about 5 to 11.82, more than double. That's very good to see. That's very promising. Not a high dividend yield, though, pretty negligible at 0.7%. P/E ratio is very good though, 16.48 for the past 12 months and projected to be 6.94 for the next 12 months. That small of a projection, that almost signals that the P/E ratio is actually going to end up being higher because the price will likely go up, right? It seems very unlikely the price will go down further with the higher earnings and the P/E ratio ends up being even smaller than that. So in general, I like it quite a bit. It's probably going to go somewhere in A. Let's see what the situation in A is like. Where can we squeeze this one in? Do I like it better in UPS? Perhaps a little bit. Or I might just put it right after UPS. Feels a little low though, I'm not gonna lie. Maybe, where else? Okay, you know what? I'll just put it ahead of the riskier ones. I'll put it somewhere around here. Maybe right after Dell. Next up, we have Cintas, which is a company that produces a lot of uniforms and first aid kits and stuff along those lines. Their earnings expected to go from 4.5 to 5.37. A little bit of an increase, maybe like 17-18%. Not bad. Dividend yield pretty non-existent at 0.89%. Pretty negligible. P/E ratio a little too high though, especially for this type of company. Like you just... They're not, again, reinventing the wheel necessarily, right? So 41.88 seems a little too overpriced. Even projected forward is 35.09. So it just seems like a low B to me. It seems like a little bit overpriced, a little bit overblown. I'll probably put it somewhere around here. Next up, we have Illinois Tool Works, which is a company that produces a lot of engineered components or specific tools or stuff like that. Their earnings expected to go from 10.3 to 11.2, about like an 7-8%, 9% increase. Not the worst, but not too high either. Dividend yield of 2.36%. Again, not bad, but not too great either. P ratio, again, okay, 295.1, projected to be 23.08 for the next 12 months. All of the data seem way middle of the road, like smack down middle of B. So we're just going to do that with this company as well. We're going to throw it somewhere in the middle of B, maybe right after John Deere. Next up, we have Ecolab, which is a sustainability company, particularly as it pertains to water. Earnings expected to go from 6.95 to 8.48. That's about like a 20-somewhat% increase. Dividend is 1%, pretty negligible. P ratio a little bit higher than you'd like to see with these kinds of companies, 37.56 for the past 12 months, 30.81 for the next 12 months. So seems like a low B to me. It's gonna drop right there, perhaps right after Comcast, right before, maybe right after Comcast. Next up, we have Warner Brothers Discovery, which looks like it's going to be acquired by either Netflix or Paramount or something like that. So this particular one, again, it just seems a little bit redundant to rank at this point because very soon it's probably not going to exist as an independent company and it's going to be sold. And, you know, right now it's just one of those stocks that I don't think any of us need to worry about until we find out exactly what's going on with that whole sale situation. So I'll just drop it right in the middle of B. Not because, you know, I rank it there just to say, you know, don't worry about this one. Just throw it in the middle. Moving on to the next one. Next up, we have Equinix, which is a digital infrastructure company. Earnings expected to go from 10.9 over the past 12 months to 14.9 over the next 12 months. That's almost a 50% increase. Not bad at all. Dividend yield of 2.46%. It's okay, at least a little bit higher than 2%, not bad, but the P ratio is what really kills this one. 69.7, that's quite a bit. And again, I understand a little bit more with this one because probably has gone up because of the AI boom and all those sorts of things, because there's a lot more need for more infrastructure to be built, more servers, all those sorts of things. But again, it just seems a little too risky. And there were some other better options. If you want to get involved with the AI boom and you don't mind risking a little bit, there were some better options that we looked at earlier with a lot of other tech companies, AI companies, all those sorts of things. So I wouldn't necessarily go with this one. I would maybe stick to just one of those. So for that reason, I'm going to throw this one into a low B, maybe even a C, honestly. It should probably be around a low B, but because there's just better options if you want to get involved with that sector, I'm going to throw it at a high C, just to signal that, you know what, I would just stay away from this one and maybe go for some other companies in that sector that just show more promise and are maybe a little bit more shielded against risk. Of course, this company could blow up. I'm not saying it can't, but I just think there's just too much risk to just go there, and there are better options out there that you could look at instead. Next up, we have Williams Companies, which is another energy company. They focus on natural gas and all those sorts of things. Earnings expect to go from 1.93 to 2.33. That's about a 20% increase. Not bad. Dividend yield decent. Again, similar to a lot of other energy companies, around like 3%, 3.36% here. P ratio, maybe it would have been nice if it was a little bit lower. 30.77 over the past 12 months, 25.57 over the next 12 months. Not bad, but somewhere, again, middle of the road. Seems like a middle of the B type of company. So we'll just drop it in there and maybe go right after T-Mobil. Next up, we have TransDigm, which is an aerospace manufacturing company. Earnings expected to go from 32 to about 46. A decent, almost 30% increase. There's no dividends with this one. P ratio a little too high, to be honest. 40.26 over the past 12 months. Projected to be better, but even still slightly higher than we like it to be, 28.04. Overall, again, just not interested in this one. Gonna be a low B for me. And I'll probably just put it right after Centas. Next up, we have Cigna or Cigna. I'm not sure how you pronounce that exactly, but whichever it is, it's a healthcare company. Earnings expected to go from 22.67 to 30.51. That's almost a 30% increase. Not bad. Dividend yield a little lower than we like it to be, 2.18%. Would have been nice if it was higher for this type of a company. P ratio very good though, 12.23. Expect to be 9.08 for the next 12 months. So again, there's possibility for growth here. Even though the dividend is not that great, I do like the potential for growth. So I'll rank it a little bit higher in B, not quite the highest, but yeah, we're gonna put it perhaps somewhere over here. Maybe right ahead of American Tower. Next up, we have the Monster Beverage Corporation, which, obviously they have the Monster beverages, the energy drinks, and also a bunch of other products similar to that as well. Earnings expected to go from 1.76 to 2.23. That's about a 25 to 30% increase. Not bad. No dividend yield here. P ratio is quite high. For a beverage company, these are kind of ridiculous. 42.6 over the past 12 months, 33.6 over the next 12 months. That's just way too high. So it's just going to be a low B for me. I'm not particularly interested. It just seems a little overpriced. I'll put it probably right here next to Cigna. Next up, we have Coinbase, one of the largest cryptocurrency exchanges out there. Earnings expected to go from 11.55 over the past 12 months to so much lower at 6.97. So we expect a sharp drop. We expect the P ratio to go up massively. So it's just not looking good for Coinbase right now. Of course, cryptocurrency is very volatile. So stuff like this doesn't surprise me at all. But given these numbers, given the sharp fall of the earnings and also the P ratio ballooning up a little bit, I kind of have to even put it at D, unfortunately. Again, it's a company that I actually like, but the numbers are just not great right now. So right now, it just has to go in D, unfortunately. Next up, we have a company with a little bit of a funny name, Cummins. Insert your jokes in the comment section down below. But they're an energy company. They focus on diesel as well as other alternative fuels. Their earnings expected to go from 19.27 to 25.88, about like a 25% increase, not bad at all. 1.48% dividend yield, not too high, but it's okay. If there's a little bit of growth, it could supplement that. It would be nice. P ratio was perhaps a little bit higher than we want it to be, or not too much higher than we want it to be over the past 12 months, 26.85. Expect to be a lot better at 19.99 over the next 12 months. So overall, I don't mind this one particularly. Earnings are going up a decent amount. Dividend not high enough. And the P ratio, not that bad. So probably like a middle of the road B, maybe slightly higher than the middle of the road, but not too high up in B either, and almost certainly not breaking into A. Maybe I'll put it like slightly ahead of like Cisco and Eli Lilly, something like that. Next up, we have Johnson Controls, which is a building and maintenance company. Earnings expected to go from 5.09 to 5.33, barely going up at all. Dividend yield 1.29%. P ratio not too bad, 22.95. Expected to be 21.95 in the next 12 months. But just overall, not a particular fan of the company. Numbers not that crazy. Earnings barely going up. Not a crazy amount of dividends either. So overall, it seems like a low B to me, not particularly interested. We're just going to drop it here and move on. Next up, we have Mondelez International, which is a food and beverages company. They have a lot of famous brands under them like Oreo, Cadbury, Milka, a bunch of other ones. Earnings expected to go from 2.68 over the past 12 months to 3.15 over the next 12 months. That's about a 20% increase, not bad. Dividend yield decent, 3.5%, not bad at all. P ratio going from 20.27 to 17.23 over the next 12 months, decent PE ratio. So overall, I don't mind them. Probably a high B. I don't think there's enough there to push it to like a low A or something like that, but decent company, not too bad at all. And they definitely have enough big brands in there as well. So somewhere around here at a high B looks about right, but not particularly higher than that. There's not much there that excites me either. Next up, we have CSX Corporation, which is a railroad company. Earnings expected to go from 1.54 to 1.9. That's decent. That's about a 30% increase. Dividend yield, pretty low, 1.4%, not that high. P ratios are okay, 24.17 over the past 12 months, 19.48 over the next 12 months. Overall, again, seems kind of middle of the road. Probably like a middle B, looks just about right. Not much there to be excited about, not much there to be interested by. I'll probably put it like right next to Walmart or something like that. Next up, we have Freeport-McMoRan, which is a metal production company. They produce a lot of metals such as copper, gold, all those sorts of things. Earnings expected to go from 1.4 to about 2.2. It's a decent amount of increase, about 50%, slightly higher perhaps. Their dividend yield is almost non-existent, 0.63%, pretty low. P ratio perhaps a little bit higher than we'd like to see with this type of a company. 33.41 over the past 12 months, 21.69 over the next 12 months. Overall, again, kind of seems a middle of the road type of situation. I know a lot of companies are falling there, but that's just the reality of companies. There's a lot of companies that are just kind of middle of the road. And you gotta try to see the forest for the trees and find those rare few that are really good options that you can put in these higher rankings. Next up, we have T Connectivity, which is a company that produces electrical components. Earnings expected to almost double, going from 6.16 over the past 12 months to 12.04 projected for the next 12 months. A little bit of dividend yield, pretty negligible though, 1.21%, nothing to write home about. P ratio a little bit higher than we like to see, 37.43. Projected to be a lot better at 19.15 for the next 12 months. So overall, again, looks like a kind of middle of the road type of company, right in the middle of B, maybe ahead of T-Mobil, I would say. Next up, we have Sensora, which is a drug wholesale and distribution company. Earnings expected to go up from 7.95 to more than double, almost triple at 19.53. Very nice. No dividend yield to be seen here, basically none, 0.64%, pretty negligible. P ratio really high though. But again, the earnings are expected to go up massively, so maybe we can overlook that a little bit because it's tripling almost. I mean, that's something. And again, expected to be a lot better for the next 12 months. But the real question is, are they going to hit those projections? there's definitely risk there. If they don't, then it could be all kinds of craziness going on with the stock. So I'm not too confident to put it much higher than like a middle B. Maybe I'll put it like slightly higher than just downright middle. Maybe I'll put it like next to Broadcom, Stryker, these types of a little bit riskier companies down here. But yeah, that looks somewhat about right. Next up, we have Federal Express, or FedEx for short. Earnings expect to go from 17.11 to 21.06. Again, obviously everyone knows FedEx, a delivering company. Earnings going up a decent amount, about 20%. They have 2% dividend yield. Nothing that crazy high, but it's okay. I guess 2% is decent. P ratios are very good though. 16.44 over the past 12 months. 13.35 over the next 12 months. Very decent. Doesn't seem like an overpriced stock or anything like that, but there's not a lot of promise with it either. It's fine. I'll probably put it like at a high B. I don't think there's enough there to push it into like a low A type of situation, but definitely higher up in B for sure. And I'll put it slightly ahead of these two banks over here. Next up, we have Norfolk Southern, which is another railroad company. Earnings expected to slightly go down from 13.11 to 13. They have a very small dividend yield, less than the 2% that we mentioned before, 1.8% here. And again, P ratio was okay, but of course earnings are slightly going down, so not particularly interested. I'll put it in a low B. It's not bad enough to go into C, but it's going to be a low B. Maybe I'll put it right after Monster Beverages. Next up, we have Republic Services, which is a waste disposal company. Earnings expected to go up from 6.73 over the past 12 months to 7.32 over the next 12 months. That's about a 10% increase. Dividend yield very low, 1.1%, not that high. P ratio kind of high, 32 over the past 12 months, 29.4 over the next 12 months. Seems like a middle to lower B, not too low in B, but not particularly high either. We're gonna drop it somewhere, maybe right after Williams and T-Mobil. Next up, we have Arthur J. Gallagher, another insurance and risk management company. Earnings expected to double from 6.3 over the past 12 months to 13.42, more than double. That's a pretty good sign. There's not a lot of dividends, 1.01% dividend yield, not that high. P ratio is kind of high, but the earnings are going up massively. So we'll maybe cut them a little bit of slack there. 40.76 over the past 12 months, but 19.1 projected for the next 12 months. So doesn't look that bad. You're getting in at a little bit of a discount right now as well. I don't love it enough to put it in A or anything like that, but it's going to be at a higher B. For me, the numbers look decent enough where there could be some potential here. I'll probably put it right after FedEx, right before the other two banks. Next up, we have Hilton Worldwide. Obviously, they have the Hilton hotels, and they have a lot of different brands that they have under them. Earnings expected to go up from 6.9 to 9.11. That is about a 25 to 30% increase. Not bad at all. Dividend yield almost non-existent at 0.2, very low. P ratio kind of high over the past 12 months, 41.42. Even still maybe a little bit higher than it needs to be over the next 12 months, 31.37. So not particularly interested in this one either. Probably like a middle to lower B. I'll see where I can fit this one. Maybe slightly ahead of Home Depot and Cat, but nothing that high. Next up, we have Quanta Services, which is a company that produces a lot of infrastructure products. This could be stuff like infrastructure for electricity, infrastructure for pipelines, all those sorts of things. Earnings expected to almost double, going from 6.74 over the past 12 months to 12.46 over the next 12 months. Very nice. Dividend yield almost non-existent, but P ratio is kind of high. That's the only issue here. 64.66 over the past 12 months. That's very high. Projected to be better, but still quite high at 35 over the next 12 months. So overall, it just seems like it might be a little overpriced. So I'm not particularly interested. I'm going to put it like at a low B again. Probably right around Chevron, Williams, or all these companies here, somewhere around there. Next up, we have Troist Financial. I hope I'm pronouncing that right. Another financial company. Earnings expected to go from 3.73 to 4.48. Decent, about a 20% increase. They have decent dividend yield at 4.18%. And P ratio is very solid, 13.34 over the past 12 months, 11.1 over the next 12 months. So earnings going up a decent amount of dividends. Very reasonable PE ratio, and also financial company. You're getting in a slight discount right now. I like them. Do I like them enough to put them in A? Probably not. There's enough financial companies that we've looked at already, and there's a lot bigger ones, a lot more reputable ones. In general, unless there's like an amazing deal, I probably prefer those a little bit more. But to be fair, this one is really showing really good P ratio. So maybe I can sneak it into like a low A for now, and then we can see later if we need to readjust. But for now, I'll just sneak it into like a very low A, somewhere around there. Next up, we have the Travelers Companies, which is an insurance company. The earnings expect to go up slightly from 25.44 to 26.66. Very slight increase, about like 4% increase. Dividend yield, again, quite low, 1.5%, nothing to write home about. P ratios are very solid though, 11.42 over the past 12 months, 10.9 over the next 12 months. So overall, earnings are not going up enough. There's not enough dividends or anything like that. There's not enough promise for future growth. Overall, I'm not particularly interested, but it's not that bad either. It's probably like a middle of the road B, right in the middle somewhere. We're going to drop it maybe right after Airbnb. Next up, we have Autodesk, which is a software company. I mean, their famous product is AutoCAD, which is used for a lot of engineering and stuff like that. Earnings expected to more than double over the next 12 months, 5.15 over the past 12 months, 11.56 over the next 12 months. No dividend yield, P ratio kind of high though, 57.13 over the past 12 months. You can maybe understand with these sorts of tech companies, but maybe if they're more involved with the boom at the time or like the AI growth and stuff like that, I know maybe they're implementing that into their products, but still, I'm just not particularly interested. I'm again, like a company like Adobe, I'm maybe a little bit more interested in taking a risk on them rather than Autodesk. So I'm just going to put them maybe like in a middle to high B, but not too high either. Perhaps right here after S&P Global, right before. Yeah, we'll put it right after S&P Global. Next up, we have CL, I'll just say it that way, Colgate Palmolive, is that how you say it? Some of these are a little bit difficult to pronounce, but they're basically a manufacturing company for household and consumer products. Their earnings are expected to go from 3.57 over the past 12 months to 3.84 over the next 12 months. About a 10% increase, not bad, but nothing that crazy either. Dividend yield, 2.6%. Not bad. It's all right. P ratio, again, okay. 22.27 over the past 12 months, 20.72 over the next 12 months. But just in general, it's just not the type of company or the type of sector that I'm all that interested in. I'm going to throw it, again, smack down in the middle of B somewhere. We'll drop it maybe. I'll probably put it right after Hilton. Yeah, looks about right. Next up, we have Seagate, which is a data storage company. They produce hard drives and stuff like that. Their earnings expected to almost double over the next 12 months. For the past 12 months, it was 7.8. It's expected to be 14.9 for the next 12 months. Pretty good. Dividend yield is about 1%, pretty negligible. P trailing a little bit higher than we like it to be. And again, this is not like an explosive type of like a tech company that like has a lot of investment in AI and stuff like that. It's a storage company, so it's not, we don't want to see these high P ratios particularly. 36.85 over the past 12 months. This one's a little bit better for the next 12 months, 19.27. But overall, I think like a high B makes sense for this company. I like it fine, but again, it's not something that I would go out of my way to invest into necessarily. But again, it doesn't look that bad. I'll just put it right here. Next up, we have Fortinet, a cybersecurity company. Earnings are going up a little bit. That's fine. No dividends. The PE ratio, again, was a little bit higher than we want it to be over the past 12 months. It's getting a little bit better over the next 12 months, but still probably a little bit higher than would be ideal. So again, looks like a middle of the road type of a B company. I'll just put it somewhere in B, somewhere in the middle. Somewhere around there looks about right. Next up, we have American Electric Power Company, which is a company that produces, you guessed it, electricity. I know who would have seen that coming. Their earnings are expected to go a little bit lower though, which is unfortunate because otherwise it could have been a good looking stock. 3.26% dividend yield, pretty decent. PE ratio again was pretty decent over the past 12 months, 16.76, but it's going up to 18.15 projected. So again, the fact that the earnings are going down is the only thing that kind of shoots this stock in its own foot. Otherwise, this would have been like a high B probably, but because of that lowering of the earnings, I don't know if I dislike it enough to put it in C, so I'll put it just as a low B. But yeah, it's not great that we have that. I'll probably put it like honestly at the end of B, probably. Next up, we have Motorola Solutions, which is a telecommunications company. Obviously, they had the phones with the Motorola brand, but they also have some other products for key telecommunication hardware and stuff of that nature. Earnings expected to go up about 30% from 12.5 to 16.27. Dividend yield of 1.23%, which is pretty negligible. PE trailing, not too high, but again, not great either, 29.2. It's going to be a bit better, projected for the next 12 months, 22.36. So again, seems like a middle to high B, not too high, but perhaps slightly higher than the middle, maybe like somewhere around here. Next up, we have Western Digital, which is an American data storage company. Earnings expected to go up about 30 to 40% from 6.9 to 9.4. Barely any dividend yield, 0.19%, pretty negligible. PE ratio, actually not that bad, 25.45 over the past 12 months. Probably just around where like the highest we want to see with like this kind of a tech company is, but looking to be a lot better over the next 12 months, about 18.58. I don't think there's enough there to go out of your way to put this into A or be really interested in the stock. And again, it's a data storage company. It's just I don't really see that much room for incredible growth or anything like that, but it's fine. It's not that bad. I do like it enough to put it in a high B, but probably no further than that. And let's see what we got at high B. Probably just slightly ahead of Seagate. Next up, we have SLB, which is an oil field service company. So it is in some ways related to the energy sectors, but also in some ways kind of considered to be in the tech sector. It's kind of like an amalgamation of the two. But the earnings are expected to go up slightly from 2.6 to 2.9. That's about like a 13, 14, 15% increase. Not bad. Dividend yield is okay, 3%. Not bad at all. PE ratio is really good looking though. 14.5 for the past 12 months, 12.87 for the next 12 months. So the good PE ratio, the fact that there is a decent dividend, earnings going up. And also, I just like this type of company a little bit better than some of like those data storage companies because it's also a little bit related to the energy sector as well. And you also have the high dividend, so there's regular income coming from the stock. So I like this slightly better. I'm thinking, do I put it just ever so slightly at like a low A? I probably will actually. I'm probably going to put it just barely into A. Probably like somewhere over here. Next up, we have Kinder Morgan, which is, again, an energy infrastructure company similar to SLB. Again, it's kind of like an energy sector type of a stock, but also somewhat tech related. I do like this type of a stock. Earnings expected to go up, again, a little bit, about 10% from 1.22 to 1.36. Dividends are very nice though, 4.42%, even better than what we saw with SLB. P ratio is a little bit bigger though. P ratio of 21.6 for the past 12 months, projected to be 19.3 for the next 12 months. It's fine, it's not that bad. Like that, those are not huge numbers. But of course, SLB was a little bit better in terms of the PE ratio. So overall, I think it's very comparable. I'll probably split it slightly ahead of SLB, again, because of the higher dividend, but they're pretty interchangeable because SLB, probably the price is a little bit better suited and probably less overpriced. So I'll just barely put it ahead of SLB. Next up, we have Simon Property Group, which is a REIT company that stands for Real Estate Investment Trust. And as such, they own a lot of real estate. And, if you get in on the stock of Simon Property Group, it's like you own a part of the company that, has all these real estate investment trusts. So it's kind of like you're indirectly getting involved with the real estate sector. Earnings are expected to go down, though, from the past 12 months to the next 12 months. So that's not a good sign. Dividends are pretty good, 4.68%, but we can't overlook this. And also P ratio was probably just barely okay for the past 12 months, but again, looking to go in the wrong direction. So I don't think it's the right time to get in on this particular investment. So I'm just going to put it at a high C. Dividends are very good though. So I'm not going to be too harsh on it, probably like a high C. I'll even put it first, why not? But yeah, probably not the best time to get in on it, but probably if the price was a little bit better, or if the earnings was going up at a much better rate instead of going down, then it would be something worth looking at for sure. Next up, we have Workday Inc., which is an HR and financial management company. And just immediately look at that PE ratio. That's kind of really high. It's expected to be corrected massively. I mean, the earnings projections are very high, but again, that just looks way too risky. If this does pan out the way it looks, obviously that would be great. Earnings about to quadruple. And also the P ratio about to be, settling down at a much more reasonable level. But as is right now, I'm just not particularly interested. It just looks way too risky to me. Do I put it at a high C? Probably barely at a high C. I don't think it's like that bad, but again, it looks just too risky, so it's just an avoid for me. Next up, we have Ross Stores, a chain of stores that sells stuff like shoes, clothes, home hardware, equipment, stuff like that. We have earnings of 6.4 over the past 12 months, expected to be 7.13 over the next 12 months, about like 12-13% increase. Dividend, again, pretty much non-existent at 0.89%. That's very low, even less than 1%. And the P ratio, again, perhaps a little bit bigger than we want it to be, 28.5 over the past 12 months, 25.6 over the next 12 months. So just overall looks like a middle to low B for me. So I'm just going to put it somewhere around here, maybe like right after Walmart. Next up, we have Picard, which is a truck designing company. Earnings expected to go up from 511 to 571 over the next 12 months, a little bit over 10% increase, so maybe like 11-12% increase. Dividend, pretty low, 1.18%, not enough to justify anything, but the P ratio is not bad. 21.96 over the past 12 months, 19.66 over the next 12 months. It looks okay. I don't mind this one particularly much, and it's a little bit different than a lot of the other stocks we've looked at, so it's a little bit of a hedge, particularly against like an AI potential bubble burst or anything like that. So I like it fine. I'll probably put it like in middle to high B, but again, it's nothing that I would go out of my way to look at, but it looks fine to me. I don't particularly mind it. Next up, we have EOG Resources, another energy company. Earnings expected to go up slightly from 10.04 to 10.5. It's about a 5% increase, so pretty small. Dividend yield is decent, 3.88%, almost 4%. And PE ratio is very reasonable, 10.13 over the past 12 months. Projected to be 9.69 over the next 12 months. So even though the earnings are not going up all that much, all the rest of the numbers are just looking so good that I like this one. And again, it's a little bit of an energy play. Again, energy is something that's almost always needed by everybody. So I like this one quite a bit. Again, not enough for me to put an A. Like if the earnings was going up by a decent margin, then this would be probably an A. But as is right now, probably like a high B, not super high B, but relatively high B. So let's drop this somewhere around here. Next up, we have AFLAC, which stands for American Family Life Assurance Company. And as you can tell, it's an insurance company. And the earnings are expected to go down slightly from 7.67 to 7.37. So not a good sign. Dividend yield is, again, it's okay, 2.12%, barely over 2%, but nothing to write home about necessarily either. P ratio is okay, 14.27 over the past 12 months, 14.85 over the next 12 months. So overall, if it wasn't for the earnings going down, this could have been decent. It could have been like a high B, or maybe even if like there was a massive gain in earnings, it could have even pushed into A. But as is right now, because of the lower earnings, it probably has to be like either a high C or a low B. Again, because of the really good P ratio, I won't go quite to C, but it's gotta have to be like at a very end of B, probably like just above American Electric Power. Next up, we have PayPal, the online financial company. I use PayPal all the time myself. Earnings expected to go up from 4.98 to 5.83. That's about is that a 20? Not quite 20%, but like 17-18% increase. Dividend yield of 0.23%, pretty negligible, so almost don't worry about the dividends at all. But the P ratio is very good. P ratio over the past 12 months, 12.3. Over the next 12 months, projected to be 10.5. So earnings going up like an okay amount, and also the P ratio is being so strong. It does give me confidence with this stock. So I do like this one quite a bit. I'm thinking about whether I should put it in A or a high B. I'll probably just barely sneak this one into A as well, because again, B has just gotten so ballooned up that I feel like we need to start putting some stuff maybe either barely into A or barely into C if they're like at the edges of B, so that it just the whole structure makes a little bit more sense. But I'm not going to put it too high. I'll probably put it like right here. Next up, we have Sempra, which is a utility company. Again, what I like about utility companies is that no matter what's going on with the economy or with politics or whatever, everyone still needs their utilities. They still need their power, their water, etc. So I like utility companies in general. This one in particular, earnings are going up from 3.25, projected to go up to 5.13. That's a massive increase. That's like almost 60%. Dividend yield is decent, 2.93, almost 3%. And P ratio, perhaps a little bit higher than we want it to be over the past 12 months at 27, but it's looking to get a lot better. The projections are showing that it's going to be around 17.15 because of this massive gain in earnings. So again, because of this massive gain in earnings and the decent dividend yield, I'm going to put this as like a very high B. I don't know if I'll quite put this one into A. I don't like it that much, but it's going to go higher up in B for sure. I'll probably put it like right ahead of Duke Energy. Next up, we have NXP Semiconductors, and as you probably guessed, yes, they make semiconductors. Earnings expected to go up from 8.08 to 13.75 over the next 12 months. Again, decent amount of increase. That's about like a 55-60% increase. Dividend yield is 1.77%, so it's below the 2% that I mentioned earlier. It's probably like okay, but nothing to write home about either. If there's a lot of potential for growth, then this would be a nice bonus, a nice cherry on top. But other than that, it's not gonna like convince us to do anything in particular. PE over the past 12 months was 28.42, probably a little bit higher than we want it to be. But for semiconductor companies, it's actually probably fine. That's actually pretty decent for a semiconductor company. Actually, take it back. I think that's actually pretty good. And then going forward for the next 12 months, projected to be a lot better, 16.75. So, or 7.1, I should say. I do like the company. I do like the numbers that I see here, particularly this massive jump in earnings and the fact that it wasn't overpriced. Like I just assumed it would be a lot more overpriced than it is here. So that's actually a very good sign. Usually these semiconductor companies, because of how much investment there is into them, because how much promise they have going forward, there's usually a much higher P ratio, and as such, you could infer that they are perhaps a little overpriced. But this one looks pretty good for now. But that said, there are other semiconductor companies that are also doing really well. So there's definitely a risk that this company might just start losing out contracts to some of those competitors. So that's the inherent risk with it. So that's the only reason I'm not going to put it in A quite, but I do like it quite a bit and the numbers are looking really good. It's just that inherent risk of, one, the AI bubble burst potential, and also the potential risk of the other bigger, much larger companies that are also producing semiconductors, perhaps battling against this company in certain areas and taking some of the customers away. So for that reason, I'm just going to slightly hedge against all of that and just put it in a high B instead of like a low A. But it's a decent company. Like I don't mind investing into this one. If somebody does, I'm not gonna begrudge them too much. Next up, we have Becton Dickinson and Company, which is a medical technology company. Earnings expected to go and basically almost triple up from the past year to the next year. 5.83 earnings per share over the past 12 months, 15.78 over the next 12 months projected. That's an amazing projection. Let's see if they can hit that. Dividend yield of 2.12%, so barely above the 2%, but I'd still like to see a little potential for growth, and there definitely is some, because the PE ratio is expected to go from 33.7 over the past 12 months to 12.45 over the next 12 months. So that's a very good direction that it's heading in. And there's definitely potential for this stock to grow a decent amount as this PE ratio is going to such a healthy level, for it to like balance out a little bit and people pour some more money in there and bring up the PE ratio. So I do like this one. Again, particularly the earning tripling up is what is really enticing me with this one. So it looks like a low A to me, and I would just advise against getting too involved with stocks like this, because there's always a huge amount of risk that those earnings are missed, because medical technology, I mean, it's so difficult to exactly predict which ones are going to pan out in which ways, which ones get approved, all those sorts of things. So there's definitely risk there, but there's enough promise for returns that I'm going to push it all the way to a low A, but I'm not going to like push it up to like a higher A or S or anything like that, because again, the risk is definitely there. Next up, we have Vistra, which is an electricity company. Earnings expected to almost quadruple. This is kind of crazy, or triple at least. 2.8 for the past 12 months, expected to be 8.8 over the next 12 months. That's a huge jump. Dividend yield pretty non-existent, 0.52%. But look at this. So PE ratio for the past 12 months was really high. This is kind of crazy, 62 almost. But expected and projected to be a lot better at 19.75. But again, that just seems like too big a gap to go with the earnings. So it just seems a little too risky, even though again the potential seems there. It seems too risky for me to like necessarily go with a stock like this. So I'm gonna probably put it like in a middle B. Like I don't hate it. Definitely there is some potential for it to do some gangbuster business, but it just seems a little too risky for my liking. So I'll just put it in the middle B and move on. Next up, we have AutoZone, which is an automotive parts manufacturing company. Earnings expected to go from 143 to 178. That's an increase of about, what is that, 20 something percent. Dividend yield almost or pretty much non-existent at 0%. PE ratio is decent, 23.83 over the past 12 months, projected to be 19.17 over the next 12 months. That's looking decent, but overall, again, I'm just not particularly interested in a company like this. I'm going to put it in like a middle B, and the numbers are okay, but it's nothing that blows the door off of anything, right? So we're just going to put it right there, and that right there looks about right. Next up, we have Phillips 66, another energy company. Earnings expected to almost triple from 3.66 to 11.8. There's also a 3.6% dividend yield. PE ratio is kind of high for the past 12 months, 36. Expected to be a lot better, projected to be a lot better at 11. But again, that just seems a little risky, so I'm not going to quite go into like A. But again, the numbers are just too good for me to not go, at least to be. And 36, at least it's not like closer to 50 or something like that. So overall, high B sounds about right for me. Unfortunately, not quite promising enough, or risk averse enough to go into A, but still high B, not bad at all. I'll probably just put it right there. Next up, we have Marathon Petroleum, which is a petroleum refinery company. Earnings expected to go up from 9.4 to 14.2. That's a little bit more than a 50% gain, which is pretty decent. 2.11% dividend yield. Not too bad, but again, not enough to justify getting the stock on its own. P ratio is decent though, 18.85 over the past 12 months, 12.43 over the next 12 months. So as such, good earnings going up, good P ratio, a little bit of dividends as well. Looks pretty good to me. I'm going to go a low A. We're going to pick it up and we're going to drag it all the way there. And I'll probably put it maybe slightly ahead of these ones, maybe like right there. Next up, we have IDEX, which is a pet healthcare company. Earnings expected to go up a little bit from 12.6 to 14.45. That's about like a 15, 16, 17% increase, something along those lines. No dividend yield to see here, and also the P ratio is massive. This is kind of crazy. 55 for the past 12 months, 48 over the next 12 months. That just seems way too overpriced, so I'm just not interested. I'm going to probably put it like in a high C. I'll probably put it right about there. Next up, we have Ford, which is one of the most famous car companies in the world. Earnings expected to go up from 1.17 over the past 12 months to 1.5. That's pretty decent. It's about a 30% increase. There's a nice amount of dividend yield as well at 4.4%. Very nice. And the P ratio is very good. 11.72 over the past 12 months, 9.14 over the next 12 months projected. So the earnings going up a decent amount. P ratio very healthy. Very high amount of dividends. I really like the stock. I'm going to put it in A. Perhaps not too far down either. We'll see where we can squeeze it. Let's take a look at what we have in A. I can probably put it ahead of these ones. Maybe somewhere around like BlackRock or something. Maybe I'll put it just after NVIDIA. I like this one quite a bit. Next up, we have Allstate, which is an insurance company. Earnings expected to go down from 30.5 0.89 to 24.22. There's not even a lot of dividends or anything like that. P ratio is good, but again, earnings are going down. That's not a good sign. I'm not particularly interested in this one. So we're going to go and we're going to drop it like at a high C, something like that. Next up, we have L3Harris, which is a technology company and also a defense contractor. Earnings expected to go from 9.3 to 12.44, about a 30% increase. Not bad at all. There is a decent amount of dividends, or at least I shouldn't say decent. It's like a little bit of dividends, 1.7%. Would have been nice if it was over 2%, but it's fine, I suppose. P ratio a little bit higher, but I suppose it's fine for like this kind of a technology company. And also, you know, they have a lot of defense contracts, so that always helps a little bit. P ratio of 30.37 over the past 12 months, projected to be 22.74 over the next 12 months. Overall, I don't mind this stock too much. The P ratio would have been nicer if it was a little bit lower, but it's still fine for this type of a tech company. And earnings are going up a decent amount. And again, these companies that have a lot of defense contracts, I do like that about them as well. So I'll probably put it like in middle to high B. Not quite enough to get into A or like the super high B levels, I should say. But yeah, probably like slightly higher than middle B looks about right. Maybe I could put it a little bit higher than that too. Somewhere around here. Next up, we have Air Products and Chemicals, which is a company that sells gas and chemicals for production to other companies. Now, their earnings was negative for the past 12 months, which is not a good sign. There's obviously a lot of inherent risk there. They're projected to be able to make quite a bit and have a decent P ratio. But in general, it's just this seems way too risky for me, so I'm just not interested. I'm going to put it in C respectfully. If they do better this year and then they look to do even better the year after, then we can look at it. But as is right now, I'm just not particularly interested. Next up, we have MetLife, which is an insurance company. Earnings expected to almost double, going from 5.3 over the past 12 months to 10. And there is a decent amount of dividends at 2.7%. P ratio very good, 15.5. Projected to be a lot better at 8.2. So there's definitely some promise for growth there. Do I put it into A? Is there quite enough here? Maybe actually, maybe just barely, because earnings going up a decent amount. Very good P ratio, a little bit of dividends too. I'll put it in like a low A. It's not something that I'm like too excited about, but there's a little bit of potential there that I don't mind at all. So I'll probably put it like right there. Next up, we have NASDAQ Inc. And of course, everyone knows the NASDAQ Stock Exchange. Let me know if you want to see me do a video about the NASDAQ 100, by the way, similar to this video where I go over all the stocks. Let me know in the comments down below if that's something you'd like to see. But here, NASDAQ itself, earnings expected to go up from 2.8 to 3.81 over the next 12 months. That's about a 30% increase. That's pretty decent. Dividend yield is 1.13, pretty negligible. P ratio, perhaps a little bit higher than we like it to be over the past 12 months, 33.13, but looking to be a bit better over the next 12 months at 24.4. So overall, it's fine. Probably like a middle B, maybe slightly higher than the middle of the road B. Sounds about right. So we'll take this and we'll put, you know what, we'll put it right next to S&P. Why not? The two can be right next to each other. Next up, we have Realty Income, which is another real estate management firm. And right off the bat, I can tell you the PE ratio just seems really high. It seems kind of overpriced. Dividend yield is pretty good at 5.6. Earnings are going up about like 50% or so, but that PE ratio is just way too high. So I'm going to put it in a low B because I'm just not particularly interested. It just seems a little bit risky with the price of the stock. Next up, we have Zoetis, which is a drug company. Earnings expected to go from 5.93 to 6.8. That's about like a 15% increase, which is not bad. Dividend yield, there's a little bit, 1.6, but not too high, not enough to like make us want to go out and get the stock right away. PE for the past 12 months was not bad, 20.76, projected to be even a little bit better at 18.13. Not looking bad, nothing particularly exciting, but it seems okay. Probably like a middle to high B is probably right. So we're gonna bring it up here and we'll probably put it right next to Boston Scientific. Next up, we have Digital Realty, another one of these real estate types of companies, and the earnings are expected to fall off a cliff. 3.87 over the past 12 months, projected to be 1.64. That's so much lower. And the PE ratio is absolutely ballooning up. It was already not that great, but 91.36. You know what? I think we know where this one is going. Right there. Another one into D. Next up, we have United Rentals, which, again, you'd never guess this, but it's a rental company. I know, crazy. Earnings expected to go from 38.87 to 47.14. That's about like a 25-30% increase. Dividend yield pretty non-existent at 0.87, pretty negligible. P ratio is decent, 21.06 over the past 12 months, 17.37 over the next 12 months. Not bad at all. Probably like a slightly higher than middle B. I don't particularly love, but I mean, it's going up by 30%, so maybe I should be like at a high B, actually. I'll go at a high B with this one. So we'll take it, and we'll go all the way up here. Maybe right next to some of these ones. Maybe I'll even go ahead of TJX. Why not? Next up, we have Datadog, which produces cloud-based analytics software. Those P ratios are crazy, though. Look at this. For the past 12 months, 474.42, projected to be at 60.5. Even that's kind of high up there. Earnings, yes, it is going up massively, but again, very risky. What if it misses those projections? It's not looking good. Let's put it that way. And talk about overpriced. I mean, that's just insane. So this one, no offense, and look, this one could absolutely blow up and could do amazing. But right now, I just look at that and all I hear is run away. Stay away from this one. Too risky. Not worth looking at unless you're throwing like $10 on it or something like that and nothing more. So no offense to it, and it could do really well. Like this could look really weird that I put in D if it like absolutely blows up over the next year or so. But there is a lot of risk there, a lot of risk. So not particularly interested right now. Maybe if it does a lot better and those numbers are looking a lot better going forward, maybe we can take another look at it. But right now, just not even interested to put it into C, to be honest. Next up, we have Valero Energy Corporation, another energy company. Earnings expected to almost triple from past year to next year. A decent amount of dividends, 2.78%. P over the past 12 months was a little bit higher than we like it to be, 33.9. Projected to be a lot better, though, 12.83 over the next 12 months. So again, looks like slightly higher than middle B, maybe like somewhat high B. There's some potential with it, but again, I'm not jumping out of my seat necessarily, so I'll just put it right there. Next up, we have Electronic Arts, EA, which is a video game production company. Earnings expected to almost triple. That's really good. 3.42 to 9.3. Not a lot of dividends there, so pretty negligible there. The P ratio is kind of really high over the past 12 months, almost 60. Looking to be or projected to be a lot better at 22, but again, that's a big gap. Will it make that jump without any issues? We'll see. Again, it looks like a middle of the road B to me, maybe slightly higher than middle of the road. Maybe I'll put it like just over here somewhere. Next up, we have Dominion Energy, another energy company. Earnings expected to go up from 2.94 to 3.6, about a 20% increase. Not bad. 4.5% dividend yield. That's all right too. And the PE ratios are decent too. Over the past 12 months, 20.2. Over the next 12 months, projected to be 16.5. So there's enough there for it to be a high B, but not quite enough probably to be breaking into A, at least not for me. So I'll dump it somewhere around here. Let's go perhaps right above FedEx. Looks somewhat about right. Next up, we have Edwards Lifesciences, another medical technology. Earnings expected to go up a decent amount, about 20% or so. No dividend yield. P ratio kind of high, particularly for the past 12 months. Maybe a little bit better over the next 12 months, but still kind of high even then. So overall, looks like a middle of the road B, maybe even slightly lower to me. So I'm just going to dump it somewhere around there. Next up, we have Roper Technologies, which is a holding company that owns a lot of other tech companies. underneath it, basically. Earnings expected to go up by about 50%. Dividend yield, less than 1%, pretty negligible. P ratio, again, kind of high over the past 12 months, but might be okay for tech companies. But I'm just not particularly interested in one of these companies that owns a lot of different companies, and each of them are doing their own thing. So I'm not particularly interested. It's not looking bad. Numbers are okay, so I'm not going to be too harsh on it. I'll just dump it like somewhere here at a low B and call it a day. Next up, we have Oniak, which is an oil and gas company. Earnings expected to go up by about 10%. There's a decent amount of dividend yield at 5.8%. That's pretty good. And P ratio is very nice. 13.08 over the past 12 months, 12.02 over the next 12 months. Those are very healthy numbers. So we have earnings going up, very good P ratios, very high dividend yield. I like the stock quite a bit. I'm going to push it into A. Not too far up in A, but it's going to make it to A nonetheless. Let's see where we can put it. Probably like, do I put it ahead of PayPal? Maybe like slightly below PayPal, somewhere around there. Next up, we have Baker Hughes, which is an energy tech company. Again, I like those amalgamations, but this one in particular, the earnings are looking to go down, which is not a good sign. P ratio was decent, but again, it's going to be going up. So overall, again, probably like a low B looks right. Like the numbers aren't too bad for it to go down to a C, but can't quite put it higher than like a low B or something like that. So for that reason, I'm just going to put it like somewhere around here, maybe even here. Next up, we have Cardinal Health, which is another healthcare company. Earnings expected to almost double from 6.6 to 11. That's about like an 80-somewhat% increase. Dividend yield, pretty negligible at 1%. Nothing to write home about. P ratio was perhaps a little bit higher than we want it to be at 29.87 over the past 12 months. But over the next 12 months, looking a little bit better. Projected to be at 17.8. So overall, I don't mind it too much. Probably like somewhere between like a middle to high B looks about right, but again, it's not quite enough for me to put it into A necessarily. So we're just gonna put it somewhere around here. Next up, we have Public Storage, which is a company that provides you storage space. Earnings expect to go up by about 10% from 9.6 to 10.37. There's a decent amount of dividend yield at 4.5%, not bad. P ratio perhaps would have been nicer if it was a little bit lower, 27.8. Looking to be at 25.8 projected for the next 12 months. So again, looks kind of like middle of the road B type of company. So we're gonna take this and drop it somewhere in there. Next up, we have Fastenal, which is an industrial supplier company. Earnings looking to be going up about 15% from 1.07 to 1.22. There's a little bit of dividend yield at 2.08%. Nothing to write home about necessarily. And also the P ratio is a little bit higher than we like it to be. So overall, looks like a low B to me. It's going to go perhaps somewhere around here, but not too high. Next up, we have CBRE, which is a real estate investment and services company. Earnings looking to be going up from 4 to 7.38. That's about like an 80% increase, which is pretty decent. No dividend yield, and also P ratio perhaps a little bit higher than we want it to be. 39.7 over the past 12 months. 21.79 over the next 12 months looks a lot better, but again, that's assuming we hit those projections. These are the massive projections as well, by the way, going up about 80%. Again, if it gets there, it could be a little bit better. But because it was quite a bit higher over the past 12 months, probably can't go too much higher than like a middle B. We'll see where we can squeeze it in. Let's see. I'll probably put it like right ahead of Exxon, something like that. Next up, we have Monolithic Power Systems, which is a company that produces power management products. Earnings expected to fall quite sharply, almost in half. 39.16 over the past 12 months. Expect to go down to 20.78. It's pretty bad. Basically no dividend yield either. 0.62, pretty negligible. P ratio was okay over the past 12 months, 24.3, but looking to drop to like really bad levels, 45.78 over the next 12 months. So just overall, looks like an avoid. I'm going to put it in D. Next up, we have W.W. Grainger, which is another industrial supplies provider. Earnings expected to go up from 35.83 to 43.68. That's about a 20% increase. Not bad at all. There's basically no dividend yield at 0.86%, pretty negligible. P ratio maybe a little bit higher than we want it to be at 28.5, but looking to be a lot better at 23.4 over the next 12 months. So again, looks like kind of a middle of the road B, maybe slightly higher than middle B, but again, nothing to write home about per se. We'll probably put it like somewhere around here. Next up, we have Take-Two Interactive, which is another video game company. That's a holding company that has a lot of other video game producers. The earnings were quite negative for the past 12 months. So right there, I'm just not particularly interested. The projections also has it at 7.86 over the next 12 months, which would give it a P ratio, again, probably slightly higher than we wanted anyway. So I'm just not particularly interested. It seems like way too much risk for not particularly a lot of potential for upsides. So not really interested in this one either. I'm going to put it like somewhere around here, maybe potentially even less than Robinhood. Next up, we have Diamondback Energy, another energy company, another oil and gas company. Earnings expected to fall with this one, though, from 14.4 to 11.77. P ratio was really good. Dividend yield a little bit there, but overall, again, earnings getting lowered, maybe because of how good the P ratio is. And the fact there's a little bit of dividends, I won't go quite to D, but looks like a C to me, easy C, perhaps even a lower C than a lot of these other ones. Somewhere around there looks about right. Next up, we have Ametek, which is a company that is both the designer and the producer of a number of electrical instruments. Earnings expected to go up by a little bit from 6.35 to almost 8. That's about like a 25% increase. Not bad, actually. Dividend yield almost non-existent at 0.6%. P ratio a little bit higher than we want it to be at 31.8 over the past 12 months. Projected over the next 12 months to be a little bit better at 25.3. So overall, looks like kind of like a middle of the road B to me, maybe slightly higher than middle, but not too much higher. We'll go somewhere around here with that one. Next up, we have Rockwell Automation, which is a company that's working on industrial automation. I do like the idea of a company like this because it seems like it's very futuristic. It's on the cutting edge. And if it keeps doing well, it could potentially get in on a huge share of a future market, which could be the automation market. So I like that aspect of it. The earnings are looking to go up by a lot from 7.66 to 13.64. That's looking really good, almost doubling. There's not a lot of dividends there. 1.3, that's not that high, nothing to write home about. P ratio is a little bit up there, but with this kind of a company, which is investing into the future and is definitely like just a long-term investment, I really like this one as a long-term investment. Even for the next 12 months, it's looking that the P ratio is going to be a lot more reasonable. So I really like this one. I'm going to be putting this like in the middle A, actually. If the numbers were a little bit better, I might have even considered S, but I'll hedge against it a little bit because, these P ratios are a little bit high. And this is for the long term. For the short term, all kinds of things could happen with this stock. I would not be shocked if it falls off a cliff in the short term in the next year or two. But I do believe in it over the long term a lot, and particularly the mission of the company, what it's trying to achieve. And I really do believe that's the future. We're going to get to that point, whether it's 5 years from now or 10 years from now or 15 years from now. At some point, we're going to get to a stage where there's barely any workers in factories. It's going to be automated massively, right? So I really like this company. I'm going to be putting it up here. Let's drag it all the way up. And I'll probably put it, honestly, slightly even higher than the likes of Apple and Google. Because again, actually, do I want to put it ahead of Apple and Google? Maybe I'll put it ahead of Apple, but not Google. Maybe I'll keep Google slightly higher, but right about there looks kind of right. Next up, we have Xcel Energy, another utility company. Earnings looking to go up from 3.28 to 4.12, about like a almost a 30% increase. There's a decent amount of dividends, 3%. P ratio not too bad, 22.5 over the past 12 months, 17.88 over the next 12 months. So overall, it's fine. I'm probably going to put it at like a middle to high B. We'll see where we can squeeze it in. B is getting way too crowded, but I mean, that's just the way it is. Yeah, probably somewhere around here looks about right. I'll just dump it over there. Next up, we have Las Vegas Sands, which is a company that owns a bunch of hotels in Las Vegas and also some other places as well. We have the earnings for the past 12 months was 2.22. Projected for the next 12 months is 3.2. That's almost a 50% increase. There's a little bit of dividends at 1.5%. Again, not quite high enough to be like blowing the lid off of anything, but that's something. P ratio probably a little bit higher than we want it to be over the past 12 months at 30.4, but looking a lot better over the next 12 months, 21.06. Again, looks like a middle of the road type of B company, but because of how large that earnings increment is, maybe a little bit higher than just middle of the road B. We'll see where we can put this one. Let's see what we got. All right, maybe I'll put it right after EOG, like right there. Next up, we have Chipotle. I think everyone knows Chipotle, one of the better fast food options out there. Earnings for the past 12 months, 1.13, looking to go up a little bit by about like 7% or so to 1.21 over the next 12 months. Not bad, but not that high either. There's no dividend yield with this one. P ratio a little bit higher than we want it to be, 31.43 over the past 12 months, 29.46 projected for the next 12 months. So not really that exciting. Earnings not going up that much. P ratio not that great. No dividends either, so we're just looking at growth, and again, doesn't look particularly like a stock that is all that conducive to a lot of growth. So a low B, maybe even like a high C, honestly, probably like a high C. If I'm being honest, I'll probably just put it at the top of C. Next up, we have Ameriprise Financial, another financial company. Earnings looking to go up from 36.5 to 42 almost. That's about almost a 20% increase. Dividend yield 1.28%, nothing to write home about, pretty negligible. PE ratio is very good though, 13.5 for the past 12 months, 11.7 projected for the next 12 months. Those are very good. So earnings going up a little bit, a tiny bit of dividends, very good PE ratios. That looks like a high B to me. So I'll just take this one up the chain and we'll put it probably right after Sands. Next up, we have Courier Global, which is an environment and energy solution company. Earnings expected to go up from 2.5 to almost 3. That's about a 20% increase. A little bit of dividends at 1.68%, but again, nothing too high. P ratios are okay, 21.45 over the past 12 months. Even better at 18.16 over the next 12 months. So it's okay. Probably slightly higher than middle B. I'll put it right after Honeywell. Next up, we have Corteva, which is an agriculture company. Earnings expected to go from 2.34 to 3.67. That's about a 50% increase. Pretty nice. A dividend yield, pretty negligible at 1%. PE ratio, maybe a little bit higher than we want it to be at 28, but over the next 12 months, projected to be a lot better at 17.9. So overall, maybe closer to high B, but not quite the highest of the high B. I'll take it and I'll drop it somewhere around here, maybe just slightly ahead of Palantir, or even maybe ahead of Exxon Mobil, maybe somewhere around there. Next up, we have Exelon, a utility company. Earnings expected to be pretty stagnant from 2.79 to 2.83. That's basically no change. Dividend yield is decent at 3.66%. And P ratio is not that bad either, 15.66. And for the next 12 months, expected to be 15.44. So if the price stays stagnant, that's fine. But are we confident that the price will not go down and also the dividend that is being paid out will not go down, even though the earnings are pretty stagnant? I'm not super confident about that. So probably like a middle of the road B for me. It's not gonna quite hit a high B because of those questions that we have. So yeah, I'll just put it somewhere in the middle of B, maybe even slightly lower than middle, but somewhere around there. Next up, we have Delta Airlines. And again, in general, I'm just not all that interested in airlines, particularly because, I mean, there's not that much room to grow. What is there really to be excited about? Is there really a lot of potential for them to reinvent the wheel, so to say? And of course, there's a lot of competition, a lot of different companies that are trying to get a piece of the pie. So in general, I'm just not a big fan, but I will say this. The PE ratio for this particular company is really good. It's just below 10 and looking to be even better for the next 12 months. Now, Earnings aren't going up all that much. They're going up a little bit from 7.09 to 7.19. So that's about like a 1 or 2% increase. Very low, very negligible. And there isn't a lot of dividends with this stock either. So we're just looking at potential for growth. And again, I think it's a okay stock. It's not bad. Particularly the P ratio being so low is very good to see. But there's not a lot of potential for the earnings to go up. Not a lot of potential for the stock to go up all that much. So I'm going to put it right down the middle in B. Again, nothing against the stock. There's not a lot of things to be worried about or a lot of things to be alarmed about. It's just there's not a lot to be excited about either. So I'm just going to put it somewhere in the middle over here. Next up, we have D.R. Horton, which is a construction company. Their P ratio, again, is very good, about 12.6, and looking to be even better over the next 12 months, projected at 11.02. The earnings, again, looking to go up at least a little bit of a more decent amount than some of the other stocks we've looked at recently. 11.6 for the past 12 months, 13.28 for the next 12 months. So that's about like a 15% increase. That's pretty good. Dividend yield is a little bit, but again, not enough to write home about or be too excited about. 1.13%. Again, we really want to see growth, but what I like about this company is that with the low PE ratio and the potential for earnings to go up a decent amount, then, you know, the dividend is just a cherry on top, right? There is a little bit of an room for growth here, and it is very different to, you know, the AI stocks if you want to hedge against those things. And, you know, what we talked about with Delta right now is that, you know, unfortunately, there wasn't enough earnings growth, even though the PE ratio was really good. If the earnings growth was a little bit better, it was projected to go up a little bit more, we could have maybe even potentially looked at that company going even into A perhaps, right? So this company having a very decent expected earnings growth is very nice to see. For that reason, I'm going to put it higher up in A. I'm not quite going to put it in B, but it's definitely going to go up much higher in B than Delta. So we're just going to drop it perhaps somewhere, maybe somewhere around here. Next up, we have Exxon, which is a safety tech company. So they produce stuff like tasers, body cams, stuff along those lines. PE ratios are kind of crazy. For the past 12 months, the ratio was 184.82. I mean, talk about overpriced. Even projected with higher earnings and all that for the next 12 months, it's projected to be 76.9. So it just seems overpriced to me. Even with the higher earnings, can it sustain the growth to the same extent? I'm not so sure. It looks very risky. Again, it's one of those companies that definitely could it blow up? Of course it could. But there's a lot of risk. There's a lot of risk. It could easily as well just not do all that much or just even lose you money, right? So for that reason, I'm a little bit more skeptical with this type of an investment. And again, this is not one of those companies which is in one of those industries that you expect to boom, that you expect to do incredible business going forward. There's not that much great news that really excites me about the company and their prospects and the new developments and new products and all that. So for all that reason, it's just not a risk that I'm personally willing to take. Again, you might feel differently if you know more about the company, if you're excited about some of the products. Maybe you can look at something like this because the earnings are expected to more than double from the past 12 months to the next 12 months, going from 3.16 to 7.59. That's almost 2.5 times. So there's definitely a lot of room for growth. There's definitely potential with this one. But again, it just seems way too risky for my liking, and I'm just not all that interested. So for that reason, I'm going to put it in C. But again, I'm not going to begrudge anyone who might want to like have a go at this one or maybe look closer and see if they can see perhaps something that I haven't seen that really excites them about this company. Next up, we have Target, and I think everyone knows Target, a huge supermarket store chain. Their earnings per ratio are expected to go down. This is not a good sign. PE ratios was really good. The PE ratio for the past 12 months was 12.08. For the next 12 months, even with the lower earnings, it's still expected to be a very decent 12.98. But again, it's just not a good sign to see lower expected earnings per share going forward. Usually these projections are perhaps even a little bit more optimistic. So a lot of times they might project earnings going higher and it doesn't. So when they project lower earnings, that is just not a good sign at all. That perhaps tells you that it might even be lower than expected going forward. And yes, the dividend yield is very high, 4.54%. But again, as soon as I see the lower earnings, I'm immediately alarmed. Let's put it that way. That doesn't necessarily mean that the stock is going to do poorly. It doesn't necessarily mean that, projections can't be wrong. Maybe they end up doing really well in like the third or the fourth quarter and they really bring it back up. But as is right now, just looking at these numbers, it's not a company I'm interested in. So for that reason, I'm going to put it in C. And I'll even put it a little bit lower than Exxon that we just took a look at, because whereas with that one I can at least understand the potential, with this one I think that's an avoid for the time being. If numbers get better in the future, I don't have anything against the company, and the 4.5% yield is very nice, but right now I think it's one that we should stay away from. Next up, we have Entergy, another energy company, another electrical company, and the P ratio for this one is not too bad. Would have been nicer if it was a little bit lower, 22.91 over the past 12 months, projected to be a little bit better at 21.17 over the next 12 months. Earnings are expected to go up about 10%, maybe just slightly under 10%, from 4.05 to 4.39. Dividend yield is decent. It's 2.63%, but again, it's not super high, like 3 or 4%. That would really make us take a look at this stock. So I don't mind this one particularly. I do think there are other energy companies that we've already taken a look at that offer better dividend yields, or are just more reputable, or just have a bigger piece of the pie. So I'd probably prefer some of those over this one. So for that reason, I'm not too excited about this company. And again, there's nothing really there. Like, it's not like a 10 PE ratio or anything like that makes you go like, okay, this is looking really good. It seems kind of standard. I wouldn't be shocked if it stagnates and just gets you that 2.63%, but I also wouldn't be shocked if it fluctuates a little bit as well. So overall, just nothing that particularly interests me. It's not bad. It's definitely not like super high risk or anything like that. It's not something that I would look at and say avoid, but again, I just think there are better options out there even for this particular sector. So for that reason, I'm going to put it at a low B. Nothing against the company, it's just I think there are better options within the same sector that we can take a look at. Next up, we have Kroger, another supermarket chain, and this one, the PE ratio is kind of high. That's not great to see. The earnings was very low for the past 12 months. They're expected to go up a lot, but again, usually with these kinds of gaps, and for this particular type of a company, like if this was like an AI company or something like that, maybe you can understand that with a high PE ratio, low earnings, because they're investing into future, they're coming up with revolutionary products, they're trying to absolutely change the state of the art and how a lot of things are done. So maybe you can understand that, and you would bank on them being able to develop a lot of revenue with their newly developed products or newly developed services. But with a supermarket, I don't really see that the same way. So this is not a good sign to me. And I just don't understand how the projections can be so much higher. It seems a little dubious. The expected PE ratio for the next 12 months is 11.94. Now, if this ends up being the case, that's very good. And potentially could even push up the stock, because that's a huge difference, right? Going from 58 to 12, the market could react to that, and there could be a lot of people buying in, getting in on the stock. But again, at the same time, that's assuming the earnings are correct, or the earnings reports are correct. The projected earnings, the projected PE ratio, I'm not entirely sure about that. 2%, 2.12% dividend yield is also not bad either, but overall, it just seems a bit risky, particularly with the PE ratio over the past 12 months. So overall, I'm just going to put this one like in a B in the middle. Not super excited about this one. Probably wouldn't be investing in this, but it's definitely not like one of the worst options we've seen out there. So I'll just put it somewhere around here. Next up, we have the Fair Isaac Corporation, also known as FICO. It's a data analytics company, and you might have heard about the FICO score, which is basically the credit score. It's very similar to the credit score. It's provided by this specific company, and they do services along those lines, data analytics and trying to predict behavior and such things. PE ratio quite high for the past 12 months, 66.05. For the next 12 months, projected to be better, but still on the higher side of things, 34.84. Maybe you can understand a little bit this being a tech company. But again, I wouldn't really classify this on the bleeding edge of tech either, like a lot of the AI companies that we've taken a look at. So given that that's not the type of company we're looking at, I would say those P ratios are still a little bit higher than I would like them to be. Earnings are expected to go up a decent amount though, from 26.5, expected to almost double at 50.3. Now there's no dividends, but there's definitely potential for growth. But again, it does seem a little overpriced as well. So I don't hate the stock, but again, it just seems too risky, seems a little bit overpriced. For that reason, I'm not super excited. I'm probably going to put it at a low B. I'm not going to be going after the stock quite yet. Maybe if the numbers improve, we can take another look at it. But for now, not particularly interested. Next up, we have AIG, the American International Group, another insurance company. And the P ratio for this one looks really good, 15.5 over the past 12 months, projected to be 10.95, almost 11 for the next 12 months. Earnings expected to go up a decent amount from 5.58 to 7.9. That's almost 50-60% increase. That's pretty good. And the dividend yield is 2%. So it's not the highest, but again, there's potential for growth with this one, which is what I like. So overall, I don't mind this one. This one, does it quite crack into A is the real question. Probably not. I'll probably put it at a very high B. What I don't like is that the dividend yield, I would have liked it to be like 2.5% or 3%, something like that. Then I would have really been all over this one. Or you know what? Maybe I will just put it barely into A because the P ratios are very good. Projections are very good. Screw it. We'll put it at a low A, but not too high in A. But yeah, the P ratio and the projections are just so good that I can't quite go without putting it into A. So I'll probably put it right next to MetLife because they're probably similar in terms of how I would look at these companies in the sector. But yeah, just barely breaking into A. Nothing I'm going to like go out of my way to invest into right away, but definitely not a bad option either. Next up, we have OXY, a petrochemical production company, and the P ratios maybe a little bit higher than we want them to be. Not super high, but perhaps a little bit higher at 29 over the past 12 months, 25.37 over the next 12 months, expected to be a little bit better. Earnings expected to go up about like 16-17% from 1.37 to 1.57. So decent amount going up, and the dividend yield is not bad. 2.4%. Really, the only thing I would have liked to see in order to push this into maybe a low A is a better P ratio. If this was below 20 for both the past 12 months and the next 12 months projected, then you know what? I would probably put this into a low A. But as is right now, I'm just a little bit more worried. I'm going to put it somewhere in like a high to mid B. But yeah, I'm just going to be a little bit more cautious because, again, I think there are also other good options out there as well. So that this one doesn't necessarily blow my socks off or anything like that. So I'll probably put it right after Goldman Sachs or PepsiCo, probably right there. Not a bad option, but there might be better options out there. Next up is Paychex, which is a company that provides businesses with HR, help with payroll, and also employee benefits. The P ratio is perhaps a little bit higher than we want it to be at 25.88. It's expected to be a lot better going forward for the next 12 months at 19.3. Earnings are expected to go up a decent chunk as well from 4.4 to 5.9. That's about a 30% increase, not bad at all. And dividend yield is very good at 3.7%. That's what I really like about this company. So very good, very high dividend yield, almost near 4%. PE ratio, perhaps not the greatest, but looking to be better. And the earnings are going up a lot. If the dividend wasn't this high, maybe I would have taken more issue with the PE ratio. But because you're getting that consistent 3.7% year in, year out, I'm willing to be perhaps a little bit more flexible with that. And also the earnings are expected to go up a very decent amount, about 30%. So overall, I will push it into a low A. But of course, if the PE ratio was even better than this is here, maybe it was less than 20 for the past 12 months and also for the next 12 months, then this could even be like a middle to even a high A. But as is right now, we'll barely push it into A. We'll go up here somewhere. There's so many companies here. I'll probably put it right ahead of PayPal, but somewhere around there looks about right. Next up, we have MSCI, which is a leading global provider of investment analysis. So this is stuff like risk-benefit analysis. This is stuff like market indicators, benchmarks. And they work with a lot of big banks and financial institutions to provide them those services. The PE ratio for the past 12 months, quite high, 37.8. I would say that's a little bit higher than I'd like it to be. Even forward, with the higher earnings, they're still expected to be at around 30.19, which is, again, probably higher than I would like them to be at this stage. Earnings for the past 12 months, 15.78. Looking to be a lot better for the next 12 months, 19.37. That's almost a 20 somewhat % increase, which is decent, but dividend, there is not that much, 1.23%, not a lot to write home about. We want to see potential for growth, but again, it seems like it is a little bit overpriced. At least that's what it indicates with 37 over the past 12 months, even for the next 12 months, still 30. We would have liked this to be below 25, maybe even potentially below 20. Then this would have looked like a really good investment opportunity. But as is right now, I'm just not particularly interested. So I'm going to put it at a low B. Earnings looking to go up. I do like what the company does. I do understand the value they provide, but I just think they're a little overpriced. So I'm not going to quite go to C, but probably a low B looks about right for this particular company as well. Next up, we have Targa, which is an energy infrastructure company. They provide infrastructure for gas, for natural gas, etc. P/E ratio, again, not super high, but perhaps a little bit higher than we like it to be at 24.59. It's expected to be a lot better at 18.6 over the next 12 months. Earnings, again, expected to go up about 25% or so from 7.44 to 9.83. So decent growth in earnings expected. Dividend yield, 2%. Barely at the stage where we consider it as at an okay amount of dividends, but again, nothing to write home about necessarily. It's not like a high dividend that immediately justifies the stock, but it's okay. It's not bad. Earnings are going up a decent amount. And again, with the PE ratio looking to be a little bit better next 12 months, that's not bad, but perhaps a little bit higher in the past 12 months. So altogether, it just seems like a down the road, middle of the road kind of stock that belongs right in the middle of B. Not bad, not great. It's okay. I wouldn't really begrudge anyone for investing, but am I super excited into investing? Probably not. But I don't think it's the worst option either. So I'll put it smack down right in the middle of B, somewhere in there, and we'll move on to the next stock. Next up, we have Yum Brands, which consists of a lot of different brands that you're probably familiar with. This is stuff like KFC, Taco Bell, Pizza Hut, etc. PE ratio, again, a little bit higher than we like it to be, 29.84. Seems a bit high, particularly for this type of a stock, for like fast food chains, etc. Expected to be 22.96 over the next 12 months, a little bit better, but even then, still a little bit higher than we wanted to see it be. Earnings expected to go from 5.14 to 6.67. That is about like a 25 somewhat percent increase, not bad at all. Dividend yield at 1.85%. Again, not super high for us to write home about, but it's something, cherry on top. But again, overall, it just seems like kind of a boring, down the road, middle of the road kind of stock. P ratio, not particularly good, but not bad either. Earnings going up, at least that's good. Dividends, again, kind of okay, but again, nothing to be too excited about. And again, just fast foods in general, like, again, it's nothing that excites me. It's nothing that I look at and see, wow, that's a great investment for a very long time. I want to say they're consistent enough to be just a steady, great investment for the long term. They don't have super high dividend for me to say, oh, they're a really good dividend investment. And they're not like particularly exciting enough for me to say, oh, they're going to grow massively, or I'm really confident, or I think there's a good chance they could do gangbusters in the stock market. So overall, it just seems like a down the road, middle of the road kind of a stock. So I'm going to put it smack down in B. And we're going to move on from there right after, probably somewhere around here. Next up, we have Agilent, which is a company that provides hardware and software for laboratories. This is things like microscopes, etc. The PE ratio expected to be better over the next 12 months at 21.17, but it was quite high over the past 12 months at 30.29, particularly for this type of a stock. And the earnings, again, expected to go up a very decent amount from 4.57 to 6.54. That's like a 45% increase. That's very nice. Dividend, very low, less than 1% at 0.72. So again, nothing to write home about at all. We're looking for potential for growth. But it seems a little bit overpriced at 30x for this type of a company. And also, yes, the earnings going up a lot, but again, is this the particular company I would like to go in and invest in? Do I see this taking off all that much? Not really. Maybe if they were infusing a lot more AI into their new products, their new product lines, and there was a lot of excitement with new potential groundbreaking things they could come up with. But again, nothing that I've seen so far. Again, if there's anything you guys know, by the way, that I've missed, that I don't know, like any news about any of these companies that I'm not aware of, let us know in the comments down below. We're definitely glad to discuss and take maybe another look at some of these companies. But from what I understand, I don't really see a lot of excitement around new products or new potential things they could do. So overall, not particularly interested. Again, numbers are not that bad. Seems a little overpriced, but earnings are going up a lot at around like 45% or so. So overall, I don't think it's the worst. I don't think it's the best. Probably middle of the road, somewhere in B. I'll put it somewhere in the middle, maybe a little bit lower than the middle B. But again, nothing too high or too low by any means. Next up, we have Public Service Enterprise Group, also known as PSEG or PEG, which is another energy company. P ratios are looking decent, 19.32 over the past 12 months, 18.06 over the next 12 months. Earnings expected to go up, not super high, but about like 6 to 7%, not bad. Dividends are very good at 3.13%. So overall, I like this stock. There were some other energy companies that were slightly better than this. Slightly lower P ratio, slightly better potential for earnings growth, slightly even higher dividends. So for that reason, I'm not going to quite push it to low A, but I think it's a decent company and I'm going to put it in high B. I don't think it deserves to be all that far down. But again, just other similar companies in the same sector seem to be slightly better. So for that reason, I'm not going to quite push it up to A. I'll probably put it right here next to Duke Energy. Next up, we have Keurig Dr. Pepper. A lot of you might know the Keurig brand from coffee makers and such. And of course, a lot of you know the Dr. Pepper brand from the drink. So that's the type of company we're dealing with here. With those sorts of products, PE ratio quite high for the past 12 months at 24.21. Well, not super high, but a little bit higher than I want it to be. I would have liked this to be below 20. It is looking to be a lot better over the next 12 months, 12.97. But again, that's a big gap. Earnings expected to double. And for this particular company, really, like, is expected to double earnings? Why? Like, they're selling more Dr. Pepper? It seems a bit of a big jump. It seems odd, a little odd to me. Dividend is very good, 3.27. But again, this is one of those particular cases where just the numbers just don't look right to me. There's something looks missing here. Either I'm missing a key information, maybe they're acquiring something, or maybe they're looking to come up with a brand new coffee maker that implements AI or something. I don't know how they would do that, but you know what I mean, right? Like, unless they're coming out with something revolutionary, or they're trying to absolutely change the way they do a lot of things, or break into new markets they've never been before, they're expected to do very well. If there's something like that, then okay, maybe this could make sense. But just taking a first glance at this company, I don't particularly find this convincing. It looks a little sus, to be honest, these particular numbers. So numbers don't definitely justify this being super down on the list, but I'm just a little cautious because I don't necessarily see if I believe these projections. So for that reason, again, just a completely personal call. I'm going to put it at a low B. This stock, something about it just turns me off. I try not to do this often, but sometimes I just take a look at the numbers. I'm like, I don't understand this. Now, I would have to do more research into this. Maybe there is something that I'm just not aware of. Maybe they are coming up with revolutionary products or breaking into new markets, something like that. So I will do more research on this one, particularly going forward. But for the sake of this video, I'm just going to rank it right off the bat, just looking at these numbers. I'm going to put it at a low B. And of course, I can't like sit there and do way too much looking into every single one of these numbers, because otherwise we're going to be here for like 20 hours, right? So I'm just going to rank this one, looking at the numbers first glance, go somewhere here. But I will say this one in particular, numbers definitely don't look that bad. Maybe there is something that I'm not aware of. In that case, we could potentially rank it higher. So again, let me know in the comments down below if there is a particular news or a particular information that I've missed about this company. But as is right now, I'm going to put it at a low B. Next up, we have Prudential, a financial services company. The PE ratio of the past 12 months was 15.62, very good. Looking to be even better for the next 12 months, 7.63. And potentially when it's looking to be projected so low, that means that if the earnings keep up, there is a very good chance of a lot of investors being interested in coming in to invest to bring that P ratio up, which means that the price of the stock goes up. And if the price of the stock goes up, that means that if you've already invested, then you're looking very good. You're going to be very happy with that, right? Earnings expected to double, more than double, from 7.3 over the past 12 months to 14.95 over the next 12 months. That's amazing numbers. And on top of that, look at this, 4.74% dividend yield. This company looks amazing. 15.62 over the past 12 months, very good P ratio already, looking to be even better. Earnings looking to more than double. And on top of that, you get 4.74% dividend yield, at least at the current price right now. But again, if the price goes up, you're going to be happy either way. because you've already invested into the stock at that price. So sure, if the dividend yield is relatively smaller to the price, then that's fine too. And of course, there's always a good chance of them increasing the dividend when the earnings are doubling or more than doubling, right? So that's very, very possible that they bring up the dividend amount as well to keep up with the dividend yield percentage as the price of the stock goes up. So overall, I love the stock. I think it's great. There's, of course, some risk with financial companies as well. These projections don't always hit their marks with financial companies, particularly because it's a little bit more nuanced. It's a little bit more volatile than some other companies. But I just think there's so much potential here that I just have to put it in S. Doesn't mean it's a guarantee or anything like that it's going to be a good investment, but I do think there's a lot of potential for this to be a great investment. So for that reason, at this point in time, with the current price of the stock and the current projections, I just think this has to go into S. So I'll put it slightly above AMEX. I'll put it right there. I just think it's a very good-looking company with a lot of potential that could do very well. Next up, we have Cognizant, which is an IT consulting company. Now, what they do is they help businesses modernize, infuse new technology into their processes, etc. Their P ratio was pretty good over the past 12 months, 19.84. Expected to be even better at 15.25 over the next 12 months. Earnings expected to go up from 4.3 to 5.6. That's a very good jump. That's about like a 25-30% jump. Very good. Dividend yield 1.45%. Nothing to write home about, but it's a decent cherry on top when the numbers are so good. Numbers just look very good all over the place. And I like consulting companies, particularly if they're helping modernize new businesses. That's something that's, I think, always valuable. But yeah, I particularly like that it's not overpriced. It doesn't seem that way, at least anyways. I particularly like that the earnings are going up and all of that. So overall, I think it's a very good company. I'm going to put it in A. And the only question is, how far up do we go in A? Let me take a look at A. What other companies do we have over there? Maybe I'll put it slightly ahead of these ones over here, but maybe not too far up either. Maybe I'll put it somewhere around here. Maybe even higher than that. Maybe right there. Yeah, that looks about right. And then, yeah, good company, good investment opportunity. I like it very much. Next up, we have Crown Castle, which is a real estate investment trust. Their earnings were negative over the past 12 months. Already a red flag, a huge red flag. Expected to be at least positive for the next 12 months, and that would give them a P ratio of 30.2 over the next 12 months. But again, these are projections. Are they going to stick with that? And of course, they have to offer a lot of dividends because a lot of investors are going to be turned off by these numbers. So overall, I just like to stay away from these types of companies. Way too risky, way too all over the place. We'll take another look at this company, a year or two from now. If they actually do hit these projections, then okay, maybe we can take a look at that. And if the dividends stay at a high amount. But right now, again, it just seems too risky. I'm not particularly interested in a company that was losing money for the better part of last year. So for now, I'm just going to stay away. I'm going to put it in C. Doesn't mean the company can't have merit going forward, but right now, it just seems like the wrong time to look at it. So I'll just put it maybe at a lower C, somewhere around here. Next up, we have Garmin, which is another tech company particularly focused on producing GPS-related products. The P ratio over the past 12 months, perhaps not that high, but a little bit higher than we would like to see over here at 25.33. Earnings or P ratio going forward, I should say, 23.37 for the next 12 months projected. Earnings expect to go up a little bit, not too much, from 8.11 to 8.79. That's about like an 8-9% increase. Not bad, but not super high either. Dividend yield 1.68%, nothing to write home about. So overall, it seems like kind of the middle of the road type of stock. Not the worst, not the best. P ratio not terrible, but not amazing either. Earnings going up a little bit, so not bad, but not particularly exciting either. Not a lot of dividends. So overall, and I'm not particularly interested. GPS seems like a technology that has matured. How much more can you get excited by a company that does that, and how much more potential for growth is there? So again, seems like a middle of the road type of stock. Not that bad, not the worst, but I'm not particularly interested either. I'll probably put it like somewhere like mid to low B. Next up, we have Vulcan, which is a company that produces construction material. The P ratio over the past 12 months, quite high at 35. Expected to be better over the next 12 months at 29.9, but again, still higher than we'd like to see. Earnings expected to go up from 8.4 to 9.8. about a 17-18% increase. Not bad, but again, not anything that crazy either. Dividend yield very low. So overall, seems like a low B to me. I'm not that interested. Not going to quite put it in C, but not even going to be that high in B, to be honest with you. So I'll put it somewhere around there. Next up, we have GE Healthcare, another healthcare company. P ratio very good, 17.3 over the past 12 months. Projected to be 16.9 over the next 12 months. Earnings, again, projected to go up a little bit, but not too high, from 4.84 to 4.95. That is about like a 2-3% increase. Nothing to write home about. Dividend yield almost non-existent at 0.17%. So really the only thing I really like about this stock is the low P ratio. Earnings are not exciting me that much. Not much dividends, not much potential for growth. Again, healthcare company, how much room for growth do they have and all those sorts of things. So overall, nothing particularly excites me about this one. Because the P ratio is so good, I'm not going to be too mean on it. I'll probably put it somewhere, again, down the road, middle of the road, B, smack down middle would be. But yeah, nothing that excites me particularly about this stock. Next up, we have eBay. I think everyone knows the platform, the online platform, the buying and selling platform. With the auction, really fun website. The P ratio for the past 12 months has been 18.54, expected to be 4.58 over the next 12 months. These are very good P ratios. Earnings expected to go up from 4.6 to 5.85. That's not bad either. That's about like a 20-some-odd% increase. Dividend yield, 1.36, nothing to write home about, but it's a nice cherry on top when you have so many other good numbers. So overall, I like eBay. Is it quite enough to put into A? I don't think so. And also eBay, again, it's not the type of company that I would look at and say, oh, it has a lot of potential for growth. These types of companies, you know, if they offer a decent amount of dividends, then I can be like, okay, now that's a little better. But if we're just looking at growth, and again, this dividend is not high enough to convince anyone of anything. If we're just looking at growth, how much room does it have for growth? Probably not a lot, but it is good that it's not super overpriced. I like that. And I do like that the earnings are going up like a 20-somewhat% as well. So overall, I'll put it a high B. But I just don't think it's quite enough for it to go into even a low A. At least not right now. But to be fair, B is looking very chunky. It looks like there's a lot of companies in B. So I might end up having to put some of these higher B companies maybe into a lower A, and then some of the lower Bs maybe into a higher C, just to make the whole situation, this whole tier list, look a little bit more digestible. But as is right now, for now, I'll just put it at a high B, and then we can reassess later. Next up, we have Ventas, another real estate investment trust, and just look at these PE ratios. 150 over the past 12 months, 125 over the next 12 months. I mean, and it's not even like they offer a ton of dividends to make up for that. It's only 2.37. It's not like they're offering 5-6% to like try to help entice you. It's just, take one look at this company and I'm like, D. And I think that's understandable, and I don't think anyone's going to be super upset about that. I'm sorry, just the numbers are not there. So I'll just put it in D, and we move on to the next one. Next up, we have Block Inc., which is Jack Dorsey's company. They're basically a cash app, financial services type of a company. Earnings expected to go down. That's not a good sign. Earnings going down from 4.97 over the past 12 months to 3.22 over the next 12 months. It's not good at all. PE ratio, again, falling. It was good for the past 12 months, 13.33, but we don't like to see it go in that direction. Expected to be over 20, slightly over 20 over the next 12 months. So projections are not looking great. No dividends or anything like that either. So overall, because of the earnings going down so much, unfortunately, I just have to put it in D. It's just an avoid at this point. Very sorry to put it there. Again, I respect the Jack Dorsey and what he's trying to do, and cash apps. Sure, there could be some potential, but right now, it's just not the time to look at the stock. Maybe if the numbers improve, we can take another look at it, but right now, it's just an avoid. Next up, we have Estee Lauder, which is a makeup, skincare, those types of things company. Earnings were negative over the past 12 months. Already a really bad sign, huge red flag. Expected to be 2.92 over the next 12 months, which would give it a P ratio of 36.91. Even if they hit those projections, that's still a very high P ratio. It would indicate that the price of the stock is probably a little bit overpriced. Even with these numbers, it seems like it's overpriced. Not even a lot of dividends, 1.3%. Again, just looks like a D. Unfortunately, it's just an avoid right now. Maybe it'll improve later, but right now, not interested. Next up, we have Copart, an online auction company. P ratio, not bad, but perhaps a little bit, just a tiny bit higher than we want it to be. 24.1 over the past 12 months, 22.2 projected over the next 12 months. Earnings expected to go up a little bit, about 10% or so, from 1.63 to 1.77, just under 10% expected to go up. No dividends though. So P ratio, not bad, but not amazing either. Earnings going up just under 10%, not bad, but again, not amazing either. And no dividends. We're just looking for potential for growth. Is there a lot? Probably not. So again, not bad. It's not a bad stock. I don't mind it, but it's probably just down the road, middle of the road, smack down in the middle of B. We're gonna take it and dump it somewhere in the middle right there. Next up, we have IQVIA, which is a company that is involved with data analytics when it comes particularly to life sciences or healthcare. Earnings, or I should say P ratio for the past 12 months was about 31.15, which is perhaps a little bit higher than we like it to be. Expect to be a lot better over the next 12 months at 17.55. Earnings expected to go up a very decent amount from 7.28 to 12.93. That's about like a 60-70% increase. Very nice. No dividends, but again, a lot of potential for growth. Only thing I don't like is that it seems like it's a little overpriced right now at 31.15. So is there going to be a lot of growth even if we hit these projections? Maybe, maybe not. So overall, numbers look decent. I'm just a little bit cautious with that. So I won't quite go into A, but I think it's a decent B. I think it will be slightly higher than a middle B, but perhaps not even like the highest, the high B, like slightly from middle to high B, somewhere around there. We'll go take a look. We'll see what other companies are there, and we'll just put it somewhere there. Maybe a little bit higher than Boston Scientific. Do I put it higher than Sands? Perhaps. I don't think I'd go above Seagate, so I'll probably put it somewhere around here. And yeah, we'll move on to the next one. Next up, we have Martin Marietta, which is a company that is a supplier for construction and heavy construction materials for those specific things. PE ratio, again, slightly higher than we want it to be at 34. We want it to be ideally below 25. Even better, below 20 would be very nice. P ratio for the next 12 months expected to be lower, but still maybe a little bit higher than we want it to be at 29.65. Earnings expected to go up from 18.98 to 21.75, which is not bad. That's about like a 13-14% increase. The dividend yield is pretty much non-existent at 0.5%. So we're just looking for potential for growth. And again, I just don't particularly like that it might be a little overpriced. Earnings are going up, but again, it's not like a huge exciting thing. So overall, I think it's okay. Again, we have had so many of these companies where I think it's okay. Probably middle of the road, probably in the middle of B. And this is just another one. Not particularly great, not particularly bad. It's just okay. So it goes somewhere in the middle of B. And we move on to the next company. Next up, we have EQT, another energy company. P ratio pretty decent, 18.4 over the past 12 months. Expected to be a lot better at almost 12 over the next 12 months. Earnings expected to go up from 2.93 to 4.51. That's a very good increase. That's about like a 35 or so % increase, which is pretty decent. Dividend yield, not that high, 1.18. Nothing to write home about. We're looking for potential for growth, but I like that the stock doesn't look super overpriced. Looks to have a lot more earnings and could potentially be even better price going forward, or the P ratio could rise up to be a little bit closer to what it is right now, which would mean that more people are investing and the price is going up, which is good for you as an investor. So I don't mind this one, but again, is there enough to push into A? Probably not. Again, there are some other energy companies that I just preferred a little bit more. So for that reason, I'll put it at a high B next to some of the other energy companies we had there. I think we had Duke Energy and stuff like that in high B. Let me take a look over here. Yeah, we had PSEG, we had Duke Energy. I'll probably put it right next to those, and we'll move on to the next one. Next up, we have Nucor, which is a steel production company. The PE trailing is 23.38. Not too bad. Could have been a little bit better at just under 20. PE forward for the next 12 months expected to be 14.5, much better. Earnings expected to go up a very decent amount from 7.12 to 11.47. That's about a 50% increase. Very nice. Not a lot of dividends, 1.3, but could be a nice cherry on top if everything else is looking good. Everything else is not looking that bad, but it's not, I don't think it's quite enough to be A. If the P ratio for the past 12 months was under 20, then I think that 50% going up in earnings would definitely be conducive to a stock that could have a lot of potential for growth. But as is right now, I'll be a little bit more cautious. I'll probably put it like at a high B, but it could have gotten to a low A as well if the numbers were a little better, because the earnings going up on its own is just so massive. And also steel, there's a lot of things going on with onshoring steel production, particularly with the tariffs and all of that. The new American government has done a lot to make sure there's a lot more steel produced within the American borders, and that could help a lot of American companies that are dealing with steel. So that there is a lot of potential, but a lot of that growth probably has already happened. That's the real issue, is that those tariffs came into place many months ago. So a lot of that growth probably has already materialized, at least in the expectations with the stock price and all of that. How much more room does it have to grow? Probably a little bit more, but is it enough for me to put it in A? Probably not quite, but it's a very high B. It's definitely not a stock to scoff at by any means. I don't mind it. I don't mind it as an investment. I just think there might be a little bit of a better couple of stocks out there that just barely edge it into the A category, but I don't mind this stock at all. I'll probably put it somewhere around here at a high A. Maybe I'll just put it slightly ahead of the energy companies and somewhere around there. Next up, we have Hershey, which is the chocolate production company. Hershey, a lot of you probably know the chocolate bars. PE ratio 27.55, probably slightly higher than we want it to be. Even for the next 12 months, expected to be 26.72. Again, would have been nice if it was at least below 25, ideally even below 20. Earnings expect to go up very small margin from 6.68 to 6.89. That is about like a 3% increase. Not a lot to excite us. There's a decent amount of dividends, almost 3%, but again, there isn't enough for me to be all over the stock. But again, not bad. The dividends are very good, so I'll put it like somewhere like in the middle of B. But again, if it was showing a much better P ratio or the earnings were going up massively, then we could have talked about higher B, maybe even low A, something like that. But as is right now, I think middle B sounds a little bit better until we can see more potential for earnings growth, or maybe the stock comes down a little bit in price so that the P ratio is looking a little bit healthier. But as is right now, I'll probably just put it somewhere around here. Next up, we have ResMed, which is a medical equipment company. PE ratio for the past 12 months, 25, just over that marker that I've indicated. 25, wanted to be below 25, but it's looking to be a lot better for the next 12 months at 20.23. Again, it would have been nicer if this was below 25. Even nicer if this was below 20, but as is actually not that bad. It's still better than a lot of companies out there. Earnings expected to go up about 30%, just under 30%, from 9.77 to 12.10. That's probably like 26, 27%, something like that. Decent amount of growth in the earnings expected. And the dividend is pretty much non-existent. It's 0.92, so it's nothing to write home about, nothing to convince us any which way. As is right now, again, with medical equipment, there's a lot of risk involved, as well as that the P ratio, not bad, but it's not great either. Earnings are going up a decent amount. So again, I'll probably go like middle of the road B. I'll probably put it a little bit above Hershey, but besides that, I don't see a lot of difference. So just slightly above where we put Hershey, in B, in the middle of B, but not too dissimilar, probably somewhere around here. Next up, we have Microchip Technology, which is a company that you would never guess, but they produce stuff related to microchips. So this is microcontrollers, storage, etc., stuff like that. Their earnings for the past 12 months was actually negative. This is an issue. They lost money over the past 12 months. And again, with these types of companies, again, there's just too much risk. I'm not saying you can't find a great investment out of these companies that lost money over the past year somehow, somewhere, but I just look at these and I say, you know what, there's so many better options out there. I'm just not interested in the risk. I'll put it aside. Even for the next 12 months, it's not like the P ratio is looking amazing or the earnings looking amazing or there's a lot of dividends being paid to entice investors. So overall, like here, the dividend is like 2.8%, which is like not that much. That's not that crazy. So overall, I just think this is a D, simple D. And I'm just going to take it and drop it somewhere around here. Next up, we have Wabtec, which is a company that produces transit vehicles. Their earnings for the past 12 months expected to go up from 6.88 to, for the next 12 months, 10.18. That's a massive increase, about 35 or so percent. Pretty nice. PE ratio a little bit higher than we want it to be, though. 31.87 over the past 12 months. That's quite high. You want to be below 25, ideally below 20. P ratio for the next 12 months projected with the massive earnings increase to be at 21.5. Still not amazing, but of course much better. There's almost no dividends. They're pretty negligible, 0.46%. Nothing to write home about. So overall, again, it just seems like middle of the road B type of company. P ratio indicates it might be just a little overpriced, or at least the earnings have not been there yet. It looks like it's going to be a lot better going forward, but we'll see how that goes. And also, over the long term, I'm a little bit more skeptical with these types of companies because with the automation of self-driving cars and all of that, and potentially self-driving transit coming into play at some point as well, how is a company like this going to look 4, 5, 6, 7 years down the road, right? So there's a lot to not be sure about here. So maybe I'll even put it a little bit lower than just straight middle B. I'm not going to put it like super low B, but maybe just a little bit lower than right down the middle. So we'll go perhaps somewhere around here, maybe right after these. Next up, we have Keysight Technologies, which is a company that produces electronic testing and measurement equipment. Their P ratio was quite high over the past 12 months at 42.18. Seems to indicate maybe it was a little overpriced, or at least the earnings were not there to justify the price quite yet. P ratio looking to be a lot better over the next 12 months, projected at 22.33. Still would have been nicer if it was a little bit lower, but it's obviously a lot better than 42. Earnings expected to go from 4.88 over the past 12 months to projected 9.23 over the next 12 months, about doubling, which is fantastic. But no dividends and all of that. Overall, there could be a little bit of potential with this one. The earnings doubling is always a good sign, but the P ratio for the past 12 months is way too high. If the P ratio was low, if it was like even close to 20 over the past 12 months, and it was looking to double their earnings, then we're probably talking like A territory even, right? But as is at 42, I'm just a little bit more cautious. So I'm going to go at around B, maybe slightly higher than middle of the road B, because the earnings are going up so much, at least expected to. And I do like what the company is doing. It's a little bit unique. It's a little bit out there, but is it enough for me to justify even a high B? I don't think so. So I'll just go a little bit higher than the middle of the road B, but not much higher than that. So we're just going to take it and see where we can fit it over here. Perhaps like just above Palantir or something like that. And Exxon Mobil, maybe even a little bit higher. What else do we got here? I'll probably put it just below Goldman Sachs. That looks a little bit better. Next up, we have Finzerv, another financial tech company, another payment company. The P ratio is looking amazing. Look at this, 10.44 over the past 12 months, projected to be 8.13 over the next 12 months. This is looking really good. It seems to indicate it might be slightly underpriced, which would indicate it's a very good time to get in on this type of a stock. The earnings expected to go from 6.47 over the past 12 months to 8.3. That is about close to a 30% increase in earnings. Very nice, very good to see. So overall, it's looking very good for the stock. Seems to the numbers are very good. P ratio very low. Particularly for a type of a tech company. I know it's a financial tech company, but still, these numbers are fantastic, right? So when the P ratio is expected to be that low for the next 12 months, that seems to indicate there's a very good chance that it might get balanced up and come back up by a lot more people investing into the company and bringing up the price of each share, which means that if you've already invested, then your stock is going up in price, which is fantastic news to anyone. So I do like this one. I think I'll put it perhaps middle A. I don't think it's quite enough to be super high A, but and there's no dividends, by the way, for this stock, but I think middle of the road A sounds about right. Let me just take a look at what we got in A. There's so many companies. It's hard to keep up. But yeah, it's definitely, I would say, above these ones. I'll probably put it right next to NVIDIA, which is high praise, obviously. But yeah, that looks about right. Very good investment opportunity. Next up, we have State Street, another banking company. Their P ratio is very good at 14, projected to be 11.64 over the next 12 months. Earnings expected to go up about 20% or so, from 9.45 over the past 12 months to 11.37 over the next 12 months. There's even a little bit of dividends to 2.36%, not bad. A little bit of a cherry on top as well, pretty good. And I like the stock quite a bit. Again, the P ratio is very healthy. Earnings expected to go up a decent amount, perhaps not as much as the last company we took a look at, but it's still pretty good. And also you're getting dividend yield as well. It's a decent amount. It's above 2%. So you're getting a little bit of a regular payment as well, alongside the potential for growth with the stock. So I'm not going to go too high with this stock because this is a little bit more of a dividend stock. Perhaps you want to see a little bit more of a combo effect going on here. And the earnings going up 20%, that's not gangbusters or anything like that, like the last stock was with 30% or something like that. And of course, we have seen some other stocks that have even more potential for growth with their earnings and also with their innovation and all those sorts of things. Whereas this banking, it's a little bit more of a limited in terms of how much it can explode as an investment, right? So I'll still go in A, but perhaps a little bit leaning towards the lower side of A. But we'll go up there and take a look at where we can fit it in. I'll probably put it above PayPal. Over here, I'll probably put it right next to Marathon and Southern Company. Somewhere around there looks about right. Next up, we have Cisco, which is a food service distribution company. Their PE ratio is not bad, 19.89, just below that 20% marker that we've set, and expected to be even better over the next 12 months, projected at 14.72. Earnings per share for the past 12 months, 3.73, expected to be 5.04 for the next 12 months. That's very good. That's about a 30% increase. Very nice to see. And there's a decent amount of dividends as well, 2.83%. Now, overall, I do like that the P ratio is healthy. I do like that the earnings are going up about 30%. That's very good. Dividend yield is also very good, slightly better than the last company that we took a look at. So I'm probably going to put it just ahead of that one. Also an A. Very good opportunity with this one as well. And we're just going to drag it up over here. Find State Street. Where do we put that one? Over there. And I'm just going to put it right one ahead of it. That looks about right. Next up, we have Consolidated Edison, which is an energy company. Their PE ratio for the past 12 months, very good at 17.35, projected to be slightly better at 16.48 over the next 12 months. Earnings expected to go up a little bit, not too much, from 5.72 to 6.03. That is, what is that, about like a 5% increase or something like that? Yeah, that's probably what it is. 0.3, yeah, so about 5% increase. Dividend yield of 3.42, very good dividend yield, but the earnings are not going up all that much for me to be too excited about the stock. The PE ratio is healthy though, so I'm not going to be too mean on it, and dividends are very nice. So probably like a high B, but again, I would have liked to see a little bit more of an earnings increment expected from the company to be able to be a little bit more excited about it and also maybe push it into a low A type of a thing. But as is right now, it's going to go in the higher bounds of B. So let's take it up there and see where we can fit it in. B is so chunky and so full of companies that it's looking to be a little tough. But yeah, I'll probably put it ahead of FedEx. Would I put it ahead of the energy companies? Probably not. So I'll probably just put it just below the energy companies over here. But yeah, that looks pretty good. Next up, we have United Airlines, a very reputable airline. You know that I'm not particularly interested in airline companies, but look at this one in particular. P ratio of 11.42 over the past 12 months, 8.77 over the next 12 months. Those are very good. Even I, as someone who's not particularly interested in airline companies and all those sorts of things, even I have to look at this and be like, it's looking pretty good, And of course, United has been on the forefront of being innovative with their passenger planes. In particular, they were, I believe, the first company to sign a contract with Starlink, allowing users to have free access to Wi-Fi on their planes using the Starlink satellites and stuff like that. So seeing initiatives like that from the company does give me a lot of confidence that, okay, they are serious about competing. They are serious about always being on the front edge, pushing the boundaries, trying to provide more and more new and efficient, beneficial services to their customers. And I like signs like that. And of course, when you see numbers like this, that just makes you even more happy with the company. So 11.42 over the past 12 months, 8.77 over the next 12 months. Earnings expected to go from 9.98 over the past 12 months to 13 over the next 12 months. The 30% increase, very nice. There's no dividends with this stock, but this is a growth stock, right? And the numbers suggest that it might even be slightly underpriced. And again, below 10 projected for the next 12 months. That could suggest that it could actually end up being higher because the price of the share goes up. And again, if you're investing right now, that's very good news for you, right? If the price of the share goes up, that means that you're making money on your investment. So I think it's a very good time to get into United specifically. So even though I'm not a big fan of airline companies, United in particular, I just have to put it in A. The numbers are way too good, and I'm liking what the company is doing in recent times as well, trying to compete with others and also retain and gain new customers as well. So I'll put it somewhere around here. I'm not going to go too high in A, but I think I'll probably put it ahead of some of these companies over, maybe right over there somewhere. Looks about right. Next up, we have Kimberly-Clark, which is a company that produces hygiene products. Their P ratio was very good for the past 12 months, 17.11. Expected to be even better for the next 12 months at 13.18. Earnings per share expected to go up from 5.9 over the past 12 months to 7.67 over the next 12 months. That's pretty good. That is about a 25 or so percent increase. Not bad at all. But look at this, dividend yield 5%. That is very good. 5% dividend, and for a company that is looking so good with their numbers, right? Usually when you have above 4%, it's companies that are maybe struggling in some areas or not looking particularly great. Maybe they're a little overpriced. Maybe their earnings are expected to go up. Maybe their earnings are even expected to go down in some instances. But that's not the case here. It's looking very good, and it looks like it's a good time to get in. Even if the price goes up and the dividend yield percentage-wise seems to be smaller than what it is right now, that would still mean that if you invested right now, the price went up, so you're still making money on your investment. So I really like the company. I really like these numbers. I think we have to put this one in A as well. So we're going to go and see where we can fit it in. This one's a little bit different than the other ones. This is a dividend stock, so we're not particularly looking for growth in terms of the value of the stock itself all that much. As long as we can sustain that dividend payment without losing too much value in the stock itself, or perhaps even retaining, even slightly going up in value, that would be amazing, right? So I'm going to put it somewhere around here, maybe just below State Street, but it's definitely a very good option, particularly if you're looking for a dividend type of a stock to get those regular payments coming through. Next up, we have WEC Energy. As the name suggests, another energy company. The P ratio is good for the past 12 months, just below 20, so 19.94. Expected to be slightly better over the next 12 months, but not that much of a difference, 18.85. Earnings per share expect to go up a little bit from 5.29 to 5.6. Again, maybe like a 4 or 5% increase. Not a lot to be super excited about. There's a decent amount of dividends, 3.38%. That's very good. But again, I just don't see a lot of earnings growth here. And that does make me wonder if these dividends are going to persist at these levels, or if the stock price is going to persist at those levels. If there's not a lot of growth, the P ratio is not bad, so it's probably not super overpriced. But again, I'm just not particularly interested. Again, I think there's a lot of better companies in this sector, a lot of better energy companies that we've looked at so far. I've put a lot of energy companies in like a high B territory. There's like one or two that we made even higher as well. So I just think if you're looking for an energy company to round out your portfolio, you want to cover that sector, I think there are just better options out there. So even though I don't mind this one particularly much, and I'm still not going to go too far low, I still think it's a decent option as well, a decent amount of dividends. So I'll still go like a little bit higher than a middle B, but not quite high enough to get to those other energy companies at a high B. So I'll probably put it, let's see where we can fit it in. Maybe actually I'll put it next to Next Era Energy. I think that's probably apt. Just a little bit lower down than these other energy companies over here. I just think that's probably the right placement for it. Next up, we have Otis Worldwide, which is a company that produces elevators, escalators, moving walkways, all those sorts of things. P ratio over the past 12 months was 25.82, slightly higher than the 25 that we want to be ideally below of. Ideally, even below 20 would be nice. It's looking to be a lot better over the next 12 months, 19.53 projected. Earnings per share expected to go up from 3.39 over the past 12 months to 4.49 over the next 12 months. That's a decent amount of growth, about 30 to 33% growth, not bad at all. Dividend yield, not quite enough to be justifying anything, but not the worst either, 1.88%, almost at 2%. So not bad. Overall, I don't mind this one. Again, I do think it's a little bit better than like a middle of the road B. Actually, I'll go to a high B because it's a little bit of a different company. It's a company that produces things that are just required all over the place. We all need elevators. We all need escalators, moving walkways, all those sorts of things. And there's not a lot of different companies that provide those. And also on top of that, numbers are not that bad, right? The numbers aren't that bad. The earnings are expected to go up in massive amounts. You get a little bit of dividends to be a little bit of cherry on top of the potential growth. The PE ratio, again, it does seem like it's not like super underpriced for sure, right? We'll see how the price does. I'm not super excited about this one, but I'll go in between high and middle B. So we'll see where we can fit it in. Perhaps somewhere around here, right after Seagate or something like that. That could work. Next up, we have Fidelity, which is a company that offers financial products and services. A very famous company. You've probably heard of Fidelity, ETFs, and such things. PE ratio is insane, though, because the earnings were really low for the past 12 months. That's not a good sign. And I'm already at a stage where I'm like, do I even want to look at anything else? Yes, the expected earnings for the next 12 months are really high. And the expected PE ratio for the next 12 months, a very decent amount, but I mean, I just cannot ignore the 211x PE ratio over the past 12 months. That's not a good sign at all. So right now, I'm just going to stay away from this one. It's a D for now. That doesn't mean it's not a good company. It doesn't mean it can't do well. And again, if the numbers look a lot better in a couple months from now, then we can definitely reassess, put this a lot higher. But right now, I just see that number and I just say, you know what? I don't even need to look at this. There's so many other better options, so many better options in finance and tech and all these other sectors that I don't even need to bother with this one when I see such a high multiplier. So I'm just going to dump it in B and move on to the next one. Next up, we have Carnival, which is a cruise line operating company. The PE ratio is very good, 15.35 over the past 12 months, projected to be even better at 10.78 over the next 12 months. Earnings expected to go up from 2 to 2.85. That's about a 43% increase. Very nice. No dividends, but there's a lot of potential for growth. The PE ratio indicates that it's likely not overpriced at all, maybe even slightly underpriced, and P ratio going forward is very healthy as well. I really like this stock, really like it as far as a potential growth stock that is also a little bit different than, your AI and tech industries, and, it's a very good hedge against those, and it can very well grow even if there is a tech burst or a tech bubble and all of those. This is just so different, so out there, so isolated from those things that it could still end up doing very well. Earnings are looking to do a lot better going forward as well. So I think it's a very good time to get in on this one. It has to be an A just based on those numbers alone. So we're just going to take it and move it up the chain. And let's see where we can put it. I'll probably put it somewhere around here, maybe right after BlackRock. Very good option. I believe in it, and I think it could do very well. Next up is Xylem, which is a company that produces new technologies, particularly for transportation of water and stuff like that. The P ratio is a little bit higher than we want it to be at 35.7 over the past 12 months, looking to be better for the next 12 months at 24.9, but still not super low either. Earnings expected to go up from 3.89 to 5.57. That's a decent increase. That's about a 40 or so % increase. There's not a lot of dividend yield to this one, 1.15, pretty negligible. Overall, again, P ratio is a little bit higher than we want it to be. It might be slightly overpriced. Earnings are going up a decent amount, but again, I'm just cautious over here. There's not a lot of dividends to, justify me one way or another either. So for that reason, I'm just gonna be a little bit more cautious with this one. I'm gonna put it in B, probably in the middle B. And it's not that I don't like the company or I don't like their mission or I don't think they can do well. It's just that there seems to be a little bit more risk than I like there to be with this one. So I'm not gonna go too far up. I don't think it's a bad investment opportunity or anything like that, but I'm not particularly too excited about it either or too interested in it. Next up, we have Arch, which is a Canadian real estate investment management company. Their P ratio was very good over the past 12 months, 8.97. It looked really good, but it is going up over the next 12 months at 10.29. And the reason for that is because the earnings are expected to drop, unfortunately. Again, the P ratio is very good with this stock. No dividends, so we're just looking at potential for growth. But with the earnings coming down, it seems like there's not a lot of opportunity for growth, at least for the foreseeable future. They could definitely turn it around. They have done well in the past, but it just seems like the wrong time to get in. I'm not going to be going too harsh on them. I'm not going to quite go on D because at least the P ratios are very healthy. So I don't think it's like too overpriced or anything like that, but it does have to at the highest go into C, unfortunately, because we never want to see earnings going down, at least not with this type of a company where it's not like on the verge of breaking through with new technology or something like that, or coming out with a brand new product that changes everything. No, it's just an asset management company, right? So we want to see those earnings going up. We definitely don't want to see them go down. So I'm just gonna go ahead and take this one and put it somewhere in the middle C and move on to the next one. Next up, we have PG&E, which stands for Pacific Gas and Electric Company, another energy company over here. And the PE ratio is very good, 13.44 over the past 12 months, projected to be 9.68 over the next 12 months, very good. Earnings expected to go up from 1.17 to 1.63. It's about like a 45% or so increase, very nice. Dividend yield is pretty negligible, 0.63%, nothing to write home about. But I really like that the stock doesn't seem overpriced. It seems like it might even slightly be underpriced, or at least might be going forward. There might be a little bit of the price coming up because of this P ratio falling down so much. And of course, that's really good. That means it could be a good entry point right now. Earnings are going up a very nice amount, 45%. So I really like this one. I think this is one of the better energy companies that we've taken a look at. So I am going to push it up. Do I go to a low A? Maybe if there was a little bit of dividends, I could have. But then again, the earnings are going up 45%. That's nothing to scoff at. You know what? I'll barely push it into a low A. We'll see. We'll see what we have there as well, actually. Let's bring it all the way up. And what do we have at a low A? Yeah, I think we can probably put it right after these medical companies over here. Yeah, I'll put it right after AIG. And we'll just leave it for there. Next up, we have Hewlett-Packard, better known as HP. You probably have some HP products, whether it's a printer or a computer or stuff like that. They're everywhere. They're almost ubiquitous. That said, though, their earnings for the past 12 months was negative. They lost money over that last 12 months. And you know me, once I see that, I'm already not interested, right? Again, there might be some companies that lost money this year that absolutely do amazing next year, but it's very difficult to find those. And for the purposes of this video, I'm just going to keep it simple. If I see you losing money, I'm already not interested. So even though it's looking a little bit better next year, and there could be a very good P ratio per the projections, again, I just think there's too much risk with that. We don't know if they're going to hit those projections or they're going to keep losing money, at least for the foreseeable future. So we're going to take Hewlett-Packard and we're going to put it right here in D. Next up, we have Live Nation. This is the parent company of Ticketmaster, and they own a bunch of other assets as well. P ratio already extremely high. I mean, look at that, 106.4 over the past 12 months. Even getting better over the next 12 months, still 69.85. So I'm already not interested. Sure, your earnings are going up and all that, but this is way too high for this type of a company. You're not like a bleeding edge tech company pushing the boundaries, coming up with brand new products, coming up with brand new solutions that are going to change humanity forever. You're a ticket company. You're a concert management company, whatever you call those things. So 100x is just ridiculous. It seems way overpriced. Not interested. Honestly, I'm going to put it in D. I'm not even going to be nice about it and sugarcoat. Try to somehow fit it into C or something like that. I'm just going to put it right in D. And we're going to move on to the next one. Next up, we have Kenvue, another healthcare company. This one, the PE ratio of the past 12 months, 23.1. At least it's below 25, but it would have been nice if it was below 20. PE ratio going forward for the next 12 months projected at 15.52, a lot better. Earnings expected to go up from 0.74 per share to 1.11. So that's a decent growth. That's about a 35% or so increase. Not bad at all, but look at this, a dividend yield 4.8%. That's very good. So overall, I don't mind this one. Probably goes up to a high B. But yeah, I'm just a little cautious of the P ratio. And also, the earnings per share, just forget about the growth. Like in itself, it's a little bit low of a multiplier. Like when it's below 1, that's when it's getting, okay, like why is it so low? Right? You know what I mean? So I know the P ratio is looking not too bad, but I still would have liked to see a little bit more earnings per share as well, just as the actual number. So overall, I don't mind this one. I'm just not going to put it too high, if that makes sense. So I'll just take this one and we'll see where we can fit it in. Probably not too high in B, but a little bit higher than most. Probably put it somewhere around here, maybe right after Boston Scientific. Next up, we have Raymond James Financial, an investment banking and financial company. The P ratio is very good, 16.07 for the past 12 months, 12.29 projected for the next 12 months. Earnings expected to go up about 25 to 30% from 10.29 to 13.45. Very nice. Dividend yield, not too high, but not the worst. It's a little cherry on top, 1.21%. Overall, I don't mind this one. It's looking good. The P ratios are very healthy. Earnings going up a decent amount. Can I quite push it into like a low A? Maybe barely. Maybe barely. It's going up about 30%. P ratio, pretty good. Yeah, I'll barely push it into low A, but not going to go too high. So we'll just take this one and we'll walk it all the way up. This is going to be a chore, I'm not going to lie. And maybe we'll put it like right at the bottom of A for now. Next up, we have SanDisk, which is a tech company. They produce stuff like storage. I myself have had their micro SDs before. Their earnings for the past 12 months were negative. That's an issue. They lost money over the last 12 months. And you know me, as soon as I see that, I'm already not interested. I'm already thinking, okay, this is just a little bit more risk that I wanted to see with this company. There's so many better options. There's so many better tech companies. There's so many better tech storage companies. I mean, there's Micron Tech and stuff like that are looking amazing. So I'm just not interested. I'm going to take SanDisk. And unfortunately, it has to be a D. I'm not going to go too far down, but has to be a D, unfortunately. Next up, we have NRG Energy, another energy company. Their PE ratio for the past 12 months was 23.51. Would have been nicer if it was a little bit lower, just below 20. But it's looking to be better for the next 12 months, projected at 17.37. Earnings expected to go up from 6.84 to 9.26. That's a decent amount. It's about a 40% growth. Not bad at all. Dividends, pretty negligible, 1.09. Not that much to write home about. Overall, not bad, but it would have been nice if this P ratio was below 20. Earnings are going up a decent amount, so I'm not going to be too harsh on it. Probably, again, above middle of the B, but not quite like the highest of the high Bs. So we'll fit it in. Let's see, somewhere around here. We'll go maybe like right after these ones over here. Next up, we have The Hartford, an insurance company. Their P ratio is very solid. 11.33 over the past 12 months, 10.43 expected for the next 12 months, going the right direction. Very small numbers, small multipliers. That's good to see. Earnings per share, 12.24 over the past 12 months, projected to be 13.3 over the next 12 months. Almost a 10% increase, not bad at all. Dividend yield, there's a little bit there, 1.56, not a lot. It's still not above 2%, but it's not that low either. So it's a little bit of a cherry on top, not bad. But really the best part of this stock is the low PE ratio. I would have liked to see the earnings be maybe a little bit higher, and we could have pushed it maybe to a low A, but as is right now, it has to be a high B. So we'll grab it and we'll see where we can fit it in. There's so many companies in B. This is going to be tough. How many more can we fit in here before this category completely just explodes? Let's see. I'll probably put it just above these energy companies over here. Maybe just right there. Next up, we have Expedia. I'm sure a lot of you have used Expedia for travel booking and all those sorts of things. One of the best out there. PE ratio, a little bit higher than we want it to be at 27.5. Would have been nice if it was below 25. Ideally, even below 20. PE ratio for the next 12 months, 15.72. Looking a lot better. Earnings are expected to go up a lot. This is the best part of this stock. 10.45 for the past 12 months, projected to be 18.3 over the next 12 months. That's almost like a 75, even close to 80% increase. That's fantastic. Not a lot of dividend yield, 0.56%, but we're looking at this stock for potential growth, and there seems to be a lot of potential growth in the earnings, particularly, but the P ratio being above 25. How much is that going to grow versus how much is overpriced already, maybe anticipating those growths. So I don't mind this one, but I don't think we can quite get it to A. I don't even know if we can quite put it at the highest of the high Bs, but I'm not going to go to middle B either. I'll go in between the super high B and middle B. So I'll just take this one over here and we'll see where we can fit it in. Maybe a little bit higher than these ones, maybe just above Seagate. Next up, we have Teradyne, which is an advanced robotics company. Their P ratio is very high, but to be fair, with this particular stock, it does maybe make a little bit more sense because it's more of a long play. You're investing for the long term of these products paying off, and then in that sense, you can get the earnings later down the line. So there is not a lot of earnings for every dollar invested right now, but that's because, you know, we're trying to develop these products and have the earnings later on the back end. So for that reason, this is not something to be too alarmed about, but it's still pretty high. We do need to point that out. 72.39 for the past 12 months. Project to be a lot better at 38.58, but even that's still pretty high. 2.75 earnings per share over the past 12 months. Project to be almost double at 5.16 over the next 12 months. No dividend yield, or at least not really all that much, 0.24, pretty negligible. So overall, could be a good investment for the long term, but just my understanding of the robotics scene out there, I do think there are better players out there that might outcompete Teradyne specifically. So I'm not too confident that this will be one of the best, one of the ones that can get there first, one of the ones that can come out with the best products, one of the ones that can really produce amazing things in the robotics scenes. Maybe I'm wrong. Maybe a couple years from now, we look back and it kind of looks like, I don't know, talking about Amazon in the early days and saying, oh, I don't know about this company or something like that, right? It could be. If that happens, then anyone who invested right now would be like doing amazing, right? But I just don't have a lot of confidence in it myself. I do think there are better players out there that have more potential. So for that reason, and again, remember, this is just a company that you would invest to this is not something you invest to for the short term, right? For the short term, it's going to be very volatile. It's going to be very unpredictable. It could easily crash massively. There's not a lot of earnings to justify the price. You know, it's a lot of hope and cope for the future of what this company can do, and maybe in the future it can do gangbusters, and that's why some investors get into it. But it's definitely not something you want to look at for the short term. For the long term, I personally don't have a lot of confidence to it, so I'm going to put it in C, but that's just because of my own perception of the company. That doesn't mean that it can't be a good investment for others, or if you know more about this company specifically and there's a reason why you believe in their mission, then you can definitely take a look at it. Just me, myself, not really interested. So for that reason, I'm gonna put it somewhere here in like a low C. Next up, we have Old Dominion, which is a shipping company. Their P ratio is a little bit higher than we want it to be, 32.08 over the past 12 months, 31.08 over the next 12 months projected. Earnings aren't expected to go up that much, from 4.97 to 5.13. It's about like a 3-4% increase, not that much. Barely any dividends to see here as well. So not good P ratio, not a lot of earnings going up, not particularly a lot of dividends. Not even that much of an exciting company that's like doing anything like on the bleeding edge of tech or anything like that. So overall, it just seems like a company that you can easily avoid. So for that reason, I'm going to put it in C. I'm not going to be too mean on it. I'll probably put it like a higher C, because at least it's not like losing money, or it's not like the earnings are not expected to go down or stuff like that. So I'm not going to be too mean on it, but I don't think it's particularly anything that we can even put into B, to be honest with you. Next up, we have Ingersoll Rand, which is a producer and distributor of compressed air, which is very useful for particular products and services. P ratio very high over the past 12 months, 60.3. That already makes me pretty much not interested in the company. That just seems way overpriced. Expect to be a lot better over the next 12 months, with the earnings going up at 22.8. Expected earnings for the next 12 months are much higher, almost tripling from, or maybe not quite tripling, maybe 2.5x from what they were over the past 12 months at 1.35, going to projected 3.56. Not any dividends to see, 0.1%, pretty negligible. So overall, I'm just not particularly interested. It could do okay. It seems like the high P ratio is because maybe momentarily they didn't have a lot of earnings this year, but again, it just seems too risky for me. So I'm not interested particularly. Again, I won't be too mean. I'll put it at a higher C. I don't think, again, at least it's not like losing money, or it's not expected to go down. But again, I'm not particularly interested. Maybe I'll just put it just below Old Dominion. Not really interested. It just seems a little bit more risky than I would like to look into. Next up, we have Willis Tower Watson, which is a risk assessment and brokerage company. Their P ratio is very good over the past 12 months, 15.97. but unfortunately looking to go up the wrong direction for the next 12 months. And that's because their earnings are expected to fall from 20.95 over the past 12 months to 19.31 over the next 12 months. And there's not even like a lot of dividends or anything like that. So overall, again, it just seems like the type of company I'm not interested in. I won't be too mean on them. I won't put them in D because at least their PE ratios are for both of them over the past 12 months and projected for the next 12 months below 20, looking healthy, so they're not too overpriced or anything like that. But earnings going down is not a good sign. I'm not particularly interested, so we're gonna have to put it in like a middle to low C, perhaps somewhere around here, and just move on. Next up, we have M&T Bank, another banking company. Their PE ratio is very good, 12.77 over the past 12 months, 11.03 for the next 12 months projected. Earnings expected to go up from 16.23 to 18.79. It's pretty good. That's about like a 17-18% increase. Very nice. There's a decent amount of dividends too, 2.75%. So I like this company quite a bit. Only thing that I would probably say doesn't excite me too much is the earnings are not expected to go up all that much. I mean, 17% actually not that bad. I shouldn't be too harsh on them, but would have been nice if this was quite a bit higher. Then we could definitely talk about like an A or something like that. As is, I'm debating whether it should be a high B or a low A. The multipliers are very low, so that's good. I do like that. And that could indicate that it could be just slightly underpriced. And with the dividends coming in, if it is underpriced and you get in at a good price and it goes up in price and you're also getting the 2.75% dividends as well, then those two could combo very well. It could be a very good combo stock, at least for the short term. So for that reason, I'll barely push it into a low A, but we're barely getting in there. And also part of it is because just B is so crowded that we do have to start moving a little bit more companies to low A or high C as well, so that B can breathe a little bit. So I'll put it just below Raymond James, just at the very low A, but could have been a high B as well. Next up, we have Humana, which is a health insurance company. P ratio for the past 12 months, not bad, but could have been better, 24.26. It would have been nice if it was below 20, but not the worst. P ratio expected for the next 12 months, 21.06. Again, not the worst, but could have been a little bit better. Earnings expected to go up, and not a bad amount, 10.67 to 12.29 projected for the next 12 months. That's about like a 15% increase. Not bad, but again, it's not like amazing either. Dividend yield, 1.37. All in all, it just seems like a down the road, middle of the road B, middle of B type of a company. So we're just going to go ahead and do exactly that. We're going to dump it somewhere around here, maybe right after Nike. Next up, we have Verisk or VE Risk, however you say that. It's a data analytics company. Their PE ratio is a little bit higher than we want to see, 33.64. Would have been nice if it was below 25 at least. Ideally even below 20. P ratio expected for the next 12 months is 28.79 projected. Even that is not the best. Not bad, but could have been a lot better. Earnings per share for the past 12 months, 6.55. Expected to be 7.65 over the next 12 months. Not the worst increase, about like 13, 14, 15% increase. Dividend yield, again, pretty negligible, 0.82%. Again, seems like a middle of the road B, middle of B type of company. Not great, not the worst. It's okay. I won't begrudge anyone who looks at this opportunity, but me, myself, I'm just not all that interested. But I'm not going to be too harsh on it. It's not the worst either. Next up, we have the Fifth Third, another banking company. PE ratio for the past 12 months, pretty good, 14.48. Expected to be even slightly better, 13.89 over the next 12 months. Earnings expected to go up, not a lot, but a little bit, 3.34 to 3.48. That's about like a 2-3% increase. Not the worst. Dividend yield of 3.12 is pretty nice. Overall, I'm really happy with the PE ratio, but unfortunately, there's not a lot of earnings growth. That's really the killer here. If there was a decent amount of earnings growth, this could be looking into like a low A type of thing. But as is, I'll get it close to a high B, maybe not the highest of the high B, but something along those lines. I do like the pricing of the stock. It's just that the earnings would have been nice if it was growing at least a little bit more than just 2-3%. That seems a little bit inconsequential in the grand scheme of things. Oh, I'm grabbing the wrong company here. I think this was over here. Let's go. Fifth Third goes, where do we put it? I'll probably put it somewhere on here. Maybe right after these ones. maybe like right there. Next up, we have Vici Properties or VC Properties, however you say it. Sorry if I mispronounce any of these names, by the way. There's like 500 companies here. I'm eventually going to mispronounce some of them. So if I do, I apologize already. But they are a real estate management company. PE ratio, very good over the past 12 months, 10.7. Very nice. Expected to be even better. Projected at 9.9 for the next 12 months. Earnings per share for the past 12 months, 2.63. Expected to be a little bit higher over the next 12 months at 2.84. About a 10% increase. So not bad. Look at this though. Dividend yield 6.27%. Oof, that's a very high amount. And particularly for a company where the PE ratio is so good. So the only thing that would have been nice if this was that it had a little bit more of an earnings growth over here, but this stock just seems so underpriced. It seems very underpriced, particularly with that dividend yield percentage. I think it might be a good time to get into this one. So I'm going to put it into not like a middle A even, but not super low A either. I'm going to put it, let's see, where can we fit this one? Probably maybe just ahead of PayPal and stuff. Should I go ahead of Verizon? Maybe I'll just put it below Verizon slightly. But yeah, definitely a good investment opportunity. Looking very good. I do like it. Next up, we have Interactive Brokers, one of the best investment platforms out there. Their P ratio is a little bit higher than we want it to be. Maybe we can make sense of it for this type of fintech company. 31.87. Expected to be 28.19 for the next 12 months, which is a little bit better. But still, maybe would have been nice if it was a little bit lower. Earnings per share for the past 12 months, 2.08. Expected to be 2.35 over the next 12 months. That's pretty decent. It's about like a 13, 14, 15% growth. Dividend yield, pretty negligible. So overall, I do like the company. I do like their mission. I do like what they're doing. I do like their product. But my only concern is P ratio a little bit higher than we want it to be. Earnings, not bad, but could have been a little bit better as well. So overall, seems like maybe slightly better than a middle B. I'm not going to go quite to a middle B, but I'm not going to go too far high in B either. So we'll try to fit it in just above middle B, maybe like right above Johnson & Johnson, maybe right above Pepsi. Yeah, somewhere around there. Next up, we have Synchrony Financial, another financial company. P ratios are very good. Look at this, 9.4. It's below 10. It's amazing. For the past 12 months, 9.4. For the next 12 months, 9.26. The earnings are not going up that much though, very slightly, from 9.15 to 9.29. That's like barely above 1% increase. So that's unfortunate. Dividend, pretty negligible, 1.34%. It's not a lot. It's a little bit. It could be a share on top, but there isn't a lot of potential for growth. I do like that the P ratio is so healthy, and it seems like the company is a little undervalued right now. Might be a really good entry point, but how much room does it have to grow? Just beside the fact that it might be a little underpriced, the earnings are not there to justify like a huge amount of growth. So it just, again, just because of how good the P ratio is, I can't go too far down. But because there's not a lot of potential for growth, seems like a middle B, unfortunately. This could have been a very, very good looking stock that could have a lot of promise if there were just a little bit more potential with earnings. Even if it was just like 7-8%. But like 1% is like bare. That's basically stagnant at that point, and that's not a great sign for a company. So I'm just going to have to go somewhere in the middle of B, maybe somewhere around here, maybe just above Applovin, and we'll leave it be. Next up, we have Lennar, which is a home building and construction company. P ratio is very good, 13.13 over the past 12 months. Expect to be 11.36 projected for the next 12 months. Earnings for the past year were 7.99 per share. Expected to be 9.23 for the next 12 months. That's a decent growth. It's about like a 15% or so increase. Dividend yield almost at 2%, just barely below 2% at 1.91%. So overall, I do like the stock. Is it good enough to go into a low A is the real question. Earnings going up, again, 15% or so, not bad. PE ratio, pretty good. I like that it's not overpriced. It could potentially be underpriced. There's a little bit of dividends as well. Maybe I'll go with this one slightly at a high B. Could have made it just into a low A, but just based on instinct, I'm going to do this one at a high B instead, but it's very close. It's not like a huge amount, a huge gap between this and some of the low A's over here, but I'll just barely put this at a high B. Next up, we're at number 300, only 200 companies left, and here we have Kellanova. This is the company that owns a lot of brands such as Kellogg's, a bunch of other cereal brands, even Pringles, some stuff like that. But recently, they're being acquired by Mars, so they are no longer trading right now because they're in the process of being acquired. So for that reason, I'm just going to put it right next to Warner Bros. Discovery because it's an irrelevant stock that right now is not trading, at least at the moment I'm recording this video. And assuming that goes through, this should not be in this current form. It should not be on the S&P 500 in the coming weeks. Where did I put Warner Bros. Discovery, by the way? It was somewhere on here. I think I put it somewhere in B. So I'll just put it right next to, yeah, there it is. I'll put it right next to that because both of these, they're in process of being acquired, so we're just not going to deal with them. Next up, we have the CoStar Group, which is a real estate information and analytics company. And just look at that PE ratio. I mean, over 1,000, basically because their earnings per share was almost non-existent over the past 12 months. So, and even like going forward, the PE ratio is still pretty high at 48.5. Obviously a lot better than 1,000, but still pretty high. So just we take one look at that. There's no dividends or anything like that either. So it's just a D. It's just an avoid. Doesn't mean it's not a good company. Doesn't mean it can't do better going forward. But as is right now, it's just an avoid. So just goes to D and we move on. Next up, we have the Kraft Heinz company. I'm sure everyone is familiar with Kraft as a brand and their fruit products, and also Heinz, the Heinz ketchup, obviously very famous. Unfortunately, their earnings was negative over the past 12 months. They lost money. So right there, I'm already very skeptical. One thing I will give them is that they are offering incredibly high dividends right now, 6.63%, to entice investors. And to be fair, their PE ratio projected for the next 12 years is pretty good. So even though this one is also risky because they were losing money, they were not in a good situation, there is enough compensation where I might just avoid putting them in D. I'm still not like happy about this. I'm still not like jumping up and down to go and get this stock because again, I think there's just too much risk involved. But I think I'll be a little bit nicer to them because at least they're offering it massive amount of dividends to entice investors. At least the projected P ratios are like very, very good. Projected earnings per shares are decent. So I'll give them a C, just barely. It was almost a D, but just because of those factors, I still think it's very risky. I still am not going to go anywhere near it, but I'll give it a C instead of a D, just barely. And actually, Abbott probably should go to D as well. Just looking at this, C is pretty chunky. And also Abbott, I'm pretty sure they were losing money, so I'll put them down here as well. And I think that just looks a little bit better overall. Maybe I'll put Abbott after Blog and maybe even after Datadog, somewhere around there. Next up, we have the MCore Group, which is a company that's in the business of building industrial infrastructure, energy infrastructure, those sorts of things. The P ratio is not bad, 25.22. Would have been nicer if it was below 25, even below 20, but still not the worst. PE ratio for the next 12 months projected at 22.43, a little bit of an improvement, but still could be a little bit better. Earnings expected to go from 24.87 over the past 12 months to a projected almost 28 over the next 12 months. So that's about like a 13-14% increase. Not bad. Dividends, again, almost non-existent, 0.16%, pretty negligible. So overall, again, I think for this type of a company, there is maybe slightly better options out there. And again, it's not the worst. It's okay. Seems like a middle of the road, down the middle B type of a company. So that's what we're going to do. We're going to take MCore and we are going to dump it somewhere in the middle of B. At this point, I'm just going to dump it somewhere. I can't segregate. There's too many companies in B. I can't like rank every single one. I'll just go, it feels somewhere in the middle. So I'll just drop it somewhere in the middle. Hopefully it's not too far off where it should be. Next up, we have Expand Energy, which is another energy company. In fact, they are the biggest independent natural gas producers in the United States. The P ratio was quite high for the past 12 months, 31.12, but expected to be a lot better at 11.22 for the next 12 months projected. And that's because the earnings are expected to almost triple, which is very interesting over here. 3.52 over the past 12 months. But to be fair, it was a little bit lower than it should have been, right? So it seems like it was either overpriced or the earnings were just missed or something like that. Expected to be a lot better over the next 12 months. Dividend yield a little bit at 2.09%. So overall, I like this one. There is definitely some potential here. It still seems a little bit riskier than I like it to. And again, I do think there are some other better stocks in the energy sector. So Not gonna quite push it to a low A, but I think a higher B does make sense for this one. So we're gonna go over here and we're going to, where did I put it? There we go. Let's bring it up to perhaps somewhere over here. Next up, we have Mettler Toledo, which is a supplier of precision instruments for laboratories and such. P ratio is a little bit higher than we want it to be, 35.42. Expect to be 31.04 for the next 12 months. Again, higher than the 25 or even 20 that we're looking for. Earnings per share expected to go up by about like 12-13% from 40.1 to 45.74. Decent amount of going up, but still not enough to justify the price of the stock. It seems it might be slightly overpriced. No dividends to speak of either. So overall, not particularly interested. I'll put it at a low B. It's not bad enough to go to a C. It's not okay enough to go to a middle B, but probably a low B would be just about right. I'll probably put it right after Texas Instruments. Next up, we have ADM, which is a company that produces all sorts of things: pet food, biofuels, beverages, those sorts of things. P ratio for the past 12 months, a little bit higher than we want it to be at 23.56, but expect it to be a lot better at 13.59 projected for the next 12 months. And that's because the earnings are expected to go up massively from 2.46 to 4.26. That's about like an 80-somewhat% increase. That's pretty good. There's a decent amount of dividends too, 3.52% dividend yield as well. So overall, if the P ratio for the past 12 months was a little bit better, this could have been an A. But as is right now, it's looking good. It's looking very promising. I'm going to put it at a high B, perhaps even higher than the last company that we took a look at. I just don't think there's enough there for me to put it at like an A. And also, like, how much room for growth does something like this have? I understand it's a dividend stock, but even then, I'm just not particularly interested in this type of a company. But it's not bad. It's definitely not bad. I don't begrudge anyone going after it. At least you're getting very good dividends on a regular basis. Next up, we have Rollins, which is a pest control company. And look at that P ratio, way too high. 56.9 over the past 12 months. Projected to be 48.09 over the next 12 months. It's just too much. It seems too overpriced. It seems like a classic C. We don't even have to look much further. We're just going to take it and dump it in C. Next up, we have Tractor Supply, which, as the name suggests, is in the business of farm supplies as well as pet supplies and stuff like that. P ratio, not bad, but could have been a little bit better. This is 24.8 over the past 12 months, projected to be 22.1 over the next 12 months. Earnings expected to go up by about like 20-somewhat% from 2.07 to 2.33. A little bit of dividend, but not a lot. 1.79%, just below the 2% we're looking for or higher. So overall, not bad, but again, seems like middle of the road B. I'm going to put it in the middle of B somewhere, maybe even slightly higher than middle, but not too high. So we'll go slightly above the middle point, maybe somewhere around here. Next up, we have Dollar General, which is a chain of discount stores. P ratios, again, not bad, but could have been a little bit better. 23.8, not bad. Projected to be quite better at 19.35, below the 20 we're looking for. Earnings expected to go up from 5.8 to 7.12. That is about, what is that, like 20-something%, 30% maybe increase, something along those lines. Dividend yield 1.7%, not that much, but not bad either. Again, seems like middle B, but maybe I'll push it a little bit higher than just middle B because at least it's projected to be below 20 over here. Earnings going up about 20-somewhat%. That's not that bad, actually. You're getting a little bit of dividend. So yeah, maybe, again, slightly higher than middle B, but it's not enough to push it into like super high B or even A by any means, at least not in my opinion. So I'll just put it maybe just ahead of Tractor Supply or somewhere around there. Next up, we have First Solar, which is a producer of solar panels. PE ratio looking very good, just over 20. Again, we want it to be below 20, but 20 itself, 20.7, that's fine too. P ratio going forward is 11.96. That's very good. And look at this, earnings expected to not quite double, but like go up by 80-somewhat%. That's very good to see. Good signs. 13.02, 22.55. And also in general, like solar companies, I do like them because I really do believe there's going to be more and more demand for solar energy. I mean, solar energy is just such a great source of energy. The sun is always there. It's always free. As long as you don't live in a part of the world where you don't get the sun that much, it's very easy to use. You just need some land to put the solar panels. That's it. So I really do believe in solar companies. I do think they're going to have a lot more clientele going forward. I do think they're going to be able to do well. So a company like this, I actually quite like. So P ratios are looking really good. I believe in their mission. I believe in their products. The earnings are going up massively. So to me, this just seems like an A. So I have to give them an A. So First Solar, We have to walk it all the way up to A. It's going to be a fun trip. Let's go. Let's go. I wish there was an easier way to bring this up. I don't think these tier lists are made to have so many different logos on there, but here we are. Where would I put First Solar? Would I put it above? I think I would put it just above Ford, perhaps. Maybe like right there. And yeah, that sounds pretty good. Next up, we have DTE Energy, another energy company. This one, the P ratios are looking good. 19.33 for the past 12 months, projected to be 16.69 over the next 12 months. Earnings expected to go up about like 13-14% from 6.68 to 7.73. That's pretty good. Dividends are pretty nice too, 3.44%. Overall, looking pretty good. Good P ratio, good dividends, good amount of earnings growing. Maybe earnings could have gone a little bit better. If it was going up like 20+%, then we would have been like solid A. As is, I'll still put it in like a low A, but it's going to be on the lower side of things, not super high. So we'll walk it up once more. And I'll probably put it somewhere around here at the very bottom of A. Next up, we have Ulta Beauty, which is a cosmetics company. The P ratio, not bad, but could have been a little bit better at 23.29 over the past 12 months. Projected to be 21.44 over the next 12 months. Earnings expected to go up just under 10% from 26.09 to 28.33. Probably like 7-8%, something like that. No dividends to see here. Overall, doesn't look that bad, but again, it seems like a classic middle of B. Maybe slightly ahead of middle of B, but not quite enough to make it all the way to like high B or low A or anything like that. So we'll just take it and we'll probably put it maybe somewhere around here. Next up, we have Atmos Energy, another energy company, one of the largest natural gas only producers in the United States. P ratio for the past 12 months, 22.5. Could have been a little bit better if it was under 20. It is projected to be better at 19.14 over the next 12 months. Earnings expected to go up from 7.47 to 8.78. That's about maybe close to a 20% increase. And dividends, there's a little bit, 2.15%, but it's not massive. It's okay though. It's not bad. So overall, probably like a kind of a high B, but not quite the highest of the high Bs. I don't think it's enough to push it to a low A. So again, we'll take it up here and probably put it somewhere around there. Next up, we have Extra Space Storage, which is a real estate investment trust and also one of the largest owners of storage spaces. The P ratio over the past 12 months was 29.25. Would have been nicer if it was at least below 25, preferably even below 20. So a little bit higher than we want it to be. P ratio for the next 12 months, still a little bit higher than those thresholds, 26.99. The earnings expect to go from 4.47 to 4.85. There's a little bit of growth, maybe close to 10%, but not a lot. But there's a lot of dividends, at least with this one. So earnings going up a little bit. P ratio might be a slightly overpriced, but dividends are pretty good. So if it wasn't for the dividends being this high, it might have been a low B. But because of the dividends, I'll push it up a little bit, maybe just ahead of middle B. But I just don't think there's enough there for me to be super excited about it, get it into like a low A or anything like that. But I'll push it just above low or middle B, I should say. Maybe like somewhere right there. Next up, we have Brown & Brown, which is another insurance brokerage. The P ratio is 24.24 over the past 12 months. Expect to be a lot better at 17.27 over the next 12 months, below the 20 threshold that we're looking for. Earnings expected to go up from 3.33 to 4.68. It's pretty decent. It's about like a 30% increase, slightly higher actually. Dividend yield, pretty non-existent, 0.76%, pretty negligible. But overall, the only thing that I don't like is that the P ratio over the past 12 months was perhaps a little bit higher than we want it to be. But overall, it's looking very good. There's definitely potential for growth here. I will put it at like a slightly higher B. Maybe not the highest of the highs, but let's see where we can put it here. Brown & Brown goes probably somewhere around there. Maybe slightly after Goldman Sachs. Next up, we have the Huntington Bank shares, another banking company. This one, the P ratios are looking phenomenal. Look at this, 12.47 over the past 12 months, projected to be 11.14 over the next 12 months. Earnings expected to go up from 1.42 to 1.59. That is about like a 10-12% increase. Not bad. Would have been nicer if it was a little bit more, but still decent. Dividends, very good, 3.5%. It's pretty decent. But what I really like is that it does seem like it might be slightly underpriced. So you could potentially be getting decent dividends on a regular basis and also have the potential for the stock to grow up a little bit. So it could be a really nice combo with a big boost from the dividends. So I do like this one quite a bit. I do think we have to make it up to like a low A. Would I put it higher than that? Probably not. I think, again, if the earnings were higher, we could have considered like a middle A or something like that. But as is, I think a low A will suffice. So we'll bring it up over here. Walk it all the way up. And I'll put it maybe right there. Next up, we have Chartercom, which is a telecommunications company. And look at these PE ratios. I mean, this stock seems way underpriced. Look at this, 5.71 over the past 12 months, projected to go even lower at 4.86 over the next 12 months. Earnings expected to go up from 36.26 over the past 12 months to a projected 42.67. That's pretty good. That's like about like what, 17-18% increase. There's no dividends, but I mean, there's just so much potential for growth here. And even looking at the chart, I mean, it just seems like you're getting in at the perfect time right now. Look at this. Look at how low it's gotten from the all-time high at 800. Again, of course, there's definitely risk there, right? Because when the stock falls this much, but I mean, the numbers back it up. The earnings are there. The earnings are there for this to be a lot higher than it is right now. So this might just be the perfect entry point for this particular stock. So just because of that risk of, you know, this sort of thing happening in the future again, I won't quite go to S, but this has to be a high A because it just seems like the perfect entry point. Because again, the earnings per share are going up significantly. The PE ratio is incredibly low. So I think this might be a very good, maybe slightly higher risk option, but there's just so much potential for this to pay off massively that for me at least, I think it might be looking into for sure, at least putting a little bit into, maybe not a whole lot, but just a little bit just to be involved with this company. So I'll put it at A, maybe even a slightly higher A, to be honest with you, maybe like somewhere around here. It looks like it could be a coup for sure. Next up, we have Ameren, another energy company. This one more concentrated on power and electricity. PE ratio over the past 12 months, 19.2. Pretty decent. Projected to be even better, 18.68 over the next 12 months. Earnings are not going up that much though, 5.2 to 5.34. That's about almost a 3% increase. Pretty negligible. It seems kind of stagnant. Dividends are decent, 2.85%. I'm just not a fan of companies that are a little bit more stagnant, but to be fair, the PE ratios are decent. Dividends not bad. So overall, again, I don't expect a lot of growth to be here. There could be, it could easily stagnate. It could easily go down. 2.85, not bad, but there's probably some other energy companies that are slightly better. So slightly better than middle of B, but not quite enough to be high B either. So I'll just take it and I'll drop it somewhere there. Next up, we have the CBOE Markets. This is a financial exchange operator based in Chicago. The P ratio over the past 12 months, slightly higher than we want it to be at 27.5, looking a little bit better at 23.38 for the next 12 months projected, but still could have been a little bit lower. Below 20 would have been ideal. Earnings expected to go up from 9.3 to 10.95. That is about like a 20 almost % increase. Decent, I guess, but dividend yield not that great, 1.05%, kind of negligible. Overall, seems like slightly better than middle B, but not much higher than that. So we'll just take it and we'll put it somewhere there. Next up, we have Broadridge, another fintech company. This company focuses mostly on producing products for asset managers. They can help them with their analysis and stuff. Their PE ratio over the past 12 months, 29.18, quite high, a little bit higher than we want it to be. A little bit better expected to be for the next 12 months, but even the projection, 22.28, slightly higher than we want it to be at, like, hopefully below 20 would be ideal. 7.82 earnings per share over the past 12 months, projected to go up quite higher, 10.24 over the next 12 months. It's about like a 25-30% increase. Dividend yield, not bad, 1.63%, but still not quite enough. Overall, again, seems like slightly higher than middle B, but not much more than that. So we'll take it and we'll put it somewhere around here. Next up, we have Dover, which is a producer of industrial products. And right there, you can see that the earnings are expected to fall from 16.26 over the past 12 months to 10.6. And the P ratio, even though it was good, it's going up. It's not great. Overall, it just looks like a C kind of company. The only reason it's not going to D is because the P ratios are very solid. And for that reason, I'll just won't quite put it in D, but it's still going to be a low C, probably somewhere around here. Next up, we have First Energy, another energy company, another electric company. P ratio, not bad, 19.48 over the past 12 months, projected to be 16.5 over the next 12 months. Earnings expected to go up from 2.3 to 2.72. That's pretty decent. That's about like a 20 somewhat percent increase. Dividend yield is also very nice at 3.92%, almost 4%. I really like this company. P ratio, very solid. Earnings going up a decent amount, above 20%. Dividend yield, almost 4%. I like it. It doesn't seem overpriced. It seems like you're getting those regular payments, and there's even some potential for it to go up. It could be a combo stock. It seems like a low A. So we're going to take First Energy, and we're going to go up, and we're going to put it, let's see, probably somewhere around here, maybe right next to Huntington. They're both looking, but maybe I'll put Huntington slightly ahead. But yeah, that looks pretty good. Next up, we have Biogen, which is a biotech company trying to come up with new treatments and new cures and stuff like that using biotechnology. P ratio is looking very solid, 16.15. Projected to be even better at 11.64 over the next 12 months. Earnings expected to go up from 10.97 to 15.21. That's about a 40 somewhat percent increase. There's no dividends, but there's definitely a lot of room for growth with this stock. I really like it. I really like the company. I believe in their mission. And it is one of those companies where if you put a little bit into it for the long term, there's definitely a lot of potential for them to be able to come up with groundbreaking new treatments or cures and such. And again, you're getting in at a good price. That's the best part of it, is that it doesn't seem overpriced. It seems even slightly might be underpriced at the moment. So it seems like a good investment opportunity. Earnings are expected to go up in the short term as well. So I like this company. Is it enough to go into S? Probably not, but it's definitely going to go into A. But of course, just be mindful that these types of biotech companies, they are a little bit risky, right? There's a lot of upside and potential for reward, but there's also definite risk there as well, because at the end of the day, it's not guaranteed that they're going to come up with anything groundbreaking, right? But I like the company itself. I think there's enough there with the numbers to justify looking at it. So I think A is definitely the right category for this one too. Next up, we have Equifax, a credit reporting agency. P ratio quite high, 42.09 for the past 12 months. That's really high for this type of a company. Even projected to be 25.2 over the next 12 months is not ideal either. It's obviously a lot better, but still would have liked it to be below 25 and even potentially below 20. Earnings per share are expected to go from 5.28 over the past 12 months to 8.85. That's a decent amount of going up 65-70%, something along those lines. Not a lot of dividends, but in general, it just seems a little overpriced, at least at the current earnings. If it does hit those earnings that are projected, then yeah, it will be better. But even then, it's not like then it's a great price, or it would just start to justify the current price at those earnings. So I'm just not particularly interested. And again, it's a credit reporting agency. This is not the type of company that you expect to like have a lot of growth or a lot of new features or elements or whatever, or to be very exciting in any way. There's not a lot of dividends being paid either, so I'm just not particularly interested. I'm going to put this one into a C. Not too low. I'm not going to be too mean on it, but it just doesn't really interest me. Next up, we have Dexcom, which is a medical device producer. They produce stuff like, for example, the glucose level indicator and stuff. P ratio for the past 12 months, 37.6, slightly higher than we want it to be. But maybe you can understand if they're like working on revolutionary products. Perhaps there's a lot of investment right now because there is potential promise for earnings in the future. But again, it just seems a little bit more risky than I want to get involved with. P ratio for the next 12 months, 27.32. Even that is slightly higher than we want it to be. Earnings expected to go up a decent amount from 1.8 to 2.47. That is about like a 30 somewhat percent increase. Not bad at all. But Again, just seems a little bit more risky than I'm interested in. So I'm going to put it at a low B. It is definitely a company that you could look at, and maybe for some people it would look like a good investment, but just I'm not particularly interested. It just seems a little bit more risk than I'm willing to get involved with without necessarily a lot of promise for higher returns, at least not in my eyes. Next up, we have Eversource Energy, another energy company. P/E ratio pretty good, 18.5 for the past 12 months, 13.5 projected to be for the next 12 months. Earnings expected to go up a decent amount from 3.64 to 4.97, about a 30-somewhat% increase. Dividends are really good too, 4.5%. That's pretty solid. So very good P/E ratio. Doesn't seem overpriced. Seems might even be slightly underpriced. Earnings going up a very decent amount, above 20 or 30%. Very good dividends. Seems like an A type of company to me. So we're going to take Eversource and we're going to walk it all the way up. And we're going to put it maybe slightly ahead of these other ones. Next up, we have W.R. Berkley, which is a casualty insurance company. P/E ratio very good, 14.82 for the past 12 months, 15.24 for the next 12 months. Going the wrong direction, but it's still very good, very small. Earnings are expected to slightly fall, but it's not that big a deal. It's like a couple of percentage from 4.76 to 4.63. That's about like 3-4%. But it's not a good sign that it's staying stagnant or slightly coming down. There's almost no dividends either here. So what do I think of this one? This one, again, doesn't seem super overpriced. It could be priced well, but it seems like it's going to be stagnant for a while. So for that reason, I'm just going to put it at a high C. But definitely could be a company we can look into later on, particularly if they pick up those earnings and start doing better. Next up, we have AvalonBay, another real estate investment trust. And just look at that. Earnings expected to fall massively from 8.2 to 5.23. P/E ratio is going in the wrong direction. It's going to be quite high, actually projected to be 35 over the next 12 months. So I think we've seen enough. It's a D. Not interested. Thank you very much. Goodbye. See you later. Next up, we have Northern Trust, a financial services company. P/E ratio is very good, 16.34 over the past 12 months, 14.95 projected for the next 12 months. Earnings expected to go up from 8.58 to 9.37. Not bad. That's almost a 10% increase. Not the highest, but still decent. Dividend, there's a little bit, 2.2%. Again, not amazing, but okay, not bad. What I really like about this is that it doesn't seem overpriced. It seems like well-priced. Earnings going up a little bit of dividends. I'll put it at a high B. I don't think there's enough there for me to go low A. I would have liked a little bit more earnings growth, or at least a little bit more dividends, either or. As is, it's still pretty good, going in the right direction, I should say. And the ratios are decent. So we'll go at a high B. Just barely not enough to make it to low A for me, but still pretty decent. So we'll put it somewhere there. Maybe right there. Next up, we have Steris, which is a company that produces products for patient care. P/E ratio quite high over the past 12 months, 36.36. Projected to be a lot better at 22.94, but even that would have been nice if it was slightly lower. Earnings expected to go up from 7.03 to 11.13. That's about like a 40-somewhat% increase. Pretty decent. Dividend yield, pretty negligible at 0.94%. Overall, it seems a little bit overpriced right now. With the new projected earnings, if it hits those, will be a little bit better, but even then it's not like great. So it just seems like a middle of the road B to me. So we'll just take it. Maybe I'll put it slightly ahead of middle of the road B, but not too much higher. Maybe like right there. Next up, we have Cincinnati Financial, which is an insurance company. And just look at that. The earnings are expected to fall from 13.44 to 8. P/E ratio going the wrong direction. Even though it did seem like well-priced, slightly underpriced, it's going in the wrong direction. So we're just not interested. Maybe I won't quite put it in D because the P/E ratios are very healthy and there's a little bit of dividends, 2.11. But then again, the earnings are dropping quite big. So I think I just have to put it in D. Maybe a high D, but D nonetheless. Next up, we have PPL Corp, another energy company. P/E ratio going from 23.87, slightly higher than we wanted to be over the past 12 months, to a lot better at 18 almost. Earnings expected to go up from 1.47 to 1.95. That's about a 30-somewhat% increase. Not bad. Dividend yield 3%. That's pretty decent too. So overall, I think I put it at a high B. If the P/E ratio over the past 12 months was a little bit lower, it could have got to like a low A. As is, I'll put it at a high B. Definitely not bad at all. Could be an okay option, but I think there's like a couple of companies that are slightly better than that in that sector at least. So I'll just put it here. I think a high B would suffice. Next up, we have Iron Mountain, which is an information management, data management type of company. P ratios are crazy. Look at this for the past 12 months, 153 because the earnings are pretty low. Even with the new earnings projected to be much higher, it's still a P ratio of 36. So it seems like an overpriced stock that I'm not particularly interested in. Yes, there's a decent amount of dividends, 3.93, but will they keep those up? Maybe with the earnings going up, they will be able to, but again, it just seems too risky for me. At least it's going in the right direction, but even then, the P ratio is still high. The 4% dividend is the only reason I'm not going to put this in D. I'll just go to C. But yeah, it's just not something I'm particularly interested in. It just seems way too risky, way too weird for me. Next up, we have American Waterworks, a utility company, a P ratio 22.89 for the past 12 months, 21.42 over the next 12 months, slightly higher than that 20 that we're looking for, but not bad. Definitely, at least they're below 25. Earnings per share for the past 12 months was 5.7. For the next 12 months, 6.1. A little bit better, but that's like what, 7-8% increase, not the highest. Dividend 2.5%, okay, but again, not amazing either. So it just seems like maybe slightly higher than middle of the road B, but not too much higher. So we'll take this one and we'll see where we can put it. Maybe somewhere around here. Next up, we have Constellation Brands, which are producers of beer, wine, spirits, those types of things, liquor in general. PE ratio for the past 12 months, 20.35. Pretty good. Just slightly ahead of that 20 that we're looking for, so that's fine. P ratio for the next 12 months projected to be a lot better, 11.25. That's pretty good. Earnings expected to almost double from 6.85 to 12.39 over the next 12 months. There's a decent amount of dividends to 2.92%, almost 3%. Overall, I like this one. P ratio is looking healthy. Earnings almost doubling. That's pretty good. Dividend, decent amount, but almost 3%. I like it. It could be a little bit of a combo stock. It seems like it might be a little underpriced. It might go up a little bit in price to reflect that much better earning. And if you're getting those consistent dividends and also going up in price a little bit, that could be very good of a very good combo. So I think a low A is pretty justified with this one. So we're going to take Constellation Brands and we're going to walk it all the way up to here and put it in perhaps a low A. Next up, we have CenterPoint Energy, another utility company. PE ratio 24.18 over the past 12 months. Would be nicer if it was a little lower. Looking better over the next 12 months at 20.06, just over that 20 threshold, so that's fine. Earnings expected to go up from 1.58 to 1.91. That is about a 20-somewhat% increase. Decent enough. The dividend yield 2.3. It's okay. Overall, this just looks okay. So again, I'll go middle of B, maybe slightly ahead of middle B, but not much higher than that. Doesn't really have much to excite us, but it's not the worst either. I'll probably put it like somewhere around there. Next up, we have Steel Dynamics, another steel company. And with the onshoring of the steel production in the United States, a lot of tariffs preventing steel coming from outside the country, from other international companies. And, you know, these internal companies getting a lot more of the pie within the American market, it should help companies like this. But again, those are probably already baked in at this point because it's been several months since that's happened. A lot of people have probably invested into these types of companies, so we're not going to let that affect us too much here. P ratio for the past 12 months, 23.28, maybe slightly higher than we want it to be, but looking a lot better for the next 12 months, projected at 13.24. But again, I'm just slightly cautious with these projections because I'm assuming they're countering that in. But again, we'll see how much that lasts. And again, this is all a little risky because it depends on the political landscape staying the way it is. A lot of this could change if there's some changes that are made to tariff policies and stuff like that. So be careful of that. Earnings per share expect to go up from 7.5 to 13.25. That's pretty decent. That's like about like what 80-somewhat% increase. It's pretty good. Dividend yield, not that high, 1.12%. Overall, not bad, but there's a little bit of risk involved here with the political landscape and all those things. I'll probably go like a middle B for this one. I'm just not all that interested, but it's not bad. It's not bad by any means, so I'll probably put it right there. Next up, we have General Mills, a food company. P ratios are very good. 10.16 over the past 12 months, 12.58 projected for the next 12 months. It's going the wrong direction because the earnings are falling, unfortunately. But the dividend is very high, 5.14. So I can't quite put it that far down. It's not going to go to D. But with the earnings going down, I'm not going to be too interested in a company like this, even though the dividends are looking really good right now. But again, will they keep those up? If the earnings go down, can they still be able to pay those kinds of dividends? Or are they going to falter as well? So for that reason, I'm just, even though the P ratio is really good, you know what? I'll put it at a high C, but it just has to be C nonetheless. So I'll put it at a very high C. Maybe I'll put it like top of C. But I can't quite push it higher than that when I see earnings going down. Next up, we have Veralto, which is a tech company that produces products related to assessing the quality of water and water analytics in general. P ratio of the past 12 months, 27.89. Expected to be slightly better at 24.35. But again, it could have been a lot better, these numbers. Earnings per share, 3.65 over the past 12 months, 4.18 projected for the next 12 months. Seems like it's projected to grow about like 10, 11, 12%, something like that. But so not bad, but not the best either. Dividend, it's pretty negligible, 0.43%. So it just seems like a middle of the road B type of company. Not particularly that excited about it, but it's not that bad. It's whatever. We'll put it in the middle and move on. Next up, we have Jabil or Jabil, however you pronounce it. It's a manufacturing company. PE ratio quite high for the past 12 months, 36.7, but expect to be a lot better over the next 12 months, 17.6. That's because the earnings were probably a little bit lower than expected this year, but project to be much higher. We'll see if they can hit those projections, almost doubling. The dividends are pretty non-existent. So it seems a little risky because of the much higher P ratio of the past 12 months. It seems like the stock might be a little overpriced and it might just start to justify the price. And again, given that there's no dividends here, we're just looking at potential for growth. So is there going to be growth, or are we just barely going to justify the price of the stock with the earnings going up that much? So it just seems a little bit more risky than I'm interested in. So I'll put Jabil or Jabil, whatever. I'll put it at a low B and move on to the next one. Next up, we have Tapestry, which is a luxury fashion holding company. P ratio kind of insane for the past 12 months because the earnings were very low, 117. Projected to be a lot better over the next 12 months, but if it hits those projections, right? So that's the thing. It's a big gap. We'll see if they can do that. 21.07 over the next 12 months. There's not a lot of dividends, 1.14%. Overall, it just seems too risky for me. I'm not interested. I don't know if they're going to hit those kinds of projections. That's a big increase, 6x increase, really, from what you were making last year to this year. It's just for a luxury fashion, I'm just not interested. It seems too risky for me. I'll put it probably like a lower end of C. Wait, where is this? There we go. Probably like somewhere around here. Next up, we have Teledyne Technologies, which is an information analysis company for industrial growth markets. P ratio expected to be a lot better over the next 12 months. It was almost 30 over the past 12 months, quite a bit higher than we want it to be. Expected to be 21.87, a little bit better, but still could have been a little bit lower as well. Would have been nice. Earnings expected to go up from 17.26 to 23.65. That's a decent increase, about a 30% or so increase. No dividends here. Earnings expected to go up a decent amount. P ratio could have been a little bit better. So it just seems like a slightly higher than middle B, but not particularly a lot higher than that. So we'll just take it and we'll bring it up. Maybe just ahead of Exxon Mobil, or actually that's maybe a little bit lower than that. We can go, we'll go here actually. Next up, we have Citizens Financial, another banking company that is also involved in the business of health insurance through some of its subsidiaries. P ratio pretty good, 16.8 over the past 12 months, projected to be 11.9 over the next 12 months. Earnings expected to go up from 3.5 to 5. That's a decent jump. That's about like a 40-somewhat% increase. Very good. Dividends are decent too, 2.87%, almost 3%. So very healthy P ratio. Doesn't seem overpriced. Might be even slightly underpriced. Earnings going up very good amount, almost 40% or 40-somewhat%. Decent amount of dividends too. I like this company. I like it. I think I'll do a low A for this one. So we'll take Citizens and we'll go all the way up here. We gotta just scroll it up, and I'll probably put it probably somewhat just ahead of MetLife and AIG probably. Next up, we have Halliburton, another energy company, another oil services company. P ratio for this one, again, pretty good, 18.5 over the past 12 months, projected to be 12.7 over the next 12 months. Earnings expected to go up from 1.5 to 2.2. That's almost a 50% growth. That's very nice. Dividend decent, 2.43%. Would have been nice if it was a little bit higher because there's a couple energy companies we're taking a look at that offered a little bit more. But overall, very good. A very healthy P ratio. Doesn't seem overpriced, might be underpriced slightly. Earnings expect to go up about 50%, decent amount of dividends too. So I like him. Probably a low A. I'll probably put it slightly lower than the other couple of companies that we took a look at recently. But low A seems justified for this one as well. And we're going to take it and I'm going to put it probably right there. Next up, we have Palantir Group. Again, I hope I'm pronouncing these correctly. It's an American home construction company. The PE ratios are very good, 9.18 over the past 12 months, 10.86 over the next 12 months. It's going in the wrong direction, but they are very low, so it doesn't seem overpriced or anything like that. Earnings are expected to fall a decent amount, though, from 12.98 to 10.97, and there's not even a lot of dividends. So, unfortunately, even though it seems like well priced and all of that, it just seems like it's going in the wrong direction and the earnings are falling, and I'm not a fan of that. So it seems like a high C to me, unfortunately. But it is one to look out for if it does start performing a little bit better with the earnings. It could be a potentially good option to look at later on, but right now it's not particularly interested. Next up, we have Dollar Tree, another discount store chain, and this one, the earnings were negative over the past 12 months, quite a big chunk as well. That's a lot of money lost. And even though they expect to have a positive year, even though the projections are projecting a decent P ratio of 18.6, I'm just not interested. It seems too risky. Are they going to hit these projections? I mean, that's a big gap to go from losing that much to all of a sudden making this much to, justify the price of the stock. It just seems too risky. I'm just not interested. I'm going to put it in D, and we're going to move on to the next one. So next up, we have HP, and you might remember that we talked about Hewlett-Packard earlier on, and that's because HP actually a while ago split into two different companies, the HP Main and also Hewlett-Packard Enterprises. And while HP Main is focused on printers and computers, laptops, those sorts of things, Hewlett-Packard, I should have clarified this earlier, is mostly focused on developing servers and storage and stuff like that. So while the numbers were pretty bad for Hewlett-Packard, I'm going to put it in D earlier on, with HP, let's take a look over here. P ratio very good, 8.77 for the past 12 months. Expect to be 7.19 for the next 12 months. Earnings expect to go up from 2.65 to 3.23. It's a decent jump. That's about like 25 or so percent, maybe 30%, something along those lines. It's going up, and dividend is amazing, 5% dividend. So as much as that one was bad, this one's pretty good. P ratio is very solid. Earnings going up. So I like it. Seems like a slightly higher than low A to me. Not too high in A, but we're going to bring it all the way up. And we're going to put it probably slightly ahead of PayPal. Maybe I'll put it like somewhere right there. Next up, we have Leidos Holdings. This is a defense company that also is involved with aviation, information technology, biotech, all those sorts of things. Basically, one of those companies that has their hands in a lot of pies, a lot of profitable pies, I should say. And again, these types of defense companies, they have their defense contracts. They're going to be doing well. P ratio is very solid, 17.34 over the past 12 months, 15.1 over the next 12 months. Earnings expected to go up from 10.72 to 12.31. It's about a 15% increase, pretty solid. The dividends are pretty non-existent at 0.88%, but I really like the stock. The PE ratios are very healthy. They don't seem overpriced, at least not at this stage. Earnings expect to go up a decent amount. Maybe it would have been nice if the earnings were going up a little bit higher, but even still, it's decent. And again, I just like these types of companies because I know that I can count on their defense contracts being there. And as volatility is increasing in the world, unfortunately, these companies I know at least are going to be doing well in terms of their business and their revenue and stuff. So I do like it. I probably put it at a low A. So we're gonna take this and we're gonna walk it all the way up to right over here. I'll probably put it not too high, actually. I'll probably put it right there, but I do like it. Next up, we have Devon Energy, another energy company. This one is involved in trying to develop new products with hydrocarbon type of chemicals. The P ratio is very solid, both below 10 for the past 12 months and the next 12 months, but it is going the wrong direction, unfortunately. That's because earnings are expected to go down a little bit. So it seems like a stagnant company a little bit. The ratios are good, so it doesn't seem overpriced or anything like that. It seems might be even underpriced. The earnings going down is not great. Seems like it's stagnating, might be even coming down a little bit. But there's also some potential, I suppose, with the explorations for new products and stuff. There's a decent amount of dividends, 2.7%. So I'll probably put it like at a low B. No, I won't be too harsh on it, but yeah, not super excited about it, unfortunately. But it is one to look out for. If the numbers improve, it could be a decent option. Next up, we have Hubbell, which is an electrical and utility solutions provider. The P ratio quite high at 28.22, at least higher than we want it to be, I should say. It's not that high, but it's not ideal. P ratio is expected for the next 12 months to be 23. Again, slightly higher than we want it to be. Earnings going up a decent amount from 16.12 to 19.8. That's about like a 20% or so increase, not bad. Dividends 1.18, nothing to write home about, pretty negligible, or at least it's just okay at best. Overall, it just seems like a middle of the road B, so I'm not gonna spend too much time on it. I'm just gonna dump it in the middle, somewhere around there. Next up, we have Regions Financial, another banking company. The PE ratio is looking really good, 12.12 over the past 12 months, projected to be even better at 10.6 over the next 12 months. Very good PE ratios. Earnings per share for the past 12 months, 2.27, projected to be a decent bit higher, about 15% higher at 2.6 over the next 12 months. So 15% growth, not bad at all. There's a decent chunk of dividends as well, 3.74. Overall, I think specifically because the P ratios are so good, it doesn't seem like an overpriced stock. If anything, it might be even slightly underpriced. There's very good dividends, almost 4%. A decent amount of earnings growth. It would have been nice if it was at least 20% or higher, but even 15% earnings growth is not bad, anything to scoff at all. So overall, I think we'll get it into a low A. The only thing I'm thinking of is that should I go high B because earnings growth is not like super high, but you know what, I'll just go barely low A because the dividends are also really good. We're gonna squeeze it in at the very end of A, but not too high. So let's go over there and see. Yeah, perhaps I'll put it like somewhere, maybe just above Raymond James, something like that. Next up, we have the Omnicom Group, an advertising company. Again, the PE ratios are looking really good. 11.88 over the past 12 months, 8.14 over the next 12 months projected. Very good, below 10. That's amazing. Earnings expected to grow a decent chunk from 6.77 to 9.88. That's almost a 50% growth. Not quite, probably like 45 or so percent, but still very nice. Dividends very high to 3.6%. So it's very similar in all aspects to the last stock we took a look at, but the earnings growth is even better. And it's also a little bit different, right? It's a marketing company. It's not a banking. We've seen a lot of banking and financial companies. So it's a little bit different. It's a little bit of a different stock to include in your portfolio. So I really like it. I'll probably go a little bit higher than just a low A, but perhaps not too high. I don't know if it'll quite get to middle A. Let's go up there and see what other companies we have, because there are some companies that have a lot of potential and perhaps even more potential than a company like this for massive growth and doing really well. So I won't go too high, but I'll perhaps put it ahead of PayPal, something like that. Next up, we have T. Rowe Price, an investment management firm. Again, PE ratio is looking really good. 11.39 over the past 12 months, 10.27 over the next 12 months. Earnings expected to grow about like 11 or so percent from 9.18 to 10.18. Dividends are also really good, 4.86%. Again, another A type of company, looking really good. Looks like it's not super overpriced. Could be even slightly underpriced. Decent amount of earnings growth. I would have liked the earnings growth to be a little bit better. But as is, it's still pretty good, and also the dividend yield is very good. So I'll put it around about where we put the last two. Again, a low A. The only reason it's not going higher into A, again, is just the earnings growth is not quite as much as some of those other companies. But I will put it just slightly ahead of Regions, maybe like somewhere around there. Next up, we have the Waters Corporation, which is a company that produces instruments for labs. PE ratios kind of high, 35.25 over the past 12 months, 26.91 projected over the next 12 months. So it is improving, but still higher than what we want to see, higher than 25, 20, etc. Earnings expected to grow about 35% from 10.88 to 14.25. So decent amount of earnings growth. But again, is that even enough to justify the current price of the stock, let alone lead to a growth in the value of the stock? Probably not. I mean, it doesn't look that way. The multipliers are quite high. Not any dividends either. So overall, it's not the worst, but I don't really like it. Probably like a middle of the road B, maybe even slightly lower than a middle of the road B. So we'll take it and we'll put it somewhere around there. Next up, we have NetApp, which is a data infrastructure company. P ratios decent, 19.04 over the past 12 months, projected to be even better at 12.8 over the next 12 months. Earnings expected to grow a very good amount, 5.75 to 8.55. That is about a 50 or so % increase in earnings. Pretty nice. Dividend, there's a little bit at 1.9. Not quite a lot though. It's still lower than the 2%. So it's not that bad, but it's not that great either. Overall, I like the valuation of the stock. I like that the multiplier is not too high. Earnings are growing very nicely. And there's a little bit of dividend. So I do like it overall. Do I like it enough to put it into a low A, or should we go high B? I'd probably just, again, go low A because, again, the earnings growth is massive here. But probably not much higher than that. Let's see where we can put this one. I'll probably put it like right around here. Maybe even a little lower. Next up, we have Equity Residential, another real estate investment trust. And look at this. Earnings are expected to go even lower than half of what they were over the past 12 months. And the P ratios are absolutely exploding out of proportion. So yeah, there's 4.35% dividends, but again, these are not good at all. So not interested. Thank you very much. We have to go with a D, unfortunately. Next up, we have Verizon, a network infrastructure company. The P ratios, again, a little bit higher than what we want them to be. 28.56 over the past 12 months, 25.45 over the next 12 months. It's going in the right direction, but still a little bit higher than what we want to ideally see in these types of stocks. Earnings expected to grow about like 12-13% from 8.58 to 9.63 over the next 12 months projected. There's a little bit of dividends, but pretty negligible, 0.94%. It's not even 1%. So overall, seems like kind of a middle of the road B type of stock. Not particularly interested in it. We're going to take it and we're going to put it somewhere around there. Next up, we have PPG Industries, which is a supplier of paints and coating. P ratio is very good, 18.61 over the past 12 months, 12.89 over the next 12 months. Earnings expected to go up a decent amount from 5.6 to 8.08. That's about close to 50% increase. Very nice. Dividend yield, decent, 2.67%. Not super high, but still decent. Thinking about whether I should go low A or high B. I'll probably go a high B with this one. I'm not particularly interested in these types of companies anyways, but numbers are good, so we have to give it its due. So we'll go at a high B with this particular stock. And let's see where we can put it. Maybe like somewhere around there. Next up, we have ON Semiconductor, which is a semiconductor supplier. The PE ratio for the past 12 months was really high, 70.5, but expected to be a lot better over the next 12 months, 18.6. And that's because earnings are expected to grow massively. But again, this is a big gap, right? So we're expecting it to do gangbusters, even though it didn't do all that much in earnings over the past year. So again, there's a lot of risk that comes with that. Those projections, are we going to actually hit those projections? Is it even feasible that we hit them? Or is that just being like optimistic or trying to see the best in what the company can do? So it's very tough to see if these numbers actually materialize, and obviously it's a very good opportunity, but do they actually materialize? That's easier said than done, right? So there's a little bit of risk with this one. I would suggest you exercise caution with this. I'm definitely going to exercise caution with it myself. For that reason, I'm not going to quite go into A, even though the numbers might suggest that it should belong in that kind of an area. I'll probably go to a high B just because I want to be a little bit more risk averse, and I'll just jump headfirst into a company like this, which, yes, it could grow massively and do absolutely amazing, but it could also not do particularly great. Like if you miss those projections, then all of a sudden it's not looking great. So for that reason, I'm going to put it somewhere around here. Next up, we have Edison International, a utility company, and the earnings are expected to go down. It's already a red flag. We don't like to see that. 7.64 over the past 12 months, projected to be 6.17 over the next 12 months. That is not great to see. That's about, what is that, like 20 somewhat percent or close to 20% decrease in expected earnings. Not great. Yes, they are offering a lot of dividends, 5.51%, but with the lowering earnings, will that still end up being around that amount, or is it going to get lowered? I mean, it's not unfeasible that it goes and gets lowered all of a sudden, right? So not particularly interested. P ratios are very good though. That's one thing I will give them, is that I don't think like the price of the stock is like really overpriced or anything like that, because P ratio over the past 12 months, 7.87, even with the lower estimated earnings, it's still expected to be, or projected to be, at 9.74 over the next 12 months. So it doesn't seem overpriced. I don't think the price of the stock is going to massively drop or anything like that. But I do expect dividends to, feasibly potentially get lowered because of the lowering of the earnings. And that's not going to be great. And also, we don't know what's going to happen after that, right? Like, is it going to recover the next year or not? So it's just overall seems very risky. Because of those amazing P ratios, I won't quite go to D, but I'm pretty sure this one has to go to C, somewhere around here. Next up, we have KeyCorp, another banking company. P ratios, not bad, 25.89, just over that 25 that we want to see. But again, even then, it could be a little bit better. Below 20 would be even better. But expected to be a lot better over the next 12 months, 11.74. Earnings expected to more than double, going from 0.81 to 1.79. So there wasn't a lot of earnings over the past 12 months, but it's expected to be a decent amount. And there's a decent amount of dividends, right? 3.91%. Again, that does seem like a big jump. Are we going to actually hit those numbers? That's a little bit of a risk. And also, was the stock price a little bit overpriced? Potentially might have been. And is that going to actually materialize, or are we going to basically just justify the stock or the price as is? It's tough to see. So I don't necessarily see a lot of potential for growth with this one because the P ratio was already very high. And I don't know if the dividends on itself are going to be enough to push this over line, because if we don't end up hitting those projections, then are the dividends going to be trouble then, right? There wasn't a lot of earnings to begin with. So when the earnings are that low per share, how are we offering this much dividends? That's the other thing, right? So basically, look at this. If you look at the actual numbers, the amount of dividend was actually higher than the earnings per share, right? So the amount was 0.82, whereas the earnings per share was 0.81. So it seems like the company was offering more in dividends than what they were actually making in earnings per share. So is that really sustainable? Overall, it's just not giving me great vibes. For that reason, I'm going to go a low B. But again, I can see, if you really believe in this particular company, I can see an argument for it, but I'm just particularly not interested. Next up, we have LabCorp Holdings, which is a company that provides lab services for healthcare decisions, diagnostic decisions, stuff like that. The PE ratio over the past 12 months was, again, perhaps a little bit higher than we wanted to be, 24.84. Would have been nice if it was below 20. Projected to be a lot better over the next 12 months, 14.46. Earnings expected to grow massively from 10.18 to 17.5. It's about a 70-somewhat% increase. Very nice. Dividend yield a little bit there, but not too much to write home about, 1.14%. Overall, I don't mind it particularly. I just don't know if there's a lot of room to grow for a stock like this. And also, is it priced correctly? Are we just going to justify the stock, the price, with the earnings growth? Or, is there potential for growth? It seems a little uncertain. So I'm just going to go maybe slightly ahead of middle B, but not too high. I don't think it's even enough to push it into like a high B type of territory, but we'll just push it just above middle B, maybe somewhere right there. Next up, we have Lululemon, very famous brand. I think everyone knows Lululemon, branding and clothes and everything. Look at this. Earnings expected to go down over the next 12 months. Not a great sign. They're expected to go down from 14.33 to 12.55. That is about like a seventh of a drop. So that's like, what is that? Like 13, 14, 15%, something like that. The PE ratio was very good over the past 12 months, 14.83. That's a very good multiplier. It's going the wrong direction, unfortunately, because of the lowering of earnings. So that could also have implications for the stock price and everything as well. And of course, there's no dividends, right? So overall, I'm okay with the multiplier, with the PE ratio. The lowering earnings is just not great. It just kind of kills the stock. There's no dividends or anything to make up for it either. So I'm thinking probably like a low C. I'll be nice. I won't quite go to D, but I think it's just not the right time to be investing in a company like this. I'm going to go somewhere around here. Next up, we have Ralph Lauren, another clothing brand. This one, the PE ratio, again, a little bit higher than we want it to be, 26.36. Expected to be 21.24, projected for the next 12 months. Even then, would have been nice if it was below 20, but still okay. It's not that bad. Earnings expected, or earnings per share for the past 12 months, I should say, 13.54. Expected for the next 12 months, 16.8. So that is approximately like a 25% or so growth, which is projected here. Not bad at all. Dividend yield 1%, nothing to write home about. So overall, it kind of looks like a middle B to me, maybe slightly higher because there's 25% earnings growth, but not much higher than that. So we're gonna take Ralph Lauren and we're gonna go perhaps somewhere around there. Next up, we have CMS Energy, another energy company. PE ratio, not bad, 20.28 over the past 12 months. Project to be even better at 18.24 over the next 12 months. Earnings per share for the past 12 months, 3.46. Projected to grow about like 12-13% up to 3.85. All right, not bad. Dividend yield 3%, pretty decent. Overall, it's okay. I think it's better than like a middle B, but I don't think it's too much better than that, right? So there's not enough about the stock that really makes me excited. Earnings growth is okay, but it's not like amazing. Dividends are good. I'll give them that. PE ratios are good, but could have even been a little bit better. We have seen other types of companies in similar sectors that are even slightly better. So overall, probably somewhere between a high B and a middle B. But not quite high B, not quite middle B either. Somewhere in between seems about right. I'll probably put it somewhere around there. Next up, we have Williams-Sonoma, another retail chain, and the PE ratios are decent, 20.57. Again, could have been a little bit better, but not that bad. Projected to be 20.45 in the next 12 months. But look at this. Earnings growth, pretty much non-existent. It seems like it's stagnating. 9.1 to 9.15. That's not even like 1% growth. That's like 0.5% growth. Dividends, again, pretty negligible, 1.36. It's not that high. Nothing to write home about. Overall, it just seems like maybe slightly lower than even a middle of the road B because it's just stagnating, right? So maybe I'll go to a low B. For this one, we'll probably put it somewhere around there. Next up, we have Lowe's, which is a company that is multi-industrial. So they are involved with financial companies, with pipeline companies, with energy companies, all sorts of different things. And I'm just not a big fan of these types of companies because just generally speaking, they're very tough to make out. They're very tough to understand what exactly they're doing or how much potential they have for growth and all of that sort of thing. And so for that reason, I'm just going to put it like it. I'm not going to be super mean to it and put it in D, but I'll put it like a low C. I'm just not particularly interested in this type of a company anyways. Next up, we have Supermicro, which is a company that is involved with building high performance and high efficiency servers. The P ratio, not bad, but could have been a little bit better over the past 12 months at 24.11, but expected to be a lot better in the next 12 months at 9.89. That's very good numbers. Earnings expected to more than double, even like almost 2.4x. Going from 1.25 to 3.04. That's great news if we can actually hit those numbers. But again, are we going to hit those numbers with servers and all those things? There's of course a lot of involvement with the AI boom, of course, because they require a lot more server infrastructure and stuff like that to be built and be used on a regular basis. So part of this, these projections could be because of that. The PE ratio, again, given that this is a company that's riding that AI wave a little bit, it's actually not that bad, right? So a lot of the AI companies that we've taken a look at, they have a higher P ratio because a lot of people are pouring in investment, expecting earnings in the future, not in the next year or two, right? So in that sense, it seems like I'm a little bit less skeptical of these numbers being hit, even though the gap is so large. But of course, the risk here instead is the AI wave gonna continue going for the next year or two, or are we gonna have a correction or a major bubble burst or something like that? It's tough to see. It's tough to say. So for that reason, I'll be a little bit more conservative with this one. I'll probably go to like a middle to low B. I'm just not particularly interested. Again, there's other bigger AI companies that we've already taken a look at. There's other ones that I think are slightly better options. This one, I just don't know if I want to stick my neck out there and risk it on this type of company, even though it could do really well, right? So this is one of those ones that I could absolutely see it doing really well, but I just don't know if I'm interested in taking that risk. So for that reason, I'm just going to put it somewhere around here. Next up, we have Corpay, which is a company that enables different methods of payment and breaking down payments and stuff like that. P ratio, not bad, 20.98. Would have been a little bit nicer if it was below 20, but still okay. P ratio expected for the next 12 months, 12.42, a lot better. Earnings expected to grow a decent amount from 14.73 to 24.87. That is about like a 60-70% growth. Very nice. No dividends here. So I do like this company, and I do think that this is a type of company that if there is a market downturn, there's actually going to be even more demand for a service like this, because if people don't have a lot of money flowing into their bank accounts, all of a sudden they're going to probably need companies like this even more, right? So it's one of those companies that is a little bit quote unquote recession proof, or perhaps thrives a little bit in those kinds of environments as well. So it's a good hedge against some of the other companies that we're going with. So I like it. I do think we're going to push it into a low A, and again, the earnings growth is pretty decent, at least what is expected and projected here. So we'll probably go to a low A. I don't know if I'm quite comfortable enough going much higher than that with this type of a company, but I think a low A is justified. So we'll go somewhere around there. Next up, we have Darden Restaurants, which is a parent company that owns a lot of different brands, stuff like Olive Garden, a lot of famous steakhouses, etc. P ratio, decent for the past 12 months, 19.59. Expected to be 16.42 over the next 12 months. Pretty good. Earnings expected to grow a decent amount from 9.54 to 11.38 projected for the next 12 months. That's pretty good. That's about a 20% increase, which is pretty decent. Dividend is also pretty good, 3.1%, not bad at all. So overall, I like this. I like the stock. Again, probably a low A. I don't think we can push it much higher than that, and probably on the lower side of A. And with this type of company, you don't necessarily expect a lot of growth, but you have those regular dividends coming in, so that should suffice. So I'll put it at the very bottom of A, and I think we can move on. Next up, we have Insulet, which is a company that produces and sells insulin. P ratio is kind of crazy high, 83.38 over the past 12 months, even with the expected growth in earnings, expected doubling of earnings. The P ratio still for the next 12 months is expected to be 46.06, still very high. So overall, I'm just not particularly interested. It seems way too risky. It seems kind of overpriced. So I'm just going to put it in C, perhaps somewhere around there. Next up, we have PTC, which is a software company. P ratios a little bit higher than we want it to be, 20.6 over the past 12 months, 20.33 projected for the next 12 months. Earnings expected to grow a decent amount, about 30% from 6.14 to 8.64. Dividends non-existent, but good earnings growth. PE ratio kind of a killer here. So for that reason, I'll probably go to a middle to high B, not too close to the high, but also not quite in the middle either. Somewhere in between seems like the right place. So we'll just go somewhere right there. Next up, we have Coterra, another energy company. P ratio is very good, 12.09 over the past 12 months, 10.14 over the next 12 months. Amazing numbers. Earnings expected to go up from 2.17 to 2.58. That's, again, pretty decent, about a 20-somewhat% increase. Very nice. Dividend yield also pretty good, 3.36%. So overall, I like this one. A very good P ratio, decent amount of growth in earnings above 20%, and also good dividends, 3.36% above 3%. Overall, again, seems like a low A to me. So we'll just walk it up all the way up and get it to a low A, perhaps somewhere around there. Next up, we have Texas Pacific Land Corp, which is a company that is involved with a lot of different investment areas, whether it's into insurance or real estate or etc. The PE ratios are kind of high, 42.68 over the past 12 months, 35.98 for the next 12 months. So again, those are very high. Seems like it might be a little overpriced. Earnings are growing a decent amount from 6.9 to 8.19. Not a lot of dividends though, pretty negligible at 0.72%. Overall, I'm just not particularly interested because of those crazy high PE ratios. It just seems overpriced to me. So I'm going to go a high C. Not something I'm interested in, but hey, if the price of this one comes down a decent chunk, then maybe we can take another look at it. Next up, we have SBA Communications, another real estate investment trust. And this one is actually a lot better than those other real estate investment trusts that we've seen so far. A lot of them had projected earnings going down. This one, earnings are going up or projected to improve. PE ratio, not bad, but could have been a little bit better. 24.38 over the past 12 months, projected to be 22.05 over the next 12 months. Not bad, but would have been nice if it was below 20. Earnings per share, 7.94 over the past 12 months, 8.78 over the next 12 months. Expected to grow about 10%, a little bit over 10%. Not bad, but could have been better. Dividend yield, 2.29%. Again, not bad, but could have been better. Overall, it's just a company that's not bad, could have been better. So it seems like a middle B to me, pretty straightforward. We'll just take it and we'll put it in middle B. That was definitely better than a lot of the other real estate investment trusts we've taken a look at so far, but still nothing too amazing. Next up, we have Quest Diagnostics, another lab company that provides a lot of data on specific diagnosis and stuff like that. PE ratio, not bad, 20.6 over the past 12 months. Expected to be better at 16.93 over the next 12 months. Earnings expected to grow a decent chunk, about 20-25% from 8.52 to 10.37. Dividends are okay, 1.79%, but not that great. Overall, seems like maybe a little bit higher than a middle B, but not too high. So probably somewhere between a middle B and a high B makes the most sense. So we're going to bring it up and put it right there. Next up, we have International Paper, which is a company that works on sustainable packaging solutions. Now, for the past 12 months, the earnings were negative. The company was losing money, which is not great. Yes, the P ratio for the next 12 months projected to be 18.18, and that's because earnings expected to be 2.19. But again, that's a big bridge to gap. Are we going to go from losing money to actually making a decent amount of earnings to justify the price of the stock? And even then, we're just justifying the stock price, right? And again, dividend yield 4.64%. Is that really feasible to keep that going? And even the amount would be pretty big chunk of the earnings that are projected. And what happens if we miss those projections? Like even if a little bit, miss it by a little bit, still it's not going to be looking great. And if we miss them by even like 20-30%, all of a sudden we're getting less earnings still than the dividend that we're paying out. So overall, I'm just not particularly interested. Seems like a D to me. I'm going to put it over here, not too low in D, maybe a higher D, but D nonetheless. Next up, we have NVR, which is both a home building and also a mortgage company. P ratio pretty decent, but earnings expected to go down from 455 to 413. So not great. The amounts are high and also the P ratios are very good. So for that reason, I'm not going to be too harsh on it, put it in D, but it can't go above a C because again, we're expected to lose money, so that's not looking great for the brand, at least in the short term, in the next year or two. If you're investing, the outlook is not great. So for that reason, I'm just not particularly interested. Next up, we have Church & Dwight, which is a consumer goods company. PE ratio a little bit higher than we want it to be, 26.87 over the past 12 months, 22.89 over the next 12 months. Better, but even then, it would have been nice if it was below 20. Earnings expected to go up from 318 to 3.73. That is about like a 17, 18, 20% growth. Not bad, but could have been a little bit better. Dividend yield 1.38. Not bad. Again, it just seems like a lot of not bads, but it's okay, whatever. So middle B, probably the right place for this one as well. We're going to take it and we're going to put it somewhere in the middle of B. Next up, we have Tyson Foods, a food processing company. They process, beef, chicken, those types of foods, and they package it and distribute it. P ratio kind of high for this type of a company, 43.17. That's pretty high. Expect to be a lot better over the next 12 months, 13.61. But look at that. Earnings expected to go from 1.36 over the past 12 months to 4.3 over the next 12 months. Are we actually going to hit those projections? That seems like a big gap, a little risky. Again, P ratio is very high. So how much more room do we have to grow? Seems kind of overpriced right now. We have to really hit these projections. Otherwise, even if you miss by a little bit, that could be problematic. Dividend yield also pretty high, 3.4%, but are they sustainable, particularly when the P ratio is that high for the past 12 months? It just seems a little risky to me. I'm going to put in a low B. It's not bad, particularly if you hit those projections, it could be very good, but it's just, I'm not particularly interested. It seems a little more risk than I need in my life. Next up, we have Southwest Airlines, another airline company. The PE ratio is pretty high for the past 12 months, 62.89, looking to be a lot better with the projections for the next 12 months. And that's because, the earnings were quite low for the past 12 months, expected to be a lot higher. But again, that's a huge gap. Are they actually going to meet that? And this is an airline company, right? So it's not like it's a huge tech company where they were investing a lot. They didn't have a lot of earnings. They're expected to start getting the earnings coming in because, their products are finally released or something like that. No, this is an airline company, so you want to see a little bit more stability than this. So it's a bit odd that the projections are so much higher than what the earnings were for the past 12 months. I don't know if they can quite bridge that gap. Are they actually going to hit those projections? Who knows? P ratio would be a lot much better, 14.43, actually pretty decent. Dividends 1.74, not that much. So overall, I'm going to go slightly below B, maybe even low B, because over the past 12 months, the multiplier is just so huge. So we're going to grab Southwest and we're going to go on the lower side. Not super low, but perhaps somewhere around there. Next up, we have Expeditors International, which is a supply chain solutions company. Their P ratio, a little bit higher than we want to see, 24.44 over the past 12 months, 25.36 over the next 12 months. It's going in the wrong direction, and that's because the earnings are expected to be slightly less than they were for the past 12 months. And also, there's not a lot of dividends, 1.03, pretty negligible. So overall, okay P ratio, but could be a lot better, but going in the wrong direction. Earnings expected to go down a little bit. Overall, not a lot to love here. Again, seems like a low B territory, maybe even a little bit lower than the last company. So we'll just go somewhere around there. Next up, we have NI Source, another utility company. PE ratios, not bad, but could be a little bit better. If it was below 20, it would be even nicer. 22.21 over the past 12 months, projected to be 20.58 over the next 12 months. It is at least going in the right direction. Earnings expected to go up a little bit from 1.89 to 2.04. That's a little less than a 10% increase. That's about 8-9% increase, something like that. Dividends are decent, 2.66%, not bad. Not the best or the most amazing, but they're okay, they're decent. Overall, again, it just kind of looks like an okay company. P ratio is okay. Earnings going up a little bit, it's okay, but again, it's not a lot. Dividends okay, so overall seems like a middle of the road B type of company. So we're just gonna put it somewhere in the middle of B. We're gonna bring it up here and perhaps somewhere around there. Next up, we have Tyler Technologies, which is a software company, and just look at that PE ratio. That is so large, 63.79. It seems a little overpriced. Even with the higher earnings, it still comes down to 36.59. Still a little bit higher than we want to see with this type of a company. Not the worst. Again, I understand it's a tech company, but there are so many better tech companies, so many better companies in the sector, and those PE ratios are just massive. They don't really give me a lot of confidence that the stock is appropriately priced. In fact, if anything, it kind of scares me that it might be a little overpriced. Earnings expected to go from 7.18 to 12.52. That's a big jump. That's very good. It's about 70-80% increase. Very nice. Dividend yield, non-existent. So overall, I like the earnings going up. It's just those PE ratios are killer. They're way too high. So for that reason, maybe slightly ahead of middle B, but can't quite go farther up from there. We'll take it and we'll see where we can put it. Again, we'll go on to middle B and then maybe slightly higher, somewhere around there. Next up, we have the Principal Financial Group, another financial company. The PE ratios look really good with this one. 12.94 over the past 12 months, 9.46 projected for the next 12 months. Very nice, below 10. That's good to see. Earnings expected to grow very nicely as well, 6.87 to a projected 9.39. That's about a 40-somewhat% increase. Very good. Dividends are also very nice, 3.46%. So you're getting those regular payments. Even if there isn't a lot of growth, which there potentially could be because the PE ratio is so low, it indicates the price of the stock might be a little bit underpriced, potentially, and the earnings are going massively, so there's enough reason for the stock price to grow. And also the dividend payment, the actual amount, it's not a huge margin of the earnings per share, right? So it's like 3.08. That's less than half of the actual earnings per share, so that's good. It's not like they're paying all the things that they're earning to as dividends to the investors, right? That would maybe cause a little bit of a concern in terms of, okay, is there actually room for growth here? But seems like there might be actually room for growth. So I really like this one. It seems like a good combo stock. I'll put it into a low A. I don't think there's enough for me to go like middle or high A. There's not enough like upside potential for it to like massively explode. But I think it's solid and good enough that it can definitely justify a low A. So we're going to take it and we're going to put it somewhere around there. Next up, we have Trimble, which is a software and hardware company. The PE ratio right off the bat is just massive. That's way too high, 54.11. Projected to be a lot better at 23.03 over the next 12 months, but even then, it would have been nice if it was below 20. And also, the earnings are going up massively from 1.47 to 3.45. That is more than double, almost like 2.2, 2.3 times. But again, that's a huge gap. Are we actually going to hit those projections? I'm just not particularly interested. There's a lot of better tech companies, a lot of better companies in the sector, that a lot of which we've already taken a look at and we've already ranked pretty high. So I would just stick to one of those. I'm not particularly interested in this one. I'm going to go slightly lower than middle B, maybe even like closer to a low B. Not like the lowest of the low, but I'll probably put it somewhere around here. Next up, we have CDW, which is a company that provides IT services for government institutions, for educational institutions, for businesses, for a lot of different use cases. PE ratio is very nice, both below 20, 17.5 for the past 12 months, 13.23 projected for the next 12 months. So it's going in the right direction. It's a good multiplier. It's not too high. Earnings expected to grow up very nicely as well, 7.9 to 10.46. That is about like a 40-somewhat% increase. Pretty good. Dividend yield 1.8, not the highest, but it's okay. It's a little bit of a cherry on top. Really, the best part about this stock is the good multipliers and the earnings growing a decent amount as well. And also, the dividend amount is not a huge portion of the earnings per share either. So overall, it's looking good. I'm not a big fan necessarily of the company or like its products and services or anything like that. I just don't really see a lot of value with that specifically. So even though the numbers are good, I'm not as interested as some other companies that do other things that might have similar numbers. So I'm just going to ever so slightly put this one at a high B instead of a low A. But again, you could easily fit it into a low A as well. I don't really see a lot of problem with that. Next up, we have The Trade Desk, which is a digital advertising company. P ratios, again, just seem too high for this type of a company. 43.49 over the past 12 months. Even with the higher earnings, it's projected to be 34.69 over the next 12 months. Again, we want it to be below 25, maybe even ideally below 20. These are just a little bit higher than we want. It could mean that the stock is a little overpriced, which is not a great sign. Earnings expected to go up from 0.88 to 1.1. That is about like a 20% growth, something along those lines, maybe slightly higher than 20%. But again, I'm just not a fan of these PE ratios. There's not any dividends either. So overall, seems like a maybe slightly lower than a middle B. So I'll just take it to B and we'll see where we can fit it in. So we have the middle B right there. Maybe I'll put it somewhere around here. Next up, we have West Pharmaceutical Services, another pharma company. PE ratio quite high again for the past 12 months, 41.01. Even with the higher projections of earnings, it's projected to be 35.47 over the next 12 months. Going in the right direction, but still higher than we want it to be. We want it to be below 25 and even ideally below 20. So not a great sign. Earnings per share, again, going up from 6.75 to 7.81. That's about like a 13, 14, 15% increase. Not bad, but again, those PE ratios are the real issue. Dividends pretty negligible, 0.31%. So overall, not particularly interested in this one either. Again, probably slightly lower than B, slightly lower than middle B, I should say. We're going to take it. We're going to go to the middle of B, and we're going to put it perhaps somewhere around there. Next up, we have Amcor, which is a global packaging company. The PE ratios, it was okay for the past 12 months, but it's looking to get a lot better with the projections for the next year. 24.51 over the past 12 months, 9.4 over the next 12 months is the projection. So if we can hit these projections, that'll be actually really good. That means that the stock price is now starting to justify itself, perhaps even go into territory where it could grow a little bit. But as it is right now, it doesn't indicate that quite, and the earnings are expected to go massively from 0.34 to 0.89. That's almost 3x. Are we actually going to hit those projections? And look at this as well. Dividend yield 6%, but currently with the current earnings over the past year, the actual number is smaller than the dividends that are being paid for each share. So for the past year, basically the company has been paying dividends out of its own pocket on top of the earnings, right? So it just seems a little bit riskier than we want it to be. Do we actually hit those projections? If we miss even by a little bit, again, the dividend would be a massive portion of even the new earnings, right? After we go up triple or whatever. So even though the dividend is very high, even though the projections are very good and the P ratio could become a lot better, it just gives me the ick a little bit with those risky trends and risky patterns that I'm kind of seeing over here. So for that reason, I'm just going to put it at a low B. It just kind of, I don't get the right feeling with this one. I could definitely listen to an argument for why it should be higher, but personally, I'm just not a fan. I'm going to put it in a low B. Next up, we have Smurfit, which is a sustainable paper packaging company. PE ratio 27.27 over the past 12 months, projected to be a lot better at 12.67 over the next 12 months. And that's because the earnings are expected to more than double from 1.42 over the past 12 months to 3.07 over the next 12 months. Also, the dividend yield is very good, 4.44%. But again, keep in mind, the dividend that's being paid right now is higher than the actual number that is being brought in with the earnings per share. So the company is paying out of pocket for those dividends right now. So if we don't quite hit these projections, are those dividends going to stay the same? Are they going to drop? And what's going to happen to the stock price, right? So again, seems a little bit risky in that sense. Some of the numbers are good, but again, P ratio for the past 12 months, a little bit higher than we want it to be, even though with the projections, they look pretty good. Are we actually going to hit those projections? So for that reason, I'm going to go like slightly lower than middle B. Again, I'm not particularly interested with this one. There could be some potential with it, but it's just not for me. Next up, we have Centene, which is a healthcare company. And look at this. The earnings were negative over the past 12 months. So that means that the company lost money. Now, they're expected to start having earnings at 2.9 per share, but they were losing 10.8 per share over the past 12 months. Are they suddenly going to turn that around and have this much more of a positive earnings per share? And also on top of that, have such a good PE ratio? Again, it just seems a little dubious. And usually I'm just not interested in companies that are losing money over the past 12 months or whatever. So not interested. I understand that it might seem like a good entry point, but again, it's just too much risk for me. I'm just going to put it in D. Next up, we have Insight, which is a biopharmaceutical company. The PE ratios are very good, 16.59 over the past 12 months, projected to be 12.78 over the next 12 months. It's going the right directions. It's below 20, which is what we want to see. Earnings expected to grow from 5.96 over the past 12 months to 7.74 over the next 12 months. That's, again, pretty decent. That's about like 25-30% increase. Very nice. No dividend yield, but that's okay. There seems to be enough with the numbers here to suggest that there could be some decent growth with the stock. And just be careful. Again, it's a biopharmaceutical company. There's always a little bit of risk with these types of companies, but I do like the numbers. I do like the earnings growth. Am I going to put it in a low A or am I going to go high B? I think I'll go a high B. Just because of the nature of the company. I'm just going to be a little bit more cautious with this one, but it's definitely not a bad option. It's definitely an okay option. And there could be some decent returns with this one as well. So I'll just put it over here. Next up, we have Global Payments, which is another fintech company, and it's involved with making payments and making transactions. P ratio 11.13 over the past 12 months, looking to be even better than that at 5.78. That's crazy. Those are really good looking numbers, and that could indicate that maybe the price of the stock is a little underpriced, and it could potentially have a lot of room to grow. Earnings expected to almost double from 7.13 to 13.71. Not a lot of dividends, only 1.26%, but that could be a nice cherry on top, specifically because of how much potential for growth there is. Particularly the best part of the stock is that not only are the P ratios good for the past 12 months, but look at this, for the next 12 months projected 5.78. That's so low that I have a lot of confidence that this stock, if it can hit anywhere near those projections in terms of earnings and P ratios, it's almost, I don't want to say that it's guaranteed or anything like that, but it seems very likely that it'll grow a decent amount. So it could be a very good investment that pays off in the next year or two or something like that. So for that reason, I'm very interested. I'm going to take them to probably close to a middle A even. I really like this one, particularly because of how low the PE ratio for the next 12 months projected is. So I'm going to go over here and I'm going to perhaps put it just above HP. Next up, we have Zimmer Biomet, and this is a tech company, and one of the most notable things they're working on are digital implants, which could be really cool. There could be a lot of potential for products like that if they can, come out with a revolutionary product. There could be a lot of upside with this one. PE ratio 22.47 over the past 12 months. Okay, not bad, but could have been a little bit better. But to be fair, it's a tech company that's, trying to unleash new products into the world, trying to discover new emerging markets and all those sorts of things. So in that sense, a little bit of a higher P ratio is okay, actually. So even 22.47, even that, it's pretty good actually for this type of a company. 10.67 projected for the next 12 months. That's where it gets really exciting and enticing. Earnings expected to more than double already, just going from this year to last year, or from the past 12 months to the next year. 4.04 over the past 12 months, 8.51 over the next 12 months. That's a massive amount of growth. And again, that's before they even come out with any revolutionary products of the such, at least at a massive scale. Dividend yield a little bit, 1.06%. But again, this is just cherry on top. It's nothing to write home about for this type of company. Overall, I really like this company. Both in the short term, numbers look good, and also for the long term. I think there's a lot of potential with this one. Of course, there's some risk associated with it. It's not a guarantee it's going to get there. It's not a guarantee they're going to come out with a revolutionary product. But I just think there's a lot of upside with this type of a company that I'm really interested. I'm going to put it somewhere in A. Let's go over there in A and see what's going on. Probably going to be closer to the middle A. But let's investigate. Would I put it above Global? Probably not. I'll probably put it just above HP as well, but just below Global Payments, somewhere around there. Next up, we have JB Hunt, which is a transportation and logistics company. The P ratio is a little bit higher than we want to see from this type of a company, 33.96. We want that to be below 25. Ideally even below 20, so that's just way too high. Even projected for the next 12 months is still higher than the 25. It's 27.63. Earnings expected to grow a decent amount from 5.78 to 7.1, but again, those PE ratios are kind of killer. And dividend yield, pretty negligible, 0.9%, not that interesting. So overall, not really interested. Probably going to be a lower B for me. We're going to take it and we are going to put it somewhere around there. Next up, we have C.H. Robinson, another transportation company. And again, the PE ratios are a little bit higher than we want to see. 32.83 over the past 12 months, projected to be 26.75 over the next 12 months. It's just higher than the numbers that we're looking for. Earnings expected to grow from 4.93 over the past 12 months to 6.05 over the next 12 months. So that's about a 20 to 23% increase. Good amount of increase, but again, those PE ratios are just kind of killing the stock. 1.54% dividends. It's okay, but nothing to write home about again. So overall, seems like a lower B. Maybe I'll put it slightly higher than the other transportation company we just took a look at. But overall, again, not particularly excited. I'll probably put it somewhere around there. Next up, we have Snap-on, which is a high-end tool designer. The PE ratios look very good, 18.33 over the past 12 months, projected to be 17.14 over the next 12 months. Earnings expected to grow from 19.08 to 20.4. That is pretty decent. That's about like Actually, it's not that high. It's like 6-7% increase, but still okay. Dividend yield 2.53%. Again, okay. So overall, it just seems okay. Like the earnings growth is okay. The dividends are okay. The PE ratios are very good, but I don't think there's enough there with the earnings growth, particularly to justify a high B. So I'll probably go like in between the high B and the middle B. So somewhere around there. We'll see where we can fit it in. Let's go over here, and I'll probably put it like maybe just ahead of AT&T or something like that. Actually, AT&T probably needs to come down a little bit. I feel like it's a little too high. Maybe I'll put it somewhere around there. Maybe I'll actually right next to Airbnb, perhaps something like that. And then yeah, Snap-on, we can put it right there, right after Oracle and Palantir. Next up, we have Bunge, which is a company that's involved with agriculture and food production. Earnings expected to go down. That's already not a good sign. 9.31 over the past 12 months, expected to be 8.76 over the next 12 months. So it's already not a great look. P ratios were really good though, to be fair. They were under 10 over the past 12 months. Projected to be 10.24 even with the lowered earnings, and the dividends were decent too, 3.1%, right? So it could have been a good looking company if the earnings were going up, but because they're coming down, I can't quite go that high. I'll probably go like a high C with this one. I won't be too harsh on it, but again, I'm just not usually a fan of seeing earnings go down unless it's like very specific circumstances. I'm just not particularly interested in those kinds of companies. Next up, we have Qnity, and we don't have a lot of data for this one because it's a company that just separated from another company, so they've only been around in this new form for a little over like a month or two or something like that. So for that reason, I'm just going to put it in C. We don't know a lot about it. We don't have to worry about it too much right now. We'll take another look at it maybe if we do another list sometime down the line, but for now we'll just put it here and not worry about it too much. Next up, we have Genuine Parts, which is a company that's involved with the production of automotives and also industrial parts. P ratios are okay. 21.37 over the past 12 months is okay. Could have been a little bit smaller, but that's fine. It's looking to be a lot better over the next 12 months, projected to be 14.76. That's a lot better. That's a lot more like it. Earnings expected to go up from 5.8 to 8.4. That's a decent amount of increase, probably over 35% increase, which is nice. Dividend yields are decent too, 3.32%. I will caution that the dividend amount is quite close to the earnings currently, but if the earnings grow, it could be a little bit more reasonable. There could be a little bit more room to breathe, but I don't necessarily expect the amount of dividends to go up all that much. So that's one thing to keep in mind. Could they come down? If we hit these projections, probably not, but we'll see what happens. There's probably a little bit of risk with this one, but overall, I do like it. I do think the numbers are good. The P ratio is good. Earnings growth is really good. I'll just be a little bit more cautious. I'll probably go like, again, between high and middle B, but not quite higher than that. So we'll take it and we'll go into B and we'll see where we can fit it in. So many companies here. It's crazy. I'll probably put it somewhere around here, maybe right after Honeywell. Next up, we have Lennox, which is a company that produces climate control products, so like thermostats and stuff. P ratio, okay, 20.85 over the past 12 months, projected to be 20.02 over the next 12 months. They're okay, they're right over the 20, but again, it would have been nicer if it was a little bit lower, but that's still okay. Earnings expected to grow a little bit from 24.69 to 24.67. That is about like a 4 or 5% increase. Not a lot, but at least it's something. At least it's going in the positive direction. The dividend yield, again, 1.02%, not that much. So overall, it just seems like a middle road B type of company. The P ratios could have been a little bit better. The earnings could have been a little bit higher. The growth of the earnings could have been a little bit higher. Dividends, again, pretty negligible. So overall, middle of the road B sounds about right for this one. We're going to take it and we're going to go. I don't even know what middle B is anymore. There's so many companies here that are supposed to be middle B that it feels like a 60% of B is middle B at this point. But yeah, we'll just put it somewhere around there, I suppose. Yeah, that looks fine, I guess. Next up, we have Packaging Corp, which is one of the largest container and packaging companies. The P ratios okay for the past 12 months, 21.08, but looking to be even better for the next 12 months at 18.34. That's a lot better. It's below the 20 that we're looking for. Earnings expected to grow from 9.89 to 11.37. It's pretty okay. It's like a 15, 16, 17% increase. Not bad, kind of decent. Dividends, 2.4%. It's okay, but again, nothing crazy. So overall, seems kind of okay, looking to be a little bit better than okay potentially if we hit these projections. So maybe a little bit higher than middle B, but not too high, probably between the high B and the middle B, something along those lines. So we'll see where we can fit it in. We'll go perhaps somewhere right there. Next up, we have McCormick and Company, which is a food production company. The PE ratios are okay, 23.7 over the past 12 months, 21.38 projected for the next 12 months. Again, they're okay. Could have been a little bit lower. Below 20 would have been ideal. Earnings expected to grow from 2.9 to 3.2. Again, that's okay. It's about like a 11-12% increase. Not bad, but again, nothing crazy high or amazing. Dividends, 2.67. It's okay. It's not bad. Overall, it just seems like an okay company. Middle of the road B looks about right, sounds about right. So we're just going to take it and we're going to see where we can fit it in the middle of B. Yeah, lots of companies here, so we'll just put it somewhere around there. Next up, we have GoDaddy, which is a very famous domain hosting website. If you want to have your own website or something, you can buy your domain through them. They're one of the biggest ones. PE ratio, okay, again, for the past 12 months, 21.73. Would have been nice if it was below 20, but looking to be a lot better over the next 12 months, 17.6 projected. Earnings expected to grow from 5.8 to 7.16. That's a decent amount of growth. That is, what is that, about like 25% or so increase, something along those lines. So decent, not bad. No dividends here, so we're just looking for potential for growth. Again, it's okay. If the P ratio was a lot smaller for the past 12 months, then we'd be looking at a really good stock, potentially a high B. But as is right now, I'll probably go a little bit lower. Maybe I'll still be a little bit ahead of middle B because the earnings growth is good. PE ratio was okay and looking to be even better for the next 12 months. So again, I'll probably go between high B and middle B. So we'll see where we can fit it in there. We'll go and we'll put it perhaps somewhere around there. Next up, we have Fortive, which is a tech conglomerate. They're involved with a lot of different tech companies and products and all those sorts of things. So again, kind of one of those companies that's all over the place. PE ratio over the past 12 months, 31.94, a little bit higher than we want it to be. But again, it's a tech company, so maybe you can understand it. If we kind of understood what the company is a little bit nicer and easier, it just seems a little too confusing, too all over the place for me to be all that interested. PE ratio for the next 12 months is 19.62, so a lot better if we can actually hit those projections. Earnings expected to go up from 1.75 to 2.85. That's a decent amount of growth. That's almost like, what is that, 60% or something like that. That could be very good if we can actually hit those numbers. But again, with this type of company, it's very difficult to understand what's going on. And, it's just, there are so many better options out there. I just don't really see the need to get involved. The dividends, again, pretty non-existent at 0.43%. So overall, I'm just going to put it in the middle B and not worry about it too much. Again, I'm just not particularly interested in conglomerates all that much. I much prefer companies that I kind of understand exactly what they're doing and what their mission is, what they're trying to accomplish. And then I just go from there, right? But this type of conglomerate, I'll just put it in middle B. Numbers look okay, so there's nothing wrong with the numbers particularly, but I'm just not all that interested. Next up, we have DuPont, which is a chemical company, and look at this. They lost money over the past 12 months. Their earnings were negative, and even they're expected to be positive for the next 12 months. P ratio would be okay. It would be 19.2, just below the 20, but again, do we trust the company that was losing money for the past 12 months to all of a sudden be making enough money to have a good multiplier and all those sorts of things? Dividend yield 1.75%, not that high. So overall, just one of those companies that I'm not interested. It's going into D. I won't go too low in D, perhaps a higher D, but just not all that interested. Next up, we have Evergy, another energy company. They're very focused on producing clean energy, hence the name Evergreen Energy or whatever that combination is supposed to be. But P ratio over the past 12 months, okay, 20.09, just over that 20 marker, but again, still okay. It's not at least close to that. Expect to be a lot better over the next 12 months at 17.04. That's more like it. Earnings expected to grow from 3.64 to 4.3. That is about a 20% increase, so that's pretty nice. Dividend yield, very good, 3.7%. Overall, I like the company. I like what they're doing. It would have been nice if the PE ratio was a little bit lower for the past 12 months. The earnings growth is decent, almost at 20%. Would have been nice if it was over 20% as well. So for those reasons, I'll probably go like a higher B rather than a lower A. But it's a good company. I don't begrudge anyone who invests into this one either. We're going to go see where we can put it in the high B territory. I'll probably put it right next to these other energy companies, maybe just slightly ahead of them, at least ahead of some of them. Maybe I'll put it right there. And yeah, that should be pretty good. Next up, we have Gen Digital, which is a software company. Their P ratio was quite high over the past 12 months at 30.05. That's higher than we want to see, but they're expected to be a lot lower over the next 12 months because the earnings are expected to grow so much. Earnings expected to grow from 0.9 to 2.86, almost tripling or just over tripling actually. And that would mean that the P ratio would be 9.6 over the next 12 months. But again, that just seems like a big gap to reach. Unless all of a sudden they have a lot of new contracts or something like that. Again, how does a software company go like this? Again, it seems a little risky. Are we actually going to hit these projections? If we don't, what's going to happen then? Because, how's the market going to react to that and all those sorts of things? And right now, I don't know if it's appropriately priced. It might be slightly overpriced. It might just start to justify its price. And again, is it going to actually hit those kinds of P ratios? Maybe. Dividends, not that great. 1.82, not that bad. If the numbers looked better over here, then that could have been very good. But, the P ratio, if the P ratio was below 20 over the past 12 months and the earnings were higher, then I would be a lot more confident of it hitting those projections and potentially getting there. But as is right now, it just seems perhaps a little risky. It's not bad. Like, the numbers look good, but I'm going to be a little risk averse. I'll probably put it like in middle B, maybe slightly higher than a middle B, but I'm not going to go much higher than that. I'm just not all that into this particular company. Not all that much. Next up, we have Hologic, which is another medical company. P ratio kind of high over the past 12 months, 30.02. Expect to be a lot better over the next 12 months at 14.9. That's because the earnings are expected to double from 2.48 to 5. There's no dividends with this one, so we're just looking for potential for growth. And again, the P ratio currently, maybe it's a little bit higher than we want to be. It just seems like it might be a little overpriced at that ratio, and it might just start to justify the price, right, with the new earnings. So do I see a lot of potential for growth? Maybe a little bit, but not a lot for me to be convinced to put it into A or anything like that. So I'm thinking probably between a middle B and a high B, somewhere around there. So slightly ahead of middle B, but not too high. I'm not like a huge fan of this one, but it looks okay. Numbers don't look that bad. I'll probably put it somewhere around there. Next up, we have Pentair, which is a water treatment company. P ratio perhaps a little bit higher than we want to see, 26.84 over the past 12 months, projected to be much better at 19.6 over the next 12 months. Earnings expected to grow from 3.94 to 5.39. That's pretty decent. That's about 40% increase or something like that. Pretty good. Dividend yield, not all that important, not pretty negligible, 0.95%. So overall, it looks okay. It looks like there could be a lot of growth. I really like the earnings growth over here. PE ratio could have been a lot better over the past 12 months. Looking to be better over the next 12 months, but just barely under the 20. So overall, maybe slightly ahead of middle B, but not much higher than that, unfortunately. So we're just going to take this one and see where we can fit it in. We're going to go perhaps somewhere around there. Next up, we have Alliant Energy, another energy company. P ratio was okay over the past 12 months, 20.59, just slightly ahead of the 20 that we want to see. And they're expected to be a little bit better over the next 12 months, just below the 20, so at 19.1. And that's because earnings are expected to grow a little bit from 3.18 to 3.43. That's less than 10%. That's about 7-8% increase. So okay, but not amazing either. Dividends, pretty good, 3.1%. That's decent. But not particularly fan of the amount of growth in the earnings. P ratios are okay. So overall, it just looks like an okay company. Looks like a middle B, maybe just slightly ahead of middle B because the dividends are at least good. But again, I'm not too into this company either. And I think there's just better energy companies that we've taken a look at. There's better options in this sector. So we don't necessarily have to go out of our way to get this one. So I'll probably go, where should I go with this one? Perhaps somewhere around there. Yeah, something like that. Next up, we have Gartner, which is a research and advisory firm. P ratios are okay over the past 12 months, but could have been a little bit better if it was below 20. It was 22.32 over the past 12 months. Expected to be a lot better at 18.81 projected for the next 12 months. And that's because earnings are expected to grow from 11.4 to 13.54, which is pretty good. It's about 17-18% increase. That's pretty nice. Dividend yield, non-existent. So we're just looking for potential for growth. There could be a little bit. P ratio, again, it was okay, but not amazing. Earnings growth, it's okay, but not amazing. Again, it's not above 20% or something like that. So again, it just seems like a middle B, maybe slightly higher than a middle B, but not too higher. So we're gonna go middle B with this one. Probably somewhere around there. Next up, we have International Flavors and Fragrances, which is basically a food production company along with other things like production of enzymes or fragrances, those sorts of things. Their earnings for the past year was negative, so they lost money. Yes, it's projected that they will be making money, but again, it just seems risky. Going from losing money to hitting these kinds of projections where you will have such a good PE ratio. Do we actually believe those projections? Do we think we're going to actually hit them? It's anybody's guess. Dividends are okay, 2.36%, but again, nothing to mitigate this amount of risk that we see over here. So for that reason, I'm just going to put it into maybe like a middle D, something like that, and move on. Next up, we have Aptiv, which is a company that is involved with the production of components that are used for automated machinery, automated cars, those sorts of things. The PE ratio was very high over the past year or so, but again, with this type of a tech company that is so focused on producing groundbreaking products, maybe you can kind of understand that. So we won't judge them too harshly for that just yet, but let's take a look at the rest of the numbers. It's projected to be a lot better, but that's a huge gap, right? It's a huge gap. Are they actually going to hit those projections? It's anybody's guess, but it would be 9.14, which would be an amazing PE ratio. But again, it seems like it's very overpriced right now at the current earnings. What happens with these higher earnings? Do we just start to justify the stock price, or do we actually go up? And also on top of that, can we actually like 7x or whatever that is? That multiplier is crazy, right? The earnings from the past 12 months to the next 12 months, it looks like they're going to 6x, 7x, whatever that is. Are we actually going to hit that? It's anybody's guess. Dividends, 0. So overall, it's one of those that are quite risky. There could be some upside here, so I won't be too harsh. I'll put it probably in the middle B. But again, just because it's so risky, I'm just not particularly interested. But it definitely could pay off. It definitely could be one of those ones that if you get into it, it could do very well for you. Next up, we have Dow Incorporated. This actually has nothing to do with the Dow Jones Index Fund or anything like that. This is a chemical company, and as you can see, the earnings were negative over the past year, and they're still expected to be negative over the next 12 months as well. They pay a lot of dividends, 8.93%, but how much longer is that going to last with these types of negative earnings? It just seems like a risky, really risky option that I'm just not particularly interested. So for that reason, we're going to go straight to D and not waste anybody's time, and we can just move on to the next one. Next up, we have Jacobs Solutions, which is a company that provides a lot of things for businesses. If they need any tech service, if they need any engineering service, if they need consulting services, a lot of different things, they provide that for the businesses that work with them. PE ratio was quite high over the past 12 months, 55.46. That means that the earnings were quite low, as we can see over here, and that could indicate that the price of the stock was at least a little bit overpriced, at least for these types of earnings. Expected to be a lot better over the next 12 months at 16.82, and that's because the earnings are expected to more than triple from 2.42 to a projected 7.97 over the next 12 months. Now, if we actually hit those projections, then that would be pretty good, but again, that's a huge gap, and going from a 55 multiplier to 16 multiplier, are we actually going to hit those numbers? It's a bit more up in the air. And, again, if this was a tech company, maybe I could understand having such a huge PE ratio up here and then perhaps getting a lot of contracts and getting those earnings coming in. But with this type of a company that's mostly like consulting and providing services, I just don't know if I like that. It just seems, again, too risky for my liking. There's a little bit of dividends, but pretty negligible, 0.96%, nothing to write home about. So overall, I'm going to put it at a low B. Not particular fan of this one. Maybe we'll take another look at it if the numbers actually do pretty well and they do hit those projections. And if the price doesn't change all that much, maybe even comes down a little bit, then maybe we can take another look at it. But as is right now, just not really interested. Next up, we have the Essex Property Trust, another real estate investment trust. And this one, the earnings are expected to fall off a cliff, going from 13.15 to 5.93. That's less than half. PE ratio was okay over the past 12 months, but expect to more than double. Yes, there's 3.85% dividends, but there are a lot of better companies that pay those dividends without having these kind of problematic numbers. And, earnings going so much lower from one year to another, never a good sign. So yeah, I think this is just pretty clear cut. This is going to a D, and we're just not interested. Next up, we have Paramount Skydance, of course, the movie studio and all those sorts of things. The PE ratio, again, we don't have it for the past 12 months because the earnings were negative, and again, not a great sign. Expect it to be positive in the next 12 months. Also, they're right now in the process of maybe acquiring Warner Brothers Discovery. We'll see how that goes. But if they hit those numbers with the earnings, then the P ratio would be good. But again, are we going to go from negative to all of a sudden really good earnings like right away? We'll see how that goes. Also, especially now that they're potentially acquiring that other business, there's a lot that has to go through and they have to make sure everything is working together and all those sorts of things. So in the short term, there might be a lot of turmoil. There might be a lot of volatility and all those sorts of things. It just seems like an avoid to me. I don't have anything against the company specifically. It's just particularly with the negative earnings over the past 12 months and also all the things that are kind of up in the air right now with the acquisition and all those sorts of things. I'm just going to say avoid this one as well. I'm going to put it in D, and we'll worry about this one later on when things stabilize a little bit. Next up, we have Invitation Homes, which is a company that is involved with the leasing of single-family households. P ratio really high for this type of a company, 53.78 over the past 12 months, projected to be 35.68 over the next 12 months. Both of them are really high. We want them to be a lot lower than those sorts of things. Earnings expected to go up by about 40-50% or something like that. But again, it's just those P ratios are kind of killer. Seems like the stock is a little overpriced. And yes, there is dividends, 4.18%. But again, it's just with those P ratios, I'm not particularly interested. I won't be too harsh on it. I'll put it at a low B or something like that. But yeah, I'm just not particularly interested in this one either. Next up, we have Weyerhaeuser, which is in the timber business. They produce a lot of timber. They own a lot of timberlands. And look at this. The earnings are expected to almost halve going from the past 12 months to the next 12 months. Not a great sign. P ratio was already really high at 52.55. Expected to be a lot worse at 99.03. Yes, there's dividends, 3.5%, but it's just these numbers look really bad. So overall, I think we've seen enough. I think this one is going to be another D. Next up, we have TKO Group Holdings, which is a sports and entertainment company, and the P ratio is super high, 85.59 for the past 12 months. Projected to be 35.64 over the next 12 months, a lot better, but still quite high. We want these numbers to be a lot lower than this. Earnings expected to grow by more than double, 2.5 to 6. Again, that's pretty nice, but it's a huge gap as well. Are we actually going to hit those projections? Dividend yield 1.07%, pretty negligible. Overall, again, it's just the P ratios are killer. Yes, there might be some potential with the earnings going up, but even at that point, are we just justifying the current price of the stock, or are we actually going to grow the price of the stock? Even at those higher earnings, if we actually hit those numbers, the P ratio would still be quite high, right? So I'm just not interested. I'm going to put it like at a middle to low C, somewhere around there, and we're going to move on to the next one. Next up, we have Cooper Companies, which is a medical device company. P ratio quite high over the past 12 months, 44. Expect to be a lot better over the next 12 months at 16.7. Earnings expected to grow massively from 1.87 to 4.94. That's more than 2.5 times. No dividends here, so we're just looking for potential for growth. But again, the P ratio for the past 12 months seems like it was a little overpriced for the current earnings, even with the new earnings, with the higher earnings, if you actually hit those projections. Are we just justifying the price of the stock? Or are we actually going to grow the price of the stock? Again, it doesn't seem super convincing here. So I'm not particularly interested. I'll probably go like a low B with this one. I'm not going to be too mean on it, but I'm just not really going to be going out of my way to invest into this company. Next up, we have Best Buy, one of the best technology chain stores out there. P ratio 22.39 over the past 12 months. Not bad. Could have been a little bit better, but still okay. Expect to be a lot better over the next 12 months at 10.06. Earnings expected to more than double, which is good to see. Almost 2.2x, 3.03 to 6.74. A lot of dividends with this one to 5.6%. Now that's really good to see, particularly when the P ratios are so good. The one thing I will caution is that the amount of dividends is higher than the current earnings per share. Now, if you actually hit these projections, then that will be a lot more feasible. But if we miss these projections, then I don't know what's going to happen with those dividends. Are we going to keep getting them, or what's going to happen? Or is the price of the stock going to tank? But the one good thing about it is that it doesn't seem super overpriced right now. It seems like it's probably appropriately priced, at least somewhat. with those multipliers. Yes, it would have been nice if it was just under 20, but even that, it's kind of okay. So overall, I like it enough to push it to a high B, but I think there's enough things to be concerned about a little here that I don't think I'm going to push it quite to a low A. So I'll go for a high B for Best Buy, which starts with 2 Bs. I think that's very appropriate. We're going to put it over here. Let's see where we can fit it in. Probably put it just ahead of some of those energy companies. Maybe like right there. Yeah. And then we'll just leave it there. Next up, we have Albemarle, which is a specialty chemicals company. Earnings were negative over the past 12 months. Again, never a good sign. Even with the projected earnings for the next year, which are projected to be positive, P ratio would still be absolutely horrendous at 97.93. And it's not even like you get a lot of dividends or anything like that. You get 1.14%. So I think it's a very easy D with this one. We're going to take it and we're going to dump it somewhere around there. Next up, we have Mid-America Apartment Communities, another real estate investment trust. And again, the earnings are looking to go down from the past 12 months of 4.72 to next 12 months projected 3.47. And as such, again, the P ratio going in the wrong direction, 29.55. And for the next 12 months, expected to be 40.2. Yes, there's 4.35% dividends, but overall, it's not looking great. And even the dividend amount, look at this, 6.06, whereas the earnings right now per share are 4.72 and projected for the next 12 months are 3.47. So you're getting paid a lot more dividends than what the company is actually making per share from their earnings. So it's just not looking good. It's another D. We're going to take it and we're going to put it somewhere around there. Next up, we have F5, another tech company involved with cloud computing and security and those sorts of things. PE ratio over the past 12 months, 21.98. Not bad, but could have been a little bit lower. Would have been really nice. But yeah, for the next 12 months, projected to be a lot better at 15.97. Earnings per share expected to grow from 11.8 to 16.24. That's about like a 30-somewhat% increase, 35% or so increase. It's pretty nice. No dividends here, so we're just looking for potential for growth. But yeah, at these P ratios, I'm actually okay with that. Earnings are growing a very decent amount. And yes, it's involved in the tech sector and those sorts of things. So again, we need a little bit of caution there, but I like the numbers. I like the PE ratio. I like the earnings growth. I'm just thinking, should I put it into a low A or do we go high B? I'll probably just barely go a high B. If the PE ratio for the past 12 months was a little bit lower, I probably would have gone a low A. But as is, we'll go a high B, but still a good option. Nothing wrong with it necessarily all that much. And definitely could do very well. So we're going to take it and we're going to put it somewhere around there. Next up, we have Textron, another conglomerate involved with a lot of different industries, a lot of different sectors. And again, I'm just not a big fan of these types of companies because it's very difficult to like narrow down exactly what they're doing and what their projections could look like, what their potential is and all those sorts of things. But the numbers look pretty good. Their P ratio of the past 12 months, 19.43, pretty good. Expected to be even better over the next 12 months, 12.9. Earnings expected to grow from 4.55 to 6.85 over the next 12 months, which is about a 50% increase. Pretty nice. Dividends pretty negligible, 0.09%. That might as well be 0%. I don't even know why that is there. But overall, the numbers are good enough for it to come up quite high. But again, just because I'm not a fan of these conglomerates, I'm not going to go more than a high B. If this was just a normal company that we could just narrow down exactly what they're doing, I probably would have gone a little bit higher, maybe a low A or something like that. But I'll go a high B with Textron. I'm just not particularly interested in conglomerates. I know maybe I'm the only one. Maybe other people like them. That's totally fine. If you do, that's totally fine. Feel free to look into this type of company more than I do, but I'm just not really all that interested. I'll probably put it somewhere around there. Next up, we have Deckers Outdoor, which is a footwear and clothing company. PE ratio pretty good, 15.58 over the past 12 months. Projected to be 15.3 over the next 12 months. It is going the right direction, even if it's a little bit. Earnings expect to grow a little tiny bit, about like 1 or 2% from 6.74 over the past 12 months to 6.87 over the next 12 months. No dividends, so we're just looking for potential for growth. And, with the earnings growing only like 1 or 2%, doesn't seem like there's a lot of potential for growth. What I will say is that the P ratios are good, so it doesn't seem overpriced or anything like that, but it could very easily stagnate. So for that reason, I'm probably just going to put it in a middle B. Not going to be too mean on it, but again, I just don't see a lot of potential for growth with this one. So I don't think we can quite go much higher than just the middle of the road B. Next up, we have Fox, which is, of course, the parent company for the media company, Fox News and those sorts of things. There's two different classes of shares with this one. There's Class A and Class B. So we're going to just take a look at one of them. Basically very similar in terms of numbers. PE ratios are pretty good, 16.59 over the past 12 months, projected to be 14.58 over the next 12 months. Earnings expected to grow from 4.44 to 5.06. That is about a 15-16% increase, which is not bad. Dividend yield pretty non-existent, 0.75%. So we're just looking for potential for growth. What I like is that the stock doesn't seem overpriced. It seems like appropriately priced. There is a decent amount of earnings growth. Not a lot. It's not like more than 20% or something like that. It's okay though. There could be a little potential here. So I'll perhaps go slightly higher than middle B, maybe in between high B and middle B. But I don't think there's enough there for this stock to be much higher than that. I'll probably go like somewhere around there. Next up, we have Erie Indemnity, which is a property and casualty insurance company. P ratio, okay, not bad. 23.41 over the past 12 months, 20.55 projected for the next 12 months. Would have been nice if these numbers were a little bit lower, ideally below 20. Earnings expected to grow from 12.3 to 14.01. That's about like a 16-17% increase, not bad. Dividend yield 1.9%. Not a lot, but it's okay. It's a little bit of a cherry on top. Overall, I just think the stock is okay. Again, the P ratios are okay. The earnings growth is okay. Dividend is okay. Nothing stands out really all that much. So probably just a middle B would be appropriate for this one. So we're just going to take it and put it somewhere in there. Probably somewhere around there. Next up, we have Domino's, of course, the famous pizza chain. P ratio, okay, 24.66, projected to be 21.56 over the next 12 months. Again, would have been nice if it was a little bit lower. Ideally, below 20 would have been a lot better. Earnings expected to grow from 17.11 to 19.57. That's, again, about a 15-16% increase. Not bad, but not amazing either. Dividends, 1.65, again, okay. So, again, everything about the stock kind of looks okay. So, probably middle of the road B, middle B seems most appropriate. So, we're just going to take this one and also go somewhere in middle B as well. Perhaps somewhere like there. Next up, we have Universal Health Services, another healthcare company. P ratio, very good, 10.52 over the past 12 months, projected to be 9.41 over the next 12 months. Earnings expected to grow a little bit, about 10% or so, from 21.04 to 23.52 over the next 12 months. Dividends pretty negligible, about 0.36%, nothing to write home about. We can just pretend like that's not even there. What I really like about this stock is the very good P ratios. It seems like the stock is not overpriced, maybe even a little underpriced. And also the earnings are growing a decent amount. I would have liked to see a little bit more growth in the earnings. 10% isn't all that huge, but the P ratios are so good that, you know what, I think overall I'm just going to put it at a high B. Could have made it just into low A, but I think I'll just go high B with this one. Maybe if the earnings growth was a little bit higher, it would have gone into a low A, or if there was at least some dividends or something. Next up, we have Brown-Forman, which is a company that is involved with the spirit and wine business. Their P ratios are pretty good, 15.37 over the past 12 months, 15.1 projected over the next 12 months, but the earnings are not growing all that much. It seems pretty stagnant, going from 1.71 to 1.74. That's about like a 1 or 2% increase, nothing that significant. Dividend yield is pretty good, 3.45%, but again, we don't see a lot of growth in the earnings, so maybe I'll go like a middle B or something like that, but I can't go much higher than that. I just would have liked to see a little bit of growth somewhere. But then again, the dividends are good enough that even if it stagnates, it should be okay. So maybe I'll go a little bit higher than middle B, but not too high. Perhaps like somewhere like there. And we'll just leave it be. Next up, we have Solventum, another healthcare company. P ratio is looking really good, 9.23 over the past 12 months, projected to be 12.6 over the next 12 months. And it's going in the wrong direction because the earnings are expected to fall, unfortunately, from 8.69 to 6.36. So I'm already not particularly interested. Just because those P ratios are so low, I'll maybe go to a low C instead of a D. But again, it's just not particularly interested in this one. I'll put it over here. Next up, we have LyondellBasell, another chemical company. And look at this. The earnings were negative over the past 12 months. Never a good sign. Yes, they're projected to be positive and to have a really good P ratio, but do we trust that they're going to hit these numbers? And right now, they're offering 12.48% dividends, which is like so high, so much higher even than the projected earnings, right? Like the projected earnings are 3.4. Whereas the dividend is being given right now, I shouldn't even say projected, they're being given 5.45. Where's all this money coming from, right? So it's just, I don't know. It seems like one of those situations where the bottom could fall off any moment. It might end up being a good investment, but it just seems way too risky for me to get involved. So this one is going straight to D. I'm just not interested. I'll go pretty low with this one actually, because those numbers kind of look a little out there. Next up, we have Kimco Realty, another real estate investment trust. And again, earnings expected to fall. We've seen this with a lot of these REITs. P ratios are okay. They're not the worst, 24.42, 28.01. Dividends are pretty high, almost 5%. But you know, the amount of dividends, again, higher than both the earnings currently per share and also the projected ones, right? So again, it looks kind of risky, and also earnings going down. The dividend being paid higher than the earnings per share. It seems like a D. I won't go as low as the other one, but yeah, it just seems like a D to me. Next up, we have Allegion, which is a company that produces security products for homes and businesses alike. PE ratios are okay, 21.81 over the past 12 months. Projected to be a little bit better, 18.1 over the next 12 months. Earnings expected to grow from 7.4 to 8.9. That's a decent amount of growth, like close to 20% or so. Dividends, 1.27%, pretty negligible, nothing to write home about. Overall, it just looks like okay, maybe slightly better than okay. P ratio, okay, looking to be better. Earnings around 20% growth, so that's pretty good, pretty okay. Dividends, nothing crazy. So perhaps somewhere in between high B and middle B is probably right for this one. So we'll just take it and we'll see where we can fit it in. We'll go perhaps somewhere around there. Next up, we have Zebra Technologies, which is involved with transportation technology and solutions. P ratio okay for the past 12 months, 24.88. Expected to be a lot better over the next 12 months at 13.91. And that's because the earnings are expected to grow massively from 9.92 to 17.74. That's about like a 77-78% increase. If we can actually hit those numbers, that would be really nice. But can we hit those numbers? Maybe, perhaps, if they have a lot of new products, a lot of new contracts, those sorts of things. So this one could be an okay pick. The PE ratio, if it was a little bit lower over the past 12 months, probably would have made it to A. But as is right now, again, probably between a high B and a middle B is probably most appropriate for this stock. So we'll just go over here, perhaps a little bit higher than the last company. We'll just put it somewhere around there. Next up, we have Avery Dennison, which is a company that produces pressure-sensitive adhesive material. PE ratio 20.8 over the past 12 months. It's okay. Would have been nice if it was a little lower. Looking to be a lot better over the next 12 months at 17.5. Earnings expected to grow from 8.8 to 10.47. It's pretty decent, about like a 20-somewhat% growth. Dividend yield is 2.02%. Not bad, but not amazing either. Overall, probably like slightly better than a middle B. Maybe slightly better than a middle of the road type of stock, but I don't think it's going to go too high in B either. Again, probably somewhere in between high B and middle B is most appropriate. So we'll just take this one and go somewhere around there. Next up, we have Hormel Foods, which is a food processing company. P ratio could have been nice if it was a little bit lower over the past 12 months, 27.6. Projected to be a lot better at 15.25 over the next 12 months, and that's because the earnings are expected to grow massively from 0.87 to 1.57. That is about like an 80-somewhat% growth, something along those lines. Dividend yield, very good, 4.84%. But again, the dividends being paid right now, the amount is actually higher than the earnings per share currently or over the past 12 months. If we actually hit these projections for the earnings for the next 12 months, then that could be maybe justified. But if we even miss those a little bit, what is that going to mean about in terms of the dividends being paid? What is that going to mean in terms of the stock price and all those things? So again, it seems a little risky. Not particularly interested in this one. Perhaps just slightly below a middle B. I don't think it's like bad enough to be like a low B or something like that, but that's not, I wouldn't put it even middle B, to be honest. I'll probably put it somewhere around there. Next up, we have Jack Henry & Associates, another fintech company, another payment processing company. PE ratio, a little bit higher than we want it to be. For the past 12 months, 27.72. For the next 12 months, projected 26.11. The earnings are expected to go up a little bit, but not much, 6.58 to 6.99 over the next 12 months projected. So that is, again, less than 10%. That's what, 6-7% increase. Not all that much. Dividends, pretty negligible, 1.27%, not a lot. Overall, it just seems like a okay type of a stock, kind of a halfway, middle of the way B type of stock. So that's what we're going to do. We're going to put it in the middle of B somewhere, and we're going to move on to the next one. Next up, we have Nordson, which is a company that produces specialized equipment. P ratio a little bit higher than we want to see, 28.21. Would have been nice if it was below 25, even below 20 would be ideal. P ratio for the next 12 months projected to be quite a bit better, below the 20 that we're looking for, so 19.8. Earnings expected to go up about, or at least close to 50%, so something like 40-something percent, 8.52 to 12.14 projected for the next 12 months. Dividend yield is 1.66%. Yeah, it's a little bit, but it's not a lot. It's not enough to convince us. If the PE ratio for the past 12 months was like a decent amount better, then we could be looking at a very good option here. As is, I'll probably put it like between a high B and a middle B. I don't think it's even quite enough to push it into a high B. Maybe if the dividends was a little bit higher or the P ratios were a little bit smaller, we could have looked at that because the best part about this is the earnings growth. That's pretty good, 47%. But all the other elements, I just think there's perhaps some better options out there. So I'll just go somewhere between a high B and a middle B for this one. So we're going to go over here and we're going to drop it somewhere there. Next up, we have Everest Group, which is a management consulting company. PE ratio quite high over the past 12 months, 25.3, but expected to be a lot better over the next 12 months. And that's because the earnings are expected to grow massively. Now, again, these projections seem a little ambitious. Are we actually going to hit these numbers? It's expected to basically quadruple from 13.48 to 55.47. That's a massive growth for a consulting company, really. Seems kind of odd. We'll see if it can hit those numbers. 2.34% dividend yield. And again, if we don't quite hit those earnings projections, are we gonna, start justifying the price of the stock, or are we gonna see a lot of growth? It seems a bit odd. If the P ratio for the past 12 months was a little bit lower, maybe we could be a little bit more excited about the stock. As is, I'm just a bit skeptical. These numbers just look a little odd to me. I'm not entirely sure what's going on. Perhaps if you're more well versed with what exactly has been going on with this particular company, maybe they had a bad year last year or something like that. Maybe they have a lot of new contracts or something like that. There's not anything in particular that I've heard that is leading to these kinds of projections. I'm sure there's probably some explanation for it though, but just going based on what I can see in front of me right here, I'm not particularly interested, but I might take another look at this later on just to see if I can dig a little bit deeper, see exactly what's going on. And of course, if any of you guys know what the reasoning for this is, feel free to share in the comments down below as well. But as is right now, I'm going to be a bit more cautious. I'm going to go probably maybe slightly ahead of middle B. I won't quite push it further up. This is the type of numbers and type of growth that could even warrant going to A, if we can maybe understand it a little bit better. But again, if I don't really understand what's going on with the particular company, I tend to be a little bit more cautious. So for that reason, I'm going to put it in a middle B for me. But again, this is one that I want to look into more and see if I can dig a little bit deeper to see what's going on with this company. Next up, we have IDEX, which is an industrial company. They produce a lot of industrial equipment and solutions. PE ratio a little bit higher than we want to see, 28.34. Would have been nicer if it was below 25. Even better if it was below 20. PE ratio for the next 12 months is better, 21.55, but still could be a little bit better. Earnings for the past 12 months per share was 6.33. For the next 12 months, projected to be 8.32. That's pretty decent. It's about like a 30-somewhat% growth. That could be promising. A dividend yield 1.57, not all that great. It's pretty redundant. Nothing to write home about. Overall, it looks okay. I like the earnings growth, but again, the PE ratios are okay. Dividend yield is okay. So maybe I'll put it slightly ahead of middle B, but not much higher than that. I'm not a big fan of this one in particular, but it's okay. It's not that bad. It's one that I won't begrudge anyone looking at, but doesn't exactly get me to go out of my way to invest. Next up, we have Wynn Resorts. Of course, they manage the incredible Wynn properties. If you've been to any of the Wynn hotels, I've been to the Vegas one multiple times. It's fabulous. It's some of the best hotels you'll see anywhere. Just the luxury and the design and all of those things, absolutely on point. They do very well. I know the hotels are very popular. PE ratio for the past 12 months, 26.54, maybe a little bit higher than we want to see. Would have been nice if it was below 25, even better if it was below 20. PE ratio for the next 12 months projected to be 20.63, a lot better, but even then, maybe could have been a little bit better. Earnings expected to grow from 4.53 per share for the past 12 months to 5.83 over the next 12 months. So that's pretty decent. That's a little bit over 20% growth. Pretty good. Dividend yield pretty negligible, 0.83%. We don't really care about that. So I like the earnings growth. PE ratio is okay. It's good. Could have been maybe a little bit better. I like the company itself and their properties and their products and services. But again, the numbers, I don't think they're enough to push into like a low A or something like that. But again, because I like the company itself so much, I think I can justify a high B. Maybe just the numbers would have been a little bit lower, maybe like somewhere between a high and a middle B, but I'll push it a little bit higher just because of how much I like the company themselves to a very high B. But I don't think I can quite justify a low A based on those numbers. So I'll just put it somewhere around, I'll put it at top of B. Why not? It's my list. I can do whatever I want. I'll just put this one over here. And yeah, we'll do it like that. Next up, we have Viatris, a pharmaceutical company, and earnings were negative over the past year. I think that's enough to see what's going on. And again, the earnings projected for the next year, look at that PE ratio, 5.09. Really? We're going from losing this much money to making enough to have that kind of a multiplier? Seems perhaps a little dubious. Of course, there's a little bit of dividend yield, 3.83%, but again, losing money. Perhaps I won't go into D because at least the dividends are good, but yeah, not particularly interested. Seems like more risk than I'm interested in partaking in. So I'll probably put it somewhere in the like a middle C, something like that. Next up, we have Masco, which is a company that produces home improvement and construction products. PE ratio 16.45 over the past 12 months, pretty good. Projected to be 15.28 over the next 12 months, pretty good as well. Earnings expected to grow from 3.9 to 4.2. That's about like a 7-8% increase. Not bad, but not amazing either. Dividend yield 1.93. It's okay, but again, nothing amazing to write home about. I really like the PE ratio. It does seem like the stock isn't like super overpriced, might even be slightly underpriced, but the earnings growth is not enough to justify like a really good rating, and the dividend neither. So probably like a between a high to a middle B is probably the best place for this one as well. So we're gonna take it and we're gonna go up here. Where can we fit this one in? Perhaps somewhere like that. Next up, we have Ball Corporation, which is an aluminum production company. PE ratio pretty good over the past 12 months, 19.92. Expected to be even better at 13.36 over the next 12 months. Earnings per share expected to grow from 2.67 to 3.99. That's very good amount of increments. That's about 50%. Very nice. Dividend yield, not a lot, 1.5%, but could be a cherry on top because all the other numbers look good. Overall, I like this one. And of course, with aluminum and all those things, there's a lot of onshoring going on. So there's some potential. Some of that might have already affected the price though, so I don't know how much more it's going to push up the price just because of that, but it's just looking pretty interesting, particularly with these numbers. PE ratios, I like the PE ratio, specifically the projected one. I think that's a very healthy number, and the earnings growth 50%, that's nothing to scoff at. Do I push it into a low A? I think so. I don't think we have like an aluminum or steel company or anything like that that high, or at least not many that I can recall. So it's okay. We can round out our portfolio a little bit and bring this one a little bit higher into a low A. The numbers certainly justify it. So That's okay with me. I'll probably put it over here, and that should be pretty good. Next up, we have Regency Centers, another real estate investment trust. This one, the P ratio, again, a little bit higher than we want to see, 31.84, expected to be 28.37 over the next 12 months. Earnings are at least growing. We've seen a lot of these real estate investment trusts have dropping in their earnings projections, but this one is at least expected to grow from 2.19 to 2.45. That is a little over 10% growth, like 11-12% growth, something like that. Not bad. Dividend yield 4.12%. That's pretty good. Yeah, it's just the P ratio is a little bit high, but overall it's okay. I'll probably put it like perhaps a little bit higher than the middle B, perhaps between the high and middle B, something like that should be appropriate for this one. So we'll just walk it all the way up, and we'll put it somewhere around there. Next up, we have Clorox, which is a company that produces products such as bleach and just cleaning products in general. P ratio pretty good, 15.8 over the past 12 months, projected to be 14.9 over the next 12 months. Earnings expected to grow about like 5-6%, something like that, from 6.38 over the past 12 months to 6.77. So there's a little bit of growth, but it's not that much, unfortunately. Dividend yield is pretty good, 4.88%, almost 5%, but the amount of dividends that you're getting paid, it's a big portion of the amount of earnings per share, even for the projected one, right? So both current and projected, it's a big chunk. So that's probably not a great sign for the growth of the company itself. But as long as dividends don't fall too much, even if they fall a little bit, it should probably be fine because the P ratios are healthy and the dividend yield is good. It's just the earnings not growing that much. So I'll probably get closer to a high B, but maybe not quite the highest of the high B. But it's definitely not a bad option. It's definitely decent enough. I'll put it, let's see where we can fit it in. Perhaps somewhere around here, maybe. Yeah, maybe around there. Next up, we have Huntington Ingalls, which is a military shipbuilding company. I really like these types of companies that have like defense contracts and stuff like that. I've already talked about this earlier. P ratio looking okay, 23.63 over the past 12 months. Could have been a little bit better if it was below 20. That would have been ideal. It's looking to be a little bit better over the next 12 months at 19.63, below the 20 that we're looking for. So that's better. But again, like could have been a little bit lower. Would have been even nicer. Earnings expected to grow from 14.5 to 17.4. That's not bad at all. That's about like a 15-16% increase. Okay. Dividend yield 1.6%. Not a lot. It's okay. Could be a little cherry on top, but not a lot to convince us to invest right away or anything like that. Overall, it just seems okay. Earnings growth is okay. P ratio is okay. Dividend yield is okay. So probably like a middle of the road B. To me, maybe I'll put it slightly higher than just middle B, because again, I do like these types of companies that are involved with like defense contracts and stuff, because there's a little bit of a reliability with that sort of an arrangement. So I'll put it there, maybe just slightly higher than middle B. Next up, we have Akamai, which is a cloud computing and cybersecurity company. P ratio 25.58, perhaps a little bit higher than we want to see, but it's okay. Again, it's a tech company, so we can give it a little bit more leeway. P ratio looking a lot better over the next 12 months, projected at 11.97, and that's because the earnings are expected to grow from 3.4 to 7.29, more than doubling. So if we can hit those projections, that would be great. But again, it just seems perhaps a little bit of risk involved in there. Are we gonna more than double the earnings just like that? There's definitely potential there, and I do like this type of company. And also, of course, there's the possibility of the AI boom coming to an end and all those sorts of things as well. So overall, I don't mind this one, but I'll be a little bit more cautious. I'll probably put it like, again, slightly higher than middle B. Maybe in between high B and low and middle B, I should say, but not too high, perhaps somewhere around there. Next up, we have Franklin Resources, which is an investment management company. P ratio a little bit higher than we want to see at 26.23 over the past 12 months, but looking to be a lot better at 8.61 over the next 12 months. And that's because the earnings are expected to grow from 0.91 per share to 2.77. So that's basically tripling the earnings. Dividend yield is also pretty high, 5.4%. That's pretty good. So overall, I will caution this though. Dividend payments right now is higher than the earnings per share, but if we hit these projections, it will be a decent portion. But are we going to hit those projections. There's a little bit of risk there. It seems like a big gap. Can we actually hit those numbers? A little up in the air. If we can actually hit it though, there's a lot of upside, potential upside with this type of company. But again, it's a finance company. It's not like a tech company where they're going to come out with a new product or they have a lot of new contracts that are going to be paying them all of a sudden or something like that. So I'm a bit more skeptical with whether they can actually hit these projections. But if they do, there could be a lot of upside. But then again, the PE ratio is a little higher than we want to see over here. So are we just justifying the price of the stock, or are we going to grow a little bit? I'll probably go to a high B, but I don't think I'll quite push it to a low A. But I think there's enough there that I have to go to a high B. I can't quite put it too far low. So we'll take it and we'll see where we can fit it in. Perhaps somewhere around there. Next up, we have Host Hotels and Resorts, another real estate investment trust. And in this one, again, the earnings are going down. So again, that's just not a great look right off the bat. PE ratio, not bad for the past 12 months, 17, but expect to go higher above the 20 marker that we look for. Dividend yield, about 4.38%. Pretty good, but again, the lower earnings doesn't give me a lot of confidence. And the dividend amount, look at this, it was already a big portion of the earnings per share, but as the earnings per share come down, it's going to be an even bigger portion. So there's a possibility that dividends could be cut lower, or there could be some ramifications with the price of the stock. So it just in general, it doesn't seem like a great entry point or like a great investment right now. So for that reason, I won't be too harsh on it. I'll put it in C, but yeah, not looking great right now. Next up, we have CF Industries. They produce a lot of hydrogen and nitrogen products. P ratio pretty good, 9.27 over the past 12 months, but it's going the wrong direction, and that's because the earnings are expected to fall, unfortunately, from 8.3 to 7.26. Again, not a great look. Dividends are okay, 2.6%, but again, the lowering of earnings is not a great sign already. The P ratios are very healthy though, so it doesn't seem like it's overpriced or anything like that. So for that reason, I won't be too harsh on it. I'll probably put it like at a high C, but yeah, again, I don't like to see lowering earnings. It's just not a great look, unless it's like really rare circumstances. I just see that as a sign to avoid the stock. So for that reason, we're going to take CF Industries. We're going to put it at a high C. But yeah, not a great option at the moment. Next up, we have Invesco, which is an investment management company. PE ratio pretty good, 17.83 over the past 12 months. Looking to be even better at 10.35 over the next 12 months. And that's because the earnings are expected to grow from 1.47 to 2.54. That's a pretty decent increase. That's about 65% increase in the earnings per share. Dividend yield is pretty decent too, 3.18%. So overall, I like this one. I like this one quite a bit. P ratios are very nice. Earnings growth is very nice. Dividends are decent. So I guess I will put it in a low A as well. There's enough stability and enough potential there to justify that. So we'll push it up here, and I'll put it somewhere like that. Next up, we have Building First Source, which is a supplier of structural building products. PE ratio decent, 19.64 over the past 12 months, looking to be even better at 15.87 over the next 12 months. Earnings expected to grow from 5.25 to 6.5. That's pretty decent. That's about a 20% increase. No dividend yield, but again, there's enough potential for growth. Decent PE ratios, a little bit of different stock than some of the stuff that we've seen so far. So I like this one as well in a low A, perhaps like a very low A, but barely squeezing in there for sure. So we're going to move it up, and we're going to dump it. Where to go? We're going to put it right there at the very end of A. Next up, we have UDR, another real estate investment trust. And this one, the earnings are going up, but the issue is, look at these PE ratios, 83.94, and even projected to be 61.5 after the higher earnings. That just seems way overpriced, at least for the current earnings. It just doesn't really justify the price of the stock. The earnings expect to go from 0.44 to 0.6. Not a lot. And again, look at that. The dividend amount is so much higher than the earnings per share. It just looks like a really risky stock. I'm just not particularly interested. So this one is just going straight to D. I'm sorry. Seems way too risky. Next up, we have EPAM, which is a software engineering company. The PE ratio a little bit higher than we want to see, 31.27, but not too bad given that it's a software company. Maybe we can be a little bit more lenient. PE ratio for the next 12 months expected to be a lot better at 16.39, and that's because the earnings are expected to almost double from 6.55 to 12.5. There's no dividends, so we're just looking for potential for growth. Now, currently, the price might be a little bit overpriced, so we might just be justifying the price of the stock with the earnings increase. So is there a lot of room and potential for growth? Not a ton, but it's still okay. So I'll probably go slightly higher than middle B, but not too high. So probably between high B and middle B is where we're going to end up with this one. So we're just going to take it and we're going to walk it up the B category, and we're going to leave it somewhere around there. Next up, we have Healthpeak Properties, another real estate investment trust. And again, this one had negative earnings, barely though, so not a lot. But even with the expected positive earnings for the next 12 months, we still have a massive PE ratio. So it just, even though we have a lot of dividend payments at 7.6%, it's just, these numbers just seem like an avoid to me. So I'm going to go a high D, but D nonetheless. So right over there. Next up, we have Align Technology, which is a medical device company. PE ratio, again, a little bit higher than we want to see at 30.26. Would have been nicer if it was below 25, particularly if it was below 20, would be really ideal. Expected to be a lot better over the next 12 months, and that's because the earnings are expected to almost double from 5.16 to 10.94, giving it a new PE ratio projected of 14.27 over the next 12 months. But again, given that the PE ratio is so high, or at least a little bit higher than we want to see over the past 12 months, this earnings doubling, we might just be justifying the price of the stock, right? It might not necessarily be conducive to a lot of growth. There's no dividends, so we're just looking for growth, nothing else. So again, similar to EPAM, I think this one has to be between the middle and high B. It's not like middle of the road enough to be middle B, but it's also not good enough to quite make it to like a high B or low A or something like that. So for that reason, we're going to go and we're going to put this actually right next to EPAM. Where the hell did we put that one? Yeah, right there. We're going to put it here. Next up, we have Hasbro, a very famous entertainment company. You think of things like Monopoly or Transformers. These are the famous IPs that they own. And of course, earnings were negative over the past 12 months, which is not a good look. They're expected to be positive over the next 12 months at 5.3, and that would give it an actually decent PE ratio of 15.46. But again, do we trust that this is going to happen? We're going to bridge that gap. We're going to go from losing so much earnings per share to making so much earnings per share to justify such a PE ratio. Again, it seems a little dicey. Yes, there is 3.4% dividends, but right now, again, the earnings are negative. So those dividends are being paid out of somewhere, right? Are we actually going to hit these projections? If we do, then yeah, the dividend wouldn't be a huge portion of the earnings. But if we miss even by like a tiny bit or a little bit, then maybe it's a different story. So overall, I'm just not particularly interested. Maybe I won't go to D. Maybe I'll go slightly higher because I like the company. I like the properties that they own. And I do think there is a possibility for them to turn the ship around. I don't think like this is a company that's going to go bankrupt tomorrow or anything like that. But again, with these numbers, we can't go much higher than a low C. So we're going to put it in a low C somewhere around here. Next up, we have Revvity, which is a life sciences and diagnostics business. PE ratio quite high over the past 12 months, 48.38. Expected to be a lot better at 18.28 projected for the next 12 months. And that's because the earnings are projected to grow massively, more than 2.5x. So from 2 to 5.29. Now, again, that's a huge gap. Are we actually going to hit these projections? Are they a little bit optimistic? It's anybody's guess. And also, the stock just seems really overpriced right now at 48x, right? So are we just starting to justify the price of the stock, or are we actually going to experience a lot of growth? It's a good question. And of course, there's not a lot of dividends, so we're just looking for potential for growth. And overall, I don't think there's all that much potential. I'm going to put it at a low B. I don't like it enough to even go middle B, to be honest with you, but it's not that bad, so we can't be too harsh on it. So yeah, we'll just probably put it somewhere on here. Next up, we have Assurant, which is a risk management and business services company. PE ratio very good, 14.65 over the past 12 months. Projected to be 11.59 over the next 12 months. Both very good, very solid. Earnings expected to grow about 25% or so from 16.44 for the past 12 months to a projected 20.78 over the next 12 months. It's a good amount of growth. It's above 20%. And the dividend yield is 1.36. It's not a lot. It's a cherry on top if everything else is good. And all the other numbers are looking good. PE ratio is very solid, very good. It doesn't seem like it's overpriced massively. Earnings expected to grow a decent amount. We like to see that. It's above 20%. It's about 25 or so percent. A little bit of cherry on top as well. So I like this one. Do I like it to go low A? I think I do. And it's a little bit different than the other companies. It's not a tech company. It's not one of those. It's basically a consulting, risk management, and all those sorts of things. So I like what they offer. I think they're a little bit different than a lot of other companies that we have up there. So it's definitely one that we can add to the portfolio. I'm going to go low A with Assurant. We're going to walk it up and see where we can fit it in. If I recall, what do we have at the low A? So I'll probably just put it slightly above these ones over here, perhaps like somewhere right there. Next up, we have Stanley Black & Decker, which is a company that produces industrial tools and also household hardware as well. A P/E ratio, okay, not too bad, but could have been a little bit better at 25.7. Would have been nice if it was below 20. P/E ratio expected to be 13.11 over the next 12 months. It's a decent amount of going in the right direction, and that's because earnings are expected to almost double, going from 2.89 to 5.67. That's a very good increase. Dividends are also pretty good, 4.44%, but currently the amount of dividends being paid are actually higher than the earnings per share over the past 12 months. So unless we can actually hit these projections, there might be some cause for concern there, right? Because if we end up missing these projections, then what's going to happen to the dividends? Are we going to keep getting those, or are they going to be lowered? What's going to happen to the price of the stock? So there's a little bit of consideration to go with it. And also the P/E ratio currently is okay. It's not amazing. So I don't think it's going to go into like a low A or a high B. Would it go to middle B or low B? Probably in between middle B and low B is where I would put it. So just ever so slightly lower than middle B. Seems like the right place to go with this one. So we'll take it up here and we'll put it probably somewhere around there. Next up, we have Dayforce, which is an HR software and services company, and their earnings were negative over the past 12 months. Never a good sign. Expected to be positive at 2.74 over the next 12 months, and that would give it a P/E ratio of 25.21. Even if they hit those numbers, that's still just okay. It's not amazing. So overall, I'm just not interested in this one. I'm gonna have to go not like too far down, maybe like a high D or something like that, but I'm just not too interested at all. Next up, we have Moderna, another pharmaceutical company. I think a lot of us got to know this company very well during the 2020 fiasco, just like Pfizer and Johnson & Johnson. And this one, I mean, the numbers are looking horrendous. Look at this. Earnings per share for the past 12 months were negative at negative 0.806. And for the next 12 months, they're still expected to be negative at negative 6.76. So they were losing money. They're going to keep losing money. Never a good sign. This one's going to go right at the bottom, somewhere around there. I might actually put it at the very, very bottom because I don't think any other company had losing, both trailing and forward, losing money data. So unfortunately, has to go at the very bottom. Next up, we have BXP, another real estate investment trust. And again, earnings are negative over the past 12 months. Never a good sign. Even the expected earnings for the next 12 months that are positive are still going to give it a P ratio that's not great, 36.46. It's pretty high, actually. We want it to be below 25, ideally below 20. Dividends are pretty good at 5%. But again, how long will that persist? Because the dividend amount that is being paid per share is much higher than even the estimated earnings for the next 12 months, which are probably optimistic anyways. So overall, it just looks pretty bad. I think this one has to be a D as well. Maybe not too low in D, but somewhere in D nonetheless. Next up, we have Camden Property Trust, another real estate investment trust. And this one, the earnings are going down from the past 12 months to the next 12 months from 2.47 to 1.15. That's less than half. And the P ratios are horrendous, 44.5 over the past 12 months, projected to be almost 100 over the next 12 months, which is pretty bad. Yes, there is almost 4% dividends, 3.8, but the amount is so much higher than the earnings per share even right now before it even goes down. So overall, it's looking really bad. I'll probably go, probably like a high D with this one. Not great, but hey, at least it's not losing money, so there's that, but it's going in the wrong direction and it's not looking good. Next up, we have FactSet, which is a financial data and software company. P ratio is pretty good, 18.46 over the past 12 months, projected to be even better at 15.25 over the next 12 months, and that's because the earnings are expected to grow about like 25 or so percent from 15.72 to 19.03 over the next 12 months, which is a decent amount of increase. Dividend yield, 1.5%, kind of a cherry on top. It's not a lot. It's not enough to like write home about or anything like that. So for that reason, We're not going to rely too much on dividends. We're going to see if there is potential for growth, and there definitely is. P ratios are good, so it doesn't seem overpriced, not particularly at least. Earnings are growing a decent amount. It's more than 20% growth. It's 25% almost, or something along those lines. So overall, I like this one. I don't think I quite like it enough to push it into like a low A, but I think a high B is appropriate for this. So we're going to walk it all the way up the B category. And we're going to put it probably somewhere around here. Next up, we have Globe Life, which is a financial services company. The PE ratio is really good, 10.13 over the past 12 months, looking to be even better over the next 12 months at 9.32. Earnings expected to grow from 13.8 to 15.01. That's about close to a 10% increase, so not a lot, but at least it's going up. Dividend yield, pretty negligible at 0.75%. We're just looking for potential for growth. And the PE ratios are good enough that this is probably a good option, but there's not enough growth or anything like that to push it into a low A. Maybe not even quite the highest of the high Bs, but somewhere between high B and middle B probably makes sense. Maybe closer, a little bit closer to the high B. So we're just gonna walk it up and we're gonna drop it probably somewhere around there. Next up, we have the JM Smucker Company, another food company. And again, earnings were negative over the past 12 months, never a good sign. They're expected to be quite positive, and that will give it a really good P ratio. But again, that just seems a little far-fetched. Are we actually going to hit these numbers? It seems a little risky, right? There's a good amount of dividends, 4.46%, but look at that, 4.36. That's a big portion for a company that's losing that much money. Yes, if they hit these projections, then it's fine. But again, there's a risk involved with that. So I won't go too low with it. I won't go like a D, but I can't go quite much higher than a low C, unfortunately. Next up, we have Pinnacle West, which is a utility company. The PE ratio is pretty good, 18.2 over the past 12 months, but going the wrong direction, 18.99 over the next 12 months. And that's because the earnings are expected to drop slightly from 4.87 to 4.67. That's about like a 5% drop or so. Dividends pretty good at 4%, but again, we're concerned about this drop in earnings. The amount of dividends is also a big portion of the earnings. So if it drops even more than that, that could be a problem. So overall, it just seems like a low B to me. It's not bad enough to go into C, but we don't like to see the earnings go down and stuff like that. So I'll just go a low B with this one. Probably somewhere right there. And we'll move on to the next one. Next up, we have Skyworks, which is a semiconductor company. PE ratio, okay, 20.6, not bad. Expect to be a lot better at 12.69 over the next 12 months. Earnings expected to go massively up from 3.08 to 5. That's about 65% increase. Very nice. Dividend yield, pretty decent, 4.45%. But currently, the amount of dividends being paid is a big portion of the current earnings per share. It would be a lot more reasonable if the earnings actually go up that much, but if we miss those projections, what's going to happen? There might be a little bit of risk there. So overall, I like that the P ratio is decent, but again, it's not like amazing either. If it was like quite a bit below 20, would have been even better. Overall, I think like, again, between high and middle B is probably the best place for this one as well. So we're going to take it and we're going to go somewhere around there, perhaps maybe a little bit, maybe right there. Next up, we have AES, which is a utility and power generation company. P ratio really good, 8.73 over the past 12 months, looking to be even better at 6.2 over the next 12 months. And earnings are expected to grow a massive amount from 1.64 to 2.3. That's very good. That's again about like a 25-30% increase, something along those lines. That's about like a 35-40% increase, which is pretty good. Dividend yield is 4.91%, almost 5%. So this one's looking really good. I'm gonna have to go with a low A on this one because for a dividend company, it's looking very solid. P ratios are very good. Dividend payment is very high. So I like this one. I like this one quite a bit. We're gonna walk it up here and we're gonna go into a low A, somewhere around there. Next up, we have MGM Resorts, which is the company that owns the MGM properties and hotels. P ratio kind of crazy over the past 12 months. That's because the earnings were very small. Expected to be a lot better and have a decent P ratio of almost 15. But again, the P ratio for the past 12 months is so high that it just seems way too risky. Again, price of stock, are we just justifying it with the new earnings even if we hit them? And that's going to be a big gap anyway, so there's no guarantee we're going to hit those projections. Even if we do, again, we don't know how much that's going to affect the price of the stock. The dividend yield 0% as well. So overall, again, it just seems like a high C, not particularly a great option, at least not right now, but I don't mind the company itself too much. I like their properties, but it doesn't seem like a great stock right now. Next up, we have News Corp, which is a mass media and publication company. There's two classes of this stock on the S&P 500, and we're gonna just take a look at Class A. They're not that different from each other, so pretty interchangeable. PE ratio for the past 12 months, 32.62, looking to be a lot better over the next 12 months at 21.67. 32.62 is a little bit higher than we want to see. Seems a bit overpriced. Earnings were okay, but looking to be a little bit better, looking to go up by about 50%, which is a good amount of increment. But even at 50% higher, the P ratio is still not like amazing or anything like that. It's okay, but not incredible. Dividends pretty negligible. Overall, it just looks like a middle of the road B, maybe even slightly lower than the middle of the B. So we're just gonna put it somewhere there. We're gonna move it up, and we're gonna put it somewhere around Domino's, perhaps. Next up, we have APA, which is the parent company for Apache, which is a company that is engaged in hydrocarbon exploration and trying to produce new products with hydrocarbons. P ratio is very good, but going in the wrong direction, unfortunately. Again, the multiplier is very small. That's a good sign usually. But it's going in the wrong direction because the earnings are expected to fall from 4.16 over the past 12 months to 2.87 over the next 12 months. That's a little bit more than a 30% decrease. It's never a good sign. Dividends are okay at 3.94%, almost 4%, but again, lowering earnings, never a good sign. Probably a C for this one, maybe a middle to low C, perhaps somewhere right there. Not a great option, unfortunately, and we'll see if they can get the earnings up. Maybe it'll be a different story, but right now, somewhere around there makes more sense. Next up, we have Generac, which is a company that produces backup power generation. PE ratio is okay, 26.86, but could have been a little bit lower, would have been better. PE ratio expected to be a lot better in the next 12 months at 17.25 projected, so that will be better. Much more along the lines that we want to see with the PE ratio. Earnings expected to grow from 5.25 over the past 12 months to 8.18 over the next 12 months. That is about like a almost 60% increase. That's pretty good. No dividends, so we're just looking for potential for growth. If the PE ratios were both below 20, like considerably below 20, it could have even pushed into a low A, but probably not, because again, the PE ratio is a little bit higher than we want to see. So it's probably going to be between a middle B and a high B. So we're going to take it and we're going to push it somewhere around maybe somewhere around here. Next up, we have Baxter International, which produces products that treat chronic or acute medical conditions. For the past 12 months, the earnings were negative, which is never a good sign. The company was losing money. For the next 12 months, earnings are going to be a lot better, but that's, again, are we actually going to hit these projections? There's definitely some risk involved there when you're losing money and then all of a sudden you're making money. Are we actually projecting this well? P ratio would be very, very nice if we actually hit these projections. But of course, there's risk involved. The company was losing money until recently. We'll got to see if they can actually turn the ship around. Dividends, 2.67%. Not that bad, but not amazing either. Overall, it just seems like a D to me. So we're just going to take it. Not like a low D or anything like that. Probably up there, but doesn't look great. Next up, we have A.O. Smith, which is in the business of water heating and water solutions. P ratio 18.45 over the past 12 months, looking to be even better at 16.56 over the next 12 months. And earnings are expected to grow from 3.7 over the past 12 months to 4.13 over the next 12 months. So that's a decent amount, just over 10% increase in earnings, which is okay, but not amazing. 2% dividend yield. Again, okay, not amazing. The best part about it is the low PE ratios, but the rest could be a little bit better. So overall, seems like a between high B and middle B. So for that reason, we're going to take it and we're going to walk it up over here. And we're going to put it perhaps somewhere right there. Next up, we have Bio-Techne, which is a life science corporation that produces specific instruments for research purposes. P ratio very high over the past 12 months, 121.9. That's almost a red flag right there. Looking to be a lot better over the next 12 months at 27, almost 27, which even then it still could have been, it would have been nice if it was a little bit lower. Earnings were pretty low for the past 12 months, expected to more than quadruple. But again, that's a huge gap. Are we actually going to hit these numbers, or are these just optimistic, hoping that we can hit a big number? Dividend yield, pretty low, 0.54%, pretty negligible. Overall, it just seems way too risky. It's a massive multiplier. Probably going to go low C with this one. So we're going to take it and we're going to put it like somewhere somewhere around there. Next up, we have Charles Rivers Laboratories, which is another life science research company. Again, earnings were negative over the past 12 months. Never a good sign. Almost a red flag right there. Expect to grow massively over the next 12 months. Again, that's a huge gap. Are we actually going to hit these numbers? I'm not super optimistic, but that would give it a decent P ratio at 18.44. No dividends to see here. Overall, it just seems too risky for me. Probably have to go either like a high D or low C, something like that. Yeah, I'll be nice. I'll go like a low C. But yeah, not looking particularly great. Next up, we have Molson, which is another beer company, very famous beverage company. Earnings were negative over the past 12 months. Never a good sign. Money was being lost by a massive margin. Expected to be a lot better, like very much so positive to the point where the P ratio is actually very good over the next 12 months. Dividend yield is pretty good at 4%, but again, I just can't ignore the fact that we're losing money here. So I won't quite go to a D because the dividends are so high, and you know, I do like the company also as well, but it's just a classic C, probably like a middle C for this one. Can't go too high with it, unfortunately. Next up, we have Paycom, which is an online payroll and HR software provider. P ratio pretty good over the past 12 months at 18.95, just below 20. Looking to be even better over the next 12 months, 15.17. Earnings expected to grow about 20% or 25% or so, from 8 to 10. It's pretty good. Dividend yield 1%, just a cherry on top. It's nothing to write home about. But again, I like that the P ratios are very, very good and reasonable. I like that the earnings growth is above 20%. It's almost 25%. So overall, it looks good. I think I'll go a low A with this one. It's a fintech company as well. So for fintech companies, the good P ratio is even better, honestly. So yeah, I'll go a low A with this one. It looks pretty promising. I do like the company. We're going to bring it up and we're going to see where we can fit it into A. I'll probably put it right next to Corp A, actually. Next up, we have Henry Schein, another healthcare provider. PE ratio okay, but not amazing over the past 12 months, 24.27. Could have been a little bit lower. Would have been nice if it was below 20. Looking to be a lot better over the next 12 months at 14.5. Earnings expected to grow from 3.17 to 5.3. That is about like a 65% or so increase. That's pretty good. No dividend yield. We're just looking for potential for growth. Overall, I do think there could be some promise here. I do wish the P ratio for the past 12 months was a little bit lower, but the earnings growth is pretty good. Overall, I think this one is going to be a high B. Probably not quite enough to push into a low A, but high B, I think, or at least somewhat high B. Maybe not the highest of the high Bs, but somewhat high B is justified. We'll see where we can put it in. Probably put it slightly ahead of those energy companies. Maybe I'll put it right ahead of Best Buy. Next up, we have the Pool Corporation, which is the largest supplier of supplies and equipment for swimming pools. The P ratio is pretty good over the past 12 months, 20.96. Would have been nice if it was below 20, but it's still okay. It's still not that bad. It's almost there. Looking to be a little bit better over the next 12 months, 19.78. But yeah, overall, could have been a little bit lower, and it would have been nice if they were both like well below 20. Earnings expected to grow a little bit, about like 5, 6, 7%, something like that, from 10.96 to 11.61. Dividend yield is 2.15%. It's okay, but it's not like amazing either. Overall, I think it's okay. It just seems like a middle of the road B, maybe just slightly ahead of middle of the road B because the P ratios are so close to being really good. So overall, maybe I'll put it between a high B and middle B, but yeah, I do think if the numbers were a little bit better, this one could have had a lot of potential to really push up into a high B or maybe even low A, but as is, we'll probably put it somewhere around there. Next up, we have Norwegian Cruise Line, another massive cruise company. P ratio pretty good, 17.35 over the past 12 months. Looking to be a lot better at 8.69 over the next 12 months. That looks really good. Below 10 is always a really good sign that, you know, the price of the stock is very well attributed, at least for the time being. Earnings expected to double from 131 to 262. That's awesome. Great to see. Dividend yield is not there. We're just looking for potential for growth. But again, with these types of numbers, there's definitely potential for growth. This has to be a low A for me. So we're going to take Norwegian Cruise Line and we're going to bring it up all the way to a low A, and we'll see where we can fit it in there. Let's see what we got. Perhaps, I'll probably put it somewhere around here. Next up, we have the Campbell's Company, very famous food production company. Their soups are very famous. PE ratio 14.33 over the past 12 months, looking to be a lot better at 10.75 over the next 12 months. Numbers looking good there. Earnings expected to grow from 1.93 to 2.58. Again, that's a decent amount of increase. That's about like 25% or so increase, which is pretty nice to see. But look at this dividend yield, 5.63%. That's awesome. That's a massive amount of dividends you're getting. Now, keep in mind the dividend amount is a big portion of the current earnings per share, but it would be a little bit more reasonable if the earnings actually go up as projected. But again, just keep in mind, if we miss those projections, then what's going to happen with the dividends? Are we going to keep getting them at the same amount, or are they going to be lowered? It's a good question, but right now it seems like you're getting in at a very good price. The price of the stock doesn't seem overpriced or anything like that. It seems a very good opportune moment to get in. So I like this one quite a bit. I'm going to put this one into a low A as well. We're going to walk it all the way up. And we'll see where we can fit it in. Maybe I'll put it slightly ahead of these ones actually, because the 5%, 5.6% dividend yield is kind of amazing. So maybe I'll go a little bit closer to like a middle A, something like that. Maybe I'll go ahead of Intuit. Maybe I'll put it right here actually. Somewhere like that. Next up, we have Federal Realty Investment Trust, another real estate investment trust. PE ratio, again, not bad, okay over the past 12 months, but going in the wrong direction because once again, the earnings are expected to fall. We've seen this with a lot of these REITs, at least right now, it seems like it's happening to a lot of them. Dividend yield, pretty good, 4.5%, but the lower earnings doesn't look good. And also the dividend amount is quite a bit higher than the earnings per share, even right now, and will be almost double what it's going to be over the next 12 months projected. So overall, it just seems way too risky. God knows how long those dividends are going to keep up being offered at those rates. P ratios not looking particularly great. It just seems like a D to me. I'm just not particularly interested like at all. So I'll put it like a middle D, something like that. Next up, we have DaVita, which is a company that provides kidney dialysis for people, who need that kind of a service. PE ratio, very good, 11.79 over the past 12 months, looking to be a lot better at 9.5 over the next 12 months. Earnings expected to grow from 9.7 over the past 12 months to 12.8, which is about a 30% increase. That's pretty good. No dividends, so we're just looking for potential for growth. But again, those PE ratios look very good. Earnings growth is pretty good. Has to be a low A, but I think barely so. I don't like this one particularly as much as some of the other low A's, but it's still pretty good. It still has to be up there. So we'll just walk it up and we'll see where we can put it in. Well, I'll probably put it somewhere around here, maybe just ahead of Darden. Next up, we have Conagra Brands, which is the parent company for a lot of consumer packaged goods companies of all kinds and all different names. Earnings were negative over the past 12 months. So right there, I'm just not particularly interested if the company is losing money already. It just seems too risky for me to come in. Yes, the earnings are projected to be a decent amount so that the PE ratio is going to be below 10 even. But again, how realistic is that? Also, the dividend yield 8% that just really seems unsustainable. And the amount is quite high. Yes, if we actually hit these projections, even then it's still a big portion of that. But I mean, right now we're losing money. So overall, I'm just not particularly. It just seems way too risky. Maybe some people can get in there, and if they actually hit these numbers with that 8% dividend, they can make a lot of money. But it just seems way too risky for me. So I'm just not particularly interested. Maybe I'll put it just in like a low C just because of that 8%, how crazy that is if that keeps up. But again, do I trust that to keep up for all that long? Not particularly. So I'm just not particularly interested. Next up, we have Lamb Weston, another food processing company. PE ratio 15.21 over the past 12 months, pretty good. 14.35 over the next 12 months, very good as well. Earnings expected to grow a little bit from 2.78 to 2.95. That is about just actually under a 10% growth, so that 8-9% growth, something like that. Dividend yield 3.5%, pretty good. Overall, I just wish there was more earnings growth here, but overall looks still pretty good. I'll put it probably between a high B and a middle B, something along those lines. So we'll take Lamb Weston and we'll go, let's see where we can put it. Perhaps somewhere around, I'll put it just after Sands. Next up, we have Molina Healthcare, another healthcare company. PE ratio pretty good, but earnings are going down, unfortunately, from 16.13 to 13.72. That's a red flag right there. No dividend yield, so we're just looking for potential for growth, and I don't particularly expect this stock to grow. Even if it does, I don't expect it to grow all that much. If your earnings are going down and P ratio is going in the wrong direction, I'm just not interested. Again, P ratio is very, very reasonable, so I'm not going to be too harsh on it, but it just seems like a low C with this one, so I'll probably put it right there. Next up, we have Match Group, which is the company that owns basically all the dating apps, whether it's Tinder, Match.com, Plenty of Fish, a lot of them, right? P ratio 14.77 over the past 12 months, expected to be even better at 11.59 over the next 12 months. Earnings expected to grow from 2.15 to 2.74. That's pretty good. That is about a 30% increase, which is nice. Dividend yield is okay as well, 2.39%. Not amazing, but definitely okay. Overall, it just looks like a good stock. P ratios were reasonable. Earnings growth is very good. Dividends are there as a cherry on top. It just looks like a low A to me. So we're going to push it all the way up to a low A and fit it in somewhere up there. So let's see what we got to work with. Let's bring it all the way. Oh, grab the wrong one. Let's grab it and bring it all the way up. And I'll probably put it somewhere around here. Next up, we have the Alexandria Real Estate Equities, another real estate investment trust. And look at this. Earnings were negative over the past 12 months, still expected to be negative over the next 12 months. Yes, you have a 12% dividend yield, but it just seems way too risky. If you have earnings that are negative and still expected to be negative, what's that going to do to the price of the stock? What's going to happen with the dividends? How are we even paying these dividends? 6. Dividends are 6, right? The dividend amount, whereas the earnings per share is negative 2.47. How is that even sustainable? So yeah, it just looks like an avoid. I'll probably put it at a high D, just because 12%, I mean, that's crazy high. Maybe if you get it for like a couple months and get in right away before the stock crashes, maybe you can do something with that, but it just looks way too risky to do anything like that even with. So I'm just going to put it right there. Next up, we have Mosaic, which is a chemical company. PE ratios are pretty good, but the earnings are expected to go down, unfortunately, from 3.85 over the past 12 months to 2.56 over the next 12 months. So even though the PE ratios were really good, it's still going in the wrong direction. Earnings are dropping. That's not a good sign. Dividend yield is pretty good at 3.52, but again, it just doesn't look like a particularly great option because of the earnings going down. So I'm going to go a C with this one as well. I'll probably put it maybe somewhere around here. Next up, we have Solstice Advanced Materials, which is a chemical company that has separated from Honeywell, used to be a part of that. So as such, it's a new company that's recently added just a couple months ago, and we don't have a lot of data on it yet. So I'm just going to put it right next to a lot of the other companies that are relevant on this list. I think I put like Warner Bros. Discovery and stuff somewhere around here. Where did I put those? I put them somewhere in B, I remember. So they should be... yeah, right there. So I'll just put it right next to Warner Bros. Discovery, Kellanova, and then Solstice. These three, again, they're all relevant for different reasons, but we're just going to put them right here. Next up, we have LKQ, which is a producer of replacement parts for automobiles. P ratio pretty good over the past 12 months, 11.15. Expected to be even better at 9.1 over the next 12 months. Earnings expected to grow from 2.7 to 3.3. That's pretty decent as well. That is more than a 20% increase, maybe close to 25%. Dividend yield is pretty good too, 4%. So overall, it just looks like a very good company. PE ratios are very solid. Earnings growth is pretty good. Dividend yield is pretty high as well. It just seems like a low A to me. So we're going to walk it all the way up and see where we can fit it in at a low A. So many companies we have to get through, but we'll do it. We'll do it. We'll get there eventually. And we'll put it, probably put it somewhere around here, right next to Newmont probably. And last but not least, we have Mohawk Industries, which is a flooring manufacturer. PE ratios looking pretty good, 16.3 over the past 12 months, 11 over the next 12 months. Earnings expected to grow from 6.7 to a projected of 9.95. That's pretty good. That's about a 50% increase. Dividend yields are non-existent, so we're just looking for potential for growth. But again, with the good PE ratios, PE ratio expected to be 11 over the next 12 months, and also earnings growing about 50% or so. Again, it just looks like a very good option that could potentially go up in price quite a bit and get you a decent amount of return on your investments. So for that reason, we're going to push it up to a low A with this one as well. Again, we have to get through all of these companies. And we'll just fit it in somewhere up there. Probably put it a little bit higher than LKQ, probably somewhere around there. And that'll do it. So thank you so much for watching this video. If you appreciate the number of hours that I had to spend to go over every single one of these companies one by one, do me a favor, make sure you smash the subscribe button and join the community. I'll also go through the entire list as well. Also, if you enjoyed this video, make sure to like the video as well. It helps me out a lot. So these are our S tier companies, the companies that ended up in the S tier. So we have 7 companies over there, just to go through them one more time. Meta, Amazon, Visa, Abbvie, Micron, Prudential, and American Express. A couple companies that were really close to making it to us: Mastercard, Altria, Medtronic. These 3 in specific, they were very close. Maybe I could even just push them up, but if you want a top 10, you can just imagine those, right? So you have the 7 on the top, and then the next 3. That's the top 10 stocks that I'm most interested in investing into right now. As things stand, of course, a lot of these could change in the coming days or weeks or whatever, but as of right now, as of this recording, that's the case. But just go through the list one more time. We're going to go through the whole thing. So this is the A section. We got a bunch of interesting stuff in there. Then we get to B, which is a massive section. So many companies here. I mean, good God. I tried my best to, arrange them as well so that they are somewhat in a ranking, but I'm sure that I probably didn't do the best job possible. It's 500 companies. It's very tough to make sure everything is ordered correctly, but I tried my best. Then we get to C, companies I'm not particularly interested in investing into right now, and then we get to D, the bottom of the bottom, at least as of this moment. But yeah, that'll do it for this video. Again, if you appreciate the amount of time I had to spend to make this video, also smash the like button down below for the YouTube algorithm, because that helps me a lot with the algorithm, and also a lot of people getting to see this video and discovering it and maybe learning something from it. And also, again, if you haven't done so already, make sure you're subscribed to the channel as well. I really appreciate it. Let me know down below if you want to see me do more videos like this. I really want to do the NASDAQ next, so that's the one I'm looking at. If this video gets a good enough reaction, enough people watching it, enough people commenting and talking about it and enjoying it, then I really want to do the NASDAQ next, so I'm looking into that. But yeah, there's a lot of different avenues I can take as well. If you want me to look at index funds, if you want me to look at other investment opportunities, let me know in the comments down below what would interest you the most. And with all that said, that's going to do it for this video. That's going to do it for me. Thank you so much for watching. And as always, I will see you in the next video. Cheers.